So hi guys, welcome to the marathon lectures from Srestha CA and CMA by Srestha faculties. Okay, so right now you may be watching the accounting or auditing or law, whatever the subject. Out of 8 subjects, you may be watching any subject. I don't know. This is just an introduction video from me. Now, what important thing that you need to do right now is don't directly skip to the subject. Don't directly fast forward the video. Please watch this video without any interruption. Even when you're watching the marathon, we have given below the description timestamps. If you click on a particular timestamp, you will go to that particular chapter. But what I sincerely advise you, please watch this entire marathon in the same order. Suppose we uploaded 12th hour, don't directly go to the 5th hour and start watching. Watch in the same order because there is a structure that we follow so that you get the best understanding. Getting it? And further, after this 1 or 2 minutes, getting it, there is my another video which is merged, which is already merged. Please watch that also because that is an instruction to be followed while watching the marathon, what material to be used, all that also I covered. So the initial 5-7 minutes of my content, please do not skip. Please do not skip. So you're going to get some guidance on how to watch this marathon. Then you can directly start with the subject. That's it. Getting it? So take care. Continue watching. And please do not watch at higher playback speed. Some students think watching at higher speed, 1.5 times, 2 times the speed, dangerous approach. See, your objective of listening to the marathon class is not to listen, but to learn something. Learning, you should not make it fast. If at all we can cover the video in 5 hours, we would have covered in 5 hours, no? See, suppose I uploaded 10 hours marathon. If at all we can cover it in 5 hours, we would have taken it in 5 hours, right? Why the hell we take 10 hours? Why the hell we take 20 hours? So if at all you're watching at 2 times the speed, 1.5 times speed, you are not actually learning. You're only listening to the words. You are not learning. You're not analyzing. Analysis will not transmit. Understanding, you'll not get the emotion exactly. Whatever the emotion or intensity the faculty is teaching, if at all you're watching at higher speed, higher playback speed, you will never get that intensity. You will never get that connection. You just listen and leave. See, this is the reason why students, in spite repeat many a times, they still do not recollect. They still do not understand the content. Some students say, sir, some students may be faster in learning. If at all you are very fast in learning, try to listen the song at 1.5 times speed. Take any one particular song, try to listen at a higher speed. See whether you are connecting or not to it. You are listening, no? Music is audible, song words are audible, vocals and music, everything is audible. But why you are unable to connect? Connection is required with the subject. In order to establish that connection, please listen to the subject at standard speed. Even though you may be very smart, you may be very intelligent, just try that intelligence while listening to the songs also. Listen to a song at 2 times the speed. Emotion is important. In anything, any work you do, emotional connection is required. So please watch the entire content at standard speed. And I'm telling you, if at all you want to try 1 hour, if 1 hour you watch at standard speed, another 1 hour you watch at higher speed, you check back yourself where you are learning better. I think that is the best judge, that is the best decision. Just try that and then do. Because many people in YouTube are misguiding students saying, listen at higher speed, revise more number. No, that's not. Listen at standard speed. Your revision, number of times revision will naturally reduce. That's it. So continue watching the video. Thank you. Have a nice time. Bye-bye. So, hi guys. First of all, thank you very much for, encouraging our institutes, rest of us CA and CMA to this level. Anyhow, so here is a good news for all of you. From Srestha, again in respect of November 2022 exams, we are going to upload again all updated marathon classes, revision classes. Okay, we are once again uploading the videos or revision videos for November 2022 exams. And we are doing it for all 8 subjects. So who are the faculties that first of all taking all these marathon revision classes? And myself, I will take audit and I will take some 2 or 3 important chapters of company law. And so nothing but P5, mainly I'll focus on, paper 6. And Satyaraju sir will focus on paper 1 and paper 5. So you'll be getting approximately 20 plus 20, 40 hours of marathon for accounts and advanced accounts put together. Then Subramaniam sir will be taking paper 2 part A, company law main chapters. And Harish Krishnan sir will be taking paper 7, which is EAS and SM marathon. And Vikita madam is taking paper 2B, other loss marathon. And Samba sir is going to take paper 4, income tax, separate marathon for 12 hours. GST some 10 hours, separate marathon. And Srinivas Reddy sir, paper 3, costing marathon, approximately we are going to upload for 15 hours. And coming to our another faculty, paper 8 part B, Naga sir is going to take economics marathon. And same Samba sir is going to take paper 8 part A, financial management marathon class. So from the entire Shrestha team, we are going to give you all 8 subjects revision marathon classes on YouTube. Now, first thing that you might get a doubt. So what are the things or what are the materials that you are going to use for these marathons? So before that, where you will find this marathon on the YouTube? Very simple. You just open caramharsha. Okay, there is a YouTube channel. So go to that home videos and there is a playlist. Here you will find a playlist separately for November 2022 marathons, revisions, CA, Inter. So in this playlist, you will find all 8 subjects. Now immediately you might get a doubt. Are all 8 subjects uploaded right now? No. By 10th of the September, you may be watching this video. You may be watching this video, on the date on which it was uploaded, or even maybe later. I don't know. Getting it? By 10th of September, all subjects except auditing, we will upload. Audit subject new marathon, we will upload after September 20. After September 20, audit related subject marathon will be uploaded. And you know what? The all revision classes, entire revision marathons are absolutely in English. Because we Shrestha is having 1500 plus students across 20 states in India. Not 20, I can say 26 states I think we have covered. Some 2 or 3 northeast states only we have not covered, but 26 states we are having admissions. So obviously, for us, the students across India, we can't use any particular regional language. So we have to stick to English. So entire explanation will be in English. Now, coming to a few questions which you need to understand. Okay. One. We have uploaded in May 2022 exams some video classes, marathon classes. I am telling you the same revision classes with slight modifications we are uploading. Some for few chapters we re-recorded like 1 or 2 chapters wherever there were amendments. But actually speaking, for May attempt and November attempt, the subject, the material, everything is exactly same. Because right now we are in September month 2022, right? If at all you go and check ICI website, what is the latest material available? November 2021 edition, October 2021 edition. So typically for May attempt, whatever material we are using, the same material we are going to use for November. I hope you are getting it. And now so we are using a particular material, right, for marathon, where you can download this marathon, where you can download this particular material which is used in the marathon classes. So there is an app in Shrestha for SHRE, Shrestha for CA and CMA. There is an application called Shrestha for CA and CMA. You will find right side, above me, there are 2 logos. First logo is there white color logo. That logo. If you type this name in the Play Store, you will get that logo. Getting it? Only from Android you can download the material. Suppose if you do not have an Android phone, please use somebody's Android phone and download the material. Okay, so in this application, you just download and log in. We have given in the main menu. If you go to the application, there is something called main menu. Just after opening the app, left side top, you will find main menu. Click on that, you will find study material. Inside that, November 2022 and May 2023, there are materials. Please download the materials. PDF copies, please download and keep it with you, so that it will be useful when you're watching the revision class, so that whatever faculty is actually using the material, so it is with you in hand. That's it. If at all you want to have a hard copy, you can buy that hard copy on the same application. But I don't think you require a hard copy, because it's a revision class. So whatever you already have gone through, whatever material you already learned from, please stick to that material. Take our revision classes as a additional guidance. And I'm telling you, you're going to enjoy the subject like anything from, See, generally in YouTube, you'll find many subject related marathon, but for all 8 subjects at a single place with a particular standard, uniform standard, you'll rarely find. So here, our institute's rest of a CA and CMA is giving you that option. Getting it? So I hope you understood what we are going to deliver. Now, what are the topics that we are going to cover approximately, if at all you ask me? So if you look at paper 1, accounting, we are going to upload 2 videos. Approximately both the videos put together will be 20 plus hours. So these are the chapters: fundamentals, incorporation, introduction to accounting standard frameworks, AS2 and AS12, financial statements of company, bonus, investment accounts, redemption of debentures. That's it. We are not covering anything else from accounts subject. And paper 2A, company law, if you look at, me and Subramani sir, both of us are taking in this case the classes. Like if you look at accounts of companies and dividend, audit and auditors, these 3 chapters related revision I will take. Rest of the chapters, basic, incorporation, share capital, deposits, charges, these chapters revision will be handled by Subramaniam sir. Then other laws, all these topics are being covered by Vikita madam. And paper 3 costing, all these topics, 100% of all the chapters are being covered by Srinivas Reddy sir. Okay. Then part 2, see, costing video will be uploaded in 2 parts. Both together will be 15 to 16 hours. Then paper 4A, income tax, we are going to cover 5 heads of income, clubbing provision, set up and carry forward, chapter 6A, return of income, TDS and TCS. And GST, we are going to cover almost all the chapters. Then advanced accounts, introduction, few accounting standards, amalgamation, reconstruction, liquidation, partnership, consolidation. All these topics we are going to cover as part of revision. And accounting, advanced accounting is also being uploaded in 2 parts. Accounts, you will have 2 parts videos. Advanced accounts, you will have 2 parts videos. Sorry. Company you will have 2 parts. Sorry. Costing, you'll have 2 parts videos. Then coming to auditing, ignore auditing right now because I have not yet uploaded the, marathon. Then paper 8A, financial management, these chapters. Paper 8B, these chapters. Even paper 7A, paper 7B also, we are going to upload all the subjects. I told you where you will find all these videos. You will find that in the Play Store. Open caramharsha, open playlist. Inside that you will find first playlist, November 2022 marathon. So in that playlist you will find all the 8 subjects video. By the way, you will find all these videos by 10th September maximum. Getting it? So actually I'm recording this video on 4th September. So right now after this video I'll be uploading the marathon videos. And this video will be a common video in all in all marathon videos, whatever I'm going to upload, 12 hours videos. In all the videos, this video right now whatever I'm recording will be a common video, so that every time whoever is watching a new revision class will not miss all this. Now one more important thing. Now who should not watch this marathon class? If at all you are a first time learner. Now many people will ask me, sir, is it useful for a first time learner? No. This is not for first time learners at all. This is for those who are going to write exam. Okay. Those who are just about to go and write the exam. No, for them only this is. See, a subject is completely covered in 20 hours. 100 marks paper is hardly being covered in 20-24 hours. A regular course will be 120-150 hours. Imagine we are reducing 1/5 time. It's a revision. First of all, understand. Revision is useful. Revision class will be useful only for those who already prepared the subject once. You may have prepared in self-preparation method or you may have taken coaching. That doesn't matter. That doesn't matter. But those who already prepared once, only for them this is useful. For others, strictly I'm saying not at all useful. Because don't waste your time. But I'm telling you, those who already have gone through books, who already wrote 1 or 2 attempts, getting it, or who are first timers. Maybe you are first time you're writing in November. But you already gone through the coaching. For you, these marathons are going to be a best, thing, in your preparation. Definitely, after watching this marathon, you will definitely get a new look on the subject, new idea, new perspective on the subject, so that within next 1.5 months, you can plan your preparation perfectly. That's it. Okay. Take care. Have a nice time. So continue the classes. Getting it? So this is an intro video. First, I'll upload this normally. Then again, I'll upload this as part of the revision videos. Getting it? So continue. Thank you. Have a nice time. Bye bye.
A very good morning, students. So welcome to the income tax marathon classes. In the last session, we have completed discussion regarding GST marathon classes. It will be around for 12 hours. In 12 hours, we have completed all the 10 chapters. almost 70% of the syllabus we have completed, and which includes all the latest amendments applicable for May 2022 examinations. Similarly, from now onwards, for the next 12 hours, I'm going to discuss about the income tax syllabus, income tax marathon classes. So in totally, sir, in income tax, we have 17 chapters at CA Inter level. So that 17 chapters I've divided into the two different parts. Module 1 containing 7 chapters and module 2 containing the remaining 10 chapters. Totally put together, we have 17 chapters in income tax. Okay, mom. But of course, it's a marathon class, not a regular class, not even a crash batch, right? Don't expect all the 17 chapters explanation with 100% coverage. Okay, sir, it's a marathon class. Okay, sir. And marathon come amendments class also, right? So selective basis in this session means in this 12 hours session for income tax marathon, which I have allocated for. In this 12 hour session, I'm going to discuss only the selective chapters, precisely all the 5 heads of income. I'm going to discuss income from salaries, house property, PGBP, capital gains, income from other sources, all the 5 chapters, and then set off and carry forward of losses, then chapter 6A reductions, then TDS and TCS. So primarily, I'm decided to cover 8 chapters, which are very important from your examination point of view, right, sir? See, you see here in the important chapters list, I've given total income problems as the first priority because it is a compulsory question. It's a compulsory question, right, sir? Whenever you open the taxation paper, part A consisting of income tax, in that the very first question is from the total income problems. See, total income problems is nothing but it's a consolidated problem, sir. It is a consolidated problem, right? Means it contains the provisions from the 5 heads of income, or at least it covers 3 heads of income like PGBP capital gains, house property, or PGBP capital gains salaries. Like that, it will cover minimum 3 heads of incomes provisions. And then it contains the provisions from setup and carry forward of losses. It contains the provisions from chapter 6A reductions. Are you following, sir? It's a consolidated problem. So for doing the total income problems, you must have the overall knowledge. You must have overall knowledge. So for doing the total income problems, whatever the knowledge required, I will give you in this marathon classes. So generally that question is for a minimum of 10 marks and maximum of 14 marks. If you look at the December 2021 attempt, you got a total income problem for 14 marks. 14 marks. So by listening to these income tax marathon classes, I cannot give you an assurance that you will score 14 out of 14, but I can give you assurance up to 10 marks if you follow the income tax marathon classes. So at the time of doing the total income problems, you will be having a confidence that you can score up to 10 marks out of 14. Clear, sir? Right? So that's why I'm going to cover only the very important chapters, like all the 5 heads of income, set off and carry forward of losses, chapter 6 reductions, TDS and TCS. Clear? After covering all these 8 chapters, if any time left over, then we will discuss some more chapters. Clear, everyone? So, and in all these 8 chapters also, I'm not going to cover all the 100% syllabus, only the very important provisions from that particular chapter, very important provisions, plus the latest amendments from that particular chapter. So amendments, I've already taken the statutory guidelines given by the ICI for May 2022 examinations. So these are the statutory updates, ma, and you have the updates from capital gains, chapter number 7, and then advanced tax, TCS and TDS and TCS, chapter number 9. And so majority of the amendments is from TDS and TCS only. So TDS and TCS will be discussed in detail, don't worry. And then provisions for the filing of return of income and self-assessment. So we have one more amendment from return of income. That's it. So these are the statutory guidelines given by the ICI from May 2022 examinations. All these statutory guidelines will be covered in my marathon classes. Clear, my everyone? And whatever the material I provided, volume 1 and volume 2, this material is already updated material. updated with ICI latest version of study material. Clear, ma'am? Right? Next. So look at here, sir. As I said, income tax, paper 4 taxation, right? In group 1, you have paper 4 taxation, which contains 100 marks. Paper A, part A income tax for 60 marks and part B GST for 40 marks, out of which GST portion we have already completed, right, sir? And then time for the income tax, which contains 60 marks for your examination purposes. And I have already told you that all the 17 chapters. First, let us go by what are all that 17 chapters. Let's have some brief understanding of all the 17 chapters and what it contains. Okay, first chapter, introduction to income tax, which contains all the fundamentals, whereby you are going to learn about about the taxes, direct taxes, indirect taxes, charging section, then the in-depth analysis of charging section, like person, assessee, maximum income not chargeable to tax, nothing but basic exemption limit, tax rates applicable to the different assessees, special tax rates, marginal relief, rebate. All these concepts you are going to learn from the introduction to income tax chapter. And then second chapter, residential status 1, which discussed about determination of the residential statuses of the different persons. Residential status of individual, HUF, AOP, BOI, partnership firms, companies, LLPs, local authorities, any other artificial judicial persons. And then later on, it will be discussed about the scope of total income also, like what is an Indian income, what is a foreign income, and how the Indian incomes and foreign incomes are taxable in the hands of the different categories of assessees, like resident and ordinarily resident, resident but not ordinarily resident, and non-resident. Okay, ma'am. And then chapter number 3, we are going to discuss about income from house property. So in this chapter, we are going to discuss about the taxability of income from the different types of properties, like self-occupied property, unoccupied property, let out property, deemed to be let out property, part of the property let out and part of the property self-occupied, part of the year let out and part of the year self-occupied. Like that, we will be having the different types of house properties and how that different types of house properties are going to be taxable. That we will learn from the chapter income from house property. Then capital gains. Right. In this chapter, we are going to discuss about the taxability of the different types of capital gains, long-term capital gain, short-term capital gain, special cases, section 111A, section 112A, right, sir? Slum sale, exemptions under section 54. All this we are going to be learn next. Then after that, chapter number 5, PGBP, profits and gains from business or profession. So we are going to discuss about the taxability of the income from business and profession. Right, normal businesses, speculation businesses, specified businesses, professionals, deductions from section 30 to 37. All this we are going to learn next. Then after that, income from salaries. It's going to be discussed about the salary income, how that salary income is taxable in the hands of the employee. What do you mean by the salary? Like we will see, like it's consisting of basic salary, wages, then bonus, perquisites, retirement benefits, allowances, all this. Then after that, income from other sources. It contains about the taxability of the miscellaneous incomes, means the incomes which are not covered by the above 4 heads of incomes. So this is module 1. Module 1, precisely, it contains fundamentals, residential status, and 5 heads of income. 5 heads of income. This portion is covered in module number 1. Then module number 2, the remaining chapters like clubbing provisions. What do you mean by the clubbing provisions? Clubbing provisions discussed about the clubbing of the other person's income with the total income of the assessee. Under what circumstances other person's income will be clubbed with the total income of assessee and how it is going to be taxable. Next. Then set off and carry forward of losses. In this chapter, we are going to discuss about the rules and regulations with respect to the set off of the losses and carry forwarding of the losses. Set off of the losses in the current year and carry forwarding of the losses to the future years. This we are going to be discussed from the chapter set off and carry forward of losses. Then chapter 6A deductions. It discussed about the various types of deductions, right, where an assessee can claim as deduction from his gross total income. It starts from section 80C ending with 80U. Okay, sir. Then after that, advance tax on interest. Advance tax on interest is the provisions deals with the concepts of the advance tax, to whom it is mandatory, and when a assessee becomes mandatory to pay the advance tax, how he has to discharge, right? All this we are going to discuss in this chapter, and then we are going to discuss about the interest under section 234A, 234B, and 234C, right, sir? Then after that, TDS and TCS, all the provisions of TDS and TCS we are going to discuss here. Then return of income, right? Provisions relating to the different types of returns: normal returns, belated returns, defective returns, revised returns, right, ma? So all these different types of returns we are going to discuss. What are the due dates? What is the maximum time limit up to which we can file that particular return? All this we are going to learn from the chapter return of income. And then after that, exempted incomes deals with section number 10. Right, in this chapter we are going to discuss about the different types of incomes which are exempted from tax. Okay, sir. Then after that, residential status part 2. Here we are going to discuss about the provisions relating to the incomes which are accrued or arised or received in India. And also we are going to discuss about the provisions relating to the incomes deemed to be accrued or arised in India or deemed to be received in India. Okay, ma'am. And then from chapter number 16, miscellaneous concepts in income tax, that provisions relating to the miscellaneous incomes and their tax liability. Finally, total income problems. So all this containing in the module number 2. Okay, mom. So this is the brief introduction to all the 17 chapters. Clear? And as I already told you, I'm going to start with the heads of income. First, you can see the list of important chapters I've given here. Right? So total income problems, definitely damn sure question. And then PGBP, capital gains, income from salaries or house property, definitely one question from these two heads of income. Then chapter 6A reductions and TDS and TCS. Now chapter 6A reductions, remember, you cannot expect a direct question from chapter 6A reductions, but chapter 6A reductions will be consolidated with the problems in total income and problems of the PGBP, problems of the income from salaries. It will be combined with these chapters and it will be asked, ma'am. But definitely from chapter 6A reductions, there will be certain provisions will be asked in the main exam. Clear, sir? Right? So if you prepare thoroughly these 6 chapters or 7 chapters, rather I can say, you will get a minimum of 47 marks out of 60. 47 marks out of 60. And you can see I've given the live proof also at the time of taking this class. I think this class has been taken recently only, ma. You can see here 29 January 2022. 29 January 2022. After the completion of this December 2021 exams, right? So this class has recorded on 29 Jan 2022. Means that's the day on which I have started my regular batch of income tax. Right? The very first chapter is the introduction to income tax. Okay, sir. So this is a regular batch running notes, ma. So first, initially, I've given them the list of important chapters without giving this. And then after that, I've proved it with the previous exam attempt, that is December 2021. So total income problems, as I said, it contains minimum of 10 to 14 marks. So in the December 2021 attempt, it was asked for 14 marks. PGBP, I've told you that it's a guaranteed question chapters, but it proved me wrong because in December 2021, there was no question from PGBP. But that doesn't mean that PGBP is an unimportant chapter. Right? Very rarely that situation comes like there is no problem from PGBP directly. But you do have PGBP provisions in total income problems. Yes or no? Right? This attempt, that is May 2022 attempt, you can definitely expect a question from PGBP because it was missed in December 2021. Capital gains, I said one question compulsory for 8 marks, asked in December 21 for 7 marks. Income from salaries, income from house property, I said like only one question from these two heads of income you will get, either from salaries or from house property. Only one question for 8 marks. But in the last attempt, you got a separate question from house property for 6 marks and salaries for 6 marks. So this attempt, you cannot expect same kind of situation. This May 2022 attempt, you can expect only one question, either from salaries or from house property. Because in the last attempt, it was asked 2 questions from 2 chapters. Okay, chapter 6 reductions, as I already told you that you cannot expect a direct question from this chapter, but these provisions will be consolidated with the problems of total income and PGBP and capital gains. Okay, ma'am. And TDS and TCS, yes, you will get one question compulsory for 8 marks. Yes, it was asked for 8 marks in the last attempt. So whatever the chapters I have mentioned as important chapters, that important chapters totally 41 marks you got in December 2021 out of 60 marks, 41 marks only from the 6 chapters. So if you prepare these 6 chapters thoroughly, you can expect 40 marks minimum from these 6 chapters. And out of these 40 marks, if you are able to write 30 marks perfectly with 100% confidence, 30 marks perfectly, right, sir? So income from in income tax, if you got damn sure 30 marks, if in GST out of 40, even if you're able to score 20 marks, the marks which you require to qualify that subject, you attend very easily. You have attained very easily. Are you following or not? See, taxation, many of the students feels like it is a vast subject, lengthy portion, lengthy syllabus, right? It's very difficulty to score even the qualifying marks 50. No, sir. No, sir. The qualifying marks 50 marks you can easily get if you little bit effort more, put efforts more. Exemption is very simple, sir. See, 40 marks guaranteed now. Out of 40, if you're able to score 30 to 35 minimum and GST 20 to 25 minimum out of 40, exemption guaranteed. Yes or no? Right? So like this, plan your preparation in such a way and make the preparation accordingly. Yes or no? Right? Sometimes smart works also pays off, not the hard works. Clear? This is what smart work is. Okay now? Right. So without wasting of the time, let us go for the heads of income. And as you all know that the first head of income from salaries. Yes or no? Right, ma? Totally how many heads of income we have? 5 heads of income. What are they? First one, income from salaries. Second one, income from house property. Third one, PGBP. Fourth one, capital gains. And fifth one, income from salaries. Sorry, income from other sources. 5 heads of income. Clear, ma? So first, our target is to complete this 5 heads of income. So let us start with the first head of income, that is income from salaries. Sections contain section 15 to 17. Only 3 sections. Only 3 sections from this chapter. Section 15 deals with the charging section, and section 16 deductions, and section 17 definition of salary. Right, sir? So generally in the regular classes, I'll take around some 12 hours to complete the income from salaries. Out of 12 hours, 1 hour for charging section, 1 hour for deductions. So that means 2 hours for the first 2 sections. Only for the last section, I'll take 10 hours. Only for discussing section number 17, definition of salary, I'll take 10 hours, 10 hours minimum, because it is having that much of worthiness, provisions. Section 17 deals with the definition of salary. 17.1, the basic definition salary, then perquisites, calculation of the different types of perquisites, then allowances, then the retirement benefits. Okay, now from this chapter, the main important section is section number 17. And in that also, the main important provisions are perquisites, allowances, and retirement benefits. Retirement benefits, what am? Gratuity, PF, pension, leave salary, retrenchment compensation. Are you following now? All these are comes under the retirement benefits. Clear? Right. Let us start with the first one, charging section, section number 15. Charging section, section number 15. Okay, sir. So first section, section number 15, charging section, right? Basically, we have section number 4 as charging section. We have studied this in the first chapter, introduction to income tax. Section number 4. Sir, section number 4 is a charging section for the entire income tax subject. And after that, each and every head of income has its own charging section. Right, sir? Like for income from salaries, section number 15. Section number 15 is the charging section. House property section number 22, PGBP section number 28, capital gains section number 45, and income from other sources section number 56. These are all the separate charging sections for each and every head of income. Now, what charging section deals about? Charging section deals about what are the different types of incomes taxable under that respective head of income. So for every head of income now, first of all, you have to learn the charging section, and then you have to learn method of accounting applicable to that particular head of income. Charging section deals with what are the different types of incomes taxable under that respective head of income, and method of accounting deals with on what basis that incomes are taxable under that particular head of income. What basis means accrual basis or receipt basis. So charging section deals with what are the different types of incomes taxable. Method of income deals with on what basis they are taxable. So after learning these two sections only, then you have to go forward in that particular respective head of income, because for understanding the remaining provisions of that head of income, first we should know what are the incomes taxable and on what basis they are taxable. Clear now? So then only after you got the understanding of these two sections, then only the remaining provisions are easily understandable to you. Clear now? Right. So charging section, any amount. If you look at the charging section of the income from salaries, yeah, here you can see the charging section, section number 15. It starts like any amount due to or received by an employee from employer, any amount due to or received by an employee from an employer falling within the purview of the term salary is chargeable to tax under the head salaries. So even though it starts with the wordings any amount, see, any amount is an open definition, right? Exclusive means it's not an inclusive, it's an inclusive definition which includes everything. But even though they have used the word any amount, which is an open definition, any amount can be included here, but they have restricted the purview of the term any amount by saying that that amount should be falling within the purview of the term salary. So whatever those which are covered under the definition of salary only covered here, right? So not all the amounts, only those which are falling within the definition of salary are covered here. Are you following now? Right. So any amount, even though they said any amount, but immediately they said it must be falling within the purview of the term salary. Right. Due to or received by, these wordings, due to or received by, these wordings explains about the method of accounting applicable to this chapter. Due to, any amount due to or any amount received by. Right. So what is the method of accounting applicable to this chapter? Look at here. Section 145 deals with the method of accounting. So for income from salaries, the method of accounting applicable is due or receipt basis, whichever is earlier. Due or receipt basis, whichever is earlier. So that is why in the charging section, they used the words due to or received by. Any amount due to employee, taxable. Any amount received by employee, taxable. Clear now? Look at here. Salary accrued and received, taxable in the hands of employee. Accrued and received. Salary accrued but not received, still taxable. Still taxable. Salary was due to your account but not yet received. Generally, the salary of an employee will be due or accrued on the last day of every month. On the last day of the every month. Yes or no? Right? And generally the salary will be received. Salary will be received mostly in the first week of the next month. First week of the next month. In the private sector, if you look at in the private sector, see in the government sector, generally it will be the salary was due and credited on the same day. That's the last day of the every month. See, look at our own example, sir. We are belonging to central government PSUs, right? It's a government of India undertaking. Central government undertaking. Coal India Limited. I'm an employee of the Coal India Limited, as you all know. Right? It's a central government undertaking. Even though it's a central government undertaking, our salary was due on last day of the every month and payable on or before 5th of the next month. Payable on or before 5th of the next month. So salary was due but not received. Still it is taxable because the method of accounting is due or receipt basis, whichever is earlier. If due basis is earlier, taxable. If receipt basis is earlier, taxable. Clear now. Next, salary was not accrued but received. Kind of advance salary. Advance salary. You have received the salary in advance. It was not due to you, but you have received. Still it is taxable. Okay now. Next, salary was not accrued, not received. So neither accrued nor received. So not taxable. Why it is taxable? Either it must be accrued or it must be received. If it is neither accrued nor received, then it is not at all taxable. Then it is not at all taxable. Are you following, ma? Right. So any amount due to or received by an employee from an employer. So these wordings, by an employee from an employer, this wording explains about the relationship between the payer and payee. So the relationship between the payer and payee must be employer and employee relationship. You can see here. Yeah. Relationship between payer and payee. So payer must be the employer, the person who is paying the amount, and payee must be the employee. Clear? So as long as the relationship of employer and employee existing in the payer and payee, in between payer and payee, then whatever the amounts received by the payee, taxable under the head income from salaries. Otherwise, income from other sources. Like I've given you an example here. Remuneration received by the director from the company. Directors are not the employees of company. For your kind information, directors are not the employees of company. So hence, there is no employer and employee relationship between director and company. So taxable under the head income from other sources. Director's remuneration, director's sitting fees. Clear? See, if he is a managing director, MD, then he is an employee of the company. So whatever the salary received by the managing director, taxable under the head income from salaries. He is not a managing director, he is just a director, an independent director. So then he is not an employee of the company. So income from other sources comes into picture. Are you following or not? Right, sir. So that is also provided here. Remuneration received by managing director from the company, taxable under that income from salaries. Salary received by MPs and MLAs, income from other sources, because MPs and MLAs, not the employees of the government, they are public servants. They are public servants who are making the public as servant. No, they should be the public servant, right, sir? So since MPs and MLAs are not the employees of the government, their salary taxable under that income from other sources. Commission received by the LIC agents from LIC, other sources. Salary received by partners of the partnership firm, PGBP. Because partnership firm and partners, in between these two, employer and employee relationship existing? No. Partners are the owners of this partnership firm, not the employees. So whatever the salary received by the partners from the partnership firm, taxable under the head PGBP. Okay, ma. Pension received by the retired employees, always taxable under that income from salaries, because the employer and employee relationship also past relationship, can also be the past relationship. Okay, now advanced salary received, taxable under that income from salaries, because the employer and employee relationship can also be a future relationship. So the relationship must be either the past relationship, a present relationship, or future relationship. That's it. So income from salaries comes into picture. Taxable under that income from salaries. Okay, ma. Every one of you. Right? So that's all about the charging section. And then after that, concept of employer and employee relationship. And then method of accounting also completed. Method of accounting. Next. Meaning of salary under section 17.1. 17.1. Salary definition, which I have given here also. Right? Basically, salary consisting of the basic salary, wages, annuity, pension, gratuity, fees, commission, perquisites, profit only of salaries, advance salary, leave encashment, or we can also call it as leave salary, then provident fund, right, sir? Contribution mentioned made to the central government pension scheme. All these are covered into the definition of the income from salaries. Clear, sir? So precisely, income from salary consisting of, you can see here, I've already given a list: basic salary, dearness allowance, bonus, fees, commission, all taxable allowances, all taxable perquisites, retirement benefits, profit only of salary. So there is a standard format for the calculation of income from salary, ma. Standard format. So whenever you are doing the problems from this chapter, right, you have to follow that particular standard format only. You have to follow that particular standard format only. First, you have to take all the incomes which are taxable under that income from salaries. Then total it up, you will get gross salary. From the gross salary, you have to deduct section 16 deductions, where you have three section 16 deductions. First one, section 16 clause 1A, standard deduction, right? Maximum of 50,000 rupees. It's not a flat amount, sir, for your kind information. If your gross salary is say 30,000 only, then you will get a standard deduction of 30,000 only. Are you following, sir? If your gross salary is 20,000 only, you will get a standard deduction of 20,000 only. If your gross salary is say 3 lakhs, then you will get a maximum deduction of 50,000. So if your gross salary is more than 50,000, the maximum standard deduction you will get 50,000. If your standard gross salary is less than 50,000, then the standard deduction is subject to gross salary. Clear, sir? Then after that, section 16 clause 2, professional tax. Professional tax. Section 16 clause 3, entertainment allowance. Basically, entertainment allowance is given as deduction only to the government employees. Adi kuda maximum 5,000 rupees. 5,000 rupees. Okay. So from the gross salary, you have to deduct the deductions under section 16. Then you will get the net salary, or you can call it as income from salaries, taxable salary. Clear, ma'am? Next. After that, you have the concept of profit in lieu of salary. Then computation of income under the salary that I've already discussed. Then perquisites and valuation of perquisites. Right? This is somewhat important from examination point of view. So first of all, what do you mean by a perquisite? It's nothing but an extra benefit provided by the employer in addition to monetary salary. So whatever the every month salary you are getting, in addition to the salary, whatever the additional benefits you are getting, that additional benefits are taxable as perquisite. Taxable as perquisite. Like, see here we are getting rent-free quarters. Rent-free quarters for accommodation purposes. And we also get electricity at free of cost. We'll also get water facilities at free of cost, medical facilities free of cost, educational facilities free of cost. Apart from the salary crediting to my account every month, I'm getting these additional benefits. I'm getting these additional benefits. Now, all these additional benefits will be treated as perquisites. Okay, ma. So the perquisites may be provided in cash or in kind, right? And that perquisites may be either provided at a free of cost or at a concessional rate. For us now, towards the rent and electricity, every month we are paying 1% of our basic salary. 1% of our basic salary we are paying as rent, as the amount for rent and perquisites, rent and electricity. For educational purposes, hardly we have to pay yearly 1,000 rupees. Yearly 1,000 rupees. Right. So that means I'm getting accommodation facility, electricity facility, I'm getting educational facility, but not at free of cost, at a concessional rate. Medical facilities free of cost. Are you following now? Next. So perquisites arises in the course of employment, taxable under the head salary. In the course of profession, taxable under the head PGBP. Okay, ma. Next. Types of perquisites. There are totally 3 different types of perquisites. Perquisites taxable in the case of all the employees. Number 2, perquisites taxable exempted in the case of all the employees. And then number 3, perquisites taxable only in the case of specified employees. Only in the case of specified employees. Okay, sir. Now look at here, types of the perquisites and its payment modes. Facility arranged by the employer and payment in kind. Means, suppose that I'm going on an official tour where the hotel accommodation facility is arranged by my employer. Right, sir. Now here, I'll just go to that hotel and whatever the room booked in my name, I'll occupy that room. And at the time of logging out, checking out, I am not required to pay any amount as my company booked the room and my company will pay the amount to the hotel. My employer will take care of all that hotel charges. Yes or no? Are you paying any amount? No. Your employer paying amount directly to the hotel. So payment in kind. You're just getting facility for which you're not paying any amount. Your employer paying the amount. So here the perquisite in kind. Okay, ma'am. Next. Reimbursements. Sir, here you're going on official tour. You yourself booked a room in a hotel. Right? Your employer has not provided any that arrangements. You gone to that hotel, you booked the room, and at the time of checking out, you have paid the money. You have paid the money, taken the hotel bills, and are returning to your company. You have encashed that hotel bills. You given that hotel bills in the fund section. The fund section given you the reimbursement. So first, initially you paid in cash, no? So here this is if the facility is arranged by the employee himself. After that, he got the reimbursement of the bills paid. Then it will be said as perquisite in cash. Next, direct payment arranged by the employee means this time I gone to the hotel, booked a room, but at the time of checking out, I called to my employer and my employer directly paid to the hotel. Directly clear all the bills of my hotel. That's it. So I am not paying and getting reimbursement. I've just made a call to my employer. My employer paid through online, cleared all the hotel bills. So the payment in kind. Are you following or not? Next. So specified employee. So there are certain perquisites, like if the perquisites are in kind, then these will be taxable only in the hands of the specified employee. Only in the hands of the specified employee. If the perquisites in cash, then taxable in the hands of all employees. Taxable in the hands of all employees. So that is why first of all you have to look whether he is a specified employee or not. But of course, whatever the criteria provided here, especially the third criteria for the specified employee, 99.99% of all the employees covered under specified employee category. First two criteria is very rare, but the third criteria, everyone will be hit by third criteria. Look at here. The following are treated as specified employees. Totally, there are three criteria. You can see here. First criteria, employee cum director. If you are an employee and as well as a director in that company, then you are a specified employee. Number 2, employee having substantial interest in that company. Having substantial interest means he is holding greater than or equal to 20% of equity share capital in that company. Then that employee is said to be an employee having substantial interest in that company. Means that employee is a specified employee. Okay, ma'am. Next, and while calculating this 20% equity share capital, we have to calculate only the percentage of equity shareholding by the employee, not by his relatives. Not by his relatives. Okay, ma'am. Next, and that substantial interest need not to be maintained throughout the year, sir. Even if you are holding greater than or equal to 20% of equity share capital, even for a single day, for that throughout the year, you will be treated as a specified employee. Next, the third criteria, I already told you, in the third criteria, everyone will be hit. Means an employee drawing a salary of greater than 50,000 per annum, and that means even an employee drawing a salary of 4,500 per month. 4,500 per month is a specified employee. See, nowadays the lowest cadre employee of every organization getting a minimum salary of 5,000 per month. The lowest cadre employee, say peon or a sweeper, right, getting 5,000 minimum salary every month, means per annum 60,000. So that sweeper also a specified employee of that organization. Yes or no? So that's right. In an organization, if 100 employees are there, all the 100 employees salary a minimum greater than 5,000 per month. So means all the 100 employees are specified employees. So you need not worry about this category, sir. Okay, now next. So perquisites taxable in the hands of all the employees. In that first one, the rent-free accommodation facility. I've explained here with the help of the running notes. Value of perquisite, value of rent-free accommodation. So we have two different types of accommodations, furnished accommodation, unfurnished accommodation. First, look at the unfurnished accommodation. Unfurnished accommodation means which are not furnished. Without any furniture, you are simply getting only accommodation. No furniture, no TV set, no shelves, no dining table, no sofas, nothing. A simple plain accommodation you are getting. Okay, now here the employees are categorized into two categories, central government and state government employees, other than central government and state government employees. When it comes to central government and state government employees, the license fee is taxable, determined by the government, taxable in the hands of that particular employee. And other than central government and state government, then you have to look at here. So it covers all the private government employees, local government employees, and even foreign government employees. If the accommodation is owned by the employer, then look at the population. Look at the population of the city in which the accommodation is provided to you. If in that particular city, the population is greater than 25 lakhs, then value of perquisite 15% of salary. If the population in between 10 lakhs to 25 lakhs, 10% of salary. And if the population is less than or equal to 10 lakhs, 7.5% of the salary, as you have to treat it as value of perquisite. Okay, next, if the accommodation is taken on lease basis, then there is a criteria like 15% of salary or lease rent payable by the employer, whichever is lower. Okay, now from all these cases, if you're recovering any amount from the employee, that should be deductible. Only the remaining is the taxable value of perquisite. Okay, sir. Next, coming to the value of furnished accommodation. Sir, if you given the information regarding furnished accommodation, excuse me. So if you're given with the information of furnished accommodation, first of all, you have to take an assumption that whatever the accommodation given in the problem as unfurnished accommodation. So first calculate the value of perquisite by taking the assumption that the accommodation provided is an unfurnished accommodation. Okay, so then after finding out the value of unfurnished accommodation, add the value of furniture. If the furniture is owned by the employer, that means employer's own furniture is given to you for your usage, then 10% of original cost of furniture should be added. Ledu sir, if the furniture is not owned by the employer, the same is taken on lease basis and provided to the employee, then the lease rentals of the furniture should be added back. Then you will get the value of furnished accommodation, from which if you recover any amount from employee towards rent or everything, then that should be deductible. Finally, you will get the taxable value of perquisite. Okay, ma'am. Next, sir, what do you mean by the salary for this purpose? The very important thing from this chapter is you have a definition of salary under section 17.1. This is basic definition. Basic definition. Apart from this, you have some specific definitions at different situations. Specific definitions, especially while you are discussing about retirement benefits. For each and every retirement benefit, there is a specific definition to salary. So you must be careful with respect to this. Okay, now here in this rent-free accommodation facility, right, you have a biggest specific definition for salary. Here salary means it contains basic salary, DNS allowance. DNS allowance you have to be considered only when it is forming part of retirement benefits. Bonus, fees, commission, all taxable allowances and any monetary payments received from employer should be considered for this purpose. And exclusions, when DNS allowance is not forming part of retirement benefits, ignore. And all the perquisites all the perquisites, employer's contribution to PF, interest on contribution to PF, all perquisites under section 17(2), you have to ignore. All exempted allowances ignore, and retirement benefits ignore. All these are to be excluded while calculating the salary for this purpose. Next. So that's all about the perquisite in the case of rent-free accommodation. And when it comes to hotel accommodation, so you have to take the least of 24% of salary, or actual charges payable are paid, whichever is lower. Clear? Next. So the remaining, or I'm going to discuss only about the important provisions, right? Educational facilities, if that educational facility at an institution owned and maintained by the employer, right? So you need to take the taxable perquisite as the fees charged by the educational institution in the similar or near locality. Okay, so the market fees, literally speaking, the market fees of similar school in same locality should be taken. Okay, so that will be the value of perquisite from which you can claim an exemption of up to 1,000 rupees per month per child, and there is no restriction with respect to number of children. Okay, sir. See, when it comes to the educational allowance, there is a restriction with respect to number of children. Maximum 2 children you can claim exemption benefit. But here educational facility as a perquisite, 1,000 per month as you can get exemption benefit, and there is no restriction with respect to number of children. Okay, ma'am. Suppose that if the educational facility market fees of the similar school 24,000, and you are sending one child for the school, only one child, so the maximum exemption benefit you will get is 12,000. The maximum exemption benefit you will get is only 12,000. So one child, so 1,000 per month, so into 12 months 12,000, the remaining 12,000 taxable amount. If you are sending 2 children for school, then 1,000 per month into 12 months into 2 children, so thereby you will get 24,000 as exemption, so then nothing will be taxable. Are you following, sir? There is also another view that if the cost of education exceeding 1,000 per month, you can also tax the entire amount of the perquisite. There are two views, right? Either you can taxable excess of 1,000 rupees, or you can tax the entire amount. In the main exam, you can follow anything, sir. Are you following, sir? See, suppose that if the market fees of the similar school is 40,000, market fees of the similar school is 40,000 rupees for 2 children. For 2 children. Okay, sir. And what is the maximum benefit you will get? The maximum benefit you will get is 24,000 rupees. The remaining 16,000 taxable. So either you can tax the remaining 16,000, or you can tax the entire 40,000. You have that option, sir. Are you following, everyone? Next. And when education and training provided to the employees, nothing will be taxable, sir. It is fully exempted. It is fully exempted. Okay. Perquisite in respect of motor car, you have to see the purposes, right? If it is wholly and exclusively used for official purposes, fully exempted, right, sir? And then if it is used for partly for official purposes, partly for personal purposes, then you have to look out. Let me take to the running notes. Yeah, look at this motor car facility. Children education facility I've just completed, and motor car facility. We have different situations, Situation 1, car owned by the employee, and repairs and maintenance expenses incurred by the employee. Now in this scenario, sir, nothing will be taxable. Nothing will be taxable as perquisite. Then situation 2, car owned by the employee, repairs and maintenance expenses incurred by the employer. Then you have to see if it is exclusively used for official purpose, nothing will be taxable. Are you following, sir? And then exclusively used for personal purposes and used for both and official and personal purposes. So you have to go through this, right? So the first scenario, motor car owned by the employee, maintenance and running expenses met by the employee. So the taxable value of perquisite is 0. Car owned by the employee, maintenance and running expenses met by the employer. If it is exclusively used for official purpose, nil. Only for personal purposes, actual expenses incurred by the employer less any amount paid by the employee. Right, sir? So whatever the actual expenses incurred by the employer, that will be taxable for both the purposes, both official and personal purposes. Look at here, given the running notes here. Actual expenses incurred by the employer, the total amount of expenses incurred by the employer, less if the cubic capacity of the engine less than or equal to 1.6 liters, 1800 per month you have to deduct. If CC of the engine exceeding 1.6 liters per month, 1.6 liters, then you have to deduct 2400 per month. And if driver facility is also provided, 900 per month you have to deduct. Are you following, sir? Now, whatever the amounts you are deducting here, this is containing that expenses incurred while the car is used for official purpose. So from the total official and personal purposes, if you are deducting the personal purposes amount, what is left over? Official purposes. Sorry, ma. If you're deducting the official purposes, what is left over? Personal purposes. So these expenses representing the car is used for personal purposes. That is the value of perquisite, from which any amount recovered from the employee should be deducted. That will give you the taxable perquisite. Are you following or not? Every one of you. So like that, for the remaining situations, you have to see where the car is owned by the employer, expenses met by the employee. Then next, car is owned by the employer, expenses met by the employer. Accordingly, you have to see the situations. Perquisite in respect of medical facility. Majority of the cases, medical facilities are exempted. A very few cases, medical facilities are taxable. Hospital owned by the employer, value of perquisite nil. Government hospital expenditure nil. Approved by the chief commissioner for prescribed diseases nil. Health insurance premium paid nil. Reimbursement of premium paid, right, nil again. And then payment of premium on personal accidental policy nil again. All these cases, the value of perquisite is nil. So then when it is taxable, when the medical facilities are provided in a private hospital, then it will be taxable. Are you following, sir? Right? And then when the medical facility is provided outside the India, towards the medical expenditure as permitted by the RBI, exemption is provided. And towards the stay expenses as permitted by the RBI, exemption is provided. Right, sir? Suppose that if you incurred a medical expenditure of 1 lakh and RBI given the permission only up to 80,000. So the remaining 20,000 taxable. Stay expenses 50,000, let us say you have incurred, but RBI given the permission only up to 30,000. So the remaining 20,000 taxable. And coming to traveling expenditure, it purely depends upon your gross total income. If your gross total income not exceeding 2 lakhs, full exemption benefit is available. If exceeding 2 lakhs, fully taxable. Traveling expenditure, fully taxable. So this is about the medical facility. Now coming to the medical allowance is fully taxable, sir. Medical allowance is fully taxable. Okay. Other fringe benefits, interest on loans. Sir, interest on loans, you can see here. ABC Limited employer given the loan of 5 lakhs to Mr. X employee without any interest. If the same is loan taken from the SBI, 10% is the rate of interest chargeable by the SBI. So the interest of, right, see, generally you have taken the loan from your employer. It is an interest-free loan, sir. Interest-free loan. Okay, sir. But if you have taken that loan from an SBI, you have to pay interest at the rate of 10%. Totally, you have taken a loan of 5 lakhs, on which 10% interest comes to be 50,000. So since you have taken the loan from your employer not charging any interest from you. That means this entire 50,000 is now a saving to you, a benefit to you. That benefit will be taxable here as perquisite. So the value of perquisite is 50,000 rupees. Okay, ma'am. Next. In case, assume that in the above case, if the interest charged by the employer is a 6%. So now this I can say that a concessional loan, not interest-free loan, a concessional loan. So the employer charging interest, but not as much as SBI. Okay, now in this scenario, what is perquisite? See, if you have taken the loan from SBI, you would have to pay 10% as rate of interest. But since you're taking the loan from your employer, where your employer charging only 6%, so that means the remaining 4% is saving to you, benefit to you. That 4% is taxable. So 5 lakhs is a loan amount into 4% is a benefit you are getting. So 20,000 will be taxable. Are you following or not? Okay, ma'am. So that is how you need to calculate the interest on loans. Next. Movable assets. When you're taking the movable assets for usage purposes, right? For the use of laptops and computers, the taxable value of perquisite is 0. Taxable value of perquisite is 0. Right, sir? And any other movable assets other than laptops and computers, right? Then 10% per annum proportionately of the actual cost of that asset. If the asset is owned by the employer, will be a taxable perquisite, or the amount of the rent incurred by the employer, as the case may be. Lease rent amount. So if the asset is owned by the employer, 10% per annum proportionately will be taxable as value of perquisite. No, the asset is not owned by the employer. The asset is taken on lease by the employer. The actual lease rentals will be taxable as perquisite. Okay, ma'am. So that here I have provided already movable assets regarding. And then the first case is for usage. Second case is for transfer. Right, sir? That means the employer is selling a movable asset to you. You are buying a movable asset from your employer. Now in that scenario, sir, right? If computers, electronic gadgets are there, then the actual cost of such asset to the employer as reduced by the 50% of cost to the employer for each and every completed year of service, right? On the basis of written down value method. So for every completed year of usage by the employer, 50% of the cost to be reduced on written down value basis. In the case of motor cars, same calculation holds good. 20% is a rate of depreciation. Any other asset, 10% SLM method is a way of calculating the value of perquisite. Like, look at this example now. Employer purchased a laptop for rupees 1 lakh on 15th of August 2017. The employer sold the laptop to the employee at 10,000 rupees on 10th of July 2020. Now look at here. First, how to calculate the value of perquisite in this scenario. First of all, in step number 1, we have to find out the written down value of the asset sold. Written down value of the asset sold. So actual cost to the employer 1 lakh. And since it is a computer and laptop, for every completed year of usage by the employer, 50% should be reduced on written down value basis. So first year means to be starting from 15th of August 2017 to 14th of August 2018. Rate of depreciation 50%, 50,000 rupees. Second completed year of usage starting from 15th of August 2018 ending with 14th of August 2019, 25,000. And third year and starting from 15th of August 2019 to 14th of August 2020. But third year was not fully utilized by the employer. On 10th of July 2020 itself, it was sold. Since third year was not completely utilized by the employer, we should not consider it. Consider chayado. We should not consider. So the return on value of the laptop sold 25,000. So 25,000 worth of laptop, 25,000 worth of laptop sold to you for 10,000 only. So that means you're getting a benefit of 15,000. No, that 15,000 will be the taxable value of perquisite. So that is how you have to calculate the value of perquisite in the case of movable assets. Are you following or not? Okay, ma. Next. Free food and fees for the concessional food and non-alcoholic beverages. So up to 50 rupees per meal exempted, ma. In excess of the 50 rupees per meal, whatever is there, that excess portion will be taxable. Suppose that if the cost of the meals provided to you is 80 rupees, 80, out of this 50 rupees per meal exempted, only 30 rupees per meal is taxable. Okay. And for your kind information, for the purpose of calculating this perquisite, you have to take 1 year is equal to 300 days only, not 365. 300 days only. Okay. Next. Gifted to the employee. If the gift is provided in cash, it is fully taxable. If gift in kind, you have an exemption benefit of 5,000 rupees. Of course, we also have an alternative view. If the gift in kind exceeding 5,000 rupees, either you can tax the excess portion or you can tax the entire portion. Suppose that on my birthday, I got a gift of a watch from my employer, a watch worth rupees 10,000. Or let it be a watch worth rupees 20,000. So in this 20,000, how to taxable? 5,000 claim exemption. So the remaining 15,000 taxable. Or else you can tax the entire 20,000 as value of perquisite. So either you can tax the excess portion or you can tax the entire portion. Absolutely no problem. Okay, now next. Coming to the specified securities as sweat equity shares. Regarding this, I'll explain you in the capital gains chapter. For the time being, wait. I'll explain you in the capital gains chapter. And then credit card facility, club facility. Employer's contribution to the provident fund. Let me explain you this, as this is the latest amendment from the Finance Act 2020. So employer's contribution to provident funds, superannuation funds, and pension funds. Right, sir? Just a second. So here, before the amendment, look at the provision before the amendment. Employer's contribution in excess of 12% of salary, right, taxable as perquisite, under that income from salaries. Okay, ma. And interest on employer's contribution in excess of 9.5% of salary, taxable as perquisite, under the head income from salaries. Okay, sir. Now, after the amendment, employer's contribution and interest on employer's contribution, taxable as perquisite only if it is exceeding 7,50,000. Sir, first of all, here, these provisions also continue to be taxable. And here, if the aggregate amount of contributions made by the employers towards the provident fund, towards the superannuation fund, and towards the pension funds, if the aggregate amount of contributions along with the interest, if exceeding 7,50,000, right, ma'am, right? So the excess portion is taxable here. Look at, ma'am, the amount overall capital limit by the introduced by Finance Act 2020. The amount or the aggregate of the amounts of any contribution made to the account of the SSE by the employer in RPF, in a pension scheme referred to under section 80CCD1, and superannuation fund, to the extent it is exceeding 7,50,000, then it shall be taxable as perquisite. And it also includes the annual accretion by way of interest, dividend, or any other amount of similar nature during the previous year to the balance at the credit of the fund. Then, to the extent it relates to the employer's contribution and included in the total income on account of the same having exceeding 7,50,000. See, first of all, whatever the old provision is there, employer's contribution to the RPF in excess of the 12% of salary, that is also taxable. Interest on employer's contribution in excess of 9.5%, that is also taxable. And in addition to that, if the aggregate amount of contributions and interest portion exceeding 7,50,000, the excess portion is taxable, and this is also taxable. Are you following, sir? Next. So with that, we have completed the discussion regarding the perquisites. And then after that, we have the discussion regarding the retirement benefits. Retirement benefits I'll cover in the next session. I'll cover up in the next session. Okay, now next session we will discuss the retirement benefits and deductions. With that, income from salaries will be closed. Okay, right. So see you in the next session, sir. Till then, have a good day and good night. Stay home and stay safe. A very good morning, students. So welcome to the income tax marathon classes. So in the last session, we have discussed about income from salaries marathon, and we have completed the discussion regarding the basic definition of the salary under section 17(1). And then after that, we have discussed about the various types of the perquisites which are taxable, right? And now time for the retirement benefits. So in this topic, we are going to discuss about what are the different types of the retirement benefits and how they are going to be taxable in the hands of the employees, like gratuity, PF, pension, leave salary, VRS, retrenchment compensation. All this we are going to be discussed in this topic, ma. Okay, now look at here, running notes. The first retirement benefit we are going to discuss about the gratuity. Right, sir. Gratuity under section 10(10). So in the case of the government employees, the entire amount of the gratuity is exempted from tax under section 10 clause 10 in the case of the government employees. And when it comes to the non-government employees, right, sir, now you have to look first whether that employee is covered by the Payment of Gratuity Act or not. If the employee is covered by the Payment of Gratuity Act, then exempted gratuity is equal to point number 1, actual gratuity received. Point number 2, statutory limit 20 lakhs rupees. And point number 3, the most important one, 15/26 into lost drawn salary into number of completed years of service or part thereof in excess of 6 months. Okay, sir. Now 15/26. What do you mean by 15/26 here? Sir, it means for every completed year of service, 15 days salary we should be taken as gratuity. 15 days salary. And for this purpose, 1 month is equal to 26 days month. So 15 divided by 26. 15 divided by 26. And lost drawn salary, and that gratuity calculation should be done based on the lost drawn salary. Lost drawn salary means the salary which you have drawn in the month of retirement. The salary which you have drawn in the month of retirement. Okay, ma, right? And here for this purpose, salary means to be basic salary plus dearness allowance. Any dearness allowance you can consider here. Means whether it is forming part of retirement benefits or not, you have to consider. Irrespective of the fact whether it is forming part of retirement benefits or not, you have to consider in the salary definition here. So here salary means to be only basic salary plus dearness allowance. Okay, sir. So 15/26 into lost drawn salary into number of completed years of service or part thereof in excess of 6 months. What do you mean by it? You can see the examples here. If the completed year of service is 20 years 7 months, you have to take it as 21 years. If the service period is 20 years 5 months, then you have to take it as 20 years. If the service period is 20 years exactly 6 months, still you can take 20 years. And then if the service period is 20 years 6 months and 15 days, so exceeding 6 months, so 21 years you have to take. That's the meaning of the part thereof in excess of 6 months. So this is how we have to calculate the exempted gratuity in the case of the non-government employees who are covered under the Payment of Gratuity Act. Now coming to the employees who are not covered under the Payment of Gratuity Act, then exempted gratuity will be, the first 2 points will be same. Actual gratuity received and statutory limit. Actual gratuity received and statutory limit. The first 2 points remains to be same. Only the third point will get changed. Okay, ma. Only third point will get changed. And the third point is 1/2, half of the salary. 1/2 into 10 months average salary. Now, what do you mean by salary for this purpose? Salary for this purpose is basic salary plus DNS allowance. You have to consider only when it is forming part of retirement benefits plus commission as a percentage of turnover. Sir, if the DNS allowance is not forming part of retirement benefits, so you should not consider it in the salary definition here. You should not consider in the salary definition here. And commission, when commission is given as a fixed commission, like some 5,000 per month or 10,000 per month, it's a fixed commission. If it is a fixed commission, again, you should not consider. When commission expressed as a percentage of turnover, means commission is equal to 5% of turnover, 10% of turnover. So when it is expressed as a percentage of turnover, then you have to consider it in the specific definition of the salary here. Okay, ma. And then number of completed years of service. So only the completed years of service you have to take. Even if he is worked for some 20 years, 11 months, still you have to take only 20 years. You have to just ignore this 11 months time period. Only the completed years of service you have to consider here. Next, for this purpose, 1 month is equal to 30 days. Right, sir? Next. So what do you mean by this 10 months average salary? Look at this example. Employee retired from the services on 31st January 2021. Right, sir? Now, here, while calculating the 10 months average salary, you should also include the month of retirement. Are you following, sir? Jan 2021, he was retired. Sorry, ma. You have to exclude. You have to exclude the month of retirement. So ignoring the Jan 2021, go back 10 months. So means December 2020, November 2020, October 2020, so on up to March 2020. So from March 2020 to December 2020, you will get last 10 months. So while calculating the 10 months here, you have to just ignore the month of retirement. Okay, ma? Every one of you, right? So last 10 months, ignoring the month of retirement, take divided by 10, you will get the 10 months average salary. Yes or no? Right, sir. So this is how we have to calculate the exempted gratuity in the case of the employees who are not covered under the Payment of Gratuity Act. Clear, sir? And all that was mentioned here. Next, look at the note points. Gratuity received during the period of service is always taxable. See, only the gratuity received at the time of retirement eligible for exemption. If you receive the gratuity during the period of service, always taxable. Okay, sir. Next, gratuity will be exempted only when the relationship of employer and employee exists between the payer and payee. If such relationship does not exist, the exemption shall not be available. Okay, now, so example, gratuity payable by the LIC of India to its insurance agents. Whatever the gratuity they are receiving, it will be fully taxable, ma. Okay, now, next, if gratuity received by an employee from more than 2 employers in the same previous year, then the aggregate amount of the gratuity exempted from the tax cannot exceed the above limits. So that means the maximum gratuity amount cannot exceed the above limits, even if you are receiving the gratuity from more than 2 employers. And also the maximum gratuity which is eligible for exemption in the case of non-government employees, you can see the maximum gratuity eligible for exemption is 20 lakhs. The maximum gratuity. Suppose that point number A, statutory limit 20 lakhs you got. Point number B, you got some 25 lakhs. And point number C, actual gratuity received, let us assume 30 lakhs. Now among this, how much is exempted, ma? 30 lakhs? No. How much is exempted? Whichever is lower, kada. Whichever is lower, the least of the following. So whichever is lower means 20 lakhs. Are you following, sir? So an employee, a non-government employee during his lifetime, the maximum amount of the gratuity which he can claim exempted is 20 lakhs rupees only, irrespective of the fact from how many employers he is receiving, in how many previous years he is receiving. Clear? Next, gratuity received by the legal heads of the government employee is fully exempted from tax. Okay, and retirement gratuity received by the members of the defense is also fully exempted from tax. Clear, sir? Next, so that's all about the gratuity. Next, moving on to the pension. Here's the running notes for the pension. So pension, there are 2 different types of the pensions are there, ma. Number 1, uncommuted pension, and number 2, commuted pension. Right. Uncommuted. Commuted means what, ma? Commutation. Commutation means sale. Sale. See, whatever the pension you're eligible to receive, If you sell that pension for a lump sum consideration, that is what we call a commuted pension. That is what we call commuted pension. So the part of the pension which is sold by the employee for a lump sum consideration. Suppose that after my retirement, I'm going to get a pension of, let us assume, some 40,000 per month. Like this, for how many years I'll get the pension? Till my death. And after that, my spouse will get the pension. Right, sir? So let us assume that this kind of pension I'm going to receive for a 20 years time period. So monthly 40,000, like that for yearly 4,80,000, like that for 20 years. So approximately I'm going to get around 1 crore plus as pension during this period of 20 years. Now this pension I'm going to sell to Mr. X for a lump sum consideration as of now. For a lump sum consideration of 50 lakhs I've sold as of now. Now this 50 lakhs, whatever I'm receiving, is what we call commuted pension. Commuted pension. Are you following, sir? Right. Suppose that if I have not sold that pension, I am only receiving the pension on monthly basis. That is what we call uncommuted pension. Uncommuted pension means that part of the pension which is not sold by the employee, which will be receivable periodically. Clear? Now, what is the tax treatment in the case of the uncommuted pension? The tax treatment is uncommuted pension is fully taxable. Uncommuted pension is fully taxable, irrespective of whether you are a government employee or a non-government employee. So uncommuted pension fully taxable in the hands of both government and as well as non-government employees. Now coming to the commuted pension, we have exemption benefit. In the case of the government employees, it is fully exempted. And in the case of non-government employees, a non-government employee receiving gratuity, the exempted pension is equal to 1/3 of the full pension. 1/3 of the full pension. And a non-government employee not in receipt of gratuity, exempted pension is equal to half of the full pension. Half of the full pension. Okay, sir. Now look at this. What is this full pension concept? Look at this example, ma'am. Employee commuted 60% of his pension for rupees 5 lakhs. So if he commuted 60% of the pension, he received 5 lakhs, then what would be the amount he would have received had he commuted 100%? What would be the amount he would have received had he commuted 100%? So make a reverse calculation. For 60%, he got 5 lakhs. For 100%, how much? So 5 lakhs into 100 divided by 60, that will give you the amount if he commuted the 100% of the pension. So had he commuted the 100% of the pension, he would have received the 8,33,333 amount, lump sum amount. Okay. Now, if he is receiving gratuity, exempted pension is equal to full pension into 1/3. If he is not receiving gratuity, full pension into 1/2. That will be the exempted pension, ma. Okay, now. So this is how we have to calculate the exempted pension in the hands of the government employees and as well as non-government employees. Okay, ma. So that's all about pension. Next, moving on to treatment of leave salary. So look at the running notes regarding leave salary. Yes, here it is about the leave salary, sir. So in the case of government employees, whatever the leave salary received by the government employees, fully exempted from tax. Fully exempted from tax under section 10(10)AA, under section 10 clause 10AA, right? And in the case of non-government employees, right? So we have the exemption benefit, but not full amount of the leave salary. Look at here. Point number 1, actual leave salary received. Point number 2, statutory limit 3 lakhs. Point number 3, 10 into 10 months average salary. Right? Now, what do you mean by the salary for this purpose? You can check out here. Salary for this purpose, basic salary plus DNS allowance forming part of retirement benefits plus commission as a percentage of turnover. The same specific definition which you have seen for gratuity in the case of the employees not covered by the Payment of Gratuity Act. The same specific definition. Okay, ma. So 10 into 10 month salary, average salary, and then point number 4, cash equivalent of the leaves outstanding to the credit of employee account. Now, how to calculate this? First of all, you have to calculate unutilized leaves. First of all, you have to calculate the unutilized leaves. Right, sir? Unutilized leaves means, look at this example. Unutilized leaves means leaves given by the employer, actual leaves given by the employer, or 30 days, 30 paid leaves per annum, whichever is lower. Suppose that if your organization providing 40 paid leaves every year. Now, while calculating the unutilized leaves balance to the credit of the employee account, you should not consider 40 paid leaves per annum for calculation purposes. Instead, you have to consider only 30 paid leaves per annum. Right, sir? Suppose that if your organization providing only 20 paid leaves per annum, only 20 paid leaves per annum, in that scenario, for the calculation purposes, you have to take 20 paid leaves per annum only. So if your organization providing more than 30 paid leaves per annum, so while calculating the unutilized leaves outstanding to the credit of employee account, you have to consider only 30 paid leaves. If given less than 30 paid leaves, actual given by the employer should be taken into account. Okay, now, so leaves given by the employer minus leave utilized by the employee. Leaves utilized by the employee. Suppose that you are in service for some 20 years now. Every year, your employer given you paid leaves of 20 paid leaves every year. So that means the total number of leaves given by the employer 400, out of which you have utilized over a period of 20 years. Over a period of 20 years, you have utilized 150 paid leaves. So that means leaves unutilized by you is 250. So 250 unutilized leaves divided by 30. First, you have to convert them into number of months multiplied with the 10 months average salary. That will give you the point number 4 value. So among these 4, whichever is lower is exempted from tax. Are you following or not? Right, sir. Now, while calculating the 10 months average salary here, that 10 months also including the month of retirement. That means, suppose that if you retired in the month of Jan 2022, so 10 months includes Jan 2022 as well. So from Jan 2022, you have to go back 10 months backwards. It will be April 2021. So April 2021 to Jan 2022 will be the 10 months. So take that 10 months salary divided by 10, that will give you the 10 months average salary. Are you following or not? So this is how you have to calculate the exempted leave salary. Okay. And then, so that's the leave salary ma. And retrenchment compensation is not so important. VRS also not that important. Right. Tax treatment relating to provident funds, you can see here. Tax treatment relating to provident funds. So generally the provident funds are mainly 3 different types ma. SPF, statutory provident funds for government employees. EPF for the private employees. In EPF, we have 2 separate categories. RPF, recognized provident fund, which is recognized by the Commissioner of Income Tax. Second one, URPF, unrecognized provident fund, which is not recognized by the Commissioner of Income Tax. And then finally, PPF, public provident fund. Public provident fund is mainly designed for the self-employed people, but of course it is open to all. It's open to all. So a private employee can also make contribution to PPF. Absolutely no problem. Okay, now next. And generally there are 3 amounts will be created to the employees provident fund account. 3 amounts. Number 1, employees contribution every month. Number 2, employers contribution. And number 3, interest on contributions. Suppose that every month from salary of the employee, let us say some 8,000 rupees will be deducting towards provident fund. 8,000 rupees will be deducted towards provident fund. So this is employees contribution. Employees contribution, and an equal amount of contribution is being made by the employer to the employee's account. So that means monthly 16,000 rupees will be created to employees provident fund account. His own contribution 8,000, equivalent amount contribution made by the employer, totally 16,000 will be created to the employees provident fund account. Are you following or not? Okay, ma. And on the 60,000, the interest will be given by the provident fund organization ma, that interest amount also will be credited to employees provident fund account. So totally 3 amounts will be credited to the employees provident fund account monthly basis. And at the time of retirement or at the time of death of the employee, the PF amount will get matured, right? So all these amounts created on a monthly basis will be matured either at the time of the retirement of the employee or at the time of the death of the employee. Okay, now in that scenario, how it is going to be taxable? Now look at employer's contribution to RPF up to 12% of salary exempted. In excess of 12% of salary, only the excess portion will be taxable. Only the excess portion will be taxable. So taxable as perquisite in the hands of the employee. And if the aggregate amount of the employer's contribution and interest and employer's contribution exceeding 7 lakh, then the excess amount will also be taxable as perquisite. The excess portion, again, I've already told you in the last session. Okay. See, in excess of 12% of salary, that excess portion, whatever is there, that is also taxable. And in excess of 7,50,000, whatever is there, that is also taxable, sir. Suppose that employer's contribution to PF, RPF, let us say 9 lakhs rupees. 9 lakhs rupees. And we have an exemption benefit up to 12% of salary. So minus exemption up to 12% of salary. Let us assume that which comes around some 8,50,000 if we calculate. So that means in excess of 12% of salary, this 50,000 is done. No, this is taxable. Point number 1. Point number 2. Again, you have to take employer's contribution to RPF 9 lakhs minus exemption up to 7,50,000. So in excess of 7,50,000, 1,50,000 is there. No, this is also taxable. This is also taxable. Earlier, we used to tax only in excess of 12% of salary, but in addition to that, we should also now tax whatever the portion in excess of 7,50,000, that portion also taxable now. Are you following or not? Okay. So I've given you the example here. Basic salary 60 lakhs, DNS allowance forming part of retirement benefits 10 lakhs, employer's contribution to RPF 9 lakhs. So basic salary 60 lakhs, calculation of the income from salary, and DNS allowance forming part of retirement benefits 10 lakhs, employer's contribution to RPF 9 lakhs, exemption up to 12% of salary. Right here, what do you mean by the salary? It includes basic salary 60 lakhs plus DNS allowance forming part of retirement benefits 10 lakhs. So 70 lakhs. So up to 12% of salary, we have exemption now. So that means 70 lakhs into 12%, you got 8,40,000. So this 8,40,000 exemption, remaining 60,000 taxable. And now as per the latest amendment, employer's contribution to RPF in excess of 7,50,000. 9 lakhs he actually made contribution, 7,50,000 exemption. Now this 1,50,000 also taxable. Are you following or not? So this is how you need to work out. Okay, sir. Next, accumulated balance in the RPF account received at the time of retirement or death of the employee. So whatever the lump sum amount you received at the time of death of the employee or retirement of the employee, what is the tax treatment? Now look at the provisions here. If employee retired from the services after rendering services for a minimum period of 5 years, then whatever the accumulated balance he is receiving, that will be fully exempted from tax. If the employee retired from the services after rendering services a minimum period of 5 years, whatever the lump sum amount is receiving from RPF account, that lump sum amount is fully exempted. Next, if employee retired from the services within 5 years of employment, then you have to see reasons for retirement. If the reason is happened to be employee's ill health, or employee's business was shut down, employer's business, or due to the reasons which are beyond the control of employee, still, even though you retired from the services within a period of 5 years, it is fully exempted from tax. But if any other reason, like you are yourself resigning from the services, no ill health, employer's business was in continuation, you yourself making resignation, then in that scenario, employee's contribution not taxable, interest on employee's contribution taxable under the head income from other sources, employer's contribution and interest on employer's contribution both are taxable under the head income from other sources. Are you following, sir? Every one of you, right? So you can see here the accumulated balance is 6 lakhs, out of which employees contribution 2,70,000 not taxable. Interest on employees contribution 60,000 taxable under that income from other sources. Employers contribution 2,20,000, interest on employers contribution 50,000. Put together 2,70,000. The entire amount is taxable under that income from salaries. Every one of you following now. Next. So that's about the retirement benefit, Chama. And after that, you will be having allowances. You have some fully taxable allowances, partly taxable allowances, and fully exempted allowances. Okay. And in these allowances, you just go through the allowances which are very important, like children education allowance, hostel allowance, you can say transport allowance, running allowance. That's it. These are the very important allowances, sir. And after that, you have HRA. Regarding HRA, I think I provided you the running notes. Let me check out. No, I guess. So regarding HRA, it's very simple, sir. First of all, you have to see from where the accommodation is located. The accommodation is located in metro cities like Delhi, Kolkata, Mumbai, Chennai, right? Either you can take KDCM or CMKD, your wish. K for Kolkata, D for Delhi, C for Chennai, and M for Mumbai. Right, KDCM. Our CM is KD or our KD is a CM. It's only for remembering purposes, ma. Right? So if that accommodation was located in metro cities, then it will be HRA actually received or rent paid minus 10% of salary or 50% of the salary. Among these three, whichever is lower exempted from tax. In case if it is located in the non-metro cities, the only difference is instead of 50% of the salary, you have to take 40% of the salary. That's it. Okay, now. And exemption is not available to the associates who are living in his own house or in a house for which he is not paying any rent, or the rent is paid but less than 10% of salary. Okay, ma'am. Every one of you. See, when you are residing in your own house, then you won't get any HRA exemption benefit because, see, you are not paying any rent, right? You living in your own house. So there is no HRA exemption will be allowed to you. And then you are living in a rented premises, or you are living in a premises which is not belonging to you, but you are not paying rent for that. Suppose that you are residing in your in-laws house. Are you going to pay any rent to your in-laws? No. Next, even if you paid the rent, if it is less than 10% of salary, still the exemption benefit is not available. Are you following, sir? Next. So that's all about HRA allowances. And then after that, you have the deductions, ma. Section 16 deductions, right, sir? So in that, the very first one, standard deduction, I've already told you. If your gross salary, right, is greater than 50,000 rupees, if your gross salary greater than 50,000 rupees, then the maximum standard deduction you will get is 50,000 rupees. If your gross salary is less than or equal to 50,000 rupees, the maximum standard deduction you will get is equal to gross salary. Suppose that if your gross salary is 20,000, so the standard deduction is equal to 20,000 only. Are you following now? Next, professional tax. So look at here, professional tax. If paid by the employee, directly you can claim deduction, ma. Directly you can claim deduction under section 16 clause 3, right? And if paid by the employer, step number 1, it should be forming part of your perquisite. It should be forming part of your perquisite, forming part of your salary. So assume that the professional tax paid by the employer some 2,400 rupees. While calculating the gross salary, you have to add 2,400 rupees as perquisite. And then later on, while you are claiming deductions under section 16, then you have to claim a deduction of 2,400 rupees. So the net impact will be nil. If the professional tax paid by the employer, the net impact is nil. Are you following, ma? If professional tax paid by the employee, the net impact is minus 2,400 deduction. Clear? So that's it, sir. So with this, we have completed income from salaries. Okay, now every one of you. So all the specific definitions I have given you in a single place for your easy reference now. See, the general definition section 17.1 that is applicable in the normal cases, but in special cases, the specific definition is applicable. Clear? In majority of the cases, this will be the specific definition. Basic salary plus DNS allowance forming part of retirement benefits plus commission as a percentage of turnover. Almost in the 5 different cases, the same specific definition applicable. Clear, sir? Right. So with this, I've completed the income from salaries marathon. Okay, next session, I'll start with income from house property, the second head of income. Till then, have a good day and good night. Stay home and stay safe. Clear, sir? A very good morning, students. So welcome to the income tax marathon classes. In the last session, we have completed discussion regarding our first head of income, income from salaries. And now time for the second head of income, income from house property. Sections covered, section 22 to section 27. Okay, ma. So look at the running notes. Income from house property, sections covered 22 to 27. And the list of important sections from this chapter. The list of important sections from this chapter, like section number 22, charging section, section number 23, the calculation of gross annual value, GAV, and 24, deductions, and 25, the concept, 27, the concept of deemed owner. Concept of deemed owner. These 4 sections are very important from this chapter, income from house property. Okay, ma. So it starts with the charging section, section number 22. So look at in the running notes. So section number 22, charging section, I've already told you in the last class. Section number 4 is a charging section for the entire income tax. And for each and every head of income, we have a separate charging section again. For salaries, 15, house property, 22, PGBP, 28, capital gains, 45, and other sources, 56. Right, sir? So, and if you observe here, there is one block is missing in between salaries to house property. That block is section 18 to 21. Right now, these sections were omitted. Earlier, it used to deals with the interest on securities. We used to have 6 head of incomes. Right, sir? Including the interest on securities as a separate head of income. But right now, that interest on securities is being taxable under the head income from other sources. So now we have only 5 head of incomes, and this 18 to 21 sections were now omitted. Okay, sir. And I've already told you that for every head of income, right? Generally, whenever we are going to discuss about the head of income, first of all, we need to discuss about the 2 things. First one, charging section of that head of income, and number 2, the method of accounting applicable to that head of income. Clear, sir? Because without knowing these 2, you cannot understand the remaining provisions of the head of income. Clear? So charging section deals with what are the incomes taxable, what are the different types of incomes taxable under this head of income, and method of accounting taxable, on what basis they are going to be taxable, means on accrual basis or on receipt basis. So first we should understand these 2, what are the incomes taxable under this head and on what basis they are taxable. Then after understanding these 2 concepts of the head of income, the remaining sections of the head will be easily understandable. Clear, sir? Right. So charging sections explanations was provided here, ma, and then right. So the main provision of the charging section I have written here, the annual value of any property. It starts with the annual value of any property consisting of buildings or lands appertaining thereto, for which the assessee is the owner. Right. So then whatever the annual value is getting from that house property, that will be taxable under the head income from house property. You can see here the charging section. It starts with the annual value of any property comprising of buildings or lands appertaining thereto, for which the assessee is the owner, chargeable to tax under the head income from house property. So look at here, sir. The important points from this particular charging section is number 1. Look at this example. Mr. X is the owner and Y is a tenant. And the house property is given on let out basis to Mr. Y. and the rent amount is 10,000 per month. So the actual rent received by Mr. X is 10,000 per month into 12 months, 1,20,000. 1,20,000. Now you tell me what is taxable under that income from house property? Is this 1,20,000? No. See, the annual value of the property is going to be taxable here, not the actual rent. Annual value of the property is different, actual rent is different. Annual value is different, actual rent is different, for your kind information. Okay, sir. So then how to find out the annual value? Section number 23 will give you the answer for that. Section number 23 discussed about the same, the annual value calculation. Okay, sir. Suppose that the annual value calculation you got 1,50,000. Now among these two, you have to tax 1,50,000 only, sir, not 1,20,000, because the charging section says the annual value of the property taxable, not the actual rent of the property. Are you following, sir? And if you remember, in our introduction chapter, we have discussed a concept called income includes notional income. Sometimes in the hands of the SSE, instead of the real income, instead of the actual income, the notional income is taxable. And there is only one head of income, the notional income is taxable, and that is income from house property. The remaining 4 heads of income, only the actual income received or receivable by the SSE will be taxable in his hands. But in the income from house property chapter, right, in the head of the income from house property, the notional income is taxable instead of the actual income. Are you following, sir? Right? So look at here, he actually received only 1,50,000, but for the purposes of taxation, you have to take 1,50,000. Even though the 30,000 was not received by him, which is a notional income, still it is taxable in the hands of the employee. Are you following, sir? Right? Next. So look at the important point. The annual value of the property is taxable under that income from house property instead of the actual rent. Clear? Next. The second important point they have mentioned is, right, the annual value of any property. Even though they use the word any property, which is an open definition, right, sir? Right? Any property could be a land, building, plant and machinery, vehicles, could be anything. But here, only the annual value of the buildings and lands attached to the buildings taxable. Not every property, sir. Only. That is why, even though they use the word any property, they have made a restriction to the definition by using the word comprising. Comprising of buildings, could be a residential building, commercial building, office, godown, warehouse, with roof or without roof. Buildings could be any type of building, or lands attached to the buildings. The lands which are attached to the building in any form, like in the form of a garden, in the form of a swimming pool, in the form of a approaches to road, right, sir? In the form of a parking area, could be any land, but that should be attached to the building. Then only the annual value of that particular land attached to the building taxable under that income from house property. So look at here, sir. Land attached to the buildings. I've given you an example here. If the land is attached to the building, then taxable under that income from house property. In the case if it is an open plot, from the open plot you are getting any income, then taxable either under the PGBP or under that income from other sources. Okay, ma'am. Next. Conditions for chargeability. There must be a property, must be a building or land attached to the building, and the property must be let out during the previous year, either for the full previous year or for a part of the previous year. Absolutely no problem. And the assessee must be the owner of the property. If all the 3 conditions are satisfied, then the income from that property taxable under that income from house property. Otherwise, PGBP or income from other sources. Okay, sir. Next. Sir, assessee must be the owner of the property only in the previous year in which the income was generated. Only in the previous year in which the income was generated. He need not be the owner of the assessee during the year in which he is going to pay the tax on such income. See, during the previous year 21-22, he owned a property from which he earned some income. Basically, the income of the previous year 21-22 taxable in the year assessment year 22-23. Yes or no? We have learned the golden principle of income tax in the first chapter. Previous year income is always taxable in the hands of the assessee during the assessment year. The income of the previous year taxable in the assessment year. So this income is taxable in the assessment year 22-23. Now in the assessment year 22-23, the assessee need not be the owner of the property. He may be the owner of the property or he may not be the owner of the property. Absolutely no problem. Even though he is not the owner of the property, still that income is taxable. This income is taxable under the head house property only. Okay, ma. So the important point is that the year in which you earn the income from house property, you must be the owner. But the year in which you are going to pay the tax on such income, the ownership condition is not mandatory. Next. Sir, if there is any dispute between regarding a house property, regarding who is the owner of the house property, then till the court given its decision, it's purely at the option of the department to tax the income from house property in anyone's hands. Like, look at this case, Mr. A having a house property which is given on a lettered basis for 10,000 per month, but Mr. B also claiming the ownership of this property. B also having the ownership documents in his name. So A is claiming the property is belonging to him. B also claiming the property is belonging to him. The matter went up to the court. And basically in the courts, it will take time now. There are lakhs of cases pending in the Supreme Court and as well as in the High Court. By the time your matter will come for the discussion and the decision will be given, it will take in, let's assume, some 5 years. Now, over these 5 years, in whose hands the income will be taxable? It's purely at the option of the department. Suppose that if the department believes Mr. A is the real owner, Mr. Department can levy the tax in the hands of Mr. A until the court given its final decision. And once the court is given its final decision, as per the decision of the court, the income will be taxable. Clear, sir? Next. So that's all about we have discussed here, ma. And assessee must be the owner of the property that we have discussed. And now look at the deemed ownership concept. Deemed ownership concept. So totally there are different situations where the deemed ownership comes into picture, right? So look at here. First one, transfer to spouse. Suppose that if the assessee transferred his house property to his spouse only with a view to reduce his tax liability, then whatever the house property transferred to the spouse, even though the spouse is a legal owner of the property, Mr. X will be deemed as owner of the property. Are you following, sir? See, your intention here to reduce your tax liability, ma. You're not transferred that house property out of love and affection. You have transferred only with a view to reduce your tax liability. So in that scenario, even though the legal ownership lies with your spouse, still you will be deemed as owner of the property. And then whatever the house property income is there, that will be again clubbed in the hands of the transferor and taxable in the hands of the transferor. Look at this example, ma. Mr. X having a salary income of 10 lakhs, rental income 5 lakhs, put together 15 lakhs. Now look at the tax liability, ma. Right, for 15 lakhs, the tax liability comes out to be 2,73,000. Right, sir. Now, what he has done is, since he's paying a huge amount of tax, 2,73,000, he would like to reduce his tax liability. What he has done is, he transferred house property to Mrs. X, to his spouse. Now, after transferring the house property, so only salary income will be taxable in the hands of Mr. X, 10 lakhs. If your total income is 10 lakhs, your tax liability would be 1,17,000. And Mrs. X being the legal owner of the house property, the rental income is taxable in the hands of Mrs. X. So 5 lakhs is the total income, tax liability will be nil because you have a rebate benefit now. Now, how much total tax liability being paid by Mr. X and Mrs. X put together? Mr. X paying 1,17,000. Mrs. X 0. So both of them put together paying 1,17,000. Earlier, Mr. X alone paid 2,73,000. Now put together paying only 1,17,000. Now what is the tax savings to Mr. X? 1,56,000. The same will be treated as the tax revenue lost to the department. See, if it is a revenue to the assessee, tax benefit to assessee, then it will be a tax loss to department. Yes or no? See, for one's benefit, the other person, it will be a loss. Clear? So successfully, Mr. X escaping from the payment of taxation to the extent of 1,56,000. Are you following, sir? So that's why the department introduced the concept of deemed ownership. So Mr. X, initially he is the legal owner of the house property, but transferred the same to his spouse. Now his spouse become the legal owner of the house property. But as per the provisions of section 27 now, right? So whatever the ownership is transferred, the legal ownership lies with spouse only, but Mr. X will be deemed as the owner of the house property. Then the rental income is taxable in the hands of Mr. X only. Clear, sir? Now, so do we have any exceptions for this? Yes. The number one is property was transferred for adequate consideration. Sir, here the property was transferred to spouse, but with adequate consideration. Are you following, sir? Sir, 50 lakhs of what property transferred to Mr. X, and Mr. X claimed 50 lakhs consideration from his spouse. His spouse paid 50 lakhs consideration for that house property. So when there is adequate consideration, section 27 provisions not applicable. Number two, if the property was transferred to spouse in an agreement to live apart, means divorce cases. Right, ma? In the case of divorce, like the court will ask to provide alimony. To provide alimony to the spouse. Right. So here in the case, if the property was transferred in an agreement to live apart, again, section 27 provisions are not applicable. So in the above two exceptional cases, the provisions of section 27 not applicable. So that means the rental income is taxable in the hands of transferee only. That means in the hands of Mrs. X, spouse. Clear, sir? Next. Second transaction transferred to the minor child. The same provisions holds good. Same provisions holds good. Here the assessee transferring the house property only with a view to avoid the tax liability. Clear, sir? So again, right, if the assessee transferring the house property to his minor son with a view to avoid the tax liability, then again the provisions of section 27 comes into the picture. Even though the legal ownership lies with his son or daughter, Mr. X will be deemed as owner of the property. The rental income will be taxable in the hands of Mr. X only. Next. So do we have any exceptions? Yes, two exceptions. Number one, the same when the property was transferred for adequate consideration. And number two, the property was transferred to the minor married daughter. Minor married daughter. In these two cases, section 27 not applicable. That means the rental income is taxable in the hands of the minor child only. Okay, ma. Number three, holder of the impartible estate. Impartible, which is not partitionable, which is not separable. Clear, sir? Right? Look at this example. Mr. X is the ex-ruler. He is having 3 sons and is having the total assets of 7 estates. Now he would like to distribute these 7 estates among the 3 sons. Among the 3 sons. Right, sir? Now each son get 2 estates. So 3 into 2. 6 estates distributed, 1 left over. And this 1 estate, right, sir? How to distribute among the 3 sons? Suppose that this estate having 300 acres, 300 acres land. So each son will get 100 acres, no problem. But assume that in that particular land, there was a temple. And during this partition time, what happening is the temple also getting partitioned. So means, religious people don't like this. Okay, now, if you believe in God, separating the temple, separating the God is not correct. So that's why what Mr. X has done is, Mr. X given this house property, transferred this house property in the name of the elder son. Even though all the 3 sons having the equal ownership rights in the land, Mr. S will be deemed as owner of the property. The elder son will be deemed as owner of the property, and whatever the income generating out of that particular estate will be taxable in the hands of Mr. elder son. Okay, ma? Right. Next. Transfer of house property by association to its members, right? Means, right, a group of people formed an association for a common objective. Generally here, if you want to construct the house property for your purposes, and if you are constructing alone, the cost of construction will be 50 lakhs. But if you form an association with the people who are having the same kind of dream, having a own house, generally these kind of situations you will find in case of government employees, right? Especially those who are working in the same office, same department, they would like to be stay together. even after officers. So that's why they will form an association. They will purchase the land in a bulk quantity, like some 5 acres or 10 acres, in which they will construct their residential house properties. So during office hours, they'll stay together. Even after office hours, they will stay together. Colonies like income tax officers colony. So no, SBI officers colony, commercial taxes officers colony. You'll find the colonies like this. Yes or no? So when you form an association with the some 20 members, and now you want 20 house properties to be constructed, in that scenario, the cost of construction will get down 40 lakhs. Okay, now. So initially, they will form an association and they will collect certain amount from the members to becoming to give their membership, right, sir? Let us assume that they have collected some 10 lakhs from each member as membership fees. So total amounts to 2 crores. These 2 crores will be given as an advance to the builder. The builder will take up the project of constructing the 20 residential properties. For the total consideration, let us say some 8 crores, out of which 2 crores we have given as advance. The remaining 6 crores will pay in EMIs. Okay, now see, after the property construction was completed, the properties will be transferred in the name of the association initially, right? The association will be the legal owner, but the members who are the who are there in that association, after the property construction completed, now the properties will be handed out to the members. Even though the legal ownership lies with the association, the members will be deemed as owner of the house property. Okay, now. And the last one, section 53A, part performance of the contract. 53A. Look at this example, sir. Mr. A, Mr. B, Mr. C, joint owners of the house property, joint owners, right? Legal owners. They have sold this house property to Mr. D. Mr. D. Mr. D has paid the full consideration and they have entered into an agreement to sell. Right? Mr. D also taken the possession of the property. But the only thing is the property was not registered in the name of Mr. D. The reason is being one of the co-owners, Mr. C, is in USA. He's struck in USA due to lockdown. See, the property will be transferred, ownership will be transferred to the Mr. D only when it is getting signed by all the co-owners in the presence of the registrar. Yes or no? Mr. C is not in India, so the property was not registered in the name of Mr. D, but Mr. D paid the full consideration or he is ready to pay the full consideration. They are entered into an agreement also. And Mr. D already taken the possession of the property and using. Even though the property was legally not registered in the hands of Mr. D, but still Mr. D will be deemed as the owner of the property as section 53A applicable here. 53A of the Transfer of Property Act. Are you following, sir? So that's about the concept of the deemed ownership. Okay, sir. So all the 5 situations I have discussed. And after that, you have the concept of exempted properties. Right, section 10 clause 1, income from any farmhouse which are used for agricultural purposes, it's always farming part of agricultural income, fully exempted. Okay, ma. And you can see here where the property is used for own business or profession, fully exempted under the head income from house property. And this one, up to 2 self-occupied house property of an individual or HUF exempted from tax. Earlier we used to get only 1 self-occupied house property exemption benefit, but now you have for the provision of 2 self-occupied house properties. You have a latest amendment, up to 2 self-occupied house properties you can claim self-occupation benefit, exemption benefit. Okay, ma'am. And then here comes the most important part, calculation of the gross annual value. Okay, sir. As I said just now, no, 2 self-occupied house properties exemption per benefit, exemption, right? So I've given the provisions also here. Mr. Krishna from Andhra Pradesh, right? Assume that he is having 3 house properties in 3 capital states, Vizag, Kurnool and Amravati, right, sir? These are now the capital cities of Andhra Pradesh, right? Officially or unofficially? right? Some people thinking only Amravati as capital state city, but some people thinking there are three capital cities: Vizag, Kurnool, and Amravati. One is commercial state, the other is judicial state, and the last one is administrative state, city, administrative capital. Okay, so let us, that means he's having three self-occupied house properties, but as per the provisions, only two properties will get self-occupation benefit. Yes or no? Now, the third property should be treated as deemed to be let out property, not actually let out, that is deemed to be let out. Okay. Now, since he's having three self-occupied house properties, he will be having three options, ma. He will be having three options. What are the three options? Option one, treating the house three as deemed to be let out, the remaining two self-occupied. Option two, treating the house two as deemed to be let out, the remaining two self-occupied. And option three, treating the house one as deemed to be let out, the remaining two self-occupied. Okay, sir. So like this, you have to take the three options. See, treating the house property as deemed to be let out, it is purely at the option of SSC. Which property should be treated as deemed to be let out? It is purely at the option of the SSC, and that option can be changed from year to year. Okay, next. Section 23, the most important section. Section 23 deals with the computation of gross annual value. GAV, gross annual value. Okay, ma'am. And there is a standard format for the calculation of income from house property. You can see here, gross annual value. It starts with the gross annual value. Then from which you need to deduct the municipal taxes paid during the previous year. That will give you net annual value. Then you have to deduct deductions under section 24. Clause A, standard deduction, which is always at the rate of 30% of NAV. And clause B, interest on loans, where we have two different types of interest: pre-construction period interest and current year interest. Then finally you will get the income from house property. Okay, now next, important terminologies. Sir, for understanding the gross annual value concept, we need to understand some important terminologies. First one, FRV, fair rental value, which is also known as similar property rent, the rent of the similar property located in the near locality. Municipal rental value, it is a municipal rental value maintained by the municipal departments for the purpose of levying the municipal taxes. Sir, if municipal taxes paid, if given as a percentage, this percentage always you have to apply on MRV, municipal rental value. Standard rent, it is a rent as per the Rent Control Act. Expected rent is also known as annual letting value. That means it is a maximum rent which can be expected by the owner by letting out his house property. Then actual rent means actual rent received by the owner of the house property. Actual rent received or receivable, because the method of accounting applicable to this chapter is accrual basis. And we know that as per the accrual basis means it includes the receivables also. And unrealized rent, that portion of the rent which is not collected by the owner. Okay. Next, procedure for the computation of GAV. Step number one, you have to make a comparison between MRV and FRV. Whichever is higher, you have to take the higher portion. Step number two, take the step one value and compare with the standard rent. And then you will get whichever is lower, you have to take, then you will get the expected rent. Whichever is lower, you have to take, then you will get the expected rent. Are you following, sir? So the lower value in step number two is the expected rent. And in the case of the deemed to be let out properties, only step one and step two, two steps are applicable, ma. Two steps only applicable, only two steps, step one and step two. And whatever the value you are getting in the step two, that itself is the GAV, gross annual value. In the case of deemed to be let out properties is expected rent. Since they are not actually let out, there won't be any actual rent. Since they are not actually let out, there won't be any actual rent. So that is why there is no step number three. Step number three comes into picture. Step number three comes into picture only when the property was actually let out. Okay. So let us assume that the property was actually let out, right? So step number three, expected rent, whatever the value you got in step number two, take it to the step number three, expected rent, and that should be compared with the actual and received or receivable. Actual and received or receivable. And while calculating actual rent here, from the actual rent, you have to deduct the unrealized rent. Okay, sir. Right? So while calculating the actual rent, we have to deduct the unrealized rent. Now, among these two, look at the situation number one. If actual rent is greater than expected rent, then GAV is equal to actual rent received. Straight away, you can go ahead with the GAV is equal to actual rent received. Whereas if actual rent is lower than expected rent, then you have to verify the reasons why the actual rent is lower than expected rent. If the reason is found out to be vacancy, if the reason is found out to be vacancy, the GAV is equal to actual rent. GAV is equal to actual rent. If the reason is other than vacancy, then you have to go with the GAV is equal to expected rent. Here you have to verify the provisions applicability, section 23, subsection 1, clause C. If 23(1)(c) clause 23(1)(c) clause applicable, then GAV is equal to actual rent. Not applicable, GAV is equal to expected rent. Okay, ma? Right. Next. Sir, if the house property was in existence for 12 months, 12 months it was in existence, you have to calculate FRV, MRV, standard rent, expected rent for 12 months. But the actual rent should be calculated only for the period for which it was actually let out. See this example. The property was in existence for 12 months, but 3 months under vacancy, only 9 months let out. So actual rent should be calculated only for 9 months, but the remaining all are should be calculated for 12 months. Okay. Now look at the other example. So the property was under construction for 3 months, from 1/4/2021 to 30th June 2021. It is under construction. And immediately the construction was completed, it was given on let out basis. Sir, here in this example, I can say the property was in existence only for 9 months, not 12 months. The first 3 months of the financial year, the property was under construction, not in existence. Since the property was in existence for only for 9 months, FRV, MRV, standard rent should be calculated for 9 months, and the property was let out actually for 9 months. The actual rent should also be calculated for 9 months. Next. Calculation of NAV, next concept, calculation of NAV, net annual value. Sir, net annual value, how to calculate, sir? It's nothing but GAV minus municipal taxes paid. GAV minus municipal taxes paid is a NAV, net annual value. Yes or no? Right, sir. Now, look at here. Sir, in case, let me take to the provision. So, even though the heading is NAV, even though the heading was NAV, but the entire discussion is about the municipal taxes, sir. So municipal taxes will be allowed as deduction only if the two conditions are satisfied. Number one, it should be borne by the assessee, means it should be paid by the owner. And number two, it should be actually paid during the previous year. It means allowed on cash basis. It is allowed on cash basis. Even though the method of accounting accrual basis, still the municipal taxes paid allowed on actual payment only. This is an exception, sir. So the municipal tax is actually paid by the owner, and it should be actually paid during the current previous year. Number two, second important point. Sir, if I paid the municipal taxes of preceding previous year, current previous year, and in the next previous year, all these 3 previous years municipal taxes at one time I have paid during the current previous year. Now, can I claim during the current previous year full exemption benefit? Answer is absolutely yes. See, what ultimately matters, whether you paid the municipal taxes during the current previous year or not. Yes, sir, I have paid. See, irrespective of the fact whether they are belonging to the preceding previous year or whether they are belonging to the future previous year, it doesn't matter. Since you paid actually during the current previous year, no, you will get the deduction for current previous year. Number 3, if municipal taxes paid more than GAV, what happens? Nothing will happen. Your NAV could be negative. Suppose that if your GAV is 1 lakh, municipal taxes paid 1,20,000. So what happens? NAV just becoming negative. That's it. Negative 20,000. Nothing will happen. Next, municipal taxes paid outside the India also eligible for deductions. Even though you paid the municipal taxes to the local authority of a foreign government, still you can claim deduction in India. Okay. Next, after that, deductions under section 24, right? So deductions under section 24, there are 2 deductions you know very well. Number one, standard deduction. Number two, interest on loans. Look at the standard deduction. It is a flat amount of deduction at the rate of 30% of NAV. And it is allowing towards repairs and maintenance, insurance charges, renovation expenses, ground rent. Right, sir? All this you are getting in the form of a standard deduction. It's a flat amount of deduction, sir. Irrespective of actual expenditure incurred, it's a flat amount. 30% of NAV, you will get it as deduction. Okay, ma. Right? Next. So interest on loans under section 24B, you can claim deduction. Interest on loans. Right, sir? So interest on loans, yes, we will be having two different purposes, two different interests, pre-construction period interest and current year interest. Okay, now, so the loan must have been borrowed for these purposes, ma. Purchase or construction or repairs, renovation or reconstruction. PC or cube. PC, purchase or construction or cube. Or you can take R, R, R. R, 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 not the latest movie Triple R. It is repairs, renovation, reconstruction. So the loan must have been taken for any of these purposes. Then only you can claim interest on loans as deduction. Okay, ma. Next. Look at, try to understand the pre-construction period interest concept. Pre-construction period interest is nothing but the interest which is paid or payable during the period of construction. Right, sir? Suppose that the construction of the house property taken place 2 years, let us assume. Whatever the interest you have paid during this period of 2 years, that interest is what we call pre-construction period interest. That interest is what we call pre-construction period interest. Are you following, sir? Whatever the interest paid or payable during the period of construction is called as a pre-construction period interest. Now, how to calculate it? How to calculate? Look at the step number one. First of all, we need to determine the PCP, pre-construction period interest. Pre-construction period. It always starts with the date of borrowal of the loan. Always start with the date of borrowal of the loan and ending with two dates, ma. 31st March immediately preceding to the year of completion of construction, right? Preceding to the previous year, preceding to the completion of construction, or date of repayment of the loan, whichever is earlier. So among these two, we have to take the earlier event, ma. Are you following or not? Right, sir. Look at these examples. Date of completion of construction 31st of October 2021. That means during the previous year 21-22, the construction was completed. Okay, sir. Now, what is the 31st March prior to this particular date? That will be the 31st March 2021. So 31st March prior to the date of completion of construction. So date of completion of construction kanda mundu edaithe 31st March vastudo adi teesukovalamma. That will be the end period of the PCP. Okay. Next. Second step, we have to calculate PCPI. So the formula will be loan amount into rate of interest into PCP. You will get the pre-construction period interest. So pre-construction period interest will be allowed as deduction in 5 equal annual installments, sir. PCPI will be allowed as deduction in 5 equal annual installments starting from the previous year in which the construction was completed. So pre-construction period interest per annum is equal to PCPI divided by 5. Okay, ma. Now how to calculate? Let us assume the pre-construction period interest 7,20,000 divided by 5. So every year you will get a deduction of 1,44,000. And the property construction was completed in the year 21-22. So from there, 5 years you will get deduction, sir. Okay, now. So 21-22, 22-23, 23-24, 24-25, 25-26. So up to the previous year 25-26, you will get pre-CPI as deduction. Every year how much? 1,44,000. And from 26-27 onwards, you will be having only current year interest. Okay, now. Next. After that, ceiling limits with respect to interest on loans. Right, in the case of the let out properties, deemed to be let out properties, there is no ceiling limits, ma. You can claim any amount as deduction. Even if you paid an interest of some 10 lakhs, 10 lakhs fully you can claim deduction. Fully you can claim deduction. Okay, sir. Next, coming to self-occupied or unoccupied properties, we have ceiling limits. The maximum deduction of 2 lakhs subject to conditions. You have some 4 conditions to be satisfied. The loan should have been borrowed on or after 1/4/1999. The purchase or construction should be completed within a period of 5 years. And number 3, the purpose must be purchase or construction. And number 4, there must be a certificate from the lender. Okay, sir. If all these 4 conditions satisfied, then you can claim a maximum deduction of 2 lakhs. Otherwise, the maximum deduction you can get only 30,000 rupees. Okay, now next. Whenever you are paying interest outside the India, you are subject to 2 obligations. You have to deduct the TDS, and whatever the TDS deducted, that should be remitted to department. If the 2 following obligations are satisfied, then whatever the interest you paid outside the India, fully claimed as deduction. You can claim full amount as deduction. You can claim full amount as deduction. But if any of the 2 obligations are not satisfied, like you have not deducted TDS or you have deducted TDS but not remitted to department, then whatever the interest paid outside the India, that will not be allowed as deduction. Clear? Next. And the tax treatment of the LOP and DLOP, full format is applicable, full format. In the case of SOP and UOP, self-occupied and unoccupied, the format starts with NAV, directly NAV, net annual value, and then standard deduction 0 because your NAV is 0. The only deduction allowable is interest on loans, maximum of 30,000 or 2 lakhs. So that's why in the case of the self-occupied or unoccupied properties, there will be always a loss, always a loss. Okay, now next. Types of house properties. Totally there are 6 different types of house properties. Self-occupied property, let-out property, deemed to be let-out property, unoccupied property, and then part of the year let-out, part of the year self-occupied, part of the property let-out, and part of the property self-occupied. Okay, sir. And regarding self-occupied property, unoccupied property, the tax treatment we have discussed here already. This is the tax treatment, sir. The format directly start with NAV. You have to take 0, right, sir? Then standard deduction 0 because 30% of 0 becomes 0. Then interest on loans maximum 30,000 or 2 lakhs. So always there is a loss in the case of self-occupied or unoccupied property. And let-out property, deemed to be let-out property. These are the provisions applicable, sir. But the only difference is in the case of let-out property, section 23 calculation, GAV calculation, 3 steps applicable. In the case of deemed to be let-out property, only 2 steps applicable. Are you following, sir? So in the case of let-out property, GAV could be actual and received or receivable or expected rent. But whereas in the case of deemed to be let-out property, GAV means to be expected rent only. That's the only difference. The remaining provisions holds good same. As it is apply. Are you following or not? Part of the year let out and part of the year self-occupied. Right, sir. Look at this example. It was self-occupied for 3 months and let out for 9 months. So here we have to make the calculation by taking the assumption that as if the property was let out for full year. Even though it was self-occupied for 3 months, you have to take the assumption the property was let out for full year, 12 months. Then you have to calculate the income from house property. Okay, ma. So GAV calculation, 3 steps applicable. Step 1, step 2, step 3. Municipal taxes, you can claim 12 months municipal taxes paid deduction fully. Interest and loans fully allowable as deduction without any ceiling limits. And FRV, MRV standard rent we have to calculate for 12 months. Actual rent anyhow we will calculate only for the let out period. Okay, ma. So that's the tax treatment. Next, part of the property let out, part of the property self-occupied. Look at this example. We are having a house property out of which 60% of the portion we have given on let out basis, 40% self-occupied. Now, here you have to take the assumption that we need to calculate the income from house property by taking the assumption that as if there are 2 separate house properties. As if there are 2 separate house properties. So let out portion, a separate property, separate calculation, and self-occupied portion, separate property, separate calculations. Clear? Okay, now next. Sir, what about the situation? A fair rental value, municipal rental value, standard rent, municipal taxes, interest on loans, if they're given on consolidated basis, then you have to bifurcate right? Bifurcate between the let out portion and self-occupied portion basing upon the floor area basis or plinth area basis. Nothing but in our example, the bifurcation should be done in the proportion of 60 is to 40. 60 is to 40. Are you following, sir? And then nothing but 3 is to 2 ratio. Nothing but 3 is to 2 ratio. Clear? All these, if given on consolidated basis, they have to be bifurcated basing upon the percentages given in the problem. So with this, I've covered all the important provisions of income from house property, sir. It's a marathon class. Try to remember, sir, it's not a regular class. So I've covered almost 75% of the income from house property provisions. Right, sir? So deductions I've covered. Interest on loans, PCPI, current year interest, ceiling limits I've covered. Okay. And then self-occupied property, tax treatment I've covered. And types of house properties, self-occupied, let out, and then deemed to be let out covered, unoccupied property covered, part of the property let out, part of the property self-occupied covered, part of the year self-occupied, part of the year let out covered, section 25 covered. Tax treatment of the unrealized rent or arrears of rent received. Section 25 capital A. This is also a very important provision. Let me take you there. Tax treatment of recovery of unrealized rent. Very simple, sir. Right? For recovery of unrealized rent and arrears of rent received, the same provisions applicable. They are taxable in the year of receipt, always taxable in the year of receipt, right? Irrespective of the fact whether the asset is the owner or not in that year. And you can claim a flat amount of 30% as deduction out of it. Flat amount of 30% you can claim as deduction, sir. Right? See, 30,000 is a recovery of unrealized rent, out of which flat 30% deduction allowed, 9,000, only 21,000 will be taxable in the year of receipt. Okay, ma. So this is also done. So hardly I've left off 2 or 3 topics like co-ownership and everything, composite rent concept. That's it. After that, you will be having problems. So only I left out that co-ownership and composite rent that you can read out ma on your own. Okay. So out of the 5 heads of incomes, income from salaries, marathon completed, income from house property, marathon completed. In the next session, I'll start with the PGBP, profit or gains from business or profession, marathon. Okay, now till then, have a good day and good night, sir. Stay home and stay safe. A very good morning, students. So in the last class, we have completed discussion regarding income from house property. So welcome to the income tax marathon classes. So far we have completed income from salaries marathon class and income from house property marathon class. Now time for the PGBP, the third head of income, right? So profits or gains from business or profession, right, sir? So sections contained here, section number 28 to section number 44 DB, right, sir? So look at the running notes, chapter number 5. So profits or gains from business or profession. Sections contain 28 to 44 DB. And the weightage of the chapter, we can expect one question from this chapter, right? So one problem compulsory from this chapter for 8 marks. And apart from a specific question, a straightforward question from this chapter, and it will also comes in total income problem as well, consolidated problem. That is question number 1 in our income tax. So that question number 1 contains the provisions from any of the 3 or 4 heads of incomes, which must also include the PGBP, right, sir? So the list of important sections from this chapter, section number 28, charging section, 32, depreciation, 35, scientific research expenditure, 35, AD specified businesses, 36, other deductions, 37, residuary section for deductions, 48, clause 1, 48, 1A, disallowances, 48, 2, expenses found to be excessive, and 48, 3, cash payments greater than 10,000 rupees, 41, for recovery of bad debts, 43B, deduction on actual payments, and 44, AB, tax audit, 44, AD, ADA, and AE, presumptive taxation. So these are the list of important sections from this chapter. See, that's actually our regular way of teaching here. So basically, whenever I am introducing a new chapter, first I will introduce the chapter in brief, and then I will go for the list of important sections. Thereby, the students will be attentive at the time of discussing that particular section. While we are discussing about section 32, depreciation, the students must be attentive, 100% concentration it requires, because it's a very important section. It's a very important section. Are you following, sir? Right? So like this, every head of income, the first step I will do is I'll give the list of important sections from that particular head. Right? You might have seen already in income from salaries and in income from house property. Right? Now PGBP, sir. So first one, sir, charging section, section number 28. Right? You already learned that for every head of income, first we should learn about the two sections. Number one, charging section, and number two, method of accounting. Because charging section deals with what are the incomes taxable under this particular head, and method of accounting deals with on what basis they are going to be taxable. So what are the incomes taxable, on what basis they are taxable? So first we should try to understand about these two concepts, then we can understand easily the remaining provisions of the chapter. Yes or no? Right, sir. So section 28, charging section. Unlike the earlier charging sections, section number 15, income from salaries, any amount due to or received by the employer, received by the employee from the employer, which falls in the term salary chargeable to tax under that income from salary in the hands of the employee. That's it. Hardly it is at just 2 or 3 lines charging section. Coming to the income from house property, the annual value of any property comprising of buildings or lands appurtenant thereto for which the assessee is the owner, chargeable to tax under that income from house property. Hardly again 2-3 lines charging section. But here in PGBP, you have the biggest charging section ever. It contains almost 10 clauses, and it ranges from 2-3 pages, not 2-3 lines, 2-3 pages. The biggest charging section. Of course, it itself is the biggest head of income, PGBP. PGBP and capital gains, regular classes, ma'am. PGBP capital gains, I used to take both put together. I used to take around 50 hours, ma'am. 55 hours I'll take for the completion of PGBP and capital gains. 55 hours minimum I'll take for the completion of these two chapters. Out of the 55 hours now, so within that 55 hours, I will complete 80% of GST syllabus. 80% of GST syllabus, almost. For GST in regular classes, I will take around 70 to 75 hours. 72 to 75 hours. Regular classes GST. Right. But only the coverage of income from business or profession, capital gains itself requires 55 hours in regular classes. And of course, it's a marathon class. So for these two chapters, hardly I'm going to take 4 hours, because we should complete the entire marathon recordings within a period of 12 hours. Within 12 hours. Right, sir? So PGBP, I'm going to take 2 hours marathon, and capital gains, I'm going to 2 hours marathon. So that's why I'm not going to cover each and every provision. I'm going to cover whatever the list of important sections I've given here. Only that important sections I will touch. Okay, sir. So look at the charging section. 28 clause 1, the profits and gains of any business or profession which was carried on. This is important one. Which was carried on by the assessee or on his behalf at any time during the previous year shall be chargeable to tax under the head PGBP. Right? So profits and gains of any business or profession. It could be a specified business or a non-specified business. Could be a speculation business or non-speculation business. Right, sir? Right. So, and it covers all the professions income. It also includes income from vocational activities. Right, sir? But that business or profession should be carried on by the assessee or on his behalf at any time during the previous year. This is key point. Shall be chargeable to tax under the head PGBP. Right, sir? So the profession or business must have been carried by the assessee or by on his behalf, but that should be carried on during the previous year, at any time during the previous year. Right, sir? So then only whatever the income you are getting out of that business or profession shall be chargeable to tax under the head PGBP. Are you following, sir? Right? But of course, for this provision, we have some exceptions. We have some exceptions, and that exceptions are provided here. Yeah. The golden rule is that the business or profession must be carried on by the associate during the previous year. That's the golden rule. But for which we have exceptions. That is section number 41. Section 41 deals with what? 41 deals with deemed income. We will discuss later. Then 176.3a. 176.3a discussed about the discontinued profession. Sorry, discontinued business. Discontinued business. Suppose that I was discontinued my business in the year 2000. Let us assume that 2018 itself. But regarding the same business, I have received some amounts in the year 2022. In the year 2021-22. The business was discontinued during the previous year 18-19. Regarding the same business, there were some bad debts. There were some uncollectible amounts which I have collected in the year 2021-22. Which I have collected during the previous year 21-22. Now, during the previous year 2021-22, I have not carried out my business because that business was already discontinued. But still, for the previous year 2021-22, whatever the profits you have received from the discontinued business will be taxable in the previous year 21-22 by taking the assumption that as if your business was in continuation. As if your business was in continuation. You can see here, any money collected after the discontinued of the business will be chargeable in the same manner and to the same extent as if the business was in continuation. Are you following, sir? So you have to take the assumption that the business was still in continuation, then you have to levy the tax on that particular amounts and apply the same logic with respect to the discontinued professions. 176.4 discussed with what? Discontinued professions. So any amounts you have collected, suppose that I have discontinued my profession during the previous year 2021 itself, right? I have discontinued my profession during the previous year 2021 itself. Now, because I was joined in a government job, full-time employment. So whenever you are opting for the full-time employment, you should not be in the profession. You should not be a practicing chartered accountant. So I have surrendered my COB. I'm not a practicing chartered accountant. No, I'm a chartered accountant, but not a practicing chartered accountant. So I'm still the member of ICI, but not the practicing member of ICI. Are you following or not? So in 2020-21, I've surrendered my COB. I discontinued my practice. But regarding my practice, I'm collecting some amounts during the previous year 21-22. Some clients of mine paying their dues in the year 21-22. Right, sir? So even though my profession was discontinued, but still I'm getting the receipts from that profession. So in the previous year 2021-22, whatever the professional receipts I got, still taxable under the PGBP with the assumption that as if the profession was in continuation. So the golden rule is that the business or profession must be carried on by the associate during the previous year at any time. But we do have some exceptions like 176.3a and 176.4. Are you clear or not? Next. There is one more golden rule, that is income from the business taxable under the PGBP. Right, sir? But of course, we do have some exceptions. The exceptions is like rental income, income from house property. See, if letting out of the properties is your business, letting out of properties is your business. You're buying the property and letting out. You're buying the property and letting out. So you're buying for the not the purpose of resale. You're buying and letting out, buying and letting out. So letting out is your business. Then in that scenario, the let out income will be taxable under the head PGBP. Under the head PGBP, not house property. Under the head PGBP. Are you following or not? Every one of you. Right, sir? So actually from the exceptions, we can remove this. because this provision was recently added. Letting out of the property is your business, then let out income taxable under that PGBP. Okay. Next, dividend income always taxable under that income from other sources. Even buying and selling of securities is your business activity. Buying and selling of securities is your business activity. See, whatever the profits or gains you are earning from that particular buying and selling of securities will be taxable under the head PGBP, because whenever you are buying and selling securities on a continuous basis, the securities will become a stock in trade to you, not a capital asset. Right, sir? So PGBP will comes into picture, but whatever the dividend income you are earning out of that securities, the dividend income is always taxable under that other sources. Next, winnings. Winnings from betting, gambling, lottery, crossword puzzles, TV shows, game shows, all these always taxable under that PGBP. See, now IPL season is going on, betting season is going on, right, sir? So betting is your professional activity. From the day one of IPL till the conclusion of IPL, you are betting. So it is your professional activity. You are a professional bettor. You are a professional gambler. Still, whatever the income you are earning out of it, always taxable under their other sources only. Clear, sir? Next. Look at this point. Income from illegal business is also taxable. See, the department is least bother about the legality of business. Whether you are doing the business on a legal way, whether you are doing the business in an illegal way, it doesn't bother the department, income tax department. See, the illegality of the business will be taken care by some other departments like CBI, ACB. They will take care of. But income tax department is concerned about your profits, concerned about your gains. So have you earned by legal means or illegal means, it's least bother. The department is least bother, right? Okay, sir. So the illegal income is also equally taxable. Clear, sir? Next. The illegality of the business or profession or vocation does not exempt its profits from tax. They have to pay the tax on it. Clear, ma? So that's clause 1. And clause 2 about compensation. Compensation. See, here we have different types of compensations. Right? So compensation generally a capital receipt, ma. But there are certain capital receipts by way of compensation which are taxable under the PGBP. Right, sir? What are they? Compensation received by any person by whatever name called managing the whole or substantially the whole of affairs of an Indian company or the affairs in India of any other company at or in connection with the termination of his management or of office or the modification of any of the terms and conditions thereto. Suppose that there is an NRI who is doing business in India through an agent called Mr. A. For the first 2-3 years, Mr. A performed well. There are a huge amount of profits, right? So NRI was very happy. But later on, from the 4th year onwards, Mr. A doing something like, even though there is huge amount of profits, he is not disclosing to that NRI and is not giving good amount of profits to NRI. So NRI not satisfied with his activities from the 4th year onwards. Then immediately the NRI made some changes to his profile or terminated from this position, right? Who is managing the whole or substantially the whole of affairs of an Indian company or the affairs in India of any other company, right, sir? So now whenever there is a change in the terms and conditions or whenever there is a change in the profile, then that NRI should have to pay certain compensation to Mr. A, and that compensation is taxable under the head PGBP in the hands of Mr. A, right, sir? Next, any person by whatever name called holding an agency in India for any part of the activities relating to the business of any other person at or in connection with the termination of agency or the modifications of any terms and conditions relating thereto. Look at this example. B was a distributor of a company for the entire northern India. Later, the company has modified the contract of agency, limiting the coverage only for Delhi. Earlier, he was the distributor, whole and sole distributor of that particular company for the entire northern India, which contains almost 7, 8 states. But now his coverage restricted to only one state, Delhi. Right, sir? So there is a modification in the terms and conditions. Now for which the company has to pay certain compensation. So company compensated B with 5 lakhs rupees. Such amount will be taxable as a business income. Clear, sir? Next, compensation received by any person in connection with the vesting to the government or any corporation owned or controlled by the government of the management of any property or business. So you are giving your business to the government, or you are giving your property to the government for which you are receiving a compensation from the government. That compensation, though it is a capital receipt, taxable under the head PGBP. Clear, sir? So like this, whatever the compensations are given here, they are in the nature of capital receipts, but they are taxable under the head PGBP. Right, sir? Next, income of any trade professional association from specific services rendered to its members. Right, sir? So here, specific services. Sir, what do you mean by specific services? Look at here. Specific services are those services which are available even for members only on the payment of the prescribed fees. Only on the payment of the prescribed fees. Like that. Like, sir, ICI will conduct some seminars. Right? Its branches. Right? It will conduct some seminars. For attending that particular seminar, we have to pay certain seminar fees, delegation fees, delegate fees. Right, sir? Now, whatever the fees ICI is receiving from us in the form of seminar fees or delegate fees for providing specific services, now that fees will be taxable in the hands of the ICI, but not the entire amount. Suppose that it is collected the seminar fee of some 5 lakhs rupees. For conducting seminar, it has incurred an expenditure of 3 lakhs rupees. So what is the amount left over? 2 lakhs. Only this 2 lakhs is taxable. Are you following or not? Okay. Next, and after that, 28 clause 3 subclause A to E, which contains some export incentives in the form of CCS, cash compensatory support, DD, duty drawback, import entitlement licenses, right? So transfer profit and transfer of the duty entitlement passbook, profit and transfer of the duty free replenishment certificates, right? These are all the export incentives in relation to the exports which we have made, and all that export incentives taxable under the head PGBP. Next, value of any benefit or perquisite. So if you are receiving any benefit or perquisite in relation to your business or profession, arising out of your business or profession, that will be taxable under the head PGBP. Suppose that I have received a smartphone as a gift from my client on successful completion of his tax audit for the financial year 21-22. I've been given with a smartphone from my client worth rupees 20,000. Whatever the 20,000 rupees worth of gift I have received from my client, that will be taxable as my professional income. That will be taxable as my professional income. Are you following or not? So any benefit you are getting, any perquisite you are getting out of your business or profession, always taxable under that PGBP. Next, sum due to or received by a partner of a firm. Right, sir? See, any amount received from the partnership firm by the partner will be taxable. Generally, what are the amounts is going to receive? Number one, profits, share of profits. Anyhow, this will be exempted under section 10(2)(a) in the hands of the partners, because the firm will pay tax out of it. The firm will pay the tax on that profits. Clear, sir? Since the firm is paying the taxes, the same is exempted in the hands of the partners. Share of profits first he will receive, then he will receive remuneration from the partnership firm, taxable under the PGBP. He will also receive interest on loans. Interest on loans or interest on capital also. These also taxable under the PGBP. But of course, we have some exemption benefits, and that exemptions we will discuss in 40 small b. We will discuss in 40 small b. Okay, ma. So regarding this provision, I'll be explaining in detail in 40 small b section. Assessment of the firms. Okay, ma. Right. Completed. Now let's moving on. Section 28 clause 6. Any sum received under key man insurance policy. right, sir? Regarding the same, we have the running notes here. Key man insurance policy. Generally, employer take this insurance policy on the life of the key employee of the organization. For every organizations, there are some key employees. Their existence in the organizations is very much needed. If they resigned, or if they terminated, or if they died, it would have a great impact on company's survival. So like that, for every organization, there are some key employees. So on their life, the company will take the insurance policy, right, sir? Because whatever happen in the future, like he may get terminated, he may got, died, or he may got resigned, retired. And after that, whatever the loss they are going to face, in order to compensate that loss, they will compensate that particular losses out of this insurance policy proceeds. So that's the main objective behind taking the key man insurance policy, right? So the company will take the policy, company will pay the insurance premium, and whenever the policy gets matured, there are three possibilities, right, sir? Either the policy proceeds received by the employer, or even though the employer received the policy, the same will be remitted to employee, or if employee died, the employer given the policy proceeds to legal heads of the employee. So there are three possibilities. Now, what is the tax treatment? If employer received the key man insurance policy proceeds, then it will be taxable under the head PGBP. If employee receives income from salaries, if the legal heads of the employee receives income from other sources. So you should be very careful that whoever receiving the person, that will decide the head of income. If received by the employer, PGBP. If received by the employee, salaries. If received by the legal heads of the employee, then income from other sources. Okay, ma? Next. Fair market value of the inventory on its conversion as a capital asset. So whenever you are converting the stock in trade into your capital asset, right? So as on that particular day, whatever the fair market value is there, that fair market value, you should be taken it as your business income, right? Suppose that I am running a jewelry shop. Today we got a new stock, out of which one jewelry which was attracted me very well. There was one bracelet which attracted me very well. Since I am the owner of that jewelry shop, I've taken that bracelet from the stock and I've started wearing to my wrist. What I have done here is I've converted a stock in trade into capital asset, because personal jewelry is capital asset, which we are going to study in the capital gains chapter, right, sir? Which we are going to study in capital gains chapter. Jewelry is a capital asset. Yes or no? Right, sir? So what I've done, sir, I've converted the stock in trade into my capital asset. See, had I have not been taken that bracelet, had I have not used that particular bracelet, what would have done by me? I would have sold it. Yes or no? I would have sold it. I would have earned some business income. But because I have started using that bracelet for my personal purposes, I am not going to sell it to anyone. So that means there won't be any business income out of that bracelet. Yes or no? If there is a business income, I would have paid income tax to department. But since I've converted that stock in trade into my capital asset, I'm not going to pay any business income tax. I'm not going to pay any tax on that business income. So that's why whatever the department said is, whenever you're converting the stock in trade into a capital asset, we assume that that stock in trade was sold out and you have to pay tax on it. Are you following, sir? So the fair market value of the inventory as in the date of which conversion or treatment as a capital asset determined in the prescribed manner would be chargeable to tax as business income. It is quite opposite to conversion of a stock in trade, conversion of a capital asset into stock in trade. Right, conversion of a capital asset into stock in trade. That tax treatment we are going to study in capital gains. This is conversion of stock in trade into capital asset. So when you're converting stock in trade into capital asset, business income will come into picture and taxable under the head PGBP. When you're converting a capital asset into stock in trade, then capital gains comes into picture. capital gains comes into picture. Yes or no? Right. And 28 clause 8 is about section 35 AD, right? If you purchase any capital asset, right, against which we have taken the deduction under section 35 AD, and subsequently if you discard that capital asset, demolished or destroyed or transferred, with respect to the same, if you received any sum, that sum will be chargeable to tax under the head PGBP. See, regarding this clause 8, I will be discussed in detail along with section 35 AD. Don't worry. In section 35 AD, we will be having a provision like sale of a capital asset used for the specified businesses. We have a concept there. I will discuss in detail. Okay, ma. Next. Speculation business, right? See, if you have two businesses like speculation business and non-speculation business, anyhow both the incomes are taxable under the PGBP only, but department suggested you to maintain separate books of account for non-speculation business, separate books of account for speculation business income, because non-speculation business losses can be set up with any kind of any other non-speculation businesses. Are you following, sir? And non-speculation business losses you can also set up with speculation business profits. And non-speculation business losses can be carried forward for 8 assessment years. But whereas speculation business losses will be set up only with the speculation business profits, and the speculation business losses can be carried forward up to maximum of 4 years only. So we have a different set of provisions for non-speculation business, speculation business. That's why department suggests you to maintain the separate books of account for both their businesses. Okay, ma. Next. Method of accounting. Regarding PGBP, the method of accounting applicable is, right, accrual basis or receipt basis, whichever is regularly followed by the SSE. Whichever is regularly followed by the SSE. The option is given to SSE, sir. Option is given to SSE. If you want to follow the accrual basis of accounting, yes, you can follow. If you want to follow the cash basis of accounting, you can follow. It's purely option given to you. Okay, ma. Right. So according to section 145, which deals with the method of accounting, any income chargeable under the PGBP shall be computed in accordance with the method of accounting regularly followed by the SSE, either cash basis or mercantile basis. But of course, for this method of accounting, we have some exceptions like 32 depreciation, 43B deductions allowed only on actual payment. Like this, we have some exceptions. Okay, next. And method of income computation, it explains about the format, ma. Look at here. There is a standard format for the calculation of business income. First, if you given with the profit and loss account, majority of the cases, ma, PGBP problem, it starts with the profit and loss account, right? There will be already a profit given to you. So from that profit, you have to start your answer. So net profit as per the profit and loss account, and for which we need to make some adjustments like expenses debited to profit and loss account, but not eligible for deduction. There are some expenses which are not eligible for deduction, but you might have already claimed it as deduction, right? So what is the tax treatment, ma? Suppose that you have incurred some personal expenses for which the deduction not allowed, for which the deduction not allowable. Personal expenses don't get any deduction. Any expenditure you have incurred towards your business or profession only eligible for deduction, right, sir? But you don't have this provision and you have already debited to profit and loss account. Out of which what happens, sir? When you debited a particular expenditure to profit and loss account, what happens? Your profits will get reduced. Now we are making an adjustment entry for this. You are making an adjustment entry for this. That means since you debited this amount, now it's time to credit. When you credit that amount, what happens? Your profits will increases. So we need to add to the profit. We need to add to the profit. Are you following or not? You have debited an expenditure for which you are not eligible for deduction. Since you debited that expenditure, your profits got reduced. Now later on you came to know that I wouldn't have debit this. So now you're making an adjustment entry. See, for a debit entry, what is adjustment entry? Credit entry. So your credit into profit and loss account. And what happens? Your profit will increases. So that's why you need to add to the profit. You need to add to the profit. Next, incomes created to profit and loss account, taxable under other heads. Like you have received some dividend income and you have credited to your profit and loss account. But as per the provisions just we learned, dividend income is taxable where, amma? Dividend income taxable under that other sources, not under that PGBP. Dividend income taxable under that other sources. But you credited to the profit and loss account by which your profit got increased. It's a wrong entry. So for which you have to make a adjustment entry, right entry, and that means you have to debit it. So a credit under a debit, what happens? The impact will be nil, right? The impact will be nil, right? So now you are making a debit entry, and that means what, amma? Right? Your profit should be reduced. So less. So incomes credited to profit and loss account, taxable under other heads. So from the net profit, you have to deduct. You need to reduce your profit, so you need to deduct. Next, expenses which are eligible for deduction but not debited to profit and loss account. There are certain expenses for which you are eligible to deduction, but you forgot to claim deduction. Forgot completely, you forgot. But later on you came to know and you are claiming deduction. You are making a debit entry and whereby your profits will get reduced. So less. Okay. Next, incomes which are taxable under the head PGBP but not credited to profit and loss account. There are certain incomes which are taxable under the PGBP, but you have not taxed. You thought they will be taxable under other heads. You thought they will be taxable under other heads, but that will be taxable under the PGBP only. So you are crediting to your profit and loss account. Crediting means your profit will increase. So add back. So like this, we need to make some adjustments. And after making all these adjustments, whatever the answer you are going to get, that will be your taxable business income, or that will be your taxable professional income. Yes or no? So this is how you need to calculate the PGBP, business income or professional income. Clear? Next. After that, we are moving to the deductions. Deduction starts from section 30, section 30 to section 37. It deals with the deductions which are eligible under the head PGBP, the expenses which are eligible to deduction. Look at here, sir, in these running notes. Section 30, expenses relating to buildings, the very first section. So generally, these are the expenses we incurred in relation to a building, repairs and maintenance, rent, insurance premium, municipal taxes, rent collection charges, depreciation, interest on loans. Okay, sir. Now look at here. All these expenses, the expenses which I have shown in right side, that is repairs and maintenance, rent, insurance premium, municipal taxes, rent collection charges, all these you can get deduction under section 30. Under section 30. But except the municipal taxes, municipal taxes are subject to section 43B. What is 43B, ma? The deduction will be allowed only on actual payment. Deduction will be allowed only on actual payment. Right, sir? Ma, 43B, for your kind information, 43B is not a deduction section. Municipal taxes payable, deduction not allowed. Municipal taxes paid, you already paid, so deduction is allowed, but not under the head 43B, under the head 30 only. This is a situation where majority of the students will get mistake. They think that 43B is a deduction section. No, 43B is a compliance section. Compliance section. See, first you try to understand the nature of section, then try to understand the provisions of that section. Are you following or not? So 43B, it is a compliance. It's saying like, it will give you a list of expenses. Babu, with respect to these expenses, you will get the deduction under their respective sections, but only on actual payment. Only on actual payment. Are you following or not? So municipal taxes allowed as deduction under section 30 only, but they will be allowed as deduction under section 30 only on actual payment. Who said this? 43B said this. Clear? Next, depreciation on buildings. You can claim deduction on, under section 32 and interest on loans, section 36(1). Okay. Ma, here buildings means to be only commercial buildings, ma. Not residential buildings. You won't get the depreciation on residential buildings. Are you following or not? You don't get any depreciation on residential buildings. You purchased a house property and using for your self-occupation purposes, can you claim depreciation? Have you heard about depreciation under that house property? No. Under the house property, what are the deductions allowable? Only standard deduction, interest on loans. That's it. No depreciation. So whatever the depreciation you are studying under that PGBP, only towards the commercial buildings like office, godowns, warehouses. Are you following or not? Next, repairs expenditure. Sir, we will be having two different types of repairs here. Capital repairs, current repairs. If it is a capital repair, you can claim depreciation, not deduction. If it is a current repairs, which is a revenue expenditure, under section 30, you can claim deduction. Okay, ma. Next, section 31, expenses in relation to plant and machinery, furniture. Right, sir. So generally, we will incur the expenses like repairs and maintenance, insurance premium. These two will be allowed as deduction in section 31. Depreciation on plant and machinery, furniture, 32. Higher charges, 37. Higher charges of the plant and machinery, furniture, you will get deduction under section 37, ma, not under section 31. Clear? Next. Section 32, depreciation. Section 32, depreciation. So come to the provisions. Depreciation. Yeah. The very first point they mentioned is it compulsory to claim the depreciation? Actually, sir, claiming of depreciation is beneficial to assessee only. But there are certain situations where the assessee won't claim any depreciation. Example I've given here. When assessee is eligible for exemption under section 10AA, exemption to the SEZ units. SEZ units. Under section 10AA, you are going to study like the first 5 years of business, 100% of export profits exempted. Next 5 years, 50% of export profits exempted. And the last 5 years, that is from 11th year to 15th year, either 50% of export profits or amount transferred to SEZ reinvestment reserve account, whichever is lower, eligible for exemption. Like this, you will study the provisions. The first 5 years now, 100% of export profits are exempted from tax. Look at this example. Suppose that you have an export profit of 100 lakhs and you have a depreciation in the first year 10 crores. You have a depreciation in the first year 10 crores. Year 1 depreciation. Right, sir? Suppose that you have claimed this depreciation 10 crores. Are you following, sir? Now, out of the 100 lakhs, right? Say, let is 100 crores. If you claim depreciation worth 10 crores, see, you have a profit of 100 crores and you're claiming depreciation of 10 crores. So what will be the ultimate net profit? 90 crores. So now what is the tax treatment? This 90 crores is exempted from tax. 100% of export profits exempted. Kada? Suppose that you have an export profit of 100 crores and you have not claimed any depreciation. What is your export profits now? 100 crores. Now what is the tax treatment? Fully exempted. Right, sir? See, whether you are claiming the depreciation or not, it doesn't impact your taxability. If you claim depreciation, your tax liability is 0. If you're not claiming depreciation, still your tax liability is 0 because 100% of export profits are exempted anyhow. So that's why what the assessee said, sir, from year 1 to year 5, I don't want to claim any depreciation. I will start claiming depreciation from year 6 only. Right, sir? So though claiming of depreciation is beneficial to SSE because it will lower its profits, the business profits, because depreciation is an expenditure, non-cash expenditure. It will reduce the profits. Thereby, the SSE can reduce his tax liability. But because of this provision, the first 5 years, SSE is not interested in claiming depreciation. Right? But the department said, no, Amma, you have to claim the depreciation. Actually, earlier there is a case law, Mahendra Mills, in which the Supreme Court has given the decision that is claiming of depreciation is optional. To nullify this judgment, the department comes up with an explanation to section 32. An explanation has been provided and said claiming of depreciation is mandatory. The depreciation provisions shall apply, shall ante mandatory. Therefore, claiming of depreciation is compulsory now. Whether it is beneficial to you or not, claiming of depreciation is compulsory. Okay, ma'am. Next. After that, you have the classification of the assets which are eligible for depreciation. The assets are being classified into two main categories: tangible assets, intangible assets. Tangible assets includes plant, machinery, building, and furniture. And intangible assets, know-how, patents, trademark, copyrights, designs, drawings, logos. These are all intangible assets. But look at here. Since our childhood days, we are learning land is not a depreciable asset. Land, gold, these are always appreciable assets. Their value always increasing, not decreasing. Even there is a downfall, it's a temporary. It's a temporary. Yes or no? So on land, you should not claim any depreciation. Next, intangible assets, self-generated goodwill or internal generated goodwill is not a depreciable asset. Self-generated goodwill, name and fame. If it is self-generated, internally generated, right, sir? So that is not a depreciable asset. You cannot claim a depreciation on it. Clear? Next, after that, you have the definitions. Plant and machinery is a residuary definition, ma, right? It covers all those assets which are not covered under buildings and furniture. Right, sir. Next, types of depreciations. We have normal depreciation, additional depreciation, and you can also add here reduced depreciation. Like whenever the asset is being put to use for less than 180 days, you can claim only half of the depreciation, right? For that previous year. Yes or no? That is reduced depreciation. So normal depreciation, additional depreciation applicable only for specified categories of assets, like those who are engaged in the business of manufacturing or production of any articles or things. And reduced depreciation depends upon the number of days you have used the capital asset. Okay, ma'am. Next, conditions for claiming the business, claiming the depreciation as deduction. Assessee must be the owner of the asset, right? Assessee must be the owner of the asset. You must own that asset. Then only you can claim depreciation, sir. But of course, we have some exceptions, like number one, when tenant incurred any capital expenditures towards renovation or extension of buildings, to that extent of the renovation, to that extent of the extension, the tenant will be treated as owner of that building, and then the depreciation can be claimed. Suppose that I am the tenant of a building which contains 2 floors. Right, sir. I'm the tenant, but later on, my business got more expansion and the 2 floors are not sufficient to me. I have requested the owner to construct the 3rd floor also. Right. Again, the 3rd floor will be taken by me on rental basis. I given him assurance, but the owner said, I don't have money with me right now. Okay, no problem. You construct the 3rd floor on your own. Right. So the 3rd floor is now constructed by the tenant with his own money. Now for the 3rd floor, the tenant can claim depreciation. Okay. Next, whenever the property acquired on hire purchase basis. Sir, when the ownership will get transferred only upon the payment of the last installment of the asset. Suppose that you have taken the asset on a hire purchase basis, and at the end of the 5th year, you are going to get the ownership. 60 installment you are going to pay. End of the 5th year, you are going to get the ownership on that asset. But still, even though the first 5 years you are not the legal owner, you will be deemed as owner of that asset and you can claim depreciation. Next, joint ownership also recognized for claiming of depreciation, and registered ownership is not necessary. You are not required the registered owner of that asset. If you satisfied the 53A conditions, which we have studied in income from house property, then though the legal ownership is not in your name, if you are deemed as owner of the asset, you can claim depreciation. Okay, ma'am. Next, second condition, the asset must be used for the purpose of carrying any business or profession. Usage. So the asset must have been used for your business or for your profession. Then only you can claim depreciation. But of course, we have again some exceptions, like first one, staff quarters given to the employees. Presently, I am residing in a quarter which is given by my employer to me for my accommodation purposes. I'm residing in a C-type quarter now. Which will be given to the executives, right? Not to the staff, executives. Now, for which I'm paying hardly 1% of my basic salary as rent. 1% of basic salary will be deducted by the company towards rent and electricity. Not only rent and electricity. Okay, sir. So if my basic salary is some 50,000 rupees, so 50,000 into 1%. So every month I have to pay 500 rupees to the company towards rent and electricity. Staff quarters, right, sir? See here, the employer given the staff quarters to their employees, not for the purpose of earning rental income, sir, for the purpose of smooth functioning of his business. You know, what is my office hours? 24/7, we should be on duty. We should be on duty. Though our official timings starts from 10, ends with 6, 10 to 6 only. In between, we will be having 2 hours lunch break. In between, we'll be having 2 hours lunch break. Right, sir? Though our official timings are 10 to 6, but we should be available. We should be available on call 24/7. That's why our quarters will be nearest to the office. Will be nearest to the office. See, my quarter, from my quarter to the office, it will be hardly 5 minutes. Not only mine, every finance executive, every executive of the office, their quarters will be nearest to the office and administrative office. Administrative. The only reason is that the employee should be available within 10 minutes on call. Right. For the smooth functioning of the business activities, staff quarters are almost, you can see, sir, you can see the railways, you can see the any of the government organizations, the offices, the quarters will be nearest to their office, staff quarters. Right. So for the smooth functioning of the business, the employer constructed the quarters and given to the employees. But of course, for the maintenance, he will collect a nominal rent. And whatever the rent is collecting, taxable under the PGBP only. Next. Sir, whether the usage is an active usage or a passive usage. Active usage means actively used for your business purposes. You're using. Passive usage means you're not using, but it is kept ready for use. Kept ready for use, like fire extinguishers, water sprinklers, smoke detectors. All these are in your office premises, but they will be used only when there is a fire accident happens. You don't use the fire extinguisher every day, right? You don't use the smoke detectors, water sprinklers, fire alarms on a regular basis. Whenever there is a fire accident, then only they will use. So they will always kept ready for use. Passive usage, even if it is under kept ready for use condition, you can claim depreciation. So whether it's active usage or a passive usage, you can claim depreciation. Okay, ma. Next, sir, in case if the asset is neither used at all nor kept ready for use, then no depreciation will be allowed. Okay, next. Next important point. No depreciation allowable on cost of the land on which the building is constructed. See, with respect to the building, you can claim depreciation. But with respect to the land, you cannot claim depreciation, as land is not a capital asset. Okay, now. And then after that, there is one more provision like depreciation shall be allowed on block of assets. Right, sir? See, under the heading PGBP, or I can say that in income tax, the depreciation should be claimed block wise. The depreciation should be claimed block wise, and that is to on written down value basis. Written down value basis. It's mandatory. It's mandatory for all the assessees. Exceptions are electricity companies for which they can claim the depreciation asset wise, and they can also adopt straight line method of depreciation. Right, sir? So except the electricity companies, right? Those companies which are engaged in the power generation, power sector units, right? Remaining all other companies have to claim the depreciation blockwise, and that is to by adopting the method written down value method. Okay, ma. Now, half of the normal depreciation. I've already told you, if the asset is kept used for less than 180 days in the year of purchase, in the year of its acquisition, so this 180 days condition is applicable only for the first year. only for the first year, not for subsequent years. Right, sir? Now, from second year onwards, you can straight away claim full depreciation, irrespective of the fact for how many days the asset wasn't used. Right. So only for the first year, you have to look whether that asset is used for less than 180 days or more than 180 days. So if the asset is acquired during the year and put to use for the purpose of business or profession for less than 180 days, then you can claim only half of the depreciation. 50% of the depreciation is only allowed to you. Suppose that the value of the asset some 10 lakhs, rate of depreciation 15%, rate of depreciation 15%, and you put to use that asset only for 100 days. So only half depreciation will be given to you. Only half depreciation will be given to you. Are you following, sir? So 10 lakhs into 15%, 1,50,000 into 50%. So that means for the first year, you can claim depreciation of only 75,000. Right, sir? And I already told you the restriction of 180 days applicable only for the year of that asset is acquired and not in next years. In the subsequent years, even if the asset is used for less than 180 days, full depreciation is allowed. Okay, mom. You can see the example here. Date of acquisition 28th March 2020 means in the previous year 1920 it was purchased and put to use 28th December 2020. In 2021 put to use, you've started using the asset. Okay, sir. Now number of days used in the previous year 2021, you have used hardly for 94 days. In the month of December 4 days, January 31, February 28 and March 31. So you are put to use for less than 180 days during the previous year 2021. Means for the previous year 2021, will you get full depreciation or half depreciation? Full depreciation, sir. Because 2021 is not the first year, it is second year. In which previous year you acquired? You acquired in the year first year. So year one. Are you following or not? Next, sir. Quantum or amount of depreciation, I've already told you, sir. Depreciation shall be claimed as a percentage of written down value of the block of assets on the basis of written down value method. So therefore, depreciation is allowed on the system of block of assets and allowed on written down value method. But of course, I said like we have some exceptions, and that exception is LXCT companies, right? In the case of LXCT companies, they can claim asset wise and they can adopt straight line method of depreciation. Okay, sir. Everyone, next. And after that, you have the concept of block of assets. Sir, what do you mean by the block of assets? It consisting of a group of assets falling in the same category and having the same rate of depreciation. Right. And I'll take an example. I'll give you an example like buildings. Suppose that you have 4 buildings. Building number 1, which using for residential purposes. Building number 2, using for commercial purposes. Building number 3, residential purposes. Building number 4, commercial purposes. Totally, you have 4 buildings. Right, sir. Now here, with this information, you can create 2 blocks, ma'am. You can create 2 blocks. Block 1, name of the block, buildings. The rate of depreciation applicable, 5%. 5%. Now in this block, you can cover B1 and B3. Residential buildings chargeable to depreciation at the rate of 5% only, sir. Now next, block 2, heading buildings, rate of depreciation 10%. Commercial buildings, rate of depreciation applicable 10%. So B2 and B4. These two are covered in block 2. See, even though all of these buildings are belonging to same classification, all of these are covered under same classification building, but not belonging to the same rate of depreciation. Though it is covered under the same classification buildings, but not having the same rate of depreciation. Hence, we have created two separate blocks. So in order to create a block of assets, the condition to be satisfied, the assets must be falling under same classification like buildings, plant and machinery, furniture, and must be having the same rate of depreciation. Then only all such assets will be covered under a block. Okay, ma'am. Next, once you created the block, then you can claim depreciation on the block value. Right, sir? Now, how to compute the return on value of the block of assets? So the format starts with the opening return on value of the block. The preceding previous year's closing balance becomes opening balance for this previous year, for which add the actual cost of the assets acquired during the previous year. If you acquired any new assets, add the actual cost of that new assets. Then from which deduct the monies receivable in respect of the assets sold, demolished, discarded, or destroyed. The sale value of the assets sold, the sale value should be deducted. Then you will get the amount on which you can claim depreciation. This is the amount on which you can claim depreciation. Now on this amount, apply the rate of depreciation. Then you will get the depreciable amount, right? Deduct the depreciation. Then you will get the closing return on value of the block. Closing return on value of the block. This is what we call depreciable value. Depreciable value, from which deduct the depreciation, current year depreciation. Then you will get the closing return on value of the block. Then you will get what, Amma? You will get closing return on value of the block. Are you following, sir? Right? Next. Sir, here for claiming depreciation, there are two conditions to be satisfied. Just give me a second. There are two conditions to be satisfied. Number one, there must be at least one asset in the block. At least one asset in the block. And number two, there must be some value for the block. There must be some value for the block. So at least one asset should be existing in the block of assets, and there should be some value for the block. Then only you can claim depreciation. Assume that you have 10 assets, and during the previous year, you have sold all the 10 assets. You have sold all the 10 assets. So the assets left in the block, 0. The assets left in the block, 0. Now, can you claim depreciation with respect to 0 assets? You cannot claim. Are you following, sir? So that is why the first condition said there must be at least one asset in the block. Second condition, there must be some value for the block. Sir, you have 10 assets, out of which you have sold 6 assets. So you have 4 assets in the block, but the block value is 0. Block value. This value is 0. When this value is 0, your rate of depreciation 15%. So 0 into 15%, what is the depreciation amount? Also 0. Your rate of depreciation is 15%. So when depreciable value is 0, your depreciation is also 0. So that is where the second condition, there must be some value for the block. Okay, ma'am. Next. Actual cost, how to determine the actual cost? So first of all, you need to take the total cost incurred for acquiring that asset, for which from which you have to deduct the amount of subsidy received or granted. Regarding subsidy, I've given you an example here. This example is regarding subsidy. X Limited purchased the following assets: plant and machinery worth 10 crores, buildings worth 5 crores, furniture worth 5 crores, totally 20 crores. 20 crores. And they have received a subsidy of 5 crores from the central government with respect to all the assets. Right, sir? It's a composite subsidy. Now that composite subsidy you have to deduct from each and every asset basing upon the ratio. Now what is the ratio, ma? 10:5:5. దీన్ని మనం షార్ట్ చేస్తే 2:1:1. Okay ma. So now actual cost of the plant and machinery, original cost is 10 crores, right? From which you deduct the subsidy amount. The total subsidy you have received 5 crores into 2 by 4, 2.5 crores. The actual cost of the plant and machinery is 7.5 crores. Like this, for every asset you have to deduct. Okay ma. So any subsidy received in relation to the acquisition of asset, that subsidy should be deducted from the actual cost. Now look at this example. Okay, this is not the example, right? Suppose that I am starting a business unit. It is there in the material. I am starting a business unit, right? And that business unit is there in the located in Caesarea. Since I am starting the business unit in Caesarea, the government has given me a subsidy of 5 crores. The total worth of assets I have purchased 10 crores. And I got a subsidy from the government since I am starting my business unit in Caesarea, special economic zone area, or in a remote area or a backward area. I'm starting my business unit. So as an encouragement, the government has given me a subsidy of 5 crores. Now, can I deduct this 5 crores from the actual cost of the asset? Answer is no. Because whatever the subsidy you are getting here, the subsidy is a location specific subsidy. Location specific subsidy, not asset specific subsidy. Since you are starting your business in a remote area, in a special economic zone area, the government is giving you subsidy, not in relation to asset, in relation to location. So whatever the subsidy you are receiving from government, that should not be reduced from actual cost. Okay ma. Next, and then you have to add the interest amount on borrowed capital which you borrowed for the purchase of an asset, and that interest amount should be added back to the actual cost of the asset, should be capitalized only up to the date of asset put to use. Up to the date such asset was first put to use. So up to the date of put to use, whatever the interest you have paid, that should be capitalized. From there onwards, the interest amount should be treated as a revenue expenditure. Okay now, any expenditure incurred towards acquiring the asset like freight charges, transportation charges, transit insurance, everything should be capitalized, and installation expenses should be capitalized, added back to the cost of the asset. Then you will get the actual cost. Are you following or not? Next. Then after that, you have some explanation to section number 43.1, that is actual cost. You just go through these explanations more. General considerations for the depreciation, that I have already told you. Subsidy, grant, reimbursement, if you received in relation to the actual cost, the cost of acquisition of the asset, then the actual cost shall not include to the extent of the amount of subsidy received. Right, sir. Next, if it is a composite subsidy, not in relation to a single asset or in relation to a group of assets, the subsidy you have received in relation to a group of assets, then the proportionate amount should be calculated considering all the assets shall be excluded. Next, look at this one. Just now I've told the example. A Limited started its an industry in a backward area for which it received a subsidy of 1 crore from the central government. Should it be reduced from cost? Answer is no. It need not be reduced because the subsidy so received is directly related to the location but not to the asset. Okay now, next, depreciation is allowed to the lessor. Yes, even though the asset is being put to use by the lessee, the lessor will get the depreciation being he is the owner of the asset. Okay ma'am. Next, consequences if depreciable assets are sold. No problem, sir. 50 comes into the picture, and section 50 we are going to discuss in capital gains. Okay now. Next, sir, if any asset partly used for business and partly for personal purposes, proportionate amount of expenditure will be allowed as deduction. Okay, and after that you have the discussion regarding the rates of depreciation. I have already told you, like, buildings used for residential purposes 5%, commercial purposes 10%, temporary structures everything 40%. Earlier we used to have 100% depreciation for temporary constructions, but now we have latest amendments 100%. See, 100% depreciation is not there to any asset, not even buildings, not to any asset. Okay ma. Next, So furnitures and fittings always taxable. Having the rate of depreciation at 10 percentage. Okay, sir. And then plant and machinery, as I said, it is a residuary category. It starts with 15% rate of depreciation, and the maximum rate of depreciation covered here is some 40% or 45%, but of course that's not in existence right now, right? So motor cars, other than those used in the business of running them on hire basis, 15%. If used on running them on hire basis, 30%. Aeroplanes, aero engines, 40%. Malls used in rubber and plastic, 30%. Life-saving medical equipment, 30%. Right? Then life-saving medical equipment, 40%. Computers, including computer software, 40%. Air and water pollution control equipment, 40%. Energy saving devices, 40%. Books owned by the SSE, 40%. Whether you are using in your business or profession, right? Even annual publications, even then you are running a library, still it is a 40%. Okay, ma'am. And ships and vessels, 20%. Other plant and machinery, residuary category, 15%. Right, sir? So basically, if in the given question, it's mentioned like only plant and machinery, nothing was mentioned, whether it is a computer, whether it's an aeroplane, aero engine, bus, vehicle, nothing was mentioned. Simply mentioned as plant and machinery. So straight away, you can take 15% as rate of depreciation. Okay, ma'am. Intangible assets, the rate of depreciation, 25%. Okay, now coming to the additional depreciation with respect to new plant and machinery. Additional depreciation with respect to the new plant and machinery. Okay, sir. Sir, here for claiming additional depreciation, right? You have to satisfy some conditions, right? So first of all, additional depreciation is available to all the SSEs, but only those who are engaged in the business of manufacturing of any product or article. And this is now also extended to the business of power generating units. The SSEs who are engaged in the business of generation of transmission or distribution of power. It also applies to the captive power plants, right? So in order to give an encouragement with a view to give a boost to the manufacturing sector, this is allowed in addition to normal depreciation. See, if you are engaged in the manufacturing sector, now you can claim normal depreciation as deduction, normal depreciation as deduction. And in addition to that, you can also claim additional depreciation as deduction. Okay, sir. But of course, normal depreciation will be allowed throughout the life of the asset, whereas additional depreciation is allowed only for the first year, only for the year in which the asset was acquired. Okay, ma, right? So additional depreciation is allowed only with respect to the new plant and machinery. But of course, we have some exceptions. So with respect to all these assets, additional depreciation not allowed, sir. Additional depreciation not allowed. What are them? Buildings and furniture, road transport vehicles, ships and aircrafts, any office appliances, plant and machinery installed in any office premises, second-hand plant and machinery, whether used in India or outside the India, and any plant and machinery where 100% depreciation or deduction is allowed under the Act. For these assets, additional depreciation allowed. Ma, for these assets, you can claim normal depreciation, no problem. But additional depreciation only not allowed. Okay, ma. Next. And the rate of additional depreciation, it is 20%, ma. 20%. But of course, if the asset is put to use for less than 180 days in the year of acquisition, you have to claim only 10%. But don't worry about the remaining 10%. The remaining 10% you can claim in the subsequent financial year. Okay, sir. You can see here on 1/7/2019, the asset was purchased, new plant and machinery was purchased, and 1st of November 2019, the asset is put to use, started put to use. Though you purchased on 1st July, you started put to use that asset from November. See, what is important? Date of acquisition or date of put to use? Date of put to use, not date of acquisition. Date of put to use is important. Yes or no? The number of days calculation should be start from the date of put to use, not from the date of acquisition. So the days calculation should start from 1st November. So if you calculate, you will get less than 180 days. Means the additional depreciation is allowed how much, amma? The additional depreciation allowed only half of the amount. Okay, now the remaining half you can claim in the next financial year. No problem. Absolutely no problem. Next. And while calculating additional depreciation, no, you have to calculate asset wise. Individual asset wise, you have to calculate. For calculating normal depreciation, you have to follow the block of assets concept. For calculating additional depreciation, you can calculate individual asset wise. Okay. Next, additional depreciation is not available if the asset is sold in the year of acquisition itself. See, in 2021, 21-22, you purchased asset. You purchased the asset in the same previous year, 21-22, you have sold the asset in the same previous year. So 21-22 you purchased, in the same previous year you have sold. So you don't get any additional depreciation. You might claim normal depreciation. You may claim normal depreciation because normal depreciation is not depending upon individual asset, depends upon block of assets. If that block consisting some other assets, you can claim depreciation. But additional depreciation not allowed to the asset sold in the year of acquisition itself. Next. However, power sector units claiming depreciation on a SLM basis, they cannot claim additional depreciation. Adinti sir, just now you told power sector units also eligible for additional depreciation. Yes, power sector units also eligible for additional depreciation only when they are claiming normal depreciation on return on value basis. If they are claiming normal depreciation on return on value basis, they can claim additional depreciation. But if they are claiming normal depreciation on SLM basis, they cannot claim additional depreciation. Okay, ma. Next. Even nowadays, the associates who are engaged in the business of printing and publishing, it amounts to manufacture. Hence, they are also eligible for additional depreciation. Okay, ma. Next. Regarding terminal depreciation, I will be discussed in section 41 deemed income. There I will discuss about the terminal depreciation. So for the timing, skip it out. Provisions for unabsorbed depreciation or unclaimed depreciation. Unabsorbed depreciation. Look at the concept of unabsorbed depreciation here. There are two situations where there is a scope for unabsorbed depreciation. Two possibilities, two situations. Number one, insufficiency of profits. And number two, no profits. First, look at the situation one, insufficiency of profits. Sir, look at this example. You have a gross profit of 10 lakhs and the expenses you have 9 lakhs. Expenses excluding depreciation. We have not yet claimed the depreciation as deduction. Excluding depreciation, you have expenditure amounting to 9 lakh. And current year depreciation, you have 3 lakhs. So current year depreciation, you have 3 lakhs, but the profits available for depreciation is only 1 lakh. And the maximum depreciation you can claim as deduction only 1 lakh. The remaining 2 lakhs depreciation is whatever is there is called unabsorbed depreciation. Unabsorbed depreciation means that portion of depreciation which is not absorbed by the profits. Why not absorbed? Because you don't have profits. You don't have sufficient profits. See, you have a depreciation of 3 lakhs, but you have a profit of only 1 lakh. So the remaining 2 lakhs is what we call unabsorbed depreciation. Okay. So in the first example, you have profits, but not sufficient. Okay. Now look at the situation 2. You have a gross profit of 10 lakhs and equal amount of expenditure, excluding depreciation. Expenditure excluding depreciation. And the current year depreciation, you have 3 lakhs. You have a depreciation of 3 lakhs and the profits available for absorbing this depreciation 0. So that means the entire 3 lakhs is what we call an absorbed depreciation. Are you following or not, Amma? So in the second question, you don't have profits at all. In the second example, right, sir? Now, what is the tax treatment of unabsorbed depreciation? Look at here. The unabsorbed depreciation can be set off with the incomes from any other head of income except income from salaries. Except income from salaries, right, sir? Sir, I am doing only business. I don't have income under any other head. Then don't worry. You can carry forward that unabsorbed depreciation to the next year. Next year, carry forward, Shanama. In the next year, you can claim this unabsorbed depreciation as deduction from your business profits. Sir, if I don't have the business profits even in the next year, carry forward again. On that year also, I don't have any next profits, carry forward again. Like this, for how many periods I can carry forward? You can carry forward up to unlimited period. Unlimited period. Are you following or not? So that's about the unabsorbed depreciation. So with that, we have completed discussion regarding section 32, depreciation. Okay, sir, every one of you. Any doubts? Okay, now moving on to section 35 series. Section 35, expenditure on scientific research. Scientific research expenditure. So in scientific research expenditure, we will be having three different parts, Amma. Right? In-house expenditure applicable to all the assessees. In-house research expenditure applicable to specified companies. And third one, contributions. Look at the first part. In-house research expenditure applicable to all the assessees. Now here, the expenditure, whatever we have incurred, categorized into two categories: prior period expenditure, current year expenditure. Prior period expenditure means the expenditure which you have incurred before the commencement of business. Before the commencement of business. Because research takes time, ma'am. If I started doing research on a particular product, suppose that the research may take 5 years time. 5 years time. I've started research during the previous year, some 17, 18. So 18, 19, 19, 20, 20, 21, 21, 22. So 5 years I have taken for the completion of research. Now, finally, in the year 22, 23, I've started manufacturing the product and started selling. So the commercial production and selling starts from 22, 23. Okay. Now this 5 years expenditure is what we call prior period expenditure. But unfortunately, out of these 5 years, only the last 3 previous years prior period expenditure eligible for deduction. Not all the 5 years. Only the last three preceding previous years. Okay, ma'am. And the last 3 preceding previous years revenue expenditure, only a limited revenue expenditure eligible for deduction, ma'am. That is salaries to research staff, raw materials purchased. 100% deduction you can claim. Okay. Capital expenditure, all the capital expenditure except the cost of land, you can claim depreciation. Deduction, 100% deduction allowed. When in relation to a capital asset, you are claiming deduction, no depreciation is allowed. No depreciation is allowed with respect to same. Okay. Next, current year expenditure means whatever the expenditure you have incurred during the year 22, 23. Whenever the commercial production starts, that will be your first year, ma. So in that first year, whatever the expenditure you incurring from there onwards will be the current year expenditure, sir. And the revenue expenditure, all the revenue expenses you can claim deduction, ma. And capital expenditure, all capital expenditure except the cost of land, you can claim depreciation or deduction, 100% deduction. And in relation to the capital expenditure, you are claiming 100% deduction, hence no depreciation allowed. Okay, this is in-house research expenditure applicable to all the assessees. Now, second category, in-house research expenditure applicable to specified companies, section 35, clause 2AB. Right, sir? Only to those companies which are engaged in the business of biomedicals or in the business of manufacturing. Section 35 2AB, you can see here. Yeah. The company must be engaged in the business of biotechnology or in any business of manufacturing or production. Only for that company, section 35 clause 2AB applicable. Okay. Now, revenue expenditure, right? All the revenue expenditure eligible for deduction, ma, right? Earlier, we used to have a weighted deduction of 150%, but now it is decreased to 100%. Capital expenditure, any capital expenditure eligible for deduction, ma, except cost of land and buildings, except the cost of land and buildings, right? Earlier, we used to have weighted deduction of 1%. Now we can claim only 100%. 150% earlier, now we can claim only 100%. Sir, for land, deduction is not allowed. It's a appreciable asset. What about buildings, sir? Why can't we claim buildings, deduction for buildings? Under section 35 2AB, you cannot claim, but you can claim under section 35 subsection 1 clause 1. 100% you can claim, not 150%. So I have already mentioned here, with respect to buildings, 35 2AB deduction not allowed, but 35(1) clause 1 allowed. Okay, next. Right, sir, if we have any unabsorbed scientific research expenditure, unclaimed scientific expenditure, then look at this example. We have purchased a plant and machinery worth rupees 10 crores and we are going to use it for scientific research. Since we are using the asset for scientific research, we can claim deduction under section 35, 100%. 100%. Right, sir? Look at the profit and loss account. We have a gross profit of 12 crores and we have expenditure of 8 crores, excluding the scientific research expenditure. Right, sir? The scientific research expenditure eligible for deduction 10 crores, but you don't have sufficient profits. You have only profits worth 4 crores. So you have incurred 10 crores, but out of which only 4 crores you are claiming deduction. The remaining 8 crores, the unabsorbed capital expenditure of scientific research. Right, sir? This unabsorbed capital expenditure of scientific research will have the same tax treatment as unabsorbed depreciation. That means this unabsorbed capital expenditure of scientific research can be set off with any other incomes from other head of incomes except income from salaries, and which can be carried forward for unlimited period. Okay, ma'am. So regarding contributions, you have the percentages mentioned here. Earlier, we used to have the weighted percentage of 150%, 200%. Now we don't have such a provision. So whenever you are making contribution to a research association, where it is using for social or statistical research, 100% deduction allowed. If it is used for scientific research, again 100% deduction only, not 150%. Company registered in India for scientific, social sciences, statistical research, 100%. Whenever you are making contribution to national laboratory, universities, Indian Institute of Technology, 100% deduction, you can claim it. Okay, now, right. Unabsorbed capital expenditure treatment I have discussed just now. So with that, we have completed discussion regarding the scientific research expenditure. Okay, now, so I'm stopping the discussion here. I'll continue the PGBP marathon in the next session. Okay, so till then, have a good day, sir. Good night. Stay home and stay safe. A very good morning, students. So welcome to the income tax marathon classes. In the last session, we have started discussion regarding PGBP marathon classes. So in the last class, we have completed up to section 35, expenditure towards the scientific research. And then next, moving on to the next very important section, that is section 35 AD, deduction of capital expenditure of specified businesses. So we have 14 specified businesses, right? With respect to which, if you incur any capital expenditure, right, you can claim 100% of the amount of that capital expenditure as deduction in the year of incurring that expenditure. So basically, with respect to capital expenditure, we will get what? Generally, with respect to capital expenditure, we don't get this deduction, but we will get depreciation. So that means in order to get the total cost of that capital asset as deduction, you have to wait for some 8 to 10 years, because depreciation, if you purchased a plant and machinery, the amount of the depreciation you can claim per annum is just 15%. Yes or no? And that is true on the return on value basis, right? But whereas if you incur that capital expenditure towards a specified business, with respect to any of these 14 specified businesses, like setting up and operating a cold chain facility, or setting up and operating a warehousing facility for the storage of agricultural produce, then laying out and operating a cross-country natural gas, crude oil, petroleum oil pipeline network for distribution, building and operating anywhere in India a new hotel of 2-star or above category, then a hospital with at least 100 beds for patients. Like this, you will be having 14 specified businesses, right, sir? So if you increase any capital expenditure in respect to this 14 capital specified businesses, you can claim 100% of deduction. So section 35 AD provides for 100% in respect of any capital expenditure, 100% deduction in respect of any capital expenditure incurred by an SSE for specified businesses. Okay, ma. So here you need to remember these 14 specified businesses, and also the most important one, you have to remember the date of commencement of such businesses also. Means setting up and operating a cold chain facility, that business should be commenced on or after 1st April 2009. Right, sir. And then laying out and operating a cross-country pipeline network, then the business should be commenced on or after 1st April 2007. So like this, you need to remember the date of commencement of business also. Then amount of deduction, I've already told you 100% of the amount of any capital expenditure if the assessee is opting for deduction under section 35 AD. Clear, sir. Note, look at here, capital expenditure shall not include the acquisition of land, building, or financial. So land, goodwill, and financial instruments. Right, sir. So cost of the land, cost of the goodwill, financial instruments, these are not eligible for deduction here. Clear, sir. Next. And here you need to incur that capital expenditure. If the capital expenditure amount is greater than 10,000 rupees, then you have to meet that expenditure either by way of account pay check, or account pay draft, or ECS, or any other prescribed electronic modes. See, if the capital expenditure is less than or equal to 10,000 rupees, you can meet that expenditure by way of cash. But if the capital expenditure amount exceeding 10,000 rupees, then compulsorily you have to meet that expenditure either by way of account pay check or account pay draft, or using of any electronic clearing systems, RTGS, IMPS, NEFT, or any other prescribed electronic modes. Even through e-wallets also you can pay, like all the UPIs, right? Google Pay, Phone Pay, Paytm. Clear, sir. Next. The other prescribed electronic modes include credit card, debit card, net banking, IMPS, UPI, RTGS, NEFT, and BHIM, Bharat Interface for Money, Aadhaar Pay. Okay, ma. Next, condition to be satisfied. Sir, here you will get 100% of the capital expenditure as deduction only when with respect to the new businesses, not with respect to the businesses which are in existence. That new business should not be comes into the picture by splitting out or reconstructing of an existing business. Clear, ma? It must be a new business. So it is not set up by splitting up or the reconstruction of a business which is already in existence. Next, and here the 100% deduction is allowed with respect to the plant and machineries, all the capital expenditures, but it should be a new plant and machinery, new asset. For second-hand plant and machineries, you won't get deduction, sir. But of course, we have some exceptions. Out of the total capital expenditure incurred, let us say 100 lakhs, you have incurred a capital expenditure, out of which up to 20 lakhs rupees could be a second-hand plant and machinery, no problem. Could be a second-hand plant and machinery. So only up to 20% it is allowed, amma. Okay, now next. So in order to claim the deduction under section 35 AD, right, the deduction shall be allowed only if the accounts are audited by a chartered accountant. So the accounts of that SSE must be audited by the chartered accountant. And then once you claim the deductions under section 35 AD, so the SSE shall not be allowed any deductions in respect of the specified businesses under the provisions of chapter 6A in respect of deductions based on income. See, here majority of the students will get confused. Sir, once you claim deductions under section 35 AD, it doesn't mean that you won't get deductions under chapter 6A. No, it's not like that. Under chapter 6A, deductions are classified into 3 categories, right? Like investment based deductions, expenditure based deductions, income based deductions. See, once you opt for 35 AD, you can claim deduction investment based deductions. You can claim expenditure based deductions. There is absolutely no problem, but you only not entitled to get this income based deductions. You're not eligible to claim Only that income based deductions like section 80P, 80IA, 80IAB, 80QQB, 80RRB. These are the income based deductions. So once you opt for 35AD under section under chapter 6A, you can claim investment based deductions, you can claim expenditure based deductions, but you're not entitled only these income based deductions, right ma? Next, that's it ma. And year of deduction, I've already told you, right? The year in which you have incurred that capital expenditure, in the same previous year you will get deduction, sir. Clear? So under this section, the deduction will be allowed in the previous year in which such capital expenditure was incurred. Sir, what about the prior period expenditures? Sir, if I incurred any capital expenditure, right, before the commencement of business operations, no problem, sir. The year in which you have commenced your business operations, you can claim all the prior period expenditures as deduction, provided such capital expenditure must be capitalized in the books of account as on the date of commencement of its operations. As on the date of commencement of its operations. So prior period expenditure also eligible for deduction. In which year? The year in which you commence the operations. And what is the condition to be satisfied? All such prior period capital expenditure must be capitalized. Next, holding period of the new asset. The new asset must be held for the minimum period of 8 years, ma. For a minimum period of 8 years. See, if you purchase the asset in this year, claimed 100% deduction, and next year you have sold that asset, not allowed, ma. Not allowed. So the new asset for which 3580 deductions was allowed, that new asset must be held by the assessee and must be used for his business purposes for a minimum period of 8 years. Of course, this 8 years condition not applicable with respect to the assets which are destroyed, discarded, or transferred, and with respect to the company which is declared as a sick company. Clear? Next, consequences if the asset is not used for 8 years. Suppose that in the year 21-22 we have purchased, and immediately after 2-3 years we have sold it out. Then, so the year in which that capital asset was sold, right, you have to calculate the business income. Now, what is the business income here? Whatever the deduction allowed earlier under section 3580, the same shall be reversed and taxed as business income. Earlier, suppose that during the previous year 2021-22, suppose that during the previous year 2021-22, you have purchased a plant and machinery worth rupees 100 lakhs and you have claimed it as deduction. On debit side, you made an entry. You claimed it as deduction. Now, during the previous year 2023-24, right, you have sold it for, let us assume that you have sold it for 80 lakhs. Clear, sir? Then immediately what happens is, whatever the deduction allowed earlier, in the year of purchase, you have claimed a deduction of 100 lakhs. The same shall be treated as income now. The same shall be treated as income now. Are you following, sir? Every one of you, right? But of course, the entire amount need not be treated as income, sir, because see, earlier 3580 deduction was allowed to you, hence you have not claimed any depreciation. But the same deduction is getting reversed. Hence, now you becoming eligible for depreciation. So the for the years you have utilized it for your business purposes, right? See, you have used it for your business purposes 21-22, 22-23, 23-24. 3 years you have utilized for your business purposes. These 3 years you can claim depreciation. Let us assume the depreciation amount is 20 lakhs. So this 20 lakhs you can claim deduction. Are you following, sir? Right? Since the deduction is getting reversed, you becoming eligible for depreciation and you can claim depreciation now. Clear, sir? So look at here. In case the asset is used for the purpose other than specified businesses within a period of 8 years, the amount of deduction allowed earlier shall be deemed as income under the head PGBP. The amount of deduction allowed earlier, how much allowed earlier? 100 lakhs. The same shall be deemed as income in the year in which that asset was sold. Next, and the assessee shall be entitled to reduce the amount of eligible depreciation while computing such deemed income. So now you can claim depreciation, sir. Absolutely no problem. Next, set off and carry forward of losses from specified businesses. See, if you get any loss from specified business, the loss should be set up against only from the incomes of specified business. You cannot set off the specified business losses with non-specified business profits. Okay. Next. After that, Next important section comes to be other deductions, section 36(1), other deductions, right, sir? And the first provision in the other deductions is about the insurance premium. So generally in income tax, right, sir, insurance premium will be claimed in a different sections, different sections. Like, look at here, I've mentioned in the running notes in my regular classes. So deduction of insurance premium, just a second, sir. So general insurance premium, with respect to the loss of stock policies, fidelity insurance policies, right, sir? So we can claim deduction under section 36(1). Life insurance policies, insurance premium paid on life insurance policies, right, sir? So if paid by the employer for self, for his own self or for his spouse, right, sir, then he can claim deduction under section ADC. See, if I'm paying life insurance premium on my own insurance policy, on my spouse life insurance policy, I can claim deduction under section ADC. Next, in case if employer paid the insurance premium on the life of the employee, then the deduction will be claimed under section 37. Health insurance policies, right? If paid by the employer on his own health, or children, or spouse, parents, then the deduction will be allowed under section 80D. Next, health insurance policies on the health of the employees. If employer paid the premium on the health insurance policies of employees, the employer can claim deduction under section 36(1). Employer can claim deduction under section 36(1). Clear, ma? So these are the different sections where one can claim deduction with respect to the insurance premium. Okay, now, and then after that, any sum paid to an employee as bonus or commission, it will be allowed as deduction under section 36(1) only, but subject to section 43B, and subject to actual payment. Next, interest on borrowed capital, ma, right? Interest on borrowed capital, you can claim deduction under section 36(1) provided certain condition to be satisfied. Assessee must have borrowed the money. The loan amount must be used for the purpose of business of profession, and interest must be incurred on such a particular loan. Then you can claim interest on that particular loan as deduction. But of course, interest on loan raised for the payment of income tax is disallowed, because see, income tax itself is a disallowed expenditure. Income tax itself is a disallowed expenditure. You are going to study under section 40 small a, disallowances, 40 small a. See, for paying a disallowed expenditure, if you taken any loan and you are incurring any interest on that, then that interest also becomes disallowed. Next, interest on loan used for the payment of sales tax. Now it is GST. This will be allowed as deduction. See, GST amount, it will be allowable as deduction, sir. Right? So if you are incurring any expenditure towards an allowable expenditure, that is also eligible for deduction. Next, interest paid outside the India or to a non-resident without a deduction of TDS, disallowed. See, if you deduct the TDS and whatever the TDS deducted should be remitted to the department, if you satisfy that two obligation, deduction is allowed. Otherwise, deduction will be disallowed. Next, interest on loan used for the payment of dividend, allowed as deduction. Right? Interest on loans used for granting the interest-free loan to the employees, allowed as deduction. And interest on borrowings for used for acquiring the asset. See, up to the asset is put to use, up to the date of asset is put to use, right, sir, then it should be capitalized. And once the asset is put to use, then it will be allowed as deduction under section 36(1) clause 3, right, sir? So up to the asset is put to use, it is a capital expenditure. It is a capital expenditure. And once asset is started putting use, then it will be a revenue expenditure. Okay, ma. Next, discount on zero coupon bonds, it will be allowed as deduction on pro rata basis. So what is zero coupon bonds and how the deduction is allowable, I will discuss in capital gains chapter. Okay, now next, employer's contribution to RPF and recognized superannuation fund, allowed as deduction but subject to 43B, means subject to the actual payment. And employer's contribution to gratuity fund, allowed as deduction but subject to 43B. Next, any sum received from employees towards their contribution to the welfare fund accounts. Sir, here, whenever you are receiving an amount towards PF or RPF, like pension fund, gratuity fund. So employees contribution to the welfare fund accounts, right, sir? See, initially when that amounts are received, that shall be treated as income to the employer. Income to the employer. Now, when we are in PGBP, you always have to think from employer point of view. In every head of income, you have to assume a role. In every head of income, you have to assume a role. What is that role, ma'am? While you are discussing house property salaries, your role is employee. While we are discussing income from salaries, your role is what, ma'am? Employee. So from employee point of view only, you have to think every provision. While we are discussing income from house property, your role is owner of that house property. So each and every provision of the income from house property, you have to think from the viewpoint of the owner. While you are discussing the PGBP, your role is employer or a professional person, right, sir? So you have to think from the viewpoint of the employer. While you're discussing the provisions of capital gains, you have to think from the viewpoint of the transferor, the person who transferred the capital asset. And while you are discussing the income from other sources, you have to assume multiple roles. You have to assume multiple roles. So we cannot say you have to be this particular role. Okay. So while you are discussing the dividend provisions, your role is a shareholder. While you are discussing about the gifts taxation, your role is a transferee, the person to whom the gift is given. Like that. Okay, Namma? Right. So initially, whenever you're receiving the contributions from the employees towards their welfare fund schemes, it should be treated as income. Later on, when such contributions are remitted to the respective departments, PF department, gratuity fund department, like that, then the employer immediately can claim deduction under section 36(1). So initially it should be treated as income, then it will be treated as expenditure. 10,000 plus 10,000 minus. The ultimate impact is 0. Clear now? Next. Bad debts, right? Yes, sir. Bad debts will be allowed as deduction. Right? There are certain conditions to be satisfied for claiming the bad debts as deduction. Right, sir? Right. In order to claim a particular amount as bad debt, that amount should have been treated as income earlier. Earlier, that income should have been treated as income. Right? If that income is unable to receive, then it should be treated as a bad debt. Look at this example, ma'am. So we placed an order for plant raw materials worth 100 lakhs. We also paid advance of 10 lakhs. But that supplier unable to provide the raw materials in time, and we have terminated that contract, and whatever the advance we have paid, we have claimed it as a refund. Even that supplier was absconded, and we are unable to get this 10 lakhs as a refund. Now, can I claim this advance paid rupees 10 lakhs as a refund? No, because this advance paid 10 lakhs, earlier I was not shown this as my income. Are you following, sir? If he pays an advance amount, is that our income? No. Right, sir? Since we have not paid, we have not recognized this 10 lakhs as income earlier. Now the same advance paid, but which we are not unable to receive that amount back. So it should not be treated as a bad debt. Next, place an order for plant and machinery worth 50 lakhs. You have paid an advance of 20 lakhs. Again, the same situation. Within the time the plant and machinery was not delivered, we have terminated the contract. We have claimed a refund of 20 lakhs advance paid, but the supplier unable to pay. He was in absconding. So even this 20 lakhs cannot be treated as a bad debt, because earlier you have not treated it as income. Next, look at the third example. Credit sales 100 lakhs. Credit period allowed 3 months. So collections from debtors within 3 months is only 80 lakhs. See, whenever you made a credit sales in your profit and loss account, you might have shown it as income. On credit side, buy sales 100 lakhs. So you have recognized earlier 100 lakhs as income, but out of which you have received only 80 lakhs. So the remaining 20 lakhs, you can treat it as bad debts. Are you following or not, Amma? Every one of you. Though you made a sales of 100 lakhs, but what is your net sales? 80 lakhs only. So 80 lakhs only should be recognized as income, but you have recognized 100 lakhs as in your income. Are you following or not? So that is why whatever the 20 lakhs amount, is there, that should be treated as bad debts. Clear, sir? Next. So look at here. The debt should be incidental to the business or profession, and they should have been taken into account while computing the income of the SSE. Right, sir. So it should have been taken into account as income of the SSE, and it should represent the money lent in the course of banking business or money lending business. So banking businesses, money lending businesses, the bad debts are quite often, sir. They will offer the loans, right? They will give the loans to the borrowers, and some of the borrowers might not repay them. So that will be a bad debt to them, right, sir? Next, mere provision is not sufficient, but actual write-off of the account is required. So provision for bad debts is not allowed, ma. Provision for bad debt is not allowed. Provision for bad debts are allowed as direction only to few SSEs. Only to few SSEs like banking SSEs. Are you following or not? So remaining all other SSEs, the actual bad debts should be incurred. Next, for claiming the bad debts as deduction, the business or profession must be in continuation. But remember, sir, must be in continuation, but need not be by the same SSE. Need not be by the same SSE. Are you following, sir? The business or profession must be in continuation, but need not be by the same SSE. Next, the successor of a business or profession entitled to claim the deduction in respect of debt created by the predecessor. Yes or no? Right. Next. Right. And here, sir, I've already told you the provision for bad and doubtful debts is allowable as deduction only to the banking companies and some credit cooperative societies. Clear, sir? And here you can see. So look at this example, ma. SSE State Bank of India. So previous year 2021 provision for bad debts 20 lakhs, and they have claimed 20 lakhs as deduction. But at the end of the year, the actual bad debts are 25 lakhs. Actual bad debts are 25 lakhs. So, but in the form of the provision for bad and doubtful debts, they have claimed as deduction only 20 lakhs. So the remaining 5 lakhs now they can claim as deduction in the form of a bad debts. Sir, what if the case if the actual bad debts are only 15 lakhs, but you have claimed a deduction of 20 lakhs, excess claimed 5 lakhs, that excess balance at the balance of the provision for bad and doubtful debts, that will be carried forward to the next previous year. This will be treated as closing balance of provision for bad and doubtful debts for the previous year 2021, right? And the same will be treated as opening balance of provision for bad and doubtful debts as 5 lakhs. Clear now? See, if you claim the lower amount as deduction, the remaining portion you can claim as deduction in the form of bad debts. If you claim higher amount as deduction, the excess portion will be treated as closing balance for that year, which will become the opening balance for the next year. Clear, ma? Next. Expenditure incurred on purchase of animals. So generally, these expenditure will be allowed as deduction, but not in the year of purchase. It will be allowed as deduction in the year in which such animal die or permanently useless. That animals must have been used for the purposes of your business or profession. Clear, ma? Right? So, which are used for the purpose of business or profession is a capital expenditure. Will be allowed as deduction in the year in which such animal die or become permanently useless. But of course, from the total amount, if you receive any sale proceeds by selling the carcasses or the died animals, that sale proceeds should be deducted from the actual capital expenditure. Clear? Next, family planning expenditure. This will be allowed as deduction only to the company sum, only to the companies, not to the all SSEs. Okay, so revenue expenditure will be allowed as deduction fully in the year of incurring that expenditure, and capital expenditure will be allowed as deduction, but over a period of 5 years. Next, any amount of STT paid, securities transaction tax. Look at here, ma. Securities transaction tax allowed as deduction when you are a trader. Trader means buying and selling of securities is your business activity. Buying and selling of securities is your business activity. Are you following, sir? Then you will be treated as a trader. So if you incurring a STT as a trader, you can claim deduction under section 36(1). But if you are incurring STT as an investor, investor means like you purchase a security now, but your objective is to not to resell immediately. Your objective is to hold for a long period. Your objective is to hold for a longer period. So then you will be treated as an investor. So when you're incurring STD as an investor, you won't get any deduction. You won't get any deduction, sir. Next. Any amount of CTD paid commercial commodities transaction tax, that will be allowed as deduction. Clear? Next. After that, section number 37, it's a residuary section. It is a residuary section which covers all those expenses, which are not covered by the section 30 to 36. Right. So look at here, I've given examples. Right, section 37 allowed as deduction with respect to the expenses which are not covered by 30 to 36, like salaries paid to the employees, advertisement expenditure, printing and stationery, electricity charges, transportation charges, telephone charges, etc. These are the very important expenditure of a particular organization, sir. Any organization, if you take any organization as expenses, example, these are all the very important expenses. But unfortunately, for all these very important expenditure, we don't have a separate section. We are claiming all the most important expenditure of an organization with the help of a residuary section. Clear, sir? But of course, in order to claim a deduction under section 37, we must have satisfied some conditions. First, it should not be a personal expenditure. Personal expenditure anyhow not allowed as deduction under any of the provisions of income tax. It should not be a capital expenditure, because for capital expenditure you can claim depreciation under section 32. Okay, ma. And it should be incurred wholly and exclusively for the purpose of business or profession. Next, it should be incurred during the relevant previous year, and it should not be covered by section 30 to 36. Then whatever the expenditure satisfied all of these conditions, that expenditure eligible to claim deduction under section 37. Next, look at the advertisement expenditure. Right, sir. So here advertisement expenditure are mainly categorized into two categories, ma. First one, any advertisement expenditure incurred with respect to the advertisements in any brochure, pamphlets, souvenirs, or the like issued by the political parties. This is a disallowed expenditure under section 37 2B. Right, sir. Any advertisement expenditure incurred with respect to the advertisements in any of the pamphlets, brochures, souvenirs issued by a political party. 37 to be disallowance attracted. And any other advertisement expenditure, you can claim deduction under section 37. Okay, ma. Right. Next. CSR expenditure is also not eligible for deduction, ma. Right. Any expenditure incurred by an SSC on the activities relating to the CSR, corporate social responsibility, right, shall not be allowed as deduction, sir. Earlier it used to be allowed as deduction, ma, but recently we have got amendments, so hence deduction not allowed, sir. Next, expenditure incurred on key man insurance policy. I've already told you the employer can claim deduction under section 37. Next, and any expenditure incurred towards providing the freebies to the medical practitioner is in the violation of the Indian Medical Council regulations, then hence it will not be allowed, sir. It is an inadmissible expenditure. Right, sir. Next, these are some examples I've given, sir. Assets are not used exclusively for the business or profession, means part of the asset used for personal purposes, part of the asset used for professional purposes, business purposes. Look at this example. We have purchased a car for 10 lakhs and we are using the car 60% for business purposes and 40% for personal purposes. Now in that case, so depreciation on car is covered under the category of plant and machinery. So 15% is the rate of depreciation. So you'll get a depreciation amount of 1,50,000, but you don't get deduction of the entire amount of 1,50,000. You don't get, because only 60% of the car is used for business purposes. To that extent only you will get deduction. So 1,50,000 into 60%, 90,000 eligible for deduction under section 32. The remaining, to the extent it is utilized for personal purposes, deduction not allowed. Okay, ma'am. Next, and after that you have disallowances. 40 small a, disallowances in the case of all the SSCs. So far we have discussed about the expenses which are eligible for deduction. So far we discussed about the expenses which are eligible for deduction. Now time for the expenses which are ineligible for deduction. 40 small a. So in case of any SSC, the following expenses are disallowed, like income tax, dividend distribution tax paid is not deductible. Right, I've already told you income tax is a personal tax, hence a deduction is not allowed. And after that, I can directly come to this provision. Right, disallowances under section 40 small a clause 1. Right, and look at the running notes, sir. 40 small clause a, small a clause 1. Right, so Mr. X rendered some professional technical services to Mr. Y. Right, sir. So X, payer, who is paying the amount, X received technical services from Mr. Y, who is there in USA, recipient. Okay, sir. Now for which Mr. X has to pay the technical services fees 5 lakhs rupees. Now here, right, Mr. X, while rendering this amount of 5 lakhs to Mr. Y, he's paying the amount out of India, no? Right? So whenever the income is going out of India, it should be taxed first. So that is why what the department said is, Babu, you have to deduct TDS under section 194J at the rate of 10%. So while you're remitting the fees for technical services to Mr. Y, you have two obligations. Number one, you have to deduct the TDS, and whatever the TDS is deducted, that should be remitted to department. Two obligations. Number one, deduct the TDS. Number two, remit the TDS. Remit the TDS. Are you following, sir? Every one of you. If you satisfy these two obligations, then 40 small a clause 1 not attracted. Means disallowance not attracted. Means you are eligible for deduction. But if you fail to comply with any of these two obligations, then 40A1 comes into picture. Disallowance will be attracted. The entire amount will be disallowed. Are you following or not? Every one of you. Right, sir? So while you're remitting this 5 lakhs rupees, no, 50,000 you have to be deduct in the form of TDS, right? And the TDS should be remitted to the department. Clear. And what is a due date for the remittance of this deposit, TDS? Basically, if you deduct the TDS in the month of May, generally you have to remit the same in the month of June, next month. Right, sir? Or you can even the remittance of TDS to department on or before the due date for the filing of return of income under section 139. Either you can remit to the department in the same previous year, or you can also remittance in the next previous year, but on or before the due date for the filing of return of income. Look at this example, sir. Expenditure belonging to 2021. TDS deducted on 1st July 2020, right? And remitted to department on 31st of October 2020. So in the same previous year, TDS deducted, in the same previous year, the TDS is remitted. Hence, deduction is allowed for the previous year 2021. Okay, next. Sir, expenditure belonging to 2021. TDS deducted on 1st March 2021 and remitted on 1st July 2021. So TDS was deducted in the previous year 2020-21 and remitted during the previous year 2021-22 in the next previous year. But you can see here the TDS was remitted on or before the due date for the filing of return of income. Basically, for an individual SSC for the previous year 2020-21, the due date for the filing of return of income under section 139(1) will be 31st July 2021. Right, sir? And when the remittance was done, 1st July 2021. So well within the due date for the filing of return of income. Hence, the expenditure is allowed to the previous year in which the expenditure is belonging to. So deduction is allowable for the same previous year. Next, look at here. Expenditure belonging to 2021. TDS is deducted on 1st April 2021. Means previous year 21-22. So the first condition here you have to satisfy, if the expenditure is belonging to 2021, the TDS deduction should be done in the same previous year. See, you have the relaxation only for the remittance, not for the deduction. If the expenditure belonging to 2021, the deduction should be happened in 2021, not in 21-22. If the deduction is happened in 21-22, the deduction is allowed only to 21-22. That expenditure will be allowed for the previous year 21-22 only. Clear, sir? Irrespective of the fact whether you remitted to the department well within the due date or not. Clear? Next. Look at this example, sir. Expenditure belonging to 2021. DDS directed on 2021. 1st March 2021 and the previous year 2021. Same previous year. Very good. Remitted on 30th July 2021. But unfortunately, sir, he filed the return on 20th July 2021 itself. See, generally the due date is he can file the return up to 31st July 2021. See, the 31st July 2021 is a due date, ma. It doesn't mean that you should file the return on 31st July only. You can file any date prior to that due date. Yes or no? Right? So Mr. X filed on 20th July 2021 itself. Ante, the remittance was not happened well within the date of filing of return of income. You file your return. See, when you filed your return means you have concluded all the transactions of 2021. You have disclosed your income details to the department. The game is over for 2021. Now the gates are open for 21-22. Are you following or not? So in that scenario, what happens is the deduction is allowed for the next previous year, means 21-22. Clear, sir? Next, look at this example. Expenditure belonging to 2021. TDS directed on 1st Feb 2021. So same previous year deduction was happened. Very good. TDS remitted on 1st of August 2021. Well within the due date, after the due date, after the due date. Hence, deduction is allowed to the previous year 21-22. Next previous year lo meeku deduction vastundi. Next. Sir, here expenditure belonging to 21-22. TDS is directed on 1st March 2021. That means same previous year the deduction was made. Very happy. TDS remitted on 20th July 2022. So the due date for the filing of return of income is 31st July 2021. For the previous year 2020-21, for the filing of return of income, the due date is 31st July 2021. But you have remitted the TDS to department on 20th July 2022. Ante during the previous year 2022-23, not even in the previous year 21-22. Not even remitted to department during the previous year 21-22. You're remitted in the 22-23 previous year. Hence, the deduction is allowed to 22-23 only. Okay, ma. Next. And then after that, 40A small a. Ma, 40A1 applicable for non-resident payments. The payments which are payable outside the India. 40A1A applicable for resident payments. Resident payments. Are you following, sir? Right now, look at this example. Mr. X is a tenant paying 50,000 per month as rent to Mr. Y, owner. So here TDS will be attracted under section 194I at the rate of 10%. So rent per month 50,000. Now TDS will become 5,000 rupees. Now the tenant, while paying the rent, he should deduct the TDS under section 194I. Clear? And whatever the TDS deducted, it should be remitted to the department. Right. So resident payments, I've given the differences as well here. You can see nature of payments, 40A1, non-resident foreign companies, right? Any payments made towards the non-residents, or any payments made towards foreign companies, any payments made towards payable outside the India. All those are covered under section 40A clause 1, and 40A1A covers resident payments. Next, if 40A1 attracted 100% is a disallowance. If 40A1A attracted 30% is a disallowance. 30% is a disallowance. Are you following, sir? right? Ante even if 40A 1 year is attracted, 70% of the expenditure you can claim deduction in the same previous year itself. Only 30% will be disallowed, amma. Okay now. Next, 40 small b, assessment of the firms. Assessment of the firms. So in the case of the normal assessees other than partnership firms, the deduction is allowable under section 30 to 37. For partnership firms and LLPs, they can claim deduction under section 30 to 37. Plus, in addition to that, they can also claim deduction under section 40 small b. They can also claim deduction under section 40 small b. Are you following, sir? Every one of you, right? So partnership firms, LLPs claims deduction from 30 to 37 plus 40 small b also. Sir, under section 40 small b, what are the deductions they will get? Number one, interest paid to the partners on the loans given by the partners and as well as on their capital accounts. Number two, remuneration paid to the partners. These two expenses are allowed as deduction to the partnership firm under section 40 small b. Clear? Next. So look at here, sir. 40A1 we have discussed, 40A1A we have discussed. Assessment of the firms, right? So under section 40 small b, right, in order to claim the deductions under section 40 small b, you have to satisfy certain conditions. You have to satisfy certain conditions. So conditions for claiming deduction, right, sir? You can see here. So deductions under section 40 small b shall be subject to the following conditions. As per section 184, there must be a partnership deed, right? So there must be a formal legal document between the partners and partnership firm, and the share of profits must be specifically mentioned in the deed, right, sir? And that certified copy of the deed must be submitted to the income tax department while filing the first return of income, and the firm has never been assessed to the best judgment assessment. Once if a partnership firm assessed, its income is assessed under section 144, then the partnership firm is not entitled to claim deductions under section 40 small b. Forever, not for the year in which 144 was invoked. Forever, the firm is ineligible to claim deduction under section 40 small b. Are you following or not? Next. So I've already told you the two deductions mentioned under section 40 small b. Number one, interest on loans to the partners. Number two, remuneration to the partners. First, look at the interest on loan to the partners and as well as interest on capital accounts to the partners. So the interest amount will be allowed as deduction to the partnership firm subject to the conditions. The interest must be authorized by the partnership deed. So there must be a provision in the partnership deed that the partners are entitled to receive the interest on their loan accounts and as well as on their capital accounts. Then the payment must be related after the partnership deed, and the partner may be a working partner or a dormant partner. Here the status of the partner is irrelevant, ma. Whether he is a working partner, whether he is a sleeping partner, whether he is a partner in profits is irrelevant. Okay, now next, focus points. If the deed is silent, then the interest to the partners shall be a disallowed expenditure. Clear, sir? Right? There is no authorization from the partnership deed regarding the payment of interest, then that interest will be disallowed. Next, if the deed authorizes, yes, the interest shall be allowed as deduction to the minimum of the following: actual interest paid, interest as per the partnership deed, 12% per annum as simple interest. Suppose that if the actual interest paid is at the rate of 15%, but the deduction is restricted to 12% only. 12% only. So the maximum interest that will be allowed as deduction to the partnership firm is 12% per annum. That's it. Clear, sir? Next, remuneration to partners. Again, you will find the same conditions, ma, right? So the remuneration must be authorized by the partnership deed, and the remuneration paid to the working partner only eligible for deduction. If the remuneration paid to the dormant partner, sleeping partner, deduction is not allowable. Clear, sir? Next, look at here. Remuneration paid to the partner. Sir, here, is there any restriction with respect to the remuneration amount? Yes. See, whatever the remuneration you paid, the entire amount is not eligible for deduction. The entire amount is not eligible for deduction. We have a restriction. And now what is the restriction? Look at here. Book profits up to 3 lakhs. Book profits up to 3 lakhs. 90% of the book profits are 1.5 lakhs, whichever is higher. Next, in excess of 3 lakhs, 2,70,000, that is a 90% of book profits. Plus, in excess of 3 lakhs, that excess portion is there, no? 60% of the book profits in excess of 3 lakhs. So, maximum ceiling limits with respect to the remuneration. Sir, how to calculate? Look at these examples. So, book profits 3 lakhs. Then, the actual remuneration paid is 2 lakhs. Now, what is the deduction allowable under section 40 small b? Look at here. Actual remuneration paid 2 lakhs. Maximum permissible deduction. What is maximum permissible deduction? Up to 3 lakhs of book profits. 90% of the book profits are 1.5 lakhs, whichever is higher. So you have exactly book profits given 3 lakhs. So the maximum permissible deduction 1,50,000 or 90% of book profits. 3 lakhs into 90%, 2,70,000, whichever is higher. So the actual remuneration paid 2 lakhs, maximum permissible deduction 2,70,000, whichever is lower. So the deduction is 2 lakhs. Clear, sir? Next. Look at the second example. If in the above case, the actual remuneration paid is 3 lakhs. So actual remuneration paid 3 lakhs, but the maximum permissible deduction 2,70,000 only. So whichever is lower. So the deduction allowable under section 40 small b, 2,70,000. Clear. Next, look at the example number 3. So book profits given 8 lakhs. Book profits 8 lakhs. And the actual remuneration paid 7 lakhs. Now, can I claim the entire 7 lakhs as deduction here? No. Look at here. Actual remuneration paid 7 lakhs. Maximum permissible deduction 5,70,000. How did you calculate this? Look at here. Calculation of maximum permissible deduction. Book profits given in Tama 8 lakhs. So for the first 3 lakhs of book profits, 90% of the book profits, 2,70,000. In excess of 3 lakhs, 60% of book profits, 3 lakhs. So the total permissible deduction, 5,70,000. Okay, ma. So maximum permissible deduction, 5,70,000. Even though you actually paid 7 lakhs, but the deduction is restricted to only 5,70,000. Like that, you have to calculate, amma. Are you following or not? Okay, now. Next. And after that, you're provided with the next section 40 capital A2. This I will be discussing the next session, sir. I'll be discussing the next session. Okay, now. So next session, PGBP marathon will get completed. Clear, sir? Right. So see you in the next session, sir. Till then, have a good day and good night. Stay home and stay safe. A very good morning, students. Welcome to the income tax marathon classes. So in the last session, we are discussing the PGBP marathon classes. So in which we have completed up to section 40 small a and 40 small b. 40 small a deals with the disallowances and 40 small b deals with the assessment of the firms. Now time for the section 40 capital A series, in which the very important sections are 40 capital A2 and 40 capital A3. First, look at 40 capital A2. Expenditure found to be excessive. What this section explains about? This section explains about whenever you are incurring expenditure in relation to your business or a profession, that expenditure must be reasonable. That expenditure must be at par with the fair market value. But if you incur that expenditure in an excessive manner, which is more than fair market value, which is in an unreasonable manner, then to the extent it is unreasonable, that unreasonable portion should be disallowed. Now look at this example, sir. 48 expenditure found to be excessive. Mr. X, right, owning a company, sir, right, and in which Mrs. X, his wife, is appointed as a finance manager, and the salary giving to her is 1 lakh per month. Actually, the educational qualification of Mrs. X is just MBA finance, and the work experience is nil. So generally, a person with MBA finance with no prior work experience, the maximum salary we can provide in relation to such a candidate is hardly 20,000 per month. Hardly 20,000 per month. There are lakhs of people awaiting for the jobs. Right, sir. So those who completed their MBA finance with no prior work experience, even in the open market, you can get it for 10,000 per month. Okay, we are offering 20,000 per month. Let us assume that. So it's a market value. But how much you're offering to your wife? 1 lakh per month. So what is the unreasonable portion? See, for the same qualification, you will get a person in the open market for 20,000 per month. But you appointed your wife as a finance manager and you're offering 1 lakh per month. So to the extent it is unreasonable, that is 80,000 per month. What is the reasonable salary? 20,000 per month with this qualification. For this qualification, the reasonable salary is 20,000 per month. And how much you're offering? You're offering 1 lakh per month. So what is the unreasonable portion? 80,000 per month. So this unreasonable portion should be disallowed under section 40 capital A2. Are you following, sir? Every one of you. Right? Next. 48.3. Cash payments greater than 10,000 rupees. So look at the provision. Any expenditure in relation to business or profession, the payment should be to a single person in a single day. So whenever you are making a payment to a single person in a single day, and if the aggregate of the payments made to a single person in a single day exceeds rupees 10,000, then in that scenario, the payment should be done either by way of account paid check or account paid draft, ECS, electronic clearing systems, or any other prescribed electronic modes like credit card, debit card, IMPS, NEFT, RTGS, Aadhaar Pay, BHIM, or any other UPI. Right, sir? So whenever you are making the aggregate of payments to a single person in a single day, if the aggregate of payments exceeding 10,000 rupees in a day, then the payment should be made by way of account paid check, account paid draft, ECS, or any other prescribed electronic modes. Sir, if you made this 10,000 rupees by any mode other than these specified, then the entire amount of that expenditure would be disallowed. Look at here, sir. If the above payments were made otherwise than by the above mentioned methods, then the entire payment would be disallowed under section 43. So that means if you make the payment through cash, right? So let us say that you have paid 15,000 rupees advertisement expenses, 15,000 rupees, right, in a single day by way of cash. The entire 15,000 would be disallowed. See, if 48.2 attracted, only the excess portion disallowed, not entire portion. But when 48.3 attracted, the entire portion will be disallowed. That's the difference between 48.2 and 48.3. Clear, my everyone? Next. Look at this example, sir. March 2020, the rent amount is 15,000 rupees. Right? Basically, the March month rent will be payable in the month of April. So that's a normal tendency. So in the April, 7th of April 2020, you have paid them that amount by way of cash. Right, sir? See, for the previous year, 2019-20, though this amount is in payable status, you can claim this 15,000 as deduction. Basically, majority of the circumstances, the SFCs follows accrual basis of accounting. And as per the principles of accrual basis of accounting, paid includes payables. So though for March 2020, the rent is in payable status, still you can claim deduction for the 1920 only. Right, sir? But actually when it comes to the payment was made by way of cash. So that means this 15,000 rupees paid in cash. Sir, earlier during the previous year 2019-20, this amount you already claimed it as deduction. Now, see, basically here the rent amount is a disallowed expenditure as it is paid in cash. Since the payment exceeding 10,000 rupees and the payment was made by way of cash, it's a disallowed expenditure. But the disallowed expenditure, you already claimed it as deduction in the 1920, because as on 31st March 2020, you don't know that you are going to pay this amount by way of cash on 7th April. Yes or no? So while preparing the books of account for the 1920, you would have claimed this as expenditure. Now what you have to do is, for the previous year 2021, the same should be treated as a deemed income, rent paid in cash. Are you following, sir? See, earlier, since you claimed that amount as deduction, your profit got reduced. Now the time to increase your profit. So you need to treat it as income. Clear, sir? Next, look at this example. On 23rd March 2021, 10 a.m. we made payments to a single person, sir. Mr. X, let us assume. Through invoice number 101, we purchased raw materials worth 9,000 rupees and 9,000 we are paid in cash. And 2 p.m. again we purchased goods from the same person, Mr. X, through invoice number 110, right? Worth 9,500 rupees. Again we paid in cash. And 5 p.m. again we have purchased the goods from Mr. X and through invoice number 120. So 10,000 rupees is the total invoice value and we are paid in cash. You can see here, all these payments were made to a single person in a single day. And the aggregate of the payments comes down to be, 28,500, which is greater than 10,000. Now in this situation, so can I apply the provisions of section 48.3? Answer is no. No. So you only said no, sir. Any aggregate payments to a single person in a single day exceeding 10,000 rupees, and if that payments were made by way of cash, then the entire amount of expenditure should be disallowed as per the provisions of section 48.3. But in this scenario, there is no need of attracting the 48.3 provisions, because 10,000 limit you have to see invoice wise. Here you made the payments to a single person in a single day. Aggregate of the payments exceeding 10,000 rupees, but not in a single invoice. See, 101 invoice number having invoice value only 9,000. We are paid in cash. So well within the limits of 10,000. 110 invoice value having the cash 9,500 only invoice value, well within 10,000. Invoice number 120 having an invoice value of 10,000. Sir, 48.3 provisions applicable only when the payment exceeding 10,000. Even if it is equal to 10,000 rupees, 48.3 provisions are not applicable. So we have to see the 10,000 limit invoice wise. And none of the invoices amount exceeding 10,000 rupees. Hence, 48.3 provisions are not applicable. Clear, everyone? Right? See, generally 48.3 provisions were introduced to prevent the cash payments now. In order to encourage the cashless payments, these provisions have been introduced. See, whenever you want to introduce a particular provision with a good cause, it should not be having any exceptions. See, 48.3 provisions were introduced with a good cause, but the intention for which you have introduced 48.3 got dissolved, or we can say defeated, deceived through this exceptional cases. See, what is the need, sir? See, in our Indian Penal Code, IPC, for every crime, there is a punishment. For every crime, there is a punishment. Yes or no? Right? So if you do this particular crime, then you will be punished under this particular section. So for every crime, there is a punishment, sir. But whenever you decided the punishments for every crime, you should not allow that person to escape from the law by allowing bail. So do crime, get a bail, and enjoy. Now, who is taking the punishment, sir? Right? See, if I've done a crime, right, and I've taken a bail and I'm roaming in the streets like everyone, I'm enjoying my life like everyone. Right? I'm not a prisoner anymore, right? See, when there is a concept of bail, everyone will do the crime and go for the bail. No one will interested to take the punishments. There were so many Bollywood stars which are not only Bollywood stars, there are Tollywood stars, Bollywood stars. See, all heroes, heroines for that matter, they have made some crimes, but by taking the bail, they are doing movies, they are enjoying their routine life. What is the need of, and what is the use of having this punishment, sir? Yes or no? Simply they are taking bail and bail and bail, and they are enjoying their routine life. They are doing the shows, they are doing the movies, they are enjoying their life. Are they feeling that they are like taking like a punishment? No. Sir, no. Right, sir. So as long as this concept of bail exists, no one will fear about these punishments. As long as these exceptions are existing, no one will fear about this 48.3 section. As simple as that. Right, sir? See, in these exceptions, you can take the best advantage of this exception. Where, ma? I'll take, uh, so generally, whenever there is, an emergency payment you need to make, but at that particular time, right? If the banks were in holidays, the banks were in strike, right, sir? So then you need to make the payment by way of cash. You can escape these provisions. Are you following, sir? So of course, we have some amendments here. You can check out my here. Wherever the provision I was striked out like this, that means that is an amendment. Earlier, we have the option to pay the amount through credit card and debit card, right? Of course, anyhow, now this payment is these systems are covered under any other prescribed mode, any other prescribed electronic modes. Yes or no? Right? And also here, this provision is removed from exceptions where the payment was required to be made on a day on which the banks were closed, either on account of holiday or on strike. These provisions were also removed from the exceptions. Earlier, the people are used to take the advantage of this exception most. Whenever they happen to make the payments more than 10,000 rupees by way of cash, they will schedule them accordingly. Like they will plan on second Saturday and fourth Saturday, the days on which the banks were closed, or they will plan on Sundays, or they will plan on the days on which the banks were on strike, and they will claim this exception. Yes, sir, I tried to make the payment through electronic mode by way of check or RTGS, IMBS, but I found the bank servers were down. I found the banks were closed. I found the banks were on strike. So what should I do? My supplier urging me to pay the amount immediately. So I paid through check, cash. Earlier, they used to take the advantage of this exception, but of course, now this exception have been removed, right? Next. And after that, you have the important section like deemed profits, section 41 series. In that 41.1 refund of expenditure. Sir, earlier, if you incurred any expenditure for which you already claimed a deduction, and with respect to the same expenditure, if you're receiving any amount, then the year in which you receive that amount will be deemed as income, will be deemed profit, and will be taxable. Like, look at here, you purchased a plant and machinery for 10 lakhs. 10 lakhs. Assume that you're doing some 3580 specified businesses. So as per the provisions of section 3580, the entire cost of, not plant and machinery, raw materials. You purchased the raw materials for 10 lakhs. Right? So I mean, it's a revenue expenditure. Immediately on your profit and loss account, you can claim it as a deduction. But later on, there was a fire accident happened in your godown, the godown in which you have stored your raw materials. There was a fire accident. So the entire stock was lost. Like, and suppose that you have an insurance policy for the raw material, but the insurance company given you only 2 lakhs as compensation. Now, the amount of 2 lakhs compensation, whatever you received, the 2 lakhs will be treated as your deemed profit. So loss of stock only 2 lakhs, to that extent you received the compensation. So to that extent that should be treated as your income. Okay, so now your total raw material cost is only 8 lakhs because you have lost 2 lakhs worth of raw materials. So only the total cost of raw materials becomes 8 lakhs, for which you already claimed 10 lakhs deduction. Excess and the claim excess 2 lakhs claim, so that excess claiming now will be treated as your deemed profit. So 10 lakhs debit, 2 lakhs credit. Ultimate impact 8 lakhs debit. Okay, next. Initial caution deposit 10,000 rupees. See, this is the concept of OIT, own your telephone scheme. Own your telephone. This is an old concept, sir. Now, olden days, like the days of 1970s and 1980s. Of course, in present days, these provisions are not having any, importance. The olden days, whenever you want to get a telephone connection, sir, you have to wait for some years together. If you made an application today for the telephone connection, you will get the connection after 3 years or after 4 years. I'm talking about the days of 1970s, 1960s. right, sir? But if you want the telephone connection immediately, say within 1 week, now you have to make certain caution deposit under OIT scheme on your telephone scheme, right, sir? And if you made the deposit amount, you will get the connection within 1 week or 10 days max. No need to wait for years. Okay, so see here you made an initial caution deposit of 10,000 rupees, and its nature is refundable in nature, ma. This 10,000 rupees is a refundable deposit, ma. And when are you going to get this refund, ma? The days on which your application number came, right, sir? So basically, your application number, assume that came after 3 years. So at that time, whatever that caution deposit you have made earlier, the same will be refunded to you. Initially, at the time of making the payment of caution deposit, that will be treated as expenditure, and you can claim it as debit, expenditure, deduction. And at the time of refund, the same will be treated as income and taxable. Okay, now, so like that, you will be having some exception provisions. And in the 41 series, one more important section, recovery of bad debts. Look at the examples, ma. In the previous year, 1920, bad debts incurred 10 lakhs. So in the profit and loss account, we claimed a deduction 10 lakhs. Bad debts 10 lakhs. Now in the previous year, 2021, a recovery of bad debts, out of the 10 lakhs, we are able to recover 5 lakhs. Now the same should be treated as your deemed profit. Recovery of bad debts. Ma, bad debts recovery should be treated as income only when they were allowed as deduction earlier. See here, you claim a deduction of 10 lakhs. So deduction was allowed earlier. Since the deduction was allowed earlier, the year in which you have recovered the bad debts, the same shall be treated as your income. Assume that during the previous year 1920, nothing was allowed as deduction to you. You incurred 10 lakhs bad debts genuinely, but the department has not given you deduction. Department has not given you any deduction. Right. Now in the previous year 2021, recovery of bad debts 5 lakhs. Now in this year, there is no need to treat that 5 lakhs as your income. Had the department allowed the deduction to you earlier, then you would have treated the recovery of bad debts as income. Since the department has not given deduction earlier, there is no need to treat the recovery of bad debts as income. Earlier deduction allowed chestene, subsequent recovery will be treated as income. If deduction was not allowed earlier, there is no need of treating the subsequent recoveries as income. As simple as it. Okay, ma. Now look at this example, sir. X Limited made a credit sales worth 100 lakhs. So X Limited got amalgamated with Y Limited. Later on, X Limited got amalgamated with Y Limited. Now Y Limited collections from debtors out of this 100 lakhs. Out of this 100 lakhs, Y Limited able to collect 80 lakhs. And Y Limited incurred a bad debt of 20 lakhs. Right, sir. Y Limited incurred a bad debt of 20 lakhs. Now, after that, Y Limited amalgamated with Z Limited. Now, Z Limited, out of this 20 lakhs bad debts, Z Limited able to recover the entire 20 lakhs. Now, what is the tax treatment? What is the tax treatment? Simple, ma. In the books of account on the X Limited, in the books of account of the X Limited, they can show the entire amount of credit sales as their income by credit sales 100 lakhs. Now, in the books of account of the Y Limited, since they met with a bad debt of 20 lakhs, they can claim this bad debts as deduction. 20 lakhs, 20 lakhs. We have discussed already. Successor can claim the bad debts of the predecessor. Bad debts were created by predecessor, but that was incurred in the hands of the successor. So the successor can claim the deduction of the bad debts. Absolutely no problem. The same business must be in continuation, but need not be by the same person. Do you remember the provision? The business is in continuation, but it is now being continued by Y Limited. Hence, Y Limited can claim deduction. Now, in the hands of the Z Limited, sir, Z Limited recovered 20 lakhs as bad debts. Now, will they be taxable in the hands of Z Limited? Nothing will be taxable in the hands of Z Limited as bad debts. Nothing will be taxable. Why? Because, sir, earlier you have given deduction of 20 lakhs bad debts. To whom? Did you give to Z Limited? No. Did you given to? You given to Y Limited. See, Y Limited able to recover this 20 lakhs now. So in the hands of the Y Limited, that will be taxable. But Z Limited recover the bad debts now. Earlier you have given deduction to Z Limited. No. Hence, deduction is not allowed. Since the deduction was not allowed to Z Limited earlier, there is no need of treating this 20 lakhs as income in the books of account of Z Limited. Are you following or not? So that's 41 series for you. And after that, we'll be having a section 43B, deduction based on actual payment. Yeah, here you can see 43B, deduction based on actual payment. Here you have a list of sections like taxes. What kind of taxes here we are talking about? We are talking about indirect taxes, not direct taxes, because direct taxes anyhow not allowed as deduction under section 40 small a. Whether you paid them, whether you have not paid them, whether you paid them in advance, in any of the cases, indirect taxes not allowed as deduction. Are you following, Amma? Sorry, direct taxes. Sorry, direct taxes not allowed as deduction, like income tax, wealth tax, dividend distribution tax. These are all comes under direct taxes category. They are not at all allowed as deduction. Clear? Now, indirect taxes, yes, you can claim it as deduction, but only on actual payment. Then bonus or commission payable to employees, allowed as deduction only on actual payment. Interest on loans generally allowed as deduction on accrual basis. But if you borrowed the money from any public financial institution or SFC, state financial corporations, or state industrial investment corporations, any scheduled bank or cooperative banks, then see, whenever you are taking the loans from these financial institutions, interest will be allowed as deduction, but only on actual payment. Only on actual payment. Clear, sir? So like this, you'll be having some list of payments. You'll be having this list of payments, like any sum payable by the employer as a leave encashment, leave salary, contribution to the welfare funds, any sum payable by the assessees to the Indian Railways or the use of railways assets. These expenses allowed as deduction only on actual payment. Right, sir? And where it was mentioned 43B. Now, sir, you said that it will be allowed as deduction on actual payment. Right? Then when the payment should be made? When the payment should be made. Clear? So the payment should be made. Here the question comes. When the payment should be made to get the deduction? The payment should be made either in the same previous year. If the expenditure belonging to the previous year 21-22, the payment should be made in the same previous year. That means 2021-22, or on or before the due date for the filing of return of income under section 139(1), or on or before the date of filing of return of income, whichever is earlier. See, you can make the payment in the previous year 2022-23 also, but well within the due dates under section 139(1) or date of filing of the return of income. See, the due date must be some 31st July for individual assessees. Suppose that if you file the return on 20th July itself, so you should make the payment on or before 20th July. On or before 20th July. So the due date is 31st July, but you actually filed on 20th July. So whichever is earlier, no? So the payment should be made on or before 20th July. Are you following or not? So either you have to make the expenditure in the same previous year, or you can also make the payment in the next previous year, but well within these particular dates. Then if you made the payment well within this particular dates, the expenditure will be allowed as deduction to 21-22 itself. 21-22, the year in which the expenditure was incurred. For that same previous year, you can claim deduction. Even if you make the payment in 22-23, well within due dates, then you can claim deduction in 21-22 itself. Sir, what if the case, if I make the payment after these due dates, then the deduction will be incurred for the previous year in which the expenditure was actually paid. Suppose that you actually paid during the previous year 24-25. So the deduction will be allowed to 24-25 only, not for 21-22. Are you following, sir? Next. And after that, you have a provisions of 44AA, maintenance of books of accounts. Right, sir? and for which the assessees are categorized into two main categories, like business assessees and non-notified professionals, and second category, notified professionals. Notified professionals. Are you following, sir? And I've given the the charts as well. You just go through these charts. All these running notes will be provided to you in our Shrestha app. You will find all these running notes. You can download these running notes at free of cost. I got so many messages from the students who already watched GST marathon videos. They're asking me for the running notes, right? You can download from our Shrestha app, right? So all these running notes, all the subjects running notes will be provided as a soft copy. All the soft copies are available in our app. Clear, sir? Right? You can download them at free of cost. No need to pay any amount. Clear, sir? So you just go through this particular. It's a 44AA compliance provision, right? Not so important from examination point of view. Try to remember these limits: 2,50,000, 25 lakhs, 1,20,000, 10 lakhs. Try to remember these particular limits. Okay. And next comes the very important provision, 44AB, tax audit. Tax audit. So whenever tax audit provisions are applicable, right? Sir, first of all, what is a tax audit? It's a statutory audit. Like an audit which is mandatory by a statute is called as a statutory audit. Yes or no? As per the Companies Act 2013, company audit is mandatory, sir. It's a statutory audit. Right. As per the Banking and Regulations Act, bank audit is mandatory for certain banks. It's a statutory audit. As per the Cost Accountants Act, cost audit. As per the Information Systems Act, right? So we will be having some systems audit. Are you following, sir? Right? So these are all the different types of audits which are becoming mandatory by a statute. Hence, these are all covered under statutory audits. If any audit mandatory by the Income Tax Act 1961, that is a tax audit. Right, sir? So tax audit provisions, to whom they are applicable. Sir, if you're a business assessee, look at your turnover. If your turnover during the previous year exceeding 1 crore, for you tax audit is mandatory. For you, tax audit is mandatory. And in the case of the assessees who are opted for presumptive taxation. So what is presumptive taxation? I'll tell you in a couple of minutes. So for those assessees who opted for presumptive taxation provisions, for them, the turnover is 2 crores. For them, the turnover limit is 2 crores. If their turnover exceeding 2 crores, for them, the tax audit provisions are mandatory. Normal assessees, 1 crore. Okay, ma. And if you are a professional assessee, if your gross receipts exceeding during the previous year 50 lakhs, then tax audit provisions are mandatory, sir. Okay, now. Next. Now look at here, sir. Tax audit provisions. Yeah. So for business associates, a person carrying on a business, if the net sales amount, right, in the business for the previous year exceeding 1 crore, and we have a latest amendment by the Finance Act 2020. However, in case of the person carrying on such business, whose aggregate cash receipts in the relevant previous year less than 5% of the total receipts, including the receipts for sales, turnover, gross receipts, and the aggregate cash payments in the relevant previous year is less than 5% of the total payments, then tax audit becomes mandatory only if his total sales, turnover, gross receipts in business exceeding 5 crores in the relevant previous year. So this is the latest amendment, sir. See, generally in the normal cases, the tax audit ceiling limit is 1 crore. If the assessee satisfies these two conditions, then this limit of 1 crore, increase it to 5 crores. What are the two conditions? The aggregate cash receipts should be less than 5% of the total receipts. Out of the total receipts, the cash receipts should be less than 5%. Next, at the same time, Payments also, the aggregate cash payments in the relevant previous year should be less than 5% of total payments. So if these two conditions are satisfied simultaneously, then the tax audit becoming mandatory only when your turnover exceeding 5 crores. Only when your turnover exceeding 5 crores, not 1 crore. So everyone should be very, very careful. So look at this example, sir. Receipts, cash 15 lakhs, non-cash 2 crore 90 lakhs. Sale of car, no cash receipts, only non-cash. Plant and machinery, land, income tax refund, other receipts. You can see the total amount of receipts, 4 crores 96 lakhs 50,000, out of which the cash receipts are just 24 lakhs. As a percentage student, 24 lakhs cash receipts out of 4.965 crores. 4 crores 96 lakhs 50,000 as a percentage into 100. If you calculate you'll get 4.83 percentage. So out of the total receipts, your cash receipts are just 4.83 percentage. So first condition satisfied. First condition satisfied. Look at the payments. Purchase of goods, plant and machinery, raw materials, land, other payments. The total payments 2 crores 52 lakh 50,000. Out of which the cash payments were 14 lakhs. So 14 lakhs you have made cash payments out of 2.525 crores. As a percentage student, you will get 5.54 percentage. So that means second condition not satisfied. First condition satisfied, but second condition not satisfied. Hence, the higher ceiling limit of 5 crore not applicable to you. The higher ceiling limit of 5 crores not applicable to you. For you, 1 crore limit is applicable. Are you following, sir? You can see in this case, the cash receipts are up to 5% of the total receipts, but the cash payments are more than 5% of the total payment. So the turnover limit of 5 crores not applicable. So in this case, assessee required to audit his books of account as turnover is more than 1 crore and submit the audit report before 1 month for the due date for the filing of return of income. Clear now? His turnover exceeded 1 crore. Look at the sale of goods. This is what turnover, no? 3 crores 5 lakhs is a turnover which is greater than 1 crore. So assessee is liable for tax audit. Clear? And for those assessees who opted for 4480, then he shall not be required to get his accounts audited if the total turnover not exceeding 2 crores. Clear, sir? And CBDT clarified that the higher threshold limit for non-audit of accounts have been given only to the assessees who opted for presumptive taxation under section 4480. Clear, sir? So normal assessees 1 crore. Those assessees who satisfied cash receipts and cash payments conditions 5 crores. Presumptive taxation cases 2 crores. So one must be very, very careful. And professional assessees, the ceiling limit is 50 lakhs. Clear, sir? Next. Sir, what if the case, if tax audit becomes mandatory, then what should I do? So when tax audit becomes mandatory for you, you have to get your books of accounts audited by a practicing chartered accountant. The practicing chartered accountant, after completion of his audit, he will issue a tax audit report. And the tax audit report should be submitted along with your return of income. Clear now? Right? Next. So for present to taxation cases, right? I've already told you like one for them that ceiling limit is 2 crores. No, 2 crores, right? So here, since the turnover is just 150 lakhs, they can opt for the presumptive taxation provision. So no need to get them books of accounts audited. No need to get them, produce any expenditure and no tax audit. Nothing will be applicable, sir. Okay now. And next, sir, in case whenever you opting for presumptive income, and presumptive income means you have to declare at least 8% of your total income as your turnover income, 8% of your turnover as your total income. Just a second, sir. Yeah. So at least 8% of your turnover as your income, sir, taxable income. And in the case of all the online receipts, it is enough to declare only 6% as your business income. Out of your total turnover, only 6% as your business income. That's what presumptive taxation. But still, if you want to claim an income which is less than the 8% of turnover, which is less than the 6% of turnover, then you have to get your books of accounts audited by a practicing chartered accountant. For you, 44AA provisions, 44AB provisions are applicable. So if any SSC who opted for presumptive taxation provisions and wants to declare an income which is lower than presumptive income, they can do so, absolutely no problem. But they have to maintain the books of accounts and they have to get them audited under section 44AB. Clear, sir? And this is with respect to tax audit, right? And basically for tax audit provisions, the due date will be 30th September of the next financial year, sir. Right, sir. So 31st October is the due date for the filing of tax audit return, and 30th September you have to file the tax audit reports. Clear? Next. These are all some special cases. You can go through the provisions more. Now, finally, the last important section from this chapter, presumptive taxation. Presumptive taxation. Total, you have 3 sections: 44AD, ADA, and AE. Look at the 44AD, applicable only to the resident individuals, HUFs, and firms other than LLP, right? And this is applicable to the any business or profession other than you have some list, some list, like the persons who are carrying on the businesses covered under section 44AE, right? Those who are engaged in the business of plying, hiring, or leasing of goods carriages, anyhow they can claim the presumptive taxation provisions under section 44AE, not under section 44AD. Next, notified professionals, 44AD not applicable, but 44ADA applicable. Next, persons those who are engaged in the business where the income is earned in the way of commission or brokerage, and persons who are carrying on the agency business. For these four people, 44AD provisions not applicable. And what is the turnover condition? Your turnover shall not exceed 2 crores. Right, ma? And the conditions, you have some conditions, ma, here. You have to satisfy these conditions. Like, once you opted for presumptive taxation provisions, you are not eligible to claim any exemption under section 10AA. All income-based deductions you cannot claim, and you should not claim any expenditure as deduction from 30 to 38. And in the case of a partnership firm, they should not claim deduction under section 40 small b, because out of your turnover, you are declaring only 8% as your income. Okay, what does it mean? The remaining 92%, you are treating it as expenditure. The remaining 92%, you are treating it as expenditure. Already out of the total turnover, suppose that your turnover is 100 lakhs, ma, out of which you are declaring only 8 lakhs as your income. Remaining 92 lakhs out and out, you are getting deduction, ma, as an expenditure. Right, sir? Remaining 92 lakhs, you are getting as deduction, expenditure, out and out. So there is no need to claim deductions again from 30 to 38 and 40 small b. Okay. And presumptive income, 8% of the gross turnover, and 6% will be applicable where the total receipts are online. Gross receipts, 6% of the gross receipts, if the amount is received by way of account, paycheck, deed, or ECS. DD or any other electronic prescribed modes. Clear, sir? Next, 44ADA applicable for notified professionals. Notified professionals is applicable to any kind of resident SSCs, and gross receipts shall not exceed 50 lakhs rupees. And conditions to be satisfied: they should not claim any deductions from 30 to 38, and they should pay advance tax on or before 15th of the March of the financial year. Next, 44AE, this is applicable to any SSC those who are engaged in the business of plying, hiring, and leasing of goods carriages. Means those who are maintaining GTA, goods transporting agencies. Right, sir? So here there is no turnover or gross receipts condition. Here the condition should be the vehicles, the number of vehicles shall not exceed 10 vehicles at any time during the previous year. That's the condition, ma. Are you following, sir? Next, So the number of vehicles shall not exceed 10 vehicles at any time during the previous year. That's the condition, sir. You can see here, the eligible person carrying on the business shall not own more than 10 vehicles at any time during the previous year. Clear, sir? And even if you have more than 10 vehicles, even for a single day in the previous year, then for the entire previous year, you are not eligible for presumptive taxation provisions under section 44AE. Look at this running note, sir. So once you opted for presumptive taxation provisions, no, there is no need to maintain any books of accounts, no need to produce any documentary evidence for expenditure, and no tax audit provisions applicable to you. So generally, the presumptive taxation provisions are introduced for the benefit of the small SSEs, because for them, maintaining the books of accounts, tax audit, these provisions becomes very costlier to them. So that's why presumptive taxation provisions introduced. Once you opted for presumptive taxation, no need to maintain any books of accounts. Lot of money will be saved to you. No need to produce any documentary evidence for any expenditure. Out and out, 92% of the total turnover you can claim as expenditure. Clear? No tax audit provisions applicable to you. A lot of money again saved to you. You can peacefully concentrate on your business. Okay, next. And if the assessee wants to declare a lower income, which is lower than 8% or 6% of turnover, they can do so. Absolutely no problem. Assessee can do so, but subject to the satisfaction of the following conditions. They have to maintain the books of accounts as per the provisions of section 44AA, and they have to get them tax audit under section 44AB. Clear, ma? If these two conditions are satisfied, yes, they can declare an income which is lower than presumptive income. Next, look at 44AE example. Sir, on 1/4/2020, he owned 6 vehicles. 1/7/2020, he purchased 5 more vehicles on hire purchase basis. Absolutely no problem. Even if you purchase the vehicles on hire purchase basis, even if you get the ownership only upon the payment of the last installment, but still you will be deemed as owner of that particular vehicles from the day one. From the day one. Okay. And on 1/3 March 2021, he sold 3 vehicles. So as on the last day of the previous year, he owns just 8 vehicles, which is less than 10 vehicles. So he is eligible for 44 AE. Absolutely wrong answer. Absolutely wrong answer, because sir, initially he owned 6 vehicles. Then he purchased 5 vehicles. Total put together, how many vehicles? He's owning 11 vehicles. He's owning 11 vehicles from 1st of July 2020 till 20th February 2020. Right, sir? 11 vehicles he's owning, more than 10 vehicles. So he is not eligible for presumptive taxation provisions. So here almost from 1st July 2020 till 20th February 2021. Right, sir? So for all this period, he is owning 11 vehicles, more than 10 vehicles. Hence, he is not eligible for presumptive taxation provisions. Next, there is one more important provisions under presumptive taxations. Look at this example, So for the previous year 2021, that is assessment year 21-22, he opted for presumptive taxation provisions. And once an assessee declared income under the presumptive taxation provisions for the next 5 assessment years, assessee has to declare the income as per the provisions of 44 AD only. It's mandatory provision, compulsory provisions. For any assessment year, if you declare income under the provisions of section 44 AD, for the next 5 financial assessment years, he should declare his income under the head presumptive taxation provisions, So from assessment year 22-23 onwards, so 22-23, 23-24 till 26-27, these 5 assessment years, assessee has to declare the profits as per the provisions of section 44 AD. Okay, now suppose that if the assessee declares a profit which is lower than presumptive income in assessment year 25-26, see, first 3 years they have opted for 44 AD provisions only, but in the 4th year they have declared an income which is lower than presumptive income. Condition violated. What happens? If condition violated, what happens? See here, the assessment year in which the condition violated, from the next assessment year onwards, for the next 5 assessment years, starting from 26-27 till 30-31, for the next 5 assessment years, assessee not eligible to declare the profits under section 44 AD. So he will become disentitled, ineligible to declare the profits under section 44 AD, right, ma, for the next 5 assessment years. Are you following or not? So this is a very important provisions, ma. So with this, we have completed PGBP marathon classes. Okay, now. So it's a not a regular class, ma, it's a marathon class, but still I've covered almost all the important sections which I've mentioned right at the beginning of this chapter. Clear, ma? Right? So in the next session, I'll come up with capital gains marathon classes. Okay, now. Right, sir. So till then, have a good day, sir, and good night. Stay home and stay safe. Very good evening, students. So welcome to the income tax marathon classes. In the last class, we have completed discussion regarding PGBP marathon, right, sir? So far we have completed 3 heads of income marathon classes. First, we have completed income from salaries, then income from house property. Now, PGBP was completed, 3 heads of income completed, sir. Now, the time for the 4th head of income, that is capital gains. Capital gains. So sections covered, section 45 to 55, capital A. Right, sir? So you can see here in the running notes. So charging section 45, right, ending with 55, capital A, the total range of sections in this chapter. So weightage of the chapter, we can expect 1 question compulsory from this chapter for 8 marks. And the provisions of this chapter would also be asked in the consolidated problem, that is problems on total income. Clear, sir? And the list of important sections from this chapter, section 45 charging section, 47 exceptions to transfer, section 50 sale of depreciable capital assets, 50C where the sale consideration is lower than stamp duty value, and 54 exemptions. And there are 2 very important definitions from this chapter. One must learn section 2 clause 14 capital asset and section 2 clause 47 definition of transfer. So these are the list of important sections from this particular chapter. Okay, now so let's go through. First one, section 45 subsection 1 charging section, right? So for every head of income, first we should try to learn the charging section, and then we have to learn method of accounting, because charging section deals with what are the different types of incomes taxable under this head, and method of accounting deals with on what basis they are taxable. Clear, sir? So first, section 45 subsection 1 charging section, the basic charging section for this particular chapter, it starts with any profits or gains arising on transfer of a capital asset is chargeable to tax under the head capital gains in the year of the transfer. So any profits or gains arising on transfer of a capital asset. So there are 3 very important words from this particular charging section. Number 1, transfer. The definition of transfer we are going to learn from the section number 2 clause 47. Section 2 clause 47 deals with the definition of transfer. And then the second important terminology from this charging section is capital asset. Section 2 clause 14 deals with the capital asset definition. And the third one in the year of transfer. In the year of transfer deals with method of accounting applicable to this chapter. Method of accounting applicable to this particular head of income. Clear, sir? See, capital gains are always taxable in the year of transfer. Means irrespective of the fact whether you receive the consideration or not, right? So if you are involving into the transfer, that's it, you are subject to the payment of capital gains tax. Are you following, sir? So method of accounting applicable to this particular head of income is accrual basis of accounting. So that means capital gains are always taxable on accrual basis, whether you actually received or not. But of course, we do have some exceptions for this provision, right? We do have some exceptions. That exceptions we are going to see in 45 series, like 45 1A, 45 2, 45 3, 45 4. We have some more subsections in this section 45. Clear. So for the time being, the method of accounting applicable to this head of income, accrual basis. So capital gains are always taxable in the year of transfer, not in the year of receipt of consideration. Not in the year of receipt of consideration. Okay, ma. So look at this example. Mr. X transferred a house property on 1st March 2021. That means during the previous year 2020-21, the transfer taken place. Received the consideration on 1st May 2021 means during the previous year 21-22 the consideration was received. Transfer taken place during the previous year 2021 and consideration received during the previous year 21-22. Now for which previous year the capital gains are taxable? Answer 2021 because the transfer taken place during the previous year 2021. Okay, ma'am. Next. Look at this example, sir. For the previous year 2020-21, transfer taken place, consideration agreed 50 lakhs, out of which during the year 21-22, we received a first installment of 25 lakhs and 22-23, another installment of 25 lakhs. Total put together 50 lakhs. Clear. Sir, here the capital gains are fully taxable for the previous year 2021 because the transfer taken place during the previous year 2021, irrespective of the fact whether you received the consideration or not, whether you received the consideration in full or not, whether you're receiving the consideration at a time or in installments, it doesn't all matter. It doesn't matter, ma. Right? So you always have to see whether in which previous year the transfer taken place. Clear, sir? Next. For the levy of the capital gains tax, the following conditions should be satisfied. Number one, there must be a transfer, and number two, transfer must be of a capital asset. These two conditions to be satisfied for the purpose of levy of the capital gains tax. There must be a transfer and transfer must be of a capital asset. Clear, sir? Right? Next. First, let us try to understand the definition of the capital asset. Section 2, clause 14. And capital asset includes property of any kind, whether movable or immovable, tangible or intangible, whether connected to business or not. Right, sir? So all kinds of properties are covered here. Movable properties, immovable properties, tangible properties, intangible properties, whether you are using them in your business or not, it is a capital asset. Okay, ma. And even the securities held by the FIIs, foreign institutional investors, even that FIIs holding that securities as a stock in trade, still it should be treated as a capital asset. Still it should be treated as a capital asset. Clear, sir? Next. Exclusions. We have the list of exclusions. Of course, here I've written only two: stock in trade, personal effects. Right, sir? Stock in trade is always excludable from the definition of capital asset. Always excludable from the definition of capital asset. Because see, whatever the profits you are earning by selling the stock in trade, it is your business income. It is your business income. Are you following, sir? So then how to decide whether a particular asset as a stock in trade or as a capital asset? It's purely depends upon the nature of business you are carrying. Are you following, sir? The nature of business decides whether that asset is a stock in trade or a capital asset to you. Clear? Look at this example. Mr. X sold the jewelry. So for Mr. X, jewelry is a capital asset. And any gain arising on transfer of such jewelry, then such gain is called as a capital gain. Now, apply the same logic, same example. Kalyan Jewelers sold the jewelry, but for Kalyan Jewelers, the jewelry is a stock in trade. Whatever the income they are generating by selling the jewelry, it will be treated as business income, taxable under the head PGBP. So if buying and selling of jewelry is your business activity, for you, jewelry is a stock in trade. For all other persons, jewelry is a capital asset. If you sold the jewelry, for you, it is a business income. If I sold the jewelry, for me, it is a capital gain. Are you following or not? Every one of you. So the nature of business decides. Sir, if I sold a land or a house property, for me, it is a capital asset. But if the same land and house property is being sold by a real estate agent, a builder, a construction company, for them, it is a stock in trade. Because what is the nature of business? Buying and selling of immovable properties is their nature of business. So for them, the immovable properties are stock in trade. But for us, it's a capital asset. Are you following or not? So capital asset excludes stock in trade. Next, capital asset also excludes personal effects. So what do you mean by a personal effect? Personal effect includes all kinds of movable properties, which are being used for personal purposes. Sir, suppose that I purchased a mobile phone. And I'm using this mobile phone for my personal purposes. So then it is a personal effect. Sir, if I've earned any gain or any profit by selling this mobile phone, then that should be treated as not to be treated as a capital gain, not to be treated as a capital income. Because for me, the mobile phone is a personal effect. Now, as per the definition of capital asset excludes personal effects. I purchased a car and I'm using the car for my personal purposes. So it's a personal effect. In future, if I get any gain by selling that car, and that gain is not to be treated as a capital gains. Are you following, sir? Every one of you. Then you will get a doubt here, sir. What about jewelry? Jewelry is a movable asset and it is being using for personal purposes. Then jewelry is an exception, sir. Look at here. I've given the car example, right? So buildings. Sir, building, I purchased a building and using for personal purposes. Now, can I treat the building as a personal effect? No. Right. In order to treat a particular asset covered under personal effect, it must be a movable asset first. And here in the given example, building is an immovable property. Even though you are using for your personal purposes, it should be treated as a capital asset. Okay, ma. Next. Now, look at the example jewelry. Right, I purchased a jewelry and using for personal purposes. So exceptions to the personal effect, though it is a movable asset, though it is used for personal purposes, still it should be treated as a capital asset. Right, sir? So capital asset excludes personal effects. Personal effects excludes jewelry. So that means capital assets includes jewelry. Okay, ma. So exception to exception becomes inclusion. Right, sir? So minus into minus becomes plus. So exception to exception. Capital asset excludes personal effects. Personal effect excludes jewelry. So excludes into excludes is equal to includes. So capital asset includes jewelry. Okay, ma. Next. After that. So let us continue the list of exclusions. Stock in trade completed. Personal effects completed and rural agricultural land in India. Rural agricultural land in India. Earlier, while this particular exception was introduced, it was introduced like this. Any agricultural land in India is not a capital asset. Right, sir? There is no mentioning of rural. Rural agricultural land was recently introduced, means 6-7 years back. Why, sir? Because see, when the provision was agricultural land in India is not a capital asset, what happens? Look at this example. Mr. X, right, owning 1 acre land in Jubilee Hills. Jubilee Hills is one of the costliest areas of Hyderabad. Right, sir? So 1 acre land in Jubilee Hills, it will cost you hardly, it will cost you around 10 crores rupees, sir. Minimum 10 crores. Costliest area of Hyderabad, Jubilee Hills. Right, sir? So in that particular land, now Mr. X wants to sell that particular land. He knows very well that if he sell that land, he will get a minimum capital gains of 5 crores. Right, sir? Even if the tax rate applicable 20%, he should pay 1 crore, minimum 1 crore as income tax, which he don't want to. So then he consulted you. You are a practicing chartered accountant. You are giving him suggestion that, okay, before you are going to sell that land, do one thing, do the agriculture for 2 months in that particular land. Then the convert nature of the land into agricultural land. Once the nature becomes agricultural land, then sell it. Whatever the capital gains arises to you, that will not be taxable, because any capital gains arising on transfer of agricultural land, not a taxable capital gains. No need to pay any tax on it. Are you following, sir? Right? So that is why, even though it is a commercial land, only for the purposes of escapement from the payment of the taxes, SSEs tries to convert them into the agricultural land first, then started selling them. Right, sir? So that's why they have introduced the wording rural agricultural land. So this actually, the benefit of exception is given to only to the farmers, not for all the people. Here the actual objective is to provide the exemption benefit from the capital gains to the farmers, those who are genuinely doing the agriculture. Right, sir? But this benefit of exception is being taken by every person who ever having the land, whether it's an agricultural land or not. So that's why, in order to provide this benefit only to the farmers, they have come up with an amendment and said only the rural agricultural lands are not covered under exception. If it is a urban agricultural land, it is a capital asset straight away. If it is a rural agricultural land, yes, it's not a capital asset. So any agricultural land which is not situated in a specified area, not a capital asset. So agricultural land situated in a specified area, nothing but an urban area, so it's a capital asset. Agricultural land situated in a non-specified area means rural area, then it is not a capital asset. Then it is not a capital asset. Are you following or not, every one of you? So then how to decide specified area? We have a criteria, sir. We have a criteria like from the city local limits, municipal local limits. For every city, there is a boundary. Yes or no? So from the city local limits, first 2 kilometers less than or equal to 2 kilometers, and the population should be greater than 10,000 and less than or equal to 1 lakh. So then if these distance condition and population condition satisfied, then that is a specified area. Second, from the municipal local limits, less than or equal to 6 kilometers distance, and population should be greater than 1 lakh but less than or equal to 10 lakhs. Third, less than or equal to 8 kilometers, and the population should be greater than 10 lakhs. Population should be greater than 10 lakhs. Then that is a specified area. If both the distance condition and population condition is satisfied, it is a specified area. And if you are having any agricultural land in that specified area, it is a capital asset. Clear, sir? Next. So that's the definition of a capital asset. So all the definition of capital asset I was mentioned here, you can just go through it once. And this is distance condition and this is population condition. Clear, sir? Completed. Next, moving on. So what is a transfer? Definition of transfer. So we have the list of transactions where we should treat them as transfer, right? So sale, exchange. Exchange must be of two capital assets. One capital asset exchanged with the another capital asset. Then only that particular exchange should be treated as a transfer. Are you following, sir? Suppose that I'm exchanging my old jewelry with new jewelry in a jewelry shop. Right, sir? Now, can I treat this exchange as transfer? Answer is absolutely no. Because for you, jewelry is a capital asset. But for the jewelry shop owner, it is a stock in trade. So what is happening here? A capital asset is being exchanged with a stock in trade. So two capital assets are not getting exchanged here. So then it is not a transfer. Okay. Relinquishment of an asset. Now look at this example, sir. Relinquishment of an asset. Relinquishment means what? Giving up, sacrificing, losing. For losing a right in a capital asset, if you received any compensation, right, sir, and that compensation is subject to capital gains tax, because relinquishment of an asset in a capital asset, right, sir? So that should be amounts to transfer. Clear, right? I've explained you an example here. Mr. X is the owner of this building, which he let out to Mr. Y. So X is the owner, Y is a tenant. And they have entered into a rental agreement for 10 years. So whenever owner and tenant entered into a rental agreement, then the tenant will get an intangible right over that asset. That is what we call tenancy rights. So the tenant will get the tenancy rights over the building. Means the right to occupy the building, right to use the building. Clear, sir? 5 years completed. After 5 years, Mr. X got an opportunity from some shopping mall where they offered the rent of 2 lakhs per month. And here Y paying only 50,000 per month. So Mr. X asked Mr. Y to vacate the property, for which X is ready to pay certain compensation. So Y is vacated the property. See, actually Y have the right to use that property for 10 years. He's having the tenancy right. For losing the tenancy rights, he is getting compensation. So relinquishing the tenancy rights for a compensation. That amounts to transfer and liable to capital gains tax. Next, third one, extinguishment of right in an asset. Extinguishment comes to an end, close. Extinguish, fire extinguisher means it is an equipment which closes, which ends the fire. That's why it is called as fire extinguisher. So extinguishment comes to an end, close. So look at the example, right? We have invested into the debentures where the redemption period is 10 years. So debenture holder has to forego his right in debentures on a compulsory basis at the time of redemption. After the completion of 10 years, the company will call you for redemption. Babu, we have issued the debentures for 10 years and its life is over. Now the time for redemption. So get back the debentures and we will pay you the amount. Here you have to compulsorily forego the right in the debentures. Extinguishment. Relinquishment is optional, but extinguishment is compulsory. Anyhow, both are covered under transfer definition. Next, compulsory acquisition by the government. Right. See, if government occupying any capital asset, right, taking over the possession of capital asset belonging to you on a compulsory acquisition basis, it amounts to transfer and liable to tax. Right. Examples I've given: land pooling by the AP government for the development of capital city in Amaravati, and a roads expansion for metro in Hyderabad. See, whenever there is a metro rail project, right? See, first, what they will do is they will extend the roads. They will expand the roads. Now, in this particular side, by if there is any shop, the shops will be taken over by the government, and the shop will be demolished, and the roads will be extended. Yes or no? So, whenever the government opting for compulsory acquisition, that amounts to transfer. Next, conversion of a capital asset into stock in trade. Conversion of a capital asset into stock in trade. So whenever you are converting your capital asset into stock in trade, look at the example. Mr. X having 1 acre vacant land in high-tech city, yet another costliest areas of Hyderabad. High-tech city. See, if you are the owner of 1 acre land in high-tech city, means you are owning a minimum of 10 crores. Crorepati. Are you following, sir? Now you would like to sell that vacant land. If you sell the land as it is, vacant land is a capital asset. You are subject to the payment of capital gains tax. But if you convert that land into plots, starting a real estate business and convert this land into plots. Now, for the real estate business person, the plots are called as stock in trade. And as per the definition of capital asset excludes stock in trade. Now, you can sell this entire 1 acre land in plots and there is no need to pay any capital gains tax. Are you following, sir? Next. Any transfer covered by section 53 capital A of the Transfer of Property Act. Part performance of contract, about which we have already studied in the income from house property. Do you remember, sir? Part performance of contract. Right. So even though the ownership is not yet transferred, still it should be treated as a transfer. Redemption of zero coupon bonds. So look at the features of the zero coupon bonds. They're always issued at discount and redeemable at par. And if you made investments into these zero coupon bonds, you don't get any periodical interest, no periodical interest, right? Sir, if there is no periodical interest, then who will come forward and invest in these zero coupon bonds? Generally, whenever we are making investments, we are making the investments with the expectation of getting back something, in return. Are you following or not? But when we are not getting anything in return, then who will make investments? Sir, in zero coupon bonds, if you remember my words, I've said no periodical interest. I didn't say no interest. I said only no periodical interest. The interest will be there, but not paid periodically. The entire amount of interest will be receivable in lump sum at the time of redemption. Look at this example. Face value of the bond 1000 rupees and issue price 900 only. I've already told you these are always issued at discount. Now at the time of redemption, they are redeemable at par. So though you are making an investment of 900 rupees, at the time of redemption, you will get 1000 rupees. Now the difference between the issue price and redemption value will constitute interest. Okay, ma, you are getting 1000 rupees at the time of redemption, but you actually made an investment of 900 only. The difference is 100, and this 100 is a lump sum amount of interest. Are you following, sir? So look at here. Mr. X invested in totally 1000 bonds. And what is the redemption value is going to get? 10 lakhs. And what is the purchase value? Only 9 lakhs. So the interest income is 1 lakh rupee. Are you following, sir? Every one of you. Next. So after that, you have types of capital assets, right? We can classify the capital assets into two main categories: short-term capital asset and long-term capital assets, right, sir? How to decide whether it is a short-term capital asset or a long-term capital asset? That will be decided by POH, period of holding of that capital asset. The period of holding of the capital assets will decide its nature as a short-term capital asset or a long-term capital asset. Are you following, Ma? So then how to decide, how to describe and determine the period of holding? Look at here, sir. Period of holding always starts with the date of acquisition of the capital asset. Period of holding always starts with the date of acquisition of the capital asset and ends with the date immediately preceding to the date of transfer. Ends with the date immediately preceding to the date of transfer. Right, sir? So from the date of acquisition till the date of transfer, that will be the period of holding, and that period of holding decides the nature of capital asset, whether it is a short-term capital asset or long-term capital asset. Okay, ma'am. Now you can see here on 1/4/2020, purchased 1000 equity shares of Infosys Company Limited. It's a listed company. Infosys Company is a listed company. So we have purchased 1000 listed equity shares and we have sold them on 1st April 2021. Right, sir. Now, date of acquisition is 1st April 2020 and date of transfer 1st April 2021. Right. And while calculating the period of holding, we know that the period of holding always starts with the date of acquisition. What is the date of acquisition? 1st April 2020, ending with the date immediately preceding to the date of transfer. What is the date of transfer? 1st April 2021. What is the preceding day for this? The preceding day will be 31st March 2021. So that's right. The period of holding should be end with the 31st March 2021. So the period of holding will be 12 months. Okay, sir. Next. So look at the textbook ones. Transfer definition, then exceptions to transfer we will discuss later. Before that, types of capital assets we are discussing now. Sir, here the capital assets mainly categorized into three categories. Ma. This is category 1, category 2, and category 3, a miscellaneous category. Okay, sir. Now look at the category 1. Look at the category 1, sir. Category 1 covers listed securities, Unit Trust of India UTI, units of equity oriented mutual funds, and zero coupon bonds. This is the first category. Listed securities, units of UTI, units of equity oriented funds, and zero coupon bonds. If they held for less than or equal to 12 months, less than or equal to 12 months, then it is a short-term capital asset. If it is held for more than 12 months, then it is a long-term capital asset. Category 1. Category 2, unlisted shares of a company, unlisted shares, immovable property being the land or building or both. Now for which you need to see the period of holding 24 months. If these assets are held for less than or equal to 24 months, it's a short-term capital asset. Greater than 24 months, it's a long-term capital asset. And after that, any other capital assets which are not covered by the C1 and C2, which is not covered by C1 and C2, all those capital assets are covered by C3. And you have to see the period of holding 36 months. If held for less than or equal to 36 months, short-term capital asset, more than 36 months, long-term capital asset. Clear, sir? So look at here. So category 1, I've already said, period of holding less than or equal to 12 months, short-term capital asset, more than 12 months, long-term capital asset. And category 2, unlisted shares and immovable properties held for less than or equal to 24 months, short-term capital asset, held for more than 24 months, long-term capital asset. Category 3, any other capital assets, like I've given you examples: jewelry, painting, drawing, sculptures, archaeological collections, plant and machinery, vehicles, which are used for business purposes, and all other intangible assets. All these are covered in category 3. If held for less than or equal to 36 months, short-term capital asset, more than 36 months, long-term capital assets. Clear? Next. Sir, how to calculate the capital gains? We have a standard format for the calculation of capital gains. And that format was mentioned in section 48. Calculation of capital gains in the case of non-depreciable capital assets. Sir, what about depreciable capital assets? For depreciable capital assets, provisions of section 50 applicable. For non-depreciable capital assets, section 48 applicable. Section 48 applicable. Okay, ma. Now look at section 48 format. Name of the SSC, previous year assessment. These are routine things. Table with the 3 columns. It starts with the FVC, full value of consideration. Majority of the circumstances will take the sales value. In some of the cases, we'll take stamp duty value. From the full value of consideration, we have to deduct the transfer expenses. Any expenditure incurred in relation to the transfer. Any expenditure in relation to the transfer. All that expenses covered under transfer expenses. So from the full value of consideration, deduct the transfer expenses, then you will get net consideration. You'll get what, Amma? You'll get net consideration, from which you have to deduct the cost of acquisition and cost of improvement. What is cost of acquisition? Any capital expenditure incurred. Any capital expenditure incurred for acquiring a capital asset is called as a cost of acquisition. For acquiring a capital asset, whatever the capital expenditure you're incurring, that is a cost of acquisition. And whatever all the expenses you have incurred in relation to the acquisition, and any expenditure you incurred up to the date of asset is put to use, all such expenses are forming part of cost of acquisition. All such expenses are forming part of cost of acquisition. Next, cost of improvement. What is cost of improvement? Any capital expenditure incurred for improving the nature, for improving the income earning capacity of the capital asset. For improving the income earning capacity of the capital asset. And that capital expenditure is what we call a cost of improvement. So after acquiring a capital asset, further subsequently, if you incur any capital expenditure, that is cost of improvement. Clear, ma? So from net consideration, you have to deduct COA and COI, then you will get the gross short-term capital gains, from which you can deduct the exemptions under section 54 series, then you will get a taxable short-term capital gains. It's a standard format. Okay, now next, calculation of the long-term capital gains. Very simple, ma. This is a format for the calculation of short-term capital gains. And when it comes to the long-term capital gains, the entire format holds good Instead of COA, you have to deduct ICOA. Instead of COI, you have to deduct ICOI. Indexed cost of acquisition, indexed cost of improvement. So for cost of acquisition, you have to add the indexation benefit. You have to add the indexation benefit. After adding indexation benefit, whatever the cost of acquisition you are getting, that cost of acquisition is what we call a indexed cost of acquisition. Then same logic holds good for cost of improvement, indexed cost of improvement. So in the case of long-term capital gains, the format goes like this: full value of consideration minus transfer expenses, net consideration, from which you have to deduct index cost of acquisition and index cost of improvement. That will give you the gross long-term capital gains minus exemptions under section 54, then net long-term capital gains. Are you following that, sir? Next. Look at here, sir. You have purchased a house property for 50 lakhs. You have paid stamp duty value 3 lakhs and brokerage 1 lakh. Now, even this 3 lakh and 1 lakh also capitalized. We can capitalize. So now you have to take the cost of acquisition as 54 lakhs. Clear, sir? Next. Cost of improvement, I've already told you, right? Initially, you purchased house property for 10 lakhs. This is your cost of acquisition. And subsequently, on that building, you have constructed a second floor. So we have incurred some construction cost 5 lakhs. That's what we call cost of improvement. That is what we call cost of improvement. Next, indexed cost of acquisition. Now, what is indexed cost of acquisition and how to calculate this? It's very simple, ma. Give me a second. Indexed cost of acquisition. So basically, the indexed cost of acquisition benefit is given in the case of long-term capital assets. For short-term capital assets, indexation benefit is not available. Only for long-term capital assets, indexation benefit is available. So first of all, what is indexation benefit? Look at here. Mr. X purchased a residential house property for rupees 10 lakhs during the previous year, 2001 and 2. Now, after 20 years, Mr. X sold this house property. Now, during the previous year, 2021, Mr. X sold the residential house property for 2 crores. For 2 crores. Now, sir, how to calculate the capital gains here? Very simple, sir. What is the sale value? 2 crores. The sale value is 2 crores. Okay. At what price it was purchased? 2 crores is the sale value. It purchased for 10 lakhs. So 1.9 crores is a long-term capital gains. You purchased for 10 lakhs and sold it for 2 crores. So you got a gain of 1 crore 90 lakhs. So that will be your long-term capital gains. Absolutely wrong answer. Absolutely wrong answer. Here you have just deducted cost of acquisition. Instead, you have to deduct indexed cost of acquisition because whatever the asset involving here, it is a long-term capital asset. So first you should calculate the indexed cost of acquisition. Right, sir? So look at the answer here. Calculation of long-term capital gains, full value of consideration 2 crores, the sales value, transfer expenses, assuming that there are no transfer expenses, net consideration 2 crores, now indexed cost of acquisition. Sir, in 2001 and 2, right? Let us assume the cost of acquisition is 100 rupees. Now the same will become 301 rupees during the previous year 2021. Right, sir? So we have the list of indexation factors here. Let me take you there. Yeah, here are the indexation factor. So if you purchase a capital asset worth 100 rupees during the previous year 2020, 2001 and 2, its value is now 301 rupees during the previous year 2021. And 21-22, it is 317. These are called as inflation index factors, cost inflation index factors. Cost inflation index factors, CIFs. Are you following, sir? Right? So, sir, if I purchase an asset in the year 2001-2 for 100 rupees, now it is costing me 301 rupees. Now, if I purchase an asset during the previous year 1-2 for 10 lakhs, what would be its value as on today? What will be its value during the previous year 2021? So the indexed cost of acquisition, cross calculation, 10 lakhs into 301 divided by 100, 30 lakhs, 10,000. So whatever the house property you purchased in the year 2001 and 2, you purchased it for 10 lakhs, but the same property is not available in the open market for 10 lakhs. The same property you're selling for 2 crores. There is a buyer ready to purchase the property for 2 crores. Then how can you take the value as 10 lakhs as it is? No, you have to add the inflation impact. Over these 20 years, there is a lot of inflation. There is lot of inflation. So you need to add that inflation impact to your cost of acquisition. After adding the inflation impact, whatever the cost of acquisition you're getting, that cost of acquisition is what we call indexed cost of acquisition. Are you following, sir? So while calculating the long-term capital gains, here you should take 30 lakhs 10,000 as your indexed cost of acquisition. Only the remaining is your long-term capital gains. Are you following or not? Next. So the basic formula for indexed cost of acquisition is cost of acquisition into CII for the year of transfer divided by CII for the year of acquisition. This is a basic formula, sir. Cost inflation index for the year of transfer divided by cost inflation index for the year of acquisition. That's the formula for indexed cost of acquisition. Clear, sir? Next, look at one more example here. Sir, by looking into this table, you will get a doubt because, sir, the indexation factors are starting from the previous year 2001-2. What if the case if I purchase a capital asset before this year? Means during the previous year, some 1991-92, I purchased a capital asset. And I've sold during the previous year 2021-22. Right, sir? No, if any capital asset acquired prior to 2001-2, the base year, then how to calculate capital gains? Look at here. Mr. Akshar purchased the land for rupees 5 lakhs during the year 98-99. Right, sir? And during the previous year 2021, sold it for 1 crore. Now, how to calculate? Full value of consideration 1 crore, transfer expenses nil, net consideration 1 crore, and indexed cost of acquisition. As per the above formula, what is the formula, sir? Cost of acquisition. What is the cost of acquisition, Amma? 5 lakhs into CII for the year of transfer 312. Sorry, 317. No, here sold in the previous year 2021. So 301 divided by CII for the year of acquisition. What is the year of acquisition? 98-99. Look at the table. What is the cost inflation factor for 98-99? No, it was not mentioned. Cost inflation indexes start from 2001-2 only. Then how? So that's why what the department said, if any capital asset acquired prior to the base year, then take fair market value as on 1/4/2001 as cost of acquisition. Of course, it is purely adoption of SSEMA. Either he can continue with the actual cost of acquisition, or he can take the fair market value as in 1/4/2001 as his cost of acquisition. It's purely adoption of SSE. So generally, the SSE will be adopted for whichever is higher, because higher the cost, lower will be the gains. So then he will always choose the higher amount only. Clear? So 10 lakhs into 301 divided by 100. Since you're taking the fair market value as in 1/4/2001 as cost of acquisition, the FII for this previous year should be taken. How much, Amma? 100. So CII for the year of transfer 301 and CII for the year of acquisition 100. So you will get the index cost of acquisition. The balance will be treated as your capital gains. So if the asset is purchased prior to the 1/4/2001, now the formula for index cost of acquisition or fair market value as in 1/4/2001, whichever is higher, into CII for the year of transfer divided by CII for the base year. Clear, ma'am? Every one of you. So like this, you have to calculate the indexed cost of acquisition. And the same logic holds good even for the indexed cost of improvement. Here you have incurred the cost of improvement expenditure during the year 9-10. So from 9-10 till 2021, the indexation benefit should be given. What is the formula? Cost of improvement into CII for the year in which CII for the year of transfer divided by CII for the year in which the cost of improvement expenditure incurred. So in our example, it will be 8 lakhs into CII for the year of transfer 302 divided by CII for the year of acquisition 148. For the previous year 9-10, if you check out the cost inflation index, it will be 148. 9-10, 148. Okay, mom. So like that, you have to calculate the indexed cost of improvement. Clear? Next. If the asset is acquired prior to the 1/4/2001, prior to the base year, then the cost of acquisition is equal to what should be taken as cost of acquisition, sir? Cost of acquisition is equal to the original cost of acquisition or fair market value as on 1/4/2001, whichever is higher. That's a general provision. But of course, we have a latest amendment by the Finance Act 2020, latest amendment. And this is applicable only in the case of immovable property SAMBA, not for all the capital assets. This is applicable only for immovable properties, not for all capital assets. So the cost of acquisition should be taken as follows. The actual cost or fair market value as on 1/4/2001, whichever is higher. So what is amendment here? The same provision explained here only. The amendment is note point. This is the amendment. The fair market value as on 1/4/2001 should not exceed the stamp duty value of such asset as on 1/4/2001. This is the amendment. Okay, ma'am. So whatever the fair market value you are taking here, this should not be greater than the stamp duty value as on 1/4/2001. So technically, we can write like this. Look at here. The cost of acquisition in the case of immovable properties, if purchased prior to 1/4/2001. So the original cost of acquisition, and this should be compared with fair market value as in 1/4/2001 or stamp duty value as in 1/4/2001, whichever is lower. The lower value should be taken here compared with original cost of acquisition, whichever is higher will be the cost of acquisition for calculating the capital gains. So take fair market value as in 1/4/2001, stamp duty value as in 1/4/2001. Take the lower one among these two. The lower value should be compared with the original cost of acquisition. Then whichever is higher will be the cost of acquisition. Clear, sir? Next. And after that, you have section 47 series, exceptions to transfer. There is a list given regarding the exceptions to transfer. Right? So please go through to the that particular list. And here the rates of taxes are given, right, sir? Go through this the tax rates as well, where 111 attracted 15% is the rate of tax, right? And 112 applicable, then the rate of tax applicable is 10%, and you have an exemption benefit up to 1 lakh. And 112 is applicable in the case of unlisted securities or the shares of private limited company. 10% and 20% rate is there. Listed securities, 0 coupon bonds, 10% without benefit of indexation, 20% with the benefit of indexation, and in the case of any other long-term capital assets, 20%. Okay, sir. And then the higher rates of surcharge is 25% and 37%, not applicable in the case of short-term capital gains 111A and long-term capital gains 112A. So short-term capital gains under section 111A and long-term capital gains under section 112A, for which the higher surcharge rates of 25% and 37% not applicable. Next. Then after that, you will have a 45 series. All right, I'll start this 45 series in the next session. Clear now? Right? So next session will complete this capital gains marathon. Right, sir? So, till then, have a good day and good night, sir. Stay home and stay safe. A very good morning, mom. So, welcome to the income tax marathon classes. In the last session, we have started discussion regarding capital gains marathons. So, we have completed the basic fundamentals of capital gains. We have seen the charging section 45.1, which is applicable in the general cases. And then after that, we have learned the two very important definitions, section 2 clause 14 capital assets, and then section 2 clause 47 transfer definition. Then after that, we have seen the types of capital assets, period of holding, cost of acquisition, cost of improvement, right? Index to cost of acquisition, index to cost of improvement, concept of fair market value. All these concepts we have learned in the last class. Now let's moving on. 45 series. Section 45, we know that section 45 deals with what, Amma? Section 45 deals with charging section. Right, sir? And in that section 45.1, we have completed already. It is a charging section which is applicable in general cases. 45.1 applicable in the general cases. Right, 45.1 we have already studied in the last class, like any profits or gains arising on transfer of a capital asset shall be chargeable to tax in the hands of the assessee in the year of transfer. Do you remember? That is section 45.1, general charging section applicable in the general cases. But of course, we do have some special cases. With respect to the special cases, we have special charging sections like section 45.1a. 45.1a applicable in the case of where there is any damage or destruction of any capital asset as a result of typhoon, hurricane, cyclone, earthquakes, riots, civil disturbances, accidental fire or explosion. So whenever these things are happening, right, there is some riots, there is some civil disturbances, and because of that particular event, you have lost your capital asset. And with respect to the capital asset, you have received a compensation from insurance company. I assume that all of your capital assets got insured, and luckily that insurance company doesn't say it is an act of God, right? It was not said it is an act of God, and it has given your compensation. So you have received an amount in relation to a capital asset, hence it is chargeable to tax. But sir, you will raise a question here. So for the purpose of levying the capital gains tax, you said in the last class, there must be satisfaction of two conditions. Number one, there must be a transfer, and number two, transfer must be of a capital asset. Transfer must be of a capital asset. Sir, here, where is a transfer? Is it a sale? No, you have not sold your capital asset. Is it amount to exchange? No. Relinquishment? No. Extinguishment? No. Compulsory acquisition by the government? No. Conversion of a capital asset into stock in trade? No. Redemption of zero coupon bonds? No. So when it is not covered in the definition of transfer, then how can it be treated? And how can it be chargeable to tax under the head capital gains? See, that is why it is not being taxed under section 45.1. It is taxed under section 45.1a. Taxed under section 45.1a. So the event of typhoons, hurricanes, cyclone, earthquake, riots, civil disturbances like this, that events are amounts to transfer as per the provisions of section 45.1a. Clear, sir? So 45 series, here I explained, sir. Look at that. There is an, we have discussed with the help of example. Mr. Venkatesh is owning a puja stores, right? During the previous year, 2004-5, he has started his puja stores, a shop, a commercial shop. And during the previous year, 17-18, there was a fire accident and the entire stock in trade and as well as capital assets lost. Capital assets means that building, plant and machinery, furniture he's having in that particular shop, right? And made an application for insurance compensation. Now, during the previous year, 2021, Mr. Venkatesh received insurance compensation. So 17-18, the fire accident taken place. 2021, he received the insurance compensation. Of course, it will take time, sir, that insurance companies will make an inquiry about the incident, how that fire accident was happened. Was it intentionally happened or was it naturally happened? And whatever the claim made by the claimant, Mr. Venkatesh in this case, whether it is genuine or not, he's claiming that there is 10 lakhs worth of capital assets damaged. The insurance company has to make sure that yes, there is 10 lakhs worth of capital asset existing at the time of fire accident. So for all this, it will take time. So though the accident was happened in 1718, he received the compensation in the year 2021. Now look at this. So now for which previous year the capital gains are taxable? Technically speaking, the year in which the fire accident was taken place, that is the year of transfer. But as per the provisions of section 45(1)(a), capital gains are taxable on a receipt basis. Capital gains are taxable on a receipt basis. This is an exception to section 45(1). In section 45(1), we have learned that capital gains are taxable on accrual basis. Capital gains are taxable on year of transfer. But here, as per the provisions of section 45(1)(a), capital gains are always taxable on receipt basis. The year in which you actually receive the insurance compensation, that is the year of chargeability. Next. Sir, while calculating the indexed cost of acquisition, first of all, you have to calculate the period of holding from the year of acquisition, till the year of transfer. So only up to the year of fire accident, you have to give the indexation benefit. You have to calculate the period of holding. Are you following, sir? So after the fire accident taken place, but till the year of receipt of insurance compensation, for this period, you should not calculate period of holding because the capital asset was not in existence. Fire accident taken place and you lost the capital asset. Are you following, sir? Every one of you. So look at here. What is the taxable amount? Whatever the compensation you have received from the insurance company, as in the form of a cash or in the form of a kind asset. If you received in cash, the value of money received will be the full value of consideration, or if you received in kind, then take the fair market value of the asset will be the full value of consideration. Period of holding from the date of acquisition to the date of prior to the date of destruction. Next, year of transfer, the previous year in which the destruction taken place, but year of chargeability, the previous year in which you have received the compensation or asset was received. Okay, ma'am. Next. So this is an exception to section 45(1) because year of chargeability is equal to year of transfer. Basically, as per the provisions of section 45(1), this is year of chargeability. Right, sir? But as per the provisions of section 45(1)(a), year of chargeability is equal to the year in which you have received the compensation. Okay, ma'am. Next. If the compensation was received in respect of the destroyed plant and machinery, the same will be taxable in the hands of the assessee under section 45(1)(a). If the compensation has been received on account of destroyed stock in trade, then the PGBP will get attracted. Clear now? Next. Next, 45(1)(b), this is a new section, unit linked insurance policies. Unit linked insurance policies. It's a new section introduced by the Finance Act 2020. Look at here, where any person receives at any time during the previous year any amount under a ULIP, unit linked insurance policies, issued on or after 1st February 2021, to which the exemption under section 1010D does not apply. What is section 1010D? It will give you the exemption benefit to the lump sum amount received on maturity of insurance policies. When the insurance policy will get matured, either on the death of the policy holder or on the completion of the term of the insurance policy. On these two events, the insurance policy will get matured. At the time of maturity of the insurance policy, you will receive some lump sum amount, and that lump sum amount is exempted from tax under section 10, clause 10D. But of course, these 45(1)(b) provisions are applicable where there is no exemption benefit. Clear? So exemption under section 1010D does not apply. An account of the premium payable exceeding 2,50,000 for any previous year during the term of such policy, or the aggregate amount of the premium exceeding 2,50,000 in any of the previous years during the term of any of such ULIPs, in a case where the premiums payable by a person for more than one ULIP issued on or after 1 February 2021. See, if you have taken only one ULIP and if you paid the amount of the premium exceeding 2,50,000 per annum during the previous years, any of the previous years, in any one previous year, if you paid a premium amount exceeding 2,50,000, then 1010D benefit not available. That means whatever the lump sum amount you are going to receive, that lump sum amount shall be chargeable to tax. Suppose that you have taken 5 ULIPs. With respect to 5 ULIPs, you are paying some 60,000 per annum. So 5 ULIPs into 60,000. So you are paying 3 lakhs in aggregate. 3 lakhs in aggregate. So you have to see the aggregate amount of the insurance premium. If exceeding 2,50,000, 45 1B comes into picture. Clear, sir? Next, that any profits or gains arising from the receipt of such amount by such person shall be chargeable to income tax under the head capital gains and shall be deemed to be the income of such person for the previous year in which such amount was received. Clear, ma? That's 45 1B. Next, 45.2, conversion of a capital asset into stock in trade. Look at the example. 45.2, conversion of a capital asset into stock in trade. In 2007-8, Mr. Rahul purchased a vacant land worth 20 lakhs. 18-19, he converted that vacant land into plots. This vacant land into plots. He started a real estate business and converted the vacant land into plots. Okay, ma. So that means whatever the capital asset earlier is there, vacant land. That vacant land is a capital asset, ma. Okay, now that vacant land converted into plots. Whenever that land is converted into plots, it becomes stock in trade. Clear, sir? So in the year in which the stock in trade taken place, conversion taken place, that is the previous year 18-19, that will be your year of transfer. Year of transfer. Now the stock in trade was sold during the previous year 2021. Sold all the plots for 80 lakhs. Now we should calculate the business income and as well as capital gains for the previous year in which that stock in trade was sold. So the year of chargeability will be 2020-21. Are you following, sir? Every one of you, right? Though the transfer taken place in the year 18-19, though the conversion taken place in the year 18-19, you are not required to calculate any capital gains for the year 18-19. See, did you sold in the 18-19? No, you just converted the capital asset into stock in trade. On conversion, are you receiving any amount? No. When are you going to receive the amount? Whenever you sold it. So that is why the year of chargeability will be the year of sale. Are you following or not? Just by converting a capital asset into stock in trade, you are not getting any amount, right? Clear now? Next. So the previous year in which the stock in trade was sold out, for that previous year, we should calculate the business income and as well as capital gains. Look at here. Calculation of the business income. Sale value, you have sold all the plots for 80 lakhs. You have sold all the plots for 80 lakhs. And the cost of the plots, here you have to take the cost of the plots as fair market value as on the date of conversion. Fair market value as on the date of conversion. Clear, sir? So look at here, sir. As on the date of conversion, the fair market value is 50 lakhs. So cost of the plots 50 lakhs. Business income 30 lakhs. Clear, sir? And this will be taxable under the head PGBP. Next, you should also have to calculate capital gains. What is the full value of consideration? The same will become the full value of consideration here. So the fair market value as in the date of conversion is going to play dual role. It's going to play dual role, two roles. Number one, first, it should be treated as the cost of the plots while calculating business income. Number two, it should be treated as full value of consideration while calculating capital gains. Okay, ma. And from this, we need to deduct the indexed cost of acquisition as the asset transferred is a capital asset. During the previous year 7-8, it was purchased. 18-19, it was transferred. So held for more than 3 years, it's a long-term capital asset. We should calculate indexation benefit. So accordingly, calculate the indexed cost of acquisition, then deduct it, you'll get the long-term capital gains. Okay, ma'am. So that is what 45.2, conversion of a capital asset into stock in trade. Clear? Next, 45.3, transfer of a capital asset into the capital contribution. So whenever a partner transferring a capital asset as his capital contribution to the partnership firm, now in the hands of the partners, we should calculate capital gains because here the partner is a transferor. So whenever any person, in order to become a partnership of a partnership firm, in order to become a partner in a partnership firm, See, he should something be introduced into the partnership firm as his capital contribution. The firm asked him to give a building or a land, a capital asset as his capital contribution. So as said by the partnership firm, the person transferred his building to the partnership firm as his capital contribution. Now that person is becoming the partner. Now that partner is liable to capital gains tax. Are you following, sir? Right? So yeah, this is 45.3. Measures ABC and Co is their partnership firm, and D wants to join as a partner. And as his capital contribution, he transferred his residential house property to the partnership firm. Fair market value 20 lakhs. Right, as on the date of transfer, the fair market value of the building is 20 lakhs, but the firm recorded into its books of account only 15 lakhs as capital contribution. Now, this 15 lakhs should be treated as full value of consideration while calculating capital gains. Are you following, sir? But sir, the fair market value of the asset transferred is 20 lakhs at the time of transfer. The firm was undervalued the value of the asset. It will be a benefit to the partner because lower the full value of consideration, lower will be capital gains, lower the capital gains tax. So intentionally the firm will record at the undervalue. No problem, sir. No problem. Let it be right. No problem. Because whatever the value recorded by the firm here as full value of consideration, the same will become cost of acquisition in a later stage. Right? If the firm records its actual fair market value, the firm will be in the safer hands at the latter stage. The same 20 lakhs will be considered as a cost of acquisition. But if firm will record it undervaluation, the same will become cost of acquisition at a later stage. Lower the cost of acquisition, higher will be the capital gains. Are you following or not? Next. 45.4 distribution on dissolution. If any partnership firm dissolved either because of the resignation of a partner or death of a partner, right, sir? So then in order to settle the account of that partner, the firm will transfer capital assets to him. Now the firm become transferor. So in the firm hands, one should calculate the capital gains. Clear, sir? Okay. So the capital gains are taxable in the year of transfer. Consideration, the fair market value as on the date of distribution. The indexation benefit should be given up to the date of distribution. Okay. Next. 45.5 compulsory acquisition. Compulsory acquisition by the government. Look at it, sir. Compulsory acquisition, right? So look at this example. During the previous year, 2004-5, Mr. Rupesh purchased residential house property for 10 lakhs. Now, during the year 1718, government has taken over the residential house property on compulsory acquisition basis and compensation agreed 40 lakhs. So this is your year of transfer. This is your year of transfer. The previous year in which the government has taken over the capital asset under compulsory acquisition scheme, that will be the year of transfer. In the previous year, 1819 received the first installment of compensation 20 lakhs. In the year 1920 received second installment 20 lakhs. Okay, sir. Now, here, whenever the compulsory acquisition provisions are applicable, capital gains are taxable on receipt basis. Right. The previous year in which you have received your first installment, this is the year of chargeability with respect to the original compensation. This will be the year of chargeability. Sir, in the 1819, I have received only 20 lakhs, not the entire amount of compensation. It doesn't matter, sir. It is a year in which you have received your compensation. Whether you have received in fully, whether you have received in partly, it doesn't matter. The department is least bother. So we should calculate the capital gains for the year 1819. Full value of consideration 40 lakhs rupees, the compensation agreed, minus index cost of acquisition. You have to calculate the indexation benefit from the year of acquisition till the date of year of transfer. So from 4.5 till 7.8, you have to give the indexation benefit. Find out the long-term capital gains. Okay, ma. Next. Now, during the previous year 1920, Mr. Rupesh has filed a case against government for additional compensation of 10 lakhs. And the case was settled in favor of Mr. Rupesh and legal expenses incurred 1 lakh. Now, during the previous year 2020-21, received that additional compensation of 10 lakhs. So additional compensation also taxable. Additional compensation also taxable under the head capital gains. So additional compensation, if any, received, taxable on receipt basis only. So full value of consideration is additional compensation received minus transfer expenses 1 lakh. Whatever the legal expenses, whatever the expenses you have incurred in relation to the additional compensation, all such expenses you can claim as deduction in the form of transfer expenses. So net consideration 9 lakhs, index cost of acquisition nil, because you already claimed index cost of acquisition here as deduction while calculating the capital gains with respect to original compensation. Hence, for calculating capital gains with respect to additional compensation, the cost of acquisition or index cost of acquisition will always be 0. Okay, ma'am. Next. Mr. Rupesh has not been satisfied with the additional compensation as well. Now, during the previous year 2021, Rupesh filed a case against the government regarding interest on compensation. You can see here, during the previous year 17-18, the asset was acquired. Now 18-19 he got 20 lakhs, 19-20 he got 20 lakhs, and 20-21 he got 10 lakhs. None of these compensation are received in time. There is a lot of delay for which there is an interest loss to the assessee. Now that interest loss claiming as compensation from the government. Had I received that compensation in the year 17-18, he would have made some reinvestments and he would have received some income from out of that reinvestments. Just because there is a delay in payment of the compensation, here the assessee lost some income. Regarding the same, he is claiming interest on compensation. Legal expenses incurred 50,000 rupees. Now, during the previous year 2021, he received the interest on compensation. Now, we should calculate the income with respect to the interest on compensation. Interest on compensation received 5 lakhs minus, there is a flat 50% deduction under section 57, 2,50,000, then taxable in interest compensation 2,50,000, and this is taxable under that income from other sources, not under the head capital gains. Remember, this is interest on compensation taxable under the head income from other sources. Only original compensation and additional compensation or enhanced compensation taxable under the head capital gains. Interest on compensation is always taxable under the head income from other sources. Okay, ma'am. And while claiming that, you can claim a flat amount of deduction of 50%. Hence, no more legal expenses allowed as deduction. Legal expenses allowed as deduction only for additional compensation, not for interest on compensation. Clear, ma? That's 45.5. 45.5 is not that important. So that's 45 series for you. Right, sir? Special cases of transfer. Okay, now. Just go through it once. Complete it. Now let's moving on. Section 50, which discussed with computation of capital gains in the case of depreciable assets. We have already learned about section 48. Section 48 deals with what, ma? Computation of capital gains with respect to the non-depreciable capital assets. Non-depreciable capital assets. We have seen a format like full value of consideration minus transfer expenses, net consideration minus cost of acquisition, cost of improvement, or index cost of acquisition or index cost of improvement. That will give you the gross capital gains minus exemptions under section 54, net capital gains. Do you remember? So that format is applicable only in the case of a non-depreciable capital assets. If it is a depreciable capital assets, section 50 comes into picture. Section 50 deals with calculation of capital gains with respect to depreciable capital assets. Okay, ma. So I've already given capital gains arising on sale of non-depreciable assets 48, on sale of depreciable assets 50. Okay, sir. Now, conditions for claiming the depreciation, this we have already discussed under section 32. For the purpose of claiming section depreciation under section 32, there are two requirements to be fulfilled. Number one, there must be at least one asset in the block. Number two, there must be some value for the block. Right, sir? Section 50 and section 32. Section 50 and section 32 both are mutually exclusive sections, ma. Section 50 and section 32 both are mutually exclusive sections. Means for a situation, if section 32 applicable, for the same situation section 50 not applicable. For the given situation, if section 32 is not applicable, then only section 50 is applicable. Okay, ma'am. So the applicability of section 50 is purely depends upon applicability of section 32. As long as section 32 applies, section 50 not applicable. Clear? So look at here. Section 50 comes into the picture where any one or both of the above mentioned requirements are not satisfied. Section 32 will not be applied, and automatically the provisions of section 50 becomes applicable, which resulting into either short-term capital gain or short-term capital loss. Depreciable capital assets are always have to be treated as a short-term capital assets, Amma. Clear? Every one of you, right? So look at here, ma, running notes. Combination of capital gains in the case of depreciable capital assets. So section 50 and 32 are mutually exclusive sections. If section 32 applies, section 50 not applicable. When section 32 not applicable, then only 50 is applicable. Two conditions, right, sir? So then concept of block of assets, which we have already discussed in PGBP section number 32. It consisting of a group of assets which are belonging to the same category and having the same rate of depreciation. And after that, I've given the assets classification like buildings, furniture, plant and machinery, intangible assets. Clear? These are the classifications of the assets. Then how to create a block? I've given an example. Next. So format for the calculation of closing return on value and closing return on value of the block and current year depreciation. Right, this we've already discussed in PGBP again. It starts with the opening return on value. Opening return on value, and then add the actual cost of additions made during the previous year. If any new assets purchased during the previous year, add the actual cost of additions, and then less sale proceeds of the assets sold during the previous year, deduct it, then you'll get the depreciable value, and from the depreciable value deduct the current year depreciation. Right, sir? Then you'll get the closing return on value of the block. I've given you an example here. Look at ma. As on 1/4/2020, the opening return on value, 6 missions we have 10 lakhs. On 25th of September to July 2020, sorry ma, 25th of July 2020, we have purchased 2 more new missions for 5 lakhs. On 25th of December 2020, again we purchased 2 new missions for 8 lakhs. And 2nd of January 2021, 5 missions were sold out for 7 lakhs. Now, calculation of the current year depreciation and closing return on value. It starts with the opening return on value. We have 6 missions at the beginning and 10 lakhs worth. And we purchased totally 4 new missions. On 25th July, we purchased 2 new missions, which are put to use for more than 180 days. You purchased in the month of July, ma. Even if you ignore July, calculate from August, September, October, November, December, January, February, March. 8 months. 8 months into 30 days, 240 days. So approximately you have utilized it for 240 days during that previous year. Then more than 180 days for which you can claim full depreciation. Next, 2 more new missions purchased on 25th of December 2020 and which were put to use for less than 180 days. Because you purchased in the month of December, ma, even if you take the full month of December, January, February, March, only 4 months, under 120 days, hardly. Put to use for less than 180 days, where half depreciation only allowed. So totally 10 missions we have, where the block value 23 lakhs. Out of the 10 missions, we have sold out 5 missions for 7 lakhs. So after selling that, we have 5 missions left over and the depreciable value 16 lakhs. Only on the 16 lakhs, you have to claim the depreciation. Okay, ma? So current year depreciation, right? So with respect to the 8 lakhs, the opening return on value, 6 sorry, ma. With respect to this 8 lakhs plant and machinery, I've already told you that you can claim only half depreciation. So look at here. 8 lakhs into 15% rate of depreciation into 50%. 60,000. Remaining 8 lakhs of the depreciable value, you can claim 100% depreciation. 1,20,000. So the current year depreciation 1,80,000. Then the closing return on value, you left over 5 machines, and the closing return on value of the block 14,20,000. Okay, ma'am. Next, if in the above example, all the 10 machines were sold for 13 lakhs. All the 10 machines we have sold for 13 lakhs. Now look at here, sir. You have a value for the block, but you don't have any assets in the block. Now in this case, section 32 provisions not applicable, because in order to apply section 32 provisions, there must be at least one asset in the block. Since there are no assets left in the block, 32 provisions not applicable, so 50 comes into picture. Means we should calculate short-term capital gains, not depreciation. Okay, look at ma. Full value of consideration, you have sold all the 10 machines for 13 lakhs. Opening return on value of the block 10 lakhs. Add actual cost of additions 13 lakhs. You purchase 2 machines, no, or 2 machines actual cost in the month 13 lakhs. So there is a short-term capital loss of 10 lakhs. Are you following, sir? Every one of you. Next, point number 2. In the above example, if 8 machines were sold out for 28 lakhs, 8 machines were sold out. Now, opening return on value 6 machines we have 10 lakhs. Actual cost of additions 4 machines we have purchased for 13 lakhs. Totally 10 machines we have worth 23 lakhs. Now, out of the 10 machines, we have sold out only 8 machines, but for a value of 28 lakhs. Now, in this case, you have 2 assets left in the block, but the block value is 0. The block value is 0. In this case, as there is no value for the block, section 32 provisions are not applicable. Hence, 50 provisions comes into picture. So, full value of consideration, you have sold all the 8 machines for 28 lakhs. Opening return on value 10 lakhs. Actual cost of additions 13 lakhs. So, you got a profit of 5 lakhs. Short-term capital gains. See, 23 lakhs worth of block we have sold for 28 lakhs. So, there is a gain of 5 lakhs. So, this is how one has to calculate capital gains as per the provisions of section 50. Okay, ma? Next. After that, 50B, slum sale. What do you mean by slum sale? Slum sale is nothing but transfer of a business unit as a whole, transfer of a branch as a whole, right, sir? So here we are not selling a single capital asset or a bunch of capital assets. We are selling the business unit as a whole, the branch as a whole. Are you following, sir? Right? Like, I'll give you an example. I'll give you an example for this. So after the introduction of, the entry of DMarts, the entry of DMarts into the provisional stores, into the departmental stores division, which leads to the, it questions the survival of the other departmental stores like More, Spencer's, Big Bazaar, then Reliance, departmental stores, right, sir? Earlier, before the entry of DMart into departmental stores wing, More, Spencer's, Big Bazaar, Vishal Mega Mart, these are all the enjoys that particular division, right? Especially More. But after the entry of DMart into the departmental stores, now the DMart departmental stores are enjoying the monopoly. Many of the units of More, Spencer's, Big Bazaar were sold out. Units as a whole were sold out, ma. Earlier now, I am from Hyderabad, very well, right? Before the introduction of DMart concept, we used to have a More showroom, More Mega Mart, Mini Mart. There will be 2 concepts, More Mega Mart, More Mini Mart. We used to have More Mega Marts for every 2 streets, for every 3 streets, right, sir? But now we hardly find this more mega marts or mini marts in Hyderabad because of the DMart. Are you following, sir? Every one of you. So here they were sold out, their business unit as a whole. Whatever the loss making branches are there, they started selling. Right, sir? So here we are selling a business unit for a lump sum consideration without assigning the values to the individual capital assets, individual assets and liabilities. Right? So we have a more mega mart in Dilshuk Nagar, right? And which was sold out for 5 crores. 5 crores. See, irrespective of the fact how much stock and trade was there, how much the value of the plant and machinery, furniture installed in that mart. No. A lump sum consideration is given 5 crores and taken over. That's it. Now, this concept is what we call slump sale. If you are selling a business unit as a whole, for which you are receiving a lump sum consideration and you are not assigning the values, you are not finding out what is the actual value of the plant and machinery installed, what is the value of the furniture installed, what is the value of the stock in trade, you are not assigning these values, you have simply sold it for a lump sum consideration, then it is to be called as a slump sale. Okay, ma'am. So transfer of one or more undertakings as a result of the lump sum consideration without values being assigned to the assets and liabilities. Right, sir? And if any value is assigned, it is only for determining the payment of stamp duty. That concept is called a slump sale. Okay, so the capital gains is taxable when the slump sale is effected. The nature of capital gains is purely depends upon the period of holding of the undertaking transferred. So since how many years you are doing this business in that particular unit, if that branch is held for more than 3 years, it's a long-term capital gain. If that business unit was held for less than 3 years, it's a short-term capital gain. Okay, now, and here nothing will be taxable under that capital gain PGBP. Clear? Even though you are receiving a consideration for stock and trade in that business unit, but still it shall be taxable under that capital gains only. Cost of acquisition and cost of improvement. What is the cost of acquisition and improvement here? Net worth of the undertaking. Net worth of the undertaking. How to calculate the net worth? Look at here, ma. $50 slump sale, calculation of the capital gains, full value of consideration, nothing but the lump sum amount of consideration you are receiving, that will be the full value of consideration minus net worth. Deduct the net worth, then you will get the capital gains. Now you will get it out. What is a net worth? Net worth means total assets minus total liabilities. Take the total assets value from which deduct the total liabilities value, you will get the net worth. Next. Sir, while calculating the net worth, and especially with respect to the assets, revalued figures we should not consider. Upward revaluation, downward revaluation, we should not consider. Okay, ma. You just ignore the revalued figures. Next, in the case of the depreciable capital assets, take the return on value. Take the return on value as the cost of the as the value of that asset. And in the case of non-depreciable assets, take the book value as the value of that asset. And in the case of section 35AD assets, the value should be considered as nil, because with respect to section 35AD, anyhow 100% deduction was allowed to you. 10 lakhs worth of asset you purchased immediately in the year of incurring that 10 lakhs expenditure, you can claim deduction under section 35AD. So what is the value of the asset? Nil. Clear now, every one of you. Okay, so that's how you need to calculate here. Net worth means value of the total assets minus total liabilities. Revaluation of the assets shall not be considered. Benefit of indexation not possible. Even though the business unit was held for more than 36 months, even though it is a long-term capital assets, but indexation benefit is not available here. It's not possible to calculate indexation benefit because you are not selling capital assets individually. You are selling the business unit as a whole. And value of non-depreciable assets shall be taken at the book value. Depreciable capital assets shall be taken at the return on value. Okay, now, and in the case of section 35AD assets, the value should be taken as 0. Clear, sir? Right. Next, computation of fair market value of the capital assets for the purposes of section 50B, rule number 11 UAE. It's a latest amendment, amended by the Finance Act 2021. Latest amendment. Even you can see this amendment in the statutory updates also. These are the statutory updates applicable for May 2022 examination. Okay, ma. Now in this, you can see the amendment from the capital gains chapter. The same amendment I've given in my material already. Computation of fair market value of the capital assets for the purposes of section 50B. Same amendment I've given my material. Look at this. Every one of you. Okay, now. Clear, sir? Next. Now look at what is this amendment. So computation of the capital gains on slum sale. Whenever you're calculating the capital gains in the case of slum sale, we all know that the formula is full value of consideration minus net worth. Just now we have seen this here. Full value of consideration minus net worth, that will gives you the capital gains. Full value of consideration is equal to the fair market value of the capital assets as on the date of the transfer. Fair market value you should take into account, right? Now look at here, the same provisions I mentioned in my material, sir. The fair market value of the capital assets as on the date of transfer should be taken as full value of the consideration. Now, how to calculate the fair market value? For which purposes the department gives us 2 points. CBDT, Central Board of Direct Taxes, has prescribed that for the purposes of section 50, the fair market value of the capital assets would be the higher of, and among these two we should take whichever is higher. Among these two we should take whichever is higher. Fair market value 1 should be the fair market value of the capital assets transferred by way of slum sale, and fair market value 2 being the fair market value of the consideration, the monetary value plus non-monetary value received or accruing as a result of the transfer by way of slum sale. So point number 1 discussed about the fair market value of the assets transferred. Point number 2 discuss about the fair market value of the consideration received. Suppose that the fair market value of the capital assets transferred worth rupees 100 lakhs. And you have received a consideration of 150 lakhs. Fair market value of the consideration received 150 lakhs. Now, among these two, you should take whichever is higher. So 150 lakhs should be treated as a full value of consideration. Are you following, sir? Every one of you. Sir, in case if the fair market value of the assets transferred 100 lakhs, but you have received the lump sum consideration only 80 lakhs, there is a possibility. Even though the higher worth of capital assets are transferred, since it is a loss-making business unit, the seller, the buyer will say like, it's a loss-making business unit, sir. Who will purchase this? I'm giving you 80 lakhs. Be satisfied with that. He will demand because he's purchasing a loss-making unit. Yes or no? So he has given only 80 lakhs as compensation. There is a possibility. That's why the department comes up with this amendment. So among these two, you should go with the whichever is higher. The fair market value of the capital assets as on the date of transfer should be taken as full value of consideration. This is the latest amendment, and one should be very, very careful. You must expect a question or at least an MCQ from this amendment. Okay, now next, that's 50B. Now 50C. 50C. Special provisions for computation of consideration. Whenever you're transferring a capital asset, being the land or building or both, sir, 50C provisions are applicable only in the case of land, building, or both. Only for these capital assets, 50C provisions are applicable. If you're selling a capital asset being the land or building or both for a consideration which is lower than stamp duty value, then the stamp duty value should be taken as a full value of consideration. Look at here, sir, 50C. Yeah. Stamp duty value to be considered as full value of consideration. Immovable properties, that is land, building or both, transferred for a consideration which is less than stamp duty value. Then 50C provisions applicable. Full value of consideration should be taken as stamp duty value. Okay, now look at this example. Mr. X transferred a residential house property for 40 lakhs. Now, as on the date of transfer, the stamp duty value of that house property is 50 lakhs. Now look at here, ma. While calculating capital gains, you should take 50 lakhs as full value of consideration, not 40 lakhs. This computation is wrong. Clear now? Full value of consideration should be taken as stamp duty value. Then index cost of acquisition, you'll get long-term capital gains. Clear, everyone? Next. So sale value 40 lakhs, stamp duty value is 50 lakhs. And look at this example. Sale value 40 lakhs and stamp duty value 50 lakhs. And sir, here assume that the assessor requested the assessing officer to refer the matter to valuation officer. Assessor feeling like the value of the property is only 40 lakhs. Whatever the stamp duty value claiming here 50 lakhs, it's not correct. Right, then the assessor has every right to make a request to the assessing officer to review the matter to the valuation officer. Assume that the assessing officer reviewed the matter to the valuation officer and the value as per the valuation officer 60 lakhs. So valuation officer said, no ma, the stamp duty value is 60 lakhs. So go ahead with the 60 lakhs as full value of consideration, not required. The value as per the valuation officer, if it is exceeding stamp duty value, you can stick on with stamp duty value. Full value of consideration is equal to stamp duty value only. And in this example, you should take full value of consideration is equal to 50 lakhs only, sir. Next, sir, in case if the valuation as per the valuation officer is less than stamp duty value, then go ahead with the value as per the valuation officer. Full value of consideration is equal to value as per the valuation officer. Okay, ma'am, every one of you. Next, sir, in case if there are two stamp duty values, possibility is there. As on the date of agreement, the stamp duty value is 50 lakhs. As on the date of transfer, the stamp duty value is 55 lakhs. Now, while calculating the capital gains, which stamp duty value should I take into account? Should I go ahead with the date of agreement, stamp duty value, or should I go ahead with the date of transfer, stamp duty value? So actually, the full value of consideration is equal to here. You should take the stamp duty value as in the date of agreement. But of course, star mark and the conditions apply. What is the condition? So in order to take the stamp duty value as in the date of agreement as full value of consideration, there are two conditions to be satisfied. Number one, assessee should have received either full or part of the consideration on or before the date of agreement, and such consideration should be received either by way of account pay check, account pay draft, or any other electronic mode of transfers. So assessee should have received either full consideration or part consideration on or before the date of agreement. Number two, that consideration should be received by way of account pay check, account pay draft, or any other ECS. Then if any of the above two conditions are satisfied, go ahead with the stamp duty value as in the date of agreement. If both of those, if both of that conditions are satisfied, full value of consideration is equal to stamp duty value as on the date of agreement. If any of the above conditions are not satisfied, then take the stamp duty value as on the date of transfer. Okay, now here we have amendment for this provision by the Finance Act 2020, right? Now what is that amendment? Look at here. Sale value 50 lakhs, we have sold for 50 lakhs and stamp duty value is 52 lakhs. So here we have transferred the asset for a value which is lower than stamp duty value. Now, can I apply the provisions of section 50C by default here? No. First, you have to look at the difference between the stamp duty value and sale value. If the difference exceeding 5%, then you can go ahead with 50C. Otherwise, no. You can see here, the difference is just 2 lakhs. As a percentage you calculate, you got 4%. Means the difference is just 4% only. Are you following now? Right? Every one of you. So here the difference is less than 5%, hence 50C provisions not applicable. But of course, that 5% margin is only up to the financial year 1920. With effect from financial year 2021, it will be now 10%. And you can have a margin of difference between your sale value to the stamp duty value up to 10%. Up to 10%. Are you following, sir? And you have sold the asset for 50 lakhs. You have sold the asset for 50 lakhs, whereas the stamp duty value is 54 lakhs. The stamp duty value is 54 lakhs. You can see the difference here, 4 lakhs. As a percentage, 4 lakhs is the difference from the actual sale value 50 lakhs into 100. You'll get the difference percentage 8%. You'll get the difference percentage as 8%. And less than 10%. So 50C provisions not applicable. You can go ahead with the original sale value as your full value of consideration. Every one of you. Right, sir? Next. Right. So here the margin of difference up to 10% is acceptable, sir. If the difference is up to 10%, then 50C provisions not applicable. If difference exceeding 10%, then only 50C provisions are comes into picture. Okay, ma? Now the margin of difference is up to 10%. Okay, sir. Next. So that's 50C, and then 51 forfeiture of advance. Right. If you received any advance in relation to a capital asset, and later on if the transfer not taken place and that advance amount is forfeited by you, right, sir? Now what is the tax treatment? If the advance amount received and forfeited on or before 31st March 2014, the advance so forfeited should be reduced from the cost of acquisition. But now with effect from the 1st April 2014, advance amount so forfeited shall be chargeable to tax under the head income from other sources. Straight away taxable under the head income from other sources. No need to reduce from the cost of acquisition. Okay, ma'am. That's 51 for you. And then 54 series, the last section in the capital gains chapter. 54. Now, if you see, section 45 deals with charging section. Charging section, which deals with the chargeability, levy of tax, and quite opposite 45, reverse chain number 54 deals with the exemptions. 45 deals with the taxability, and the opposite 54 deals with the exemptions. So under what circumstances the capital gains are exempted from tax? How can one claim exemption benefit? By making reinvestments. Okay, ma. So look at the first section, exemption of long-term capital gains arising on transfer of a residential house property. Clear? So Mr. X, during the previous year 2008-9, right, he purchased a residential house property for 10 lakhs. Okay. Now, previous year 2021, he transferred that house property for 50 lakhs. So during the previous year 8-9, he purchased. During the previous year 2021, he transferred. Now, full value of consideration is equal to 50 lakhs. Less index cost of acquisition calculation number, you will get 21,97,080. Then gross long-term capital gains 28,02,920. Next. Sir, in order to claim this capital gains amount as exemption under section 54, you have to make reinvestments. Where should I make reinvestment? Look at here. The reinvestment should be made in the residential house property only. Right, sir? Now, the time limit for the reinvestment. See, the residential house property, either you can purchase or you can construct. For purchase, the time limit is 1 year before the date of transfer and 2 years after the date of transfer. And then, technically speaking, you have 3 years time limit for purchase. 1 year before the date of transfer, 2 years after the date of transfer. Here you can see you have transferred that asset on 1st July 2020. On 1st July 2020. Now, date of transfer 1st July 2020. 1 year before the date of transfer means go back. So 2nd July 2019 till 1st July 2020 is 1 year. Now 2 years after the date of transfer, go forward from 1/7/2020 till 30th June 2022. Now in between these time period, you can purchase a residential house property and you can claim exemption under section 54. Next, if you opt for construction, you have 3 years time limit, 3 years time limit. It starts from the date of transfer. Date of transfer నుంచి 3 years time limit మీకు ప్రొవైడ్ చేయడం జరుగుతుందమ్మా. So that means up to 30th June 2023. Okay. Now, amount of the reinvestment. Sir, you can make the reinvestment of capital gains. Enough, sir. There is no need to reinvest the entire amount of your sale value. Like here you have sold it for 50 lakhs. There is no need that you need to reinvest the entire amount of 50 lakhs. Not required, right? It's enough to reinvest up to your capital gains because this is the only amount you want exemption, right? Okay, now. So the amount of reinvestment will be your long-term capital gains. Sir, if the amount of investment exceeding long-term capital gains, suppose that I have invested 30 lakhs. Now, can I claim 30 lakhs as exemption? No. What is the amount of exemption you're going to get? You're going to get only 28 lakhs 2,920. Even though you invested 30 lakhs, even though you invested 40 lakhs, still you will your exemption benefit restricted to your capital gains only. Okay, ma'am. Next, if the amount of investment is less than long-term capital gains, suppose that you have to invest 28 lakhs 2,920, but you actually invested 20 lakhs only 20 lakhs you will get exemption benefit. As simple as that. Okay, now. So the amount of exemption will be your amount of investment. Next, due date for the filing of written off income under section 139(1). Generally for individuals, it will be 31st July, right? And for companies, 30th September. Yes or no? Right? Tax audit cases, 30th September. Non-tax audit cases, 31st July. Okay, sir. Now, look at this example, sir. In this example, time limit for reinvestment for purchase, we have said 30th June 2022, and for reconstruction, 30th June 2023. Here, assessee purchased a residential house property on 1st Jan 2022. On 1st Jan 2022. Now, you tell me, sir, whether the reinvestment was made within the time limit. Answer is yes. He opted for purchase. He can purchase a residential house property at any time before 30th June 2022. And he purchased on 1st January 2022, well within the time limit he purchased. Then you will get a doubt here. Sir, for the previous year 2020-21, one should file his return of income, assuming the assessee is an individual assessee. His return of income should be filed on or before 31st July 2021. Means for the previous year 2021, he should calculate the total income on which he should find out the tax liability. The tax liability should be paid to the department. Then he should find out, file his return of income. He should file his return of income. Right, sir? But sir, as on 31st July 2021, I have not made any reinvestment. I've made the reinvestment on 1st January. For the calculation of total income, first I should calculate capital gains. For the calculation of capital gains, first I should claim exemption benefit first. For the purpose of claiming exemption, I have to make reinvestment. And for reinvestments, I have the time limit up to 30th June 2022. Yes or no? I have the time limit up to 30th June 2022. I can purchase a residential house property at any time before that particular date. Yes or no? I purchased on 1st Jan 2022. Means I have not made any reinvestment prior to the date of filing of return of income. If I not made any reinvestment, I don't get exemption. So that's why what the department said, if the assessee was unable to make any reinvestments on or before the date of filing of the return of income, don't worry. Open a capital gains account scheme. Capital gains deposits account scheme in any of the nationalized banks. And the deposit the amount for which you want to claim exemption, right? Deposit the amount regarding which you are going to make a reinvestment, right, sir? So deposit this amount on or before the due date for the filing of return of income and claim exemption. File the return of income. After filing the return of income, whatever the deposits you have made earlier, withdraw it and made reinvestment within the time limit. Are you following, sir? Every one of you. Here you can see, sir. Just a second. Yeah. Here you can see. See here, whatever the amount of reinvestment you want to make, you can go ahead with the capital gains account scheme. If you're not able to make reinvestment within the due date for the filing of return of income, right, sir? For the time being, you can make deposit into capital gains account scheme, claim the exemption benefit, file the return of income. After filing the return of income, withdraw that amount and made reinvestment within the time limit. Clear, sir? Every one of you. Next. Sir, in case if that new asset purchased, the new asset house property purchased, no, it will be having a lock-in period. It will be having a lock-in period. Within that lock-in period, you should not transfer that new asset. Sir, if I transfer the new asset, what will happen? Very simple, sir. Whatever the exemption earlier allowed, that exemption will be reversed. How it is going to be reversed? It should be reduced from the cost of acquisition while calculating the cost of capital gains of new asset. Are you following, sir? Right? So 30 lakhs earlier you got the exemption benefit. The same should be reduced from the cost of acquisition. Now your cost of acquisition will become nil. The entire amount of full value of consideration should be treated as a short-term capital gains. Right, sir? Next. Here we will be having some special considerations, right? See, whatever the cost we have incurred for acquiring the land for construction of the house property, even the cost of the land should also be treated as the amount of reinvestment, the cost of acquisition. Are you following, sir? Every one of you. He transferred a residential house property, right? He got a capital gains of 50 lakhs. Now reinvestments he made like this. He purchased a land worth 20 lakhs on which he constructed a building for 30 lakhs. Total reinvestment you should take 50 lakhs. So you can give exemption of 50 lakhs. Okay, now next. Even the construction of an additional floor in the existing building, that construction cost should also be treated as a valid reinvestment. Here the construction need not be a new construction now. Whatever the constructions already in existence, upon that building, if you construct a new floor, additional floor, the cost of constructing that additional floor should also be treated as a valid reinvestment. Next. Sir, can I make reinvestments into more than one residential house property? Can I claim? Answer is absolutely no problem. There is no hard and fast rule that I've sold 10 house properties, so I should make reinvestment into 10 house properties. Not required. You can make reinvestment into a single house property, absolutely no problem. Are you following, sir, every one of you? Right. See, here we have an amendment with respect to this. Let me take you to there. Yeah. New asset to be acquired. This is the latest amendment. If the capital gains amount not exceeding 2 crores rupees, right, sir? If the capital gains amount not exceeding 2 crores rupees, one residential house property in India or two residential houses in India at the option of the SSE, right? He can make reinvestment up to 2 residential house properties. That's why in this example, I've given you 2 residential house property where the capital gains amount is less than 2 crores. So the reinvestment into 2 residential house property, you can claim exemption. But whereas look at here, the capital gains is more than 2 crores. When your capital gains amount is more than 2 crores, if the amount of capital gains exceeding 2 crores, only reinvestment into one residential house property is eligible for exemption. Only one residential house property. Look at here, sir. As my capital gains amount exceeding 2 crores, I've made reinvestment into 2 residential house properties. Residential house property 1, I've invested 1.3 crores, house property 2, 1.2 crores. So exemption benefit give you ma 1.3 crores only. Are you following, sir? Next. Any registration expenses incurred also to be treated as a valid reinvestment. Registration expenses forming part of your cost of acquisition, valid reinvestment. Next, conversion of joint ownership into single ownership, also a valid reinvestment. Even if the property was not registered in the name of the SSE, even if 53A provisions are applicable, it should be a valid reinvestment. right? The legal registration in the name of the assessee not required. If 53A provisions are applicable, it is a valid reinvestment. You can claim exemption benefit. Next, construction. Sir, here we have the time limit for construction is 3 years, but the construction need not be completed within 3 years. There is no hard and fast rule that the construction of the house property should be completed within a period of 3 years. No hard and fast rule. Are you following, sir? Every one of you. The construction should be completed, but need not be in 3 years. But whatever the construction cost you have incurred up to 3 years, only that amount is eligible for exemption benefit. Suppose that you have constructed the property in 5 years, only from year 1, year 2, year 3. These 3 years construction cost, eligible for exemption benefit. Year 4 and year 5 not eligible for exemption benefit. Okay, now next, these are some specific guidelines, special provisions you have to keep in mind while calculating exemption benefit. Okay, now right, sir, if the amount not utilized, right, till the filing of return of income, I've already told you, deposit in any nationalized bank under capital gains deposit account scheme. For the time being, claim the exemption. After claiming the exemption, withdraw the amount and made reinvestments, either purchase or construction. Okay, now next, sir, if the deposit amount is not utilized, sir, for the purpose of claiming exemption, I have opened a capital gains deposit account scheme in a nationalized bank, and then I have deposited that amount. 50 lakhs I have deposited, sir. I have claimed 50 lakhs as exemption. After claiming exemption, I have not withdrawn this amount from the capital gains deposit account. I have not made any reinvestment. Then the department will wait up to 3 years because you have 3 years time limit for reinvestment. Clear? After the completion of 3 years, the previous year in which the 3rd year time limit completed, for that previous year, whatever the exemption allowed earlier, the same shall be treated as long-term capital gains. Are you following, sir? Every one of you. Sir, if the part of the amount utilized, part of the amount not withdrawn and not made reinvestment, to the extent it was not withdrawn, to the extent it was not made reinvestment, to that extent the capital gains allowed earlier exemption, that exemption earlier will be reversed and taxable, sir. Okay, now next, holding period of the capital asset, I've told you already, right? The holding period, lock-in period of the new asset must be 3 years. And sir, if sold within 3 years, what happens? Suppose that if sold within 2 years, you should calculate short-term capital gains. And while calculating short-term capital gains, whatever the exemption allowed earlier, the previously allowed exemption should be deducted from cost of acquisition. Next, sir, if sold after 2 years, but before 3 years, then the long-term capital gain should be computed as follows. Sale consideration of the new asset, right? From this, deduct the indexed cost of acquisition. And while calculating indexed cost of acquisition, the previously allowed exemption should be reduced. Okay, now next. So that's about 54 mark. And then after that, you will be having 54B, applicable in the case of urban agricultural land. 54D, compulsory acquisition of land and building. Right, sir? Then 54EC, long-term capital gains arising on transfer of buildings, lands, or both. 54EE, any long-term capital assets. 54F, any long-term capital assets other than residential house property. So these are the 54 series. The provisions are same except few changes. Go through the material, go through the running notes, right? For every section, I've given you the running notes, right? Here you can see the running notes for 54F, right? So go through the running notes, go through the problems and theory. And if you come across any doubts, you can just ask me, sir. Clear now? 54H, everything I've given the running notes along with the detailed examples. Right, sir? When it comes to taxation subject, it is containing the lot of provisions which needs the explanations with the help of examples. That's why now in my subject taxation, sir, both in income tax and GST, both put together, definitely I'll give you around 700 to 800 examples more. 700 to 800 exams, minimum of 700 to 800 examples in the entire taxation subject. You can see my running notes. Thereby you can understand minimum 300 pages running notes book will be gets completed. I'm talking about only exams, not for problems. I'm talking about only examples. Are you following, sir? Every one of you. Okay. So I'm winding up the capital gains marathon class here. In the next session, I'll start with the income from other sources. Clear, sir? So with that, in the next session, we'll complete the heads, all the 5 heads of income marathon. Clear, sir? Right. See you in the next session, sir. Till then, have a good day and good night. Stay home and stay safe. Okay, sir. A very good morning, students. So welcome to the income tax marathon classes. In the last class, we have completed discussion regarding capital gains. Okay, ma'am. So far we have completed 4 heads of incomes: income from salaries, income from house property, PGBP, and capital gains. Now time for the 5th head of income, that is income from other sources. Right, sir? So income from other sources, look at the running notes. Sections covered, section 56 to 59. Section 56 to 59. So the important topics from this chapter: number 1, taxability of the gifts; number 2, winnings under section 115 BB; and number 3, taxability of dividends. These 3 are very important topics from this chapter, sir. Right, sir? So totally it contains hardly 4 sections: 56 charging section, 57 the expenses which are eligible for deduction, 58 deals with the disallowances, and 59 deemed income. Right, sir? Now, so let us see the first one, charging section. Yes, it's our completely since last 4 heads of income. First, we have learned about the charging section of that particular head of income, and then we discussed about the method of accounting applicable to that particular head of income. After discussing these 2 topics, then only we will we were discuss the remaining topics of the head of income. Yes or no? Right, sir? So here first we should learn section 56, that is a charging section, and then after that we will learn section 145, the method of accounting applicable. Clear? Now look at the charging section, sir. So the income of every kind which is not exempted shall be chargeable to tax under the head income from other sources if it is not chargeable to tax under any of the 4 heads specified in section number 14. In other words, the following conditions must be satisfied before an income can be taxed under the head income from other sources. Right, sir? What are the conditions? First one, there must be an income. That income must not be an exempted income, and that income must not be chargeable to tax under any of the previous heads of income. What do you mean by the previous heads of income here? Previous heads of income means income from salaries, income from house property, PGBP, and capital gains. Right, sir? So first, there must be an income. That must not be a taxable income, means that must not be an exempted income. So that means it must be a taxable income, and it should not be taxed under any of the previous 4 heads of incomes. Then only such income is taxable under the head income from other sources. So you can see here, right, those incomes which are not covered by these heads of incomes, all those incomes are covered under the head income from other sources. Income from other sources is a residuary head of income, sir. Residuary head of income, or I can say that a miscellaneous head of income. Miscellaneous head of income. It covers all those incomes which are not covered by the above 4 heads of incomes. Clear? So look at here, sir. So there are 2 separate categories of the incomes which are taxable under the head income from other sources. Number 1, incomes which are exclusively taxable under the head income from other sources. And number 2, incomes which are taxable under the head other sources if they are not taxable under other heads. They are not taxable under other heads. Are you following, sir? So there are 2 categories of incomes taxable here. Incomes which are exclusively taxable under this head. Nowhere such incomes are taxable. They are exclusively taxable under the head income from other sources. What are they? First one, I have given some examples here like dividend income, interest on securities, personal gifts, casual incomes, etc. These incomes are exclusively taxable under their other sources only. Even if your business activity is buying and selling of securities, still the dividend income from the securities, interest on securities, taxable only under the head income from other sources. Personal gifts. So regarding gifts, if the gifts are received from employer, then income from salaries comes into picture. If the gifts are received during the course of business or profession, then PGBP comes into picture. If the gifts are received from relatives, friends, family members, then income from other sources comes into picture. Are you following, sir? So the person from whom you're receiving the gift will decide your head of income. So that's why I've clearly mentioned here personal gifts, gifts which you're receiving from your friends, relatives, neighbors, colleagues, could be anyone. Okay, ma'am. Right? So these are the incomes which are exclusively taxable under their other sources. Next, there are second category of incomes. These incomes are taxable under their other sources if they are not taxable under any other head. Like director sitting fees. Director sitting fees not taxable under the head salaries because directors are not the employees of company. Hence, we are taxing under their other sources. Family pension. Here the pension is receiving not by the employee, by the family members of the employee. Hence, taxable under the head income from other sources. If employee received the pension, income from salaries. If family members received the pension, income from other sources. Commission received by the LIC agents. LIC agents are not the employees of LIC. Hence, income from salaries not comes into picture. Income from other sources comes into picture. Subletting income. Letting income is taxable under their house property because their assessee is the owner of the property. But subletting income taxable under their other sources because assessee is not the owner of the property. Clear? So these are some examples I've given, sir. Next, look at the taxability of the dividends. Taxability of the dividends. First, look at the before the amendment provision. Here, the amendment which you got during the Finance Act 2020. This amendment was made by Finance Act 2020. Before the amendment, that means the provisions standing up to 31st March 2020. Foreign company dividends fully taxable. Domestic company dividends, company will pay tax under section 115O, right, sir, except the deemed dividend under section 2, clause 22, subclause E. Since company paying dividend distribution tax, the same is exempted in the hands of the shareholders up to rupees 10 lakhs under section 34, 10 clause 34. In excess of 10 lakhs, taxable at the rate of 10% under section 115 BBDA. These are old provision. Now the new provision, amendment. The amended provision with effect from the 1st April 2020. Foreign company dividends fully taxable. Just before the amendment, whatever the provision is there, after the amendment, the same retains. Domestic company dividends also now fully taxable. Domestic dividends. Earlier, you used to have the exemption benefit up to 10 lakhs. Only the in excess of 10 lakhs is taxable. Suppose that earlier, if you have a dividend income of 11 lakhs, you used to get a 10 lakhs exemption benefit. Only this 1 lakh is taxable, sir. Only 1 lakh is taxable. But now, if you have the 11 lakhs dividend income, the entire 11 lakhs is taxable. Right, sir? Entire 11 lakhs is taxable. So since the dividends are fully taxable in the hands of the shareholders, companies dividend distribution tax not applicable. DDT has been completely abolished. Dividend distribution tax completely abolished. So no section 115O. Next, 1034 exemption fully removed. Earlier, before that, when I was as a student, I have learned that dividend income fully exempted in the hands of the shareholder. Even while I came into the teaching also, right, sir? Almost I've been in teaching since 11 years. Last 2-3 years only, I think in the Finance Act 2019, we got this restriction to exemption 10 lakhs. Right, sir? Earlier, the dividend income is fully exempted in the hands of shareholders. Now, that benefit is given to the companies. Now, dividends are fully taxable in the hands of the shareholders. So 1031 exemption fully removed. And this 115 BBDA, it's actually a new section, hardly 2-3 years old section. Just 2-3 years old section. Now this section is also completely removed. Completely removed. And dividend income fully taxable in the hands of the shareholders at the normal rates, at the general rates applicable to that particular SSE. Okay, ma. So this provision is very important as we got an amendment. So foreign company dividend fully taxable, domestic company dividend also fully taxable at the normal rates. Clear? Next. So I've given one example also here. Company distributed, IFOS Company Limited, company distributed dividend on 25th of March 2020. Dividend received by the shareholder 5th April 2020. Right, sir? And the company has paid DDT under section 115O because the company was distributed dividend on 25th of March 2020 and before the amendment. Amendment with effective from 1st April 2020. So since the dividend was distributed before the amendment, see, the dividend distribution is important, not the dividend received by the shareholder. See, here you can see the company distributed the dividend before the amendment, 25th of March 2020. It's received by the shareholder on 5th April 2020, means after amendment. After amendment. Since the company has paid the dividend distribution tax, the same is exempted in the hands of the shareholders under section 10 clause 34. Up to rupees 10 lakhs. Okay, now look at the second example. Company distributed the dividend on 1st April 2020, means after the amendment taken place. Now it is fully taxable in the hands of the shareholders. Okay, ma. Next. Now look at here, one more example I've given. Mr. X purchased 1000 shares of Reliance Industries Limited with an investment of rupees 5 lakhs. Mr. X borrowed a loan of rupees 5 lakhs. Mr. X borrowed a loan of rupees 5 lakhs from SBI at the rate of 12% per annum interest for this purpose. So he has taken a loan from SBI worth rupees 5 lakhs, and with that 5 lakhs, he made investment into the Reliance company. For the financial year 2020-21, X received a dividend of rupees 1 lakh. Now, tax treatment. Look at the tax treatment, sir. Dividend income received 1 lakh minus deduction under section 57. You can see here, ma, with respect to the dividend income, what is the deduction benefit given to us? The deduction benefit given to us is, you have to calculate like this under section 57. Actual interest paid, you have taken a loan of 5 lakhs and you're paying interest at the rate of 12%. So actual interest paid 60,000. And point number B, 20% of the dividend income, 1 lakh into 20%, 20,000, whichever is lower. So you can claim a deduction up to 20% of dividend income. So the maximum deduction allowed with respect to the dividend income is 20% of dividend income. So 1 lakh you received dividend, 20% of dividend income, 20,000. So the taxable dividend income is 80,000 rupees. Taxable dividend is 80,000 rupees. Every one of you following now, right? So you can see here. So the method of accounting applicable, it is the cash basis or mercantile basis as regularly employed by the SSE. This is just like PGBP, ma. Same as PGBP. Even in the PGBP also, you might have studied the same head of method of accounting. Accrual basis or receipt basis, whichever is regularly followed by the SSE. Okay, now next. Incomes chargeable under this head, section 56 clause 2. I've already told you that dividends from a foreign company fully taxable, dividends from a domestic company fully taxable. Casual incomes means winnings from bettings, gambling, racing, crossword puzzles, TV shows, all this covered, ma. Then interest on compensation, interest on enhanced compensation. About this point, we have studied in the capital gains chapter. Original compensation, enhanced compensation, taxable under the head capital gains. Interest on original compensation, interest on additional compensation or enhanced compensation, both are taxable under the head income from other sources. Do you remember? Okay, ma. Next. Then after that, gifts, personal gifts, ma. And this is the forfeiture of advance. Regarding, we have already studied in the capital gains chapter again, section 51. Do you remember, sir? Section 51 deals with the forfeiture of advance. If the advance amount received and forfeited prior to 1/4/2014, it should be reduced from the cost of acquisition. And if the advance amount received and forfeited on or after 1st April 2014, it will be straight away taxable under that income from other sources. No need to reduce it from the cost of acquisition. Right, sir? Next. After that, basis of the charge of dividend. So far, whatever we have learned with the help of the chart, the same was explained here, right? Next. So Finance Act 2020 has abolished the dividend distribution tax and has moved to the traditional system of taxability of dividends. And with respect to that, you can claim a deduction benefit of actual interest paid or 20% of dividend income. Clear, sir? Next, surcharge on dividend. The enhanced surcharge is not applicable to dividend. Enhanced surcharge means the higher rates of surcharges, that is 25% and 37%. These two percentages are not applicable to the dividend income. Clear, sir? Next, after that, and after that, you have the another important concept, that is taxability of dividends. Sorry, gifts, personal gifts. Taxability of personal gifts. So look at here, taxability of the gifts, right? So before that, if the gifts are arising out of the employment, at any case will be taxable under the head salaries. Gifts arising in the course of business or profession, at any case will be taxable under the head PGBP. Gifts other than those mentioned above will be taxable under the head income from other sources. Applicability, any person being the recipient, right, sir? So gifts are always taxable in the hands of the recipient. Next, taxability. So look at here, I've already explained it with the help of a chart, right? So here gifts are mainly categorized into three categories. Number one, cash gifts. Number two, movable properties. And number three, immovable properties. Number three, immovable properties. Look at the cash gifts provision. Aggregate value of the cash gifts received during the previous year exceeding 50,000, then the entire cash gift is taxable. So you have to look after the aggregate amount of the cash gifts received. Aggregate amount of the cash gifts received, right, sir? Suppose that in the month of April 2021, I have received a cash gift of some 10,000. In the month of July 2021, I have received a cash gift of some 20,000. In the month of October 2021, I have received a cash gift of some 25,000. You can see here at the end of the March 31st, look at the aggregate amount of the cash gifts. The aggregate amount of the cash gifts is 55,000, which is greater than 50,000. So the entire amount of 55,000 is taxable in my hands. Clear, sir? Aggregate amount of the cash gifts we have to see. And what is the ceiling limit, Amma? The ceiling limit is 50,000 rupees. Next one. Movable properties. If received without any consideration, then if the fair market value of such movable property exceeding 50,000, the entire fair market value is taxable. So you received a movable property as a gift. Suppose that you have received shares worth 1 lakh rupee as a gift on your birthday, right, sir? It's a movable property. It is a movable property. Are you following, sir? So 1 lakh worth of shares you have received as a gift and you have not paid nothing for it. So the entire 1 lakh is taxable in your hands. Next, sir, in case if received with inadequate consideration, like you received 10,000 shares as gift, the fair market value is 2 lakhs and you paid a consideration of 1,20,000. So here you received the gift, but not at free of cost. You have paid something for it. You have paid something for it. In that case, you just look at the difference between the fair market value and consideration paid. If the difference amount exceeding 50,000, the entire difference is taxable. Entire difference is taxable. Look at here, 2 lakhs worth of shares you have received, for which you paid only 1,20,000. So the difference amount is 80,000. As the entire difference amount exceeding 50,000 rupees, the entire difference, that is 80,000, will be taxable as gift. So this is with respect to the movable properties. Now look at the immovable properties. Same provisions holds good, Immovable properties received without any consideration. Look at the stamp duty value. If it is a movable property, you have to look after the fair market value. If it is an immovable property, you have to look after stamp duty value, SDV, stamp duty value. If stamp duty value amount exceeding 50,000 rupees, then entire stamp duty value is taxable. Next, if received without any inadequate consideration, right? You have received a building or a land as a gift. Stamp duty value 60 lakhs, for which you have just paid 40 lakhs only. So 60 lakhs of worth property you have received, for which you paid only 40 lakhs. Now look at here, ma. Look at the difference between the consideration paid and stamp duty value. If that amount exceeding 50,000 and as well as the difference is more than 10% of consideration, then the entire amount of the difference is taxable. Look at here, ma. Difference is 20 lakhs. The entire amount of the difference is taxable, sir. Clear, everyone? Right? See, here you have to see the difference like this. 50,000 rupees are 10% of consideration paid. What is the consideration paid? 40 lakhs into 10%, 4 lakhs, whichever is higher. Ante here the difference amount should exceed 4 lakhs. The difference amount should exceed 4 lakhs. Only if the difference amount exceeding 4 lakhs, then the entire amount of difference is taxable. What is the difference here? 20 lakhs. What is the maximum difference? We can accept 4 lakhs. Clear? Next, continuation. If in the above example, consideration paid was 55 lakhs. So 60 lakhs worth of property you have received. In return, you paid only 55 lakhs. The difference amount is 5 lakhs. You can say that, sir, the difference amount is 5 lakhs means which is greater than 50,000. So we can tax the entire 5 lakhs under their income from other sources. No, wait. You have to see the difference amount exceeding 50,000 and as well as the difference amount should exceed 10% of consideration paid. So 50,000, 10% of consideration paid. 55 lakhs you paid consideration. 55 lakhs into 10%, 5,50,000. So the maximum difference acceptable, 5,50,000. And what is the difference here? Only 5 lakhs. Since the difference amount not exceeding the higher of 50,000 and 10% of consideration paid, hence nothing will be taxable as gift. The department said up to 10% of the consideration paid, the margin of difference is acceptable, right? So now in this case, the margin of difference is 5,50,000, but the actual difference only 5 lakhs. So that means the difference is well within the limits of margin of difference. Hence, nothing will be taxable as gift in the hands of the recipient. Are you following or not, Amma? Okay, next. So that provisions are mentioned here. Exceptions. Gifts from the following persons. Gifts received from the following persons and situations are not taxable. Gifts received from a relative. So what do you mean by the relative? Look at the definition here, ma. Relative definition I have mentioned in the help of a chart. Assessee Mr. X. Assessee Mr. X. Right, sir? Now, for Mr. X, who are the first relative? For you, who are the first relatives? Parents. For us, parents are the first relatives. So take parents, then their parents, then their parents. So this is what we call linearly ascendant. Linearly ascendant, 3 generations upwards. Parents, grandparents, great grandparents, then children. Linearly descendant, children, grandchildren, great grandchildren, 3 generations. Okay, ma? This is linearly ascendant and this is linearly descendant. Next, brothers and sisters and parents, brothers and sisters. Okay, ma. Then his wife, Mrs. X, and Mrs. X linearly ascendant, Mrs. X linearly descendant. Mrs. X, your spouse, your wife, your spouse parents, grandparents, great grandparents, then linearly descendant means your children only, sir, right? So children, grandchildren, great grandchildren. Don't write here again. For Mrs. X, there are no separate children. Mrs. X children are your children only, yes or no? So then Mrs. X brothers and sister and the spouses of these people. So these are all people covered under the definition of relative. Now, if Mr. X receiving the gift from any person in this chart, then such gift is fully exempted from tax. If Mr. X receiving gift from any of this chart, any one member from this chart, then that gift amount is not taxable, sir. Okay, now, right? Then gift received on the occasion of the marriage of the individual. So whatever the gifts you received in the occasion of marriage, whether you're receiving from relative, whether you're receiving from non-relative, it is fully exempted. Right? And here the department is silent is about number of marriages. So if you want to claim as many gifts as possible as exemption, go for more than one marriage. Not required, sir. I'm just kidding. Right? Of course, there are some people who are going for second marriage, third marriage, fourth marriage. Right? Because they want to take the advantage of this exception. Any gifts received on the occasion of marriage, fully exempted from tax. If you want to claim a particular gift as exemption, go for marriage and take the same gift as your marriage gift. Claim exemption benefit. Okay, sir. Next. And after that, you have some list of exceptions. Like if you received any gift by way of inheritance or under a will. Right, sir? So whatever the properties you are getting out of inheritance from your father or from your forefathers, that will be fully exempted from tax. Clear? So like this, you have some list, go through it. And after that, relative definition of the relative that we have already seen. And so next, the important provisions from this chapter. Let's go through the running notes. Interest on securities, right? So interest on securities taxable under that income from other sources only, sir. Right? Now look at the example given here. Mr. X purchased securities of X Limited on 1st May 2020. Interest becomes due on 1st October and 1st April. Mr. X sold the securities on 25th of September 2020 to Mr. Y. And Mr. Y sold the securities to Mr. Z on 3rd of October 2020. Here you can see, sir, Mr. X sold on 25th of September 2020 to Mr. Y. Right, sir? So Mr. Y purchased on 25th September and sold on 3rd October. And hardly he held the securities in the month of September, hardly 6 days. In the month of October, 3 days. And hardly held for 9 days only. But still, Mr. Y is eligible to get an interest of 6 months. 6 months interest he will get, sir. Even though he held the securities only for 9 days, Mr. Y is eligible for claiming an interest of 6 months because the interest becomes due on October 1st and April 1st. And whoever the person holding securities on these due dates, and such person is entitled to claim a 6 months interest. Are you following, sir? Right? So that's important point. Whoever holding the securities as on the date on which the interest becomes due, he is entitled for 6 months interest. Clear? So that provision was already mentioned here, ma. Right? Interest is computed on due basis. Right? The calculation is on due basis, but chargeable to tax as per the method of accounting followed by the assessee. If the method of accounting followed by the assessee is also due basis, then interest also taxable on due basis. But if the method of accounting being followed by the assessee is a receipt basis, the calculation is on due basis, but the taxability on receipt basis. Okay, ma'am. Next. Another important provisions from this chapter. That's it, sir. These are all the routine provisions. No new provisions to learn here. Right. So with this, I'm winding up the marathon class for the income from other sources. So with this, we have completed all the 5 heads of income marathon classes. All the 5 heads of income. Clear, sir? right? Now, in the next session, I am going to start with set off and carry forward of losses marathon. Yet another very important chapter. Okay, ma. So till then, see you. Good day, sir. Uh, stay home and stay safe. So a very good evening, students. Welcome to the income tax marathon classes. So in the last session, we have completed discussion regarding income from other sources. So with that, we have completed all the 5 heads of income marathon classes. Now let's moving on to the yet another very important chapter, that is set off and carry forward of losses. Set off and carry forward of losses. This chapter contains 2 parts, ma. Number 1, set off of the losses, and number 2, carry forward of the losses. Right, sir? So in a general tendency, if anyone facing the losses, right, sir? So a loss is also a loss is a loss. So he will be in a sad mood. From that loss, he cannot get any benefit. But when income tax point of view, when you're talking from income tax point of view, from the loss, you can claim a benefit. From the loss, you can claim a benefit, right? And how that benefit can be claimed, and what is that benefit? What are the rules and regulations regarding the set off of the losses and carry forward of the losses? All this we are going to learn from this particular chapter, sir. Okay, now, right? Look at this example, sir. You have a house property for which you have given a let out basis, and from that house property you are earning a rental income of income from house property 2 lakhs, and you have a business loss of 1 lakh. Now what you can do is this business loss of 1 lakh you can set off with this house property income 2 lakhs, whereby your total income comes out to be 1 lakh only. This is what we call set off. Set off, right, sir? So if you have any loss under any other head of income, and that loss can be set off with the incomes from the same head of income, can be set off with the incomes from other heads of income. And the rules and regulations, yes, we are going to study, sir. Okay, now, right? Basically for this chapter, sir, generally I don't look into the study material, sir. For each and every provision of this chapter, I have given the running notes, each and every provision, right, in a very easy manner to understand. Now look at this one, sir. Totally, as you know that we have 5 heads of income. Among the 5 heads of income, right, except income from salaries, remaining in all the 4 heads, there is a possibility of getting loss. In house property, best example, self-occupied house property, there will be always a loss. Self-occupied house property, unoccupied house property, right? PGBP, from the business or profession, losses are common. Capital gains, capital losses, common. Income from other sources, yes, even in under the head income from other sources, there are some chances of getting losses. Are you following, sir? So only in the under the head income from salaries, you don't have any losses. Clear now? You only have income, salary income. So loss and a concept undadamma. Clear? Next. So that's the first point. Except under that salaries, there is a possibility of getting losses under all other heads. Next. Look at one more example. During the previous year, 2020-21, assessee Mr. X, he's earning income from salaries 5 lakhs, income from house property 3 lakhs, and loss from house property 1 lakh. So you have 2 house properties. From one house property, you are earning income. From the other house property, you are earning loss. Now, the loss of house property 2 can be set off with the income from house property 1. And this kind of setting off of the losses is what we call intra-head adjustments. Intra-head adjustments, also known as inter-source adjustments. Inter-source, and within the same source of income. Mean to say, house property and house property 1 and house property 2, though 2 different sources, but you are setting up the loss within the same head of income. Intra-head adjustment, you can also call inter-source adjustment. Okay, now, right, sir? Now, look at one more example. Income from salary is 1 lakh and loss from house property to 2 lakhs. Here you have only one house property from which you have a loss. Now the loss of house property you can set off with income from salaries. So losses from one head of income setting off with another head of income. This is what we call interhead adjustments. Interhead adjustments. Okay, now so you can see here, sir. Next, one more example. You have income from salaries 5 lakhs and business loss of 3 lakhs. Now can I set off this business loss with income from salaries? Answer is no, you cannot. You cannot, because business against to the income from salaries, only the house property loss and the other sources losses are eligible to be set off. Capital losses, business losses, these are not eligible to set off against income from salaries. Are you following, sir? You can see here in this example whether inter-source adjustment possible. No, because you don't have any other business income. Whether interhead adjustment is possible. No, because you only have income from salaries against which business losses cannot be set off. Sir, interhead adjustment not possible, inter-source adjustment not possible. Then what shall I do? This loss to be carried forward to the next year. So business loss of 3 lakhs should be carried forward to the next assessment year. Are you following, sir? Now from this example, what you have learned? The order of setting off of the losses. Look at here. Losses should be set off and carry forward in the following sequential order. First, try to set off with the same head of income. Inter-source adjustment. If not possible, go for the other head of income. Interhead adjustment. If not possible, then go for carry forwarding of losses. Carry forwarding of losses to future years. Neither to be set off from same head of income, not to be set off from other heads of income. Directly go for carry forwarding of losses. Are you following or not? Next, set off and carry forward of the losses. Right. First priority, always go for the set off with the same head, inter-source adjustment, or with other heads, interhead adjustment. If not possible, try to go for carry forwarding of losses. Clear? Now, first let us try to understand what is inter-source adjustment, also known as what? Intra-head adjustment. Intra-head adjustment. Okay, ma. So the definition, look at the definition, ma. Current year losses under one head of income are adjusted against current year profits under the same head of income. Are adjusted against current year profits under same head of income, and such type of adjustment is known as what, ma? Inter-source adjustment. So if you have house property loss, this loss you are setting from house property income only. If you have a business loss, this business loss you are setting from business profits only. If you have a capital gains loss, and this capital gains loss you are setting up with capital gains only. This is what we call inter-source adjustment. Current year losses under one head of income, setting off with the current year profits under same head of income. Clear? Now look at the provisions. Income from salaries, inter-source adjustment allowed or not allowed? This question doesn't arise because under that income from salaries there are no chances of getting losses. Next, loss from house property, whether inter-source adjustment allowed? Yes, allowed. Loss from one house property can be set off with the income from any other house property. So one house property loss can be set off with the other house property's income. This is allowed. Next, PGBP. Here for the purposes of this chapter, businesses are classified into two main categories: non-speculation business, speculation business. Of course, you can also add one more thing: specified businesses. Specified businesses. First, look at the non-speculation business. Ma, non-speculation business losses, non-speculation business losses can be set off with non-speculation business profits and as well as speculation business profits. So hence inter-source adjustment allowed. Okay, ma. Now coming to the speculation business losses, inter-source adjustment not allowed. Ma, speculation business losses can be set off with only with speculation business profits. You cannot set off speculation business losses with non-speculation business profits. Are you following, ma? Everyone. Next, look at the capital gains. First one, short-term capital losses. Amma, if you have short-term capital losses, these short-term capital losses can be set off against short-term capital gains and as well as long-term capital gains. So inter-source adjustment allowed. When it comes to the long-term capital losses can be set up only with long-term capital gains. Long-term capital losses can be set up only with long-term capital gains. That's it. You cannot set up long-term capital losses with short-term capital gains. Very, very important point, every one of you. Okay. Next, income from other sources. Two categories, Amma. Number one, losses from the activity of owning and maintaining resources. These losses can be set up with the income from same activity only. If you get any loss from the activity of owning and maintaining the resources, that loss can be set up only with the same activity income. Hence, inter-source adjustment not allowed. Suppose that you have income from personal gifts, or you have dividend income, you have interest income. Now, against to such incomes, can I set off loss from the activity of owning and maintaining resources? No, you cannot. Clear? Next. Any other activity losses, like losses from money lending business, losses from tuition center, losses from subletting. These losses, yes, inter-source adjustment allowed. These losses you can be set off with any other income from other source, right, ma? All other activity losses can be set off from all the incomes under this head, except winnings under section 115BB. Ma, against to winnings under section 115BB, no loss can be set off. Winnings under section 115BB always taxable at a flat rate of 30%. No deduction will be allowed. No losses are entitled to set off. No basic exemption limit benefits applicable. No rebate benefit is applicable. No chapter 6A deductions allowed. They're flat, taxable at a flat rate of 30%. Okay, now. So this is about inter-source adjustment. All the 5 heads of income. Go through it, sir, once. Completed. Now let's moving on. Interhead adjustments, section 71. Interhead adjustments. Now first look at the definition, sir, about the interhead adjustments. Current year losses under one head of income are adjusted against current year profits under the other heads of income. Now such type of adjustment is known as interhead adjustments, right? Means house property loss, setting off with income from salaries, right, sir? Are you following now? Or any other activity losses from income from other sources, setting up with business income. So losses from one head of income, setting off against other heads of incomes. And such a kind of adjustment is what we call them. We call it as interhead adjustments. Let us see now. Look at the table. Head of income, interhead adjustment allowed or not allowed? If allowed, under which head of income? If allowed, under which head of income? Against to which head of income we can set off our losses? First one, income from salaries. The question doesn't arise because under that income from salaries, there is no question of a loss. Next, then after that, loss from house property, interhead adjustment allowed? Yes. If allowed, under which heads of income? So house property losses can be set off with all other 4 heads, income from salaries, PGBP, capital gains, and other sources. Right, house property losses can be set off with remaining 4 heads of income. But there is a restriction ma, the maximum loss from house property which can be set off against income from any other head is only 2 lakhs. Only 2 lakhs. So the maximum loss of house property can be set off with salaries or PGBP or capital gains or other sources. The maximum loss set off is 2 lakhs rupees only. Next, PGBP, non-speculation business, inter-head adjustment allowed? Yes, allowed. Under which heads? Under the head house property, capital gains, other sources. Except income from salaries. Business losses cannot be set off against income from salaries. Cannot be set off. Are you following, sir? Right? And coming to non-speculation business losses, inter-head adjustment not allowed, amma. Sorry, speculation business losses. Speculation business losses can be set up only with speculation business profits. Only with speculation business profits. You cannot even set off with non-speculation business profits. Are you following, sir? Every one of you. Ma, speculation business losses, if you observe, we have not even given the inter-head adjustment. Ante, the same head of income itself not supporting, then why other heads will support, sir? See, when your own family members are not supporting you, not trusting you, how come the other persons will trust you? Yes or no? See, when your same head of income is not giving the chance of setting the losses, how can you expect the other heads will give that option? So many of the cases where inter-source adjustment not allowed, even inter-head adjustment also not allowed. Are you following or not? Every one of you, right? So speculation business losses can be set off only with speculation business profits. That's it. No other option available. Now, coming to the capital losses, short-term capital losses and long-term capital losses, inter-head adjustment not allowed, sir. Capital losses can be set off only with capital gains. Right, sir. No other head of income will help you to set off capital gains losses. Clear? Right. Next, income from other sources, losses of from the activity of owning and maintaining of the resources, not allowed. For this activity, inter-source adjustment itself not allowed. So you cannot expect inter-head adjustment. Losses from the activity of owning and maintaining the resources can be set off with the profits from same activity only. Next, any other activity losses? Yes. Inter-head adjustment allowed, and you can set off any other activity losses from salaries, house property, PGBP, and capital gains. Then you'll get a doubt here, sir, how come any other activity loss is getting this flexibility? Even income from salary is also there, because any other activity losses you cannot carry forward to future years. Any other activity losses cannot be carried forward to future years. Whatever the you got the loss, try to set up that loss as much as possible. Clear, sir? Within the same year. Right? So that's about the inter-head adjustments. So with that, we have completed the first part of this chapter, that is set off of the losses. First part of the chapter completed. Just go through it, sir, once and ask the doubts if any. Completed, sir. Now let's moving on. Carry forward of the losses under section 71B to 74A. Right, sir. Now we have some general introduction to the carry forward of the losses. Look at here, sir. Losses can be carried forward only after income from inter-source adjustment and inter-head adjustment. Right. See, that's why. First, if you got the losses, try to adjust with the same head of income, inter-source adjustment. If not possible, go for the inter-head adjustment. Try to set off with other heads of income. If not possible, then only go for the carry forwarding option. Okay, now. So without trying to set off, if you want to directly carry forward, that's not allowed. That's not allowed. Next, carry forward of the losses under one head of income can be adjusted against incomes under same head of income. That means carry forward of losses for inter-head adjustment not allowed. Only for current year losses, you have the benefit of inter-source adjustment and inter-head adjustment. For carry forwarded losses, inter-source adjustment only allowed, inter-head adjustment not allowed. That's why when I'm giving the definitions for inter-source adjustment and inter-head adjustment, you can see I've started with the current year losses wording, and here also the definition of inter-head adjustment, current year losses. Only for current year losses, you have that benefit, you have the benefit of inter-source adjustment and inter-head adjustment. Are you following or not? Okay, next. In case there is both current year loss and carry forward of losses under one head in the same year, the order of adjustment is as follows. Right, ma? Suppose that under the head business, PGBP, under the head PGBP. So you have current year loss and you have a carry forward loss. Now in that scenario, the first priority should be given to the current year losses, then next priority to the carry forwarded losses. First, always try to set off the current year losses, then only go for the carry forwarding losses. After setting off current year losses only, you becoming eligible for setting off of the carry forward losses. Okay, now. No, sir, I would like to set off the current carry forward losses first. Then I'll look for the current year losses. Not allowed. Not allowed. Okay, sir. So look at this example. During the previous year 2021, Mr. X, income from textile business, he got a textile business income of 5 lakhs. Current year losses from chemical business 2 lakhs and brought forward business loss of 5 lakhs. Okay, now. Right. Now here, first try to set up the current year loss and then go for the carry forwarding loss. Okay, now. So first current year losses should be set off, then only the brought forward losses should be set off. Next, each loss shall be carried forwarded separately and shall be treated separately. Each and every loss, even though that loss is belonging to same head, you have to treat them separately and carry forward them separately. Okay, now. So for which I have the example, given the examples, just go through that examples. Next, rules regarding the carry forwarding of losses. First one, anyhow, you don't have a loss from salaries. So we'll directly start with the house property loss. Carry forwarding of the house property losses, section 71B. House property loss can be carried forward only after ISA and IHA. That means only after inter-source adjustment and inter-head adjustment. And house property losses after ISA and IHA can be carried forward for 8 assessment years, succeeding the assessment year in which the loss is first computed. Okay, now these losses from house property can be carried forward up to a maximum period of 8 assessment years. Now, how to compute that 8 assessment years? Okay, now, yeah, here you can see in previous year 2021, that means assessment year 21-22, house property loss 10 lakhs and you have an income from house property to 5 lakhs, business income 5 lakhs. Okay, now, so first try to set up with the same head of income, inter-source adjustment. So first try to set up with income from house property to inter-source adjustment, section 70 ISA. Still you have a loss of 5 lakhs. Still you have a loss of 5 lakhs. Here already I mentioned, sir, ISA. Still you have a loss of 5 lakhs and you have a business income of 5 lakhs. So can I set off the 5 lakhs loss with business income of 5 lakhs? No. Right. We have already learned the maximum loss from house property can be set off with other heads only 2 lakhs. So you have a business income of 5 lakhs, but the maximum loss that can be set off is only 2 lakhs. This is what we call interhead adjustment, section 71. Okay. The remaining loss from house property 1, that is after ISA and IHA, that is rupees 3 lakhs, shall be carried forward up to 8 assessment years. Now this 8 assessment year calculation, how? Simple, ma. In which assessment year you got to know there is a loss? The assessment year 21-22. In 21-22 only you got to know there is a loss. Okay, now, right? So 8 assessment years calculation starting from assessment year 21-22. Absolutely wrong. Not starting from the assessment year in which the loss is found. It starts from the succeeding assessment year. Look at the wordings here. Carry forward up to 8 assessment years, succeeding the assessment year in which the loss is first computed. So you have computed the loss for the first time. You got to know there is a loss from house property for the first time only during the assessment year 21-22. So in 21-22, what you're going to do? You're going to set off. Carry forwarding starts from next assessment year. So starts from 22-23 till 29-30. From there, 8 assessment years, 22-23. 23-24, 24-25, like this up to 29-30. Okay, ma'am. Next, carry forwarded house property losses can be adjusted against income from house property only. We know that for carry forwarded losses, interhead adjustment not allowed. Yes or no? Next. After that, just give me a second, sir. So next one, sir, carry forwarding of non-speculation business losses and speculation business losses. So carry forwarding of non-speculation business losses dealt by section 72 and speculation business losses by section 73. Look at the provisions. Non-speculation business losses can be set off and carry forward only after ISA and IHA, but whereas speculation business losses can be directly carried forward. Because for speculation business losses, no ISA and no IHA allowed. So if you have a speculation business loss, then directly you have to carry forward. Next, non-speculation business losses can be carried forward up to 8 assessment years, whereas speculation business losses can be carried forward up to only 4 assessment years. 4 assessment years. Next, carry forwarded non-speculation business losses can be set off with profits from non-speculation business and as well as speculation business profits. But whereas carry forwarded speculation business losses can be set up only with speculation business profits. Okay. Next, let's see some common points applicable for 72 and 73. In case if there is current year depreciation, carry forward business loss and unabsorbed depreciation is there, the order of adjustment. First, try to adjust current year depreciation. Then carry forwarded business losses as there is a time limit of 8 years, and then carry forward of unabsorbed depreciation. Now for unabsorbed depreciation, always give the last priority because unabsorbed depreciation can be set off with any other head of income except income from salaries and can be carried forward for unlimited period. So always give the last priority. Okay, ma. Next. The business in which the loss has occurred need not be in continuation. Suppose that you got a loss in chemical business. So you shut down that business and you opened a textile business. Now this chemical business losses, you can set off with the textile business profits. Absolutely no problem. So discontinued business losses can be set off with other continuing businesses, but that other continuing businesses should be continued by the same assessee. Okay, ma. Next. For carry forwarding the losses to the future years, assessee should file the return of income within the due date given under section 139(1). So filing of return of income within the due date is a mandatory criteria in order to carry forward losses. In order to carry forward losses, try to listen to my words carefully. Right. So if you fails to file the return within the due date, what is the loss to you? What are you losing? You're losing only the carry forwarding option, ma. not set off option. Even though you file the return after the due date, still you can set off losses. You're just losing the right of carry forwarding only. Okay, now next. Carry forwarding of specified business losses. Section 73A deals with specified business losses can be adjusted with specified business profits only. Are you following, sir? Totally, we have list of 14 specified businesses. Any specified business loss can be set off with any other specified business profits. There is no need to have one-to-one relationship. Like you have a 5-star hotel from which you have a loss. So that 5-star hotel loss, you can set off with your hospital business profits. You have a hospital with more than 100 beds for patients. So hotel business losses can be set up with hospital business profits. Okay, now. And for specified businesses, no ISA, no IHA allowed, right? And specified business losses can be set off with only specified business profits, and they can be carry forward. There can be carry forward for unlimited period, and these losses can be carried forward only when the return of income is filed within the due date. Next. Carry forwarding of short-term capital losses and long-term capital losses. Short-term capital losses can be carried forward after ISA, but long-term capital losses, there is no ISA benefit, no IHA benefit, no intersource adjustment, no interhead adjustment. So if you have a long-term capital loss, it should be carried forward directly. Next, short-term capital losses carry forward up to 8 assessment years. Long-term capital losses also carry forward up to 8 assessment years. And carry forwarded short-term capital losses. Sorry, ma. Carry forwarded short-term capital losses can be set off with short-term capital gains and long-term capital gains. Whereas carry forwarded long-term capital losses can be set off with only long-term capital gains. Only long-term capital gains. Next. For carry forwarding the capital losses, assessee should file the return of income within the due date. That's a common provision. Next, carry forwarding the losses from the activity of owning and maintaining a resources. These losses can be carried forward directly because no ISA and IHA allowed. These losses can be carried forward up to 4 assessment years. Okay, ma. Speculation business losses and losses from this activity, these are the only 2 losses which can be carried forward up to only 4 assessment years. Okay, now. And the carry forwarded these losses can be set up with the profits from same activity only. And for carry forwarding these losses, assessee should file the return within the due date. Clear now? So with this, even we have completed the carry forwarding of losses also. Okay, now there are 2 more sections: carry forwarding of losses by partnership firm in the case of change in the constitution of the firm, and losses attributable to the carry forwarding of losses of a private limited company in case there is a change in the shareholding. These 2 are not that important topics. You can just go through the running notes, the examples, all the examples I've given, sir. Right? If you study that example, you can easily grasp the concept. That's it. The problem started. Okay, now. So with this, set off and carry forward of losses also completed. Marathon also completed, sir. Set off and carry forward. Okay, now in the next marathon, I'll start with the return of income. Return of income marathon, then TDS and TCS. So like this, we'll continue the marathon classes. Okay, ma? Right. So see you in the next session, sir. Till then, have a good day and good night. Stay home and stay home. A very good evening, students. So welcome to the income tax marathon classes. In the last class, we have completed the discussion regarding set off and carry forward of losses. Right, sir. Now let's moving on to the yet another very important chapter of income tax, that is deductions under chapter 6A, or we can also call it as chapter 6A deductions. Right, sir. This chapter, from the examination point of view, you won't expect a direct question from this chapter, but in the consolidated problem, that is total income problems, the very first question of your income tax paper, And in the PGBP problem or in the capital gains problem, you will always have some provisions from chapter 6A deductions, right sir? Though it is a PGBP sum, though it is a capital gain sum, at the end of the question he will ask you to find out, calculate total income of the assessee for the assessment year. Total income. So in that problem, you'll also have some provisions from chapter 6A deductions. So without chapter 6A deductions, there is no total income problem. Without chapter 6A deductions, there is no PGBP problem, no capital gains problem. So compulsory, whenever there is a question asked to find out the total income of the assessee, in that problem, there will be always chapter 6A deductions. So very, very important chapter, sir. Without knowing the chapter 6A deductions, you cannot complete the total income problem. You might calculate up to gross total income. From the gross total income, you have to deduct the chapter 6A deductions. Then only you will get the total income. Yes or no? Right, sir? Now, so chapter 6A deductions, you can see here. The very important sections from this chapter, I have already noted down here. Deductions with respect to payments. These are the list of important sections I have mentioned here, like section 80C, 80CCC. These are all 80C series. These are all 80C series. And this is 80D series, 80E series, and 80G series. Right, sir? Deductions with respect to payments. Of course, here only that investment based deductions, expenditure based deductions are important from examination point of view, sir. Income based deductions are not that important, except that 80TTA, 80TTB. Right, sir? Okay, so here the first provision, section 88 deals with the first provision. So whenever your chapter 6A deductions more than your gross total income, you can see here in this example, your gross total income is just 2 lakhs, whereas your chapter 6A deductions comes out to be 2,30,000. So your chapter 6A deductions greater than your gross total income, right, sir? In that scenario, sir, your chapter 6A deductions are restricted to your gross total income. Restricted to gross total income. Since your gross total income is 2 lakhs, the maximum chapter 6A deductions you'll get only 2 lakhs, not 2,30,000, only 2 lakhs. So the total income becomes 0. Sir, what about the 30,000, that excess portion of 30,000 rupees chapter 6A deductions? Can I carry forward to the next year? Can I claim in the next year? Sir, it is not a loss to carry forward to the next year. The excess portion of chapter 6A deductions which you made, that will be lapsed. So then it will be, not a favorable situation to me. Who asked you to make the investments, man? It's your option. It is your option, right? See, department not asking you to invest in all this LIC premium tuition fees, right? It is your optional. Clear now? So that's 80A provided. Section 88 deals with if your gross total chapter 6A reductions exceeding the gross total income, the maximum chapter 6A reductions allowable restricted to the gross total income. Okay, now then after that we have deductions with respect to payments. So this is the 88, the provision which I have discussed right now. Clear, sir? So here they have mentioned the aggregate amount of deductions under this chapter shall not exceed the gross total income of the assessee. That is no carry forwarding of unutilized deductions. Clear, sir? Next. So after that, you will be having deductions with respect to the payments starting from section 80C to 80GGC. 80C to 80GGC. Right, sir? Now, in section 80C, here you have a bunch of investments, right? So the eligible investments list mentioned here, Section 80C applicable only to the individuals and HUFs, irrespective of residential status. That means a non-resident can also claim deduction under section 80C. A non-resident also eligible for claiming deduction under section 80C. Clear, sir? Next, the investment or contribution should be made in an approved investment scheme. What do you mean by approved investment scheme? I have given the list here. Okay, now the payments need not necessarily be made out of income chargeable to tax. Here, whatever the investments you are making, whatever the expenses you are paying here, that should not be not necessarily from a taxable income. Even from an exempted income, you can make payments. Even from an exempted income, you can make investments. Under Section 80C, still you can claim deduction basis. Next, deduction shall be allowed only on payment basis, not on accrual basis. Under Section 80C, the deduction is allowed only on payment. Like LIC premium, LIC premium payable, deduction not allowed. LIC premium paid, deduction allowed. Tuition fees payable, deduction not allowed. Tuition fees payable, deduction not allowed. Tuition fees paid, only deduction allowed. Okay, now maximum deduction under Section 80C, right? So individual slab 1,50,000 ma, but of course the maximum ceiling limit from 80C, 80CCC and 80CCD1 shall not exceed 1,50,000 rupees. That's the aggregate amount of deduction ma. About that I will tell you later. Okay, now eligible investment, you have a list ma, like life insurance premium for individual HUF including family, right? And then premium paid in respect of contract for deferred annuities, and you can see here contributions to the PPF, right? Contributions to the SPF, RPF, right? And contributions to the superannuation fund, amount invested in NSC National Savings Certificates, eighth issue, and repayment of the loan taken from the banks and financial institutions for the purpose of purchasing or construction of the house. Nothing but housing loan repayments. And here only the principal portion eligible for deduction. Principal repayments of housing loans. Then FD is fixed deposit for a minimum period of 5 years or more. Tuition fees paid for the children, right? And the deduction is allowed maximum for 2 children for full-time education in India. And deposits in the notified bonds of the NABARD, senior citizen savings schemes, contribution towards ULIPs, unit linked insurance policies, right? Notified pension scheme of UTR mutual funds, deposits in Sukanya Samriddhi scheme, right? Sukanya Samriddhi scheme is like it is the scheme introduced for the benefit of the girl child, right, sir? And then contribution to the NHB, National Housing Bank, investments in the 5 years post office time deposits, right, sir? So all these are the eligible investments under Section 80C, right, sir? Majority of the cases in the problem, mainly they are asked the routine chapter 6 deductions under Section 80C is life insurance premium paid, contribution to PPF, RPF, SPF, investments into the NSC National Savings Certificates, repayment of the housing loans, 5 years fixed deposit, tuition fees paid, right, sir? Mainly these are asked in the exams. Clear, sir? Next, with respect to the LIC premiums, right, sir? So whatever the LIC premium you are paying, life insurance premium you are paying on a periodical basis, life insurance premium you are paying on a periodical basis, right, sir? That will be allowed deduction under Section 80C. Now you will get it out. You'll get it out, sir. Whatever the LIC premium I have paid, can I claim the entire amount of LIC premium paid as deductions, or do we have any maximum ceiling limits? The ceiling limits are there, sir, right? So look at here, ma. Deductions with respect to the LIC premiums paid, policy issued in between 1/4/2003 till 31st March 2012. If any LIC policy issued in between this period, the maximum deduction allowed is 20% of the sum assured. Maximum deduction allowed is 20% of sum assured. Sum assured is nothing but policy value, sir. Nothing but policy value. You will take the policy for a lump sum value, say for 10 lakhs or 20 lakhs. That is what we call sum assured. Okay, now, and if the policy was issued on or after 1/4/2012, the maximum deduction allowable is 10% of sum assured, right? And if the policy was issued on or after 1/4/2013, this is applicable only with respect to those assessees who are suffering with the diseases covered under Section 80 DDB and 80U. Sir, this amendment made by the Finance Act 2013, this is applicable only for those assessees who are suffering with the diseases covered by Section 80 DDB and 80U. For them, the maximum deduction allowed is 15% of sum assured. But of course, these are the maximum ceiling limits subject to your actual insurance premium paid, sir. Subject to actual insurance premium paid. So actual insurance premium paid or the ceiling limits, whichever is lower, eligible for deduction. Okay, now look at this examples. Assessing Mr. X, policy issued on 15th of April 2010. 15th of April 2010 means covered in this. And what is maximum deduction allowed? 20% of sum assured. Okay. Sum assured 10 lakhs. Sorry, ma. Sum assured 10 lakhs and insurance premium paid 2,50,000. So deduction under section ADC is equal to, sir, sum assured 10 lakhs. No. So point number A, actual insurance premium paid. Actually paid how much? 2,50,000. 2,50,000. Or maximum deduction how much? Maximum deduction is equal to 20% of sum assured. 10 lakhs into 20%, which comes to 2 lakhs. Among these two, whichever is lower should be taken. Under 2 lakhs. Now, can I claim the 2 lakhs amount as deduction? No. The maximum deduction under section ADC. What is the maximum deduction? Under section ADC, the total amount of deduction under section ADC not exceeding 1,50,000. So, deduction under section ADC 1,50,000 rupees. Okay, ma. Next one. Look at the second example. Mr. Y, policy issued on 10th April 2012. 10th April 2012 means falls in where? This category. So maximum deduction allowed in the 10% of sum assured. Sum assured 5 lakhs and insurance premium paid 70,000 rupees. So actual premium paid 70,000. Maximum ceiling limit 10% of sum assured. 5 lakhs into 10%. So 50,000, whichever is lower. Okay, 50,000 is a deduction allowable. Okay, now next, look at the third example. Mr. Z suffering from disease covered under section 80U. Policy issued on 15th of November 2012. Right, sir. And sum assured 8 lakhs. Insurance premium paid 1 lakh. So point number 1, actual insurance premium paid how much? Actually paid 1 lakh. And what is the maximum deduction? Maximum deduction 8 lakhs is a sum assured into 10%, 80,000 rupees. Among these two, whichever is lower, eligible for deduction. So 80,000. Then you will get a doubt here. Sir, assess is covered with the disease under section 80U. So the maximum deduction should be 15%. No. Why you have taken 10%? Look at the policy issue date, 15th of November 2012. Right, sir? See, the highest rate of deduction 15% is applicable only when the policy was issued on or after 1/4/2013. Look at the chart here. The policy should be issued on or after 1/4/2013. Then only 15% sum assured will be eligible for deduction with respect to the assessees, those who are suffering from diseases covered by 80D and 80 DDB and 80U. Clear now? Next. Look at the example number 4. Mr. A covered under section 80 DDB. Policy issued on 25th of August 2020. So on or after 1/4/2013. Hence 15% is a maximum ceiling limit. Sum assured 5 lakhs, premium paid 70,000. So actual insurance premium paid 70,000. And this should be compared with the maximum ceiling limit. 15% of sum assured, 5 lakhs into 15%, 75,000. Now among these two, whichever is lower should be taken. The lower amount is 70,000. Got it now? Every one of you. So like this, you have to calculate the life insurance paid amount as deduction. Try to remember the dates. If the policy issued in between 1/4/2003 till 31st March 2012, the maximum deduction allowable 20% of sum assured. With effect from 1/4/2012, 10% of sum assured. For those assessees who are covered under section 80 DDB, 80U, and the policy should be issued on or after 1/4/2013, then 15% of sum assured. Clear, ma? Every one of you? Okay, now. So that was mentioned here, sir, in this particular table. Completed, sir. Now let's moving on. Contributions to certain pension funds, section 80CCC. Right, sir. Look at the notes. So this is about the ITC, and we have seen the example as well. And ATC connecting section is there, ma. That is section 10 clause 10D, right? Which gives you the exemption of lump sum amount received on maturity of LIC insurance policy, life insurance policy. See, during the term of the policy, whatever the premiums you paid, the premiums are eligible for deduction under section ATC. Now, at the time of maturity of the policy, whatever the lump sum amount you are going to receive, that lump sum amount is exempted from tax under section 10 clause D, under section 10 clause 10D. And how that exemption is going to be, look at here. The maturity proceeds including bonus fully exempted from tax under section 10D, provided, look at here. If the policy was issued prior to 1/4/2003, maturity proceeds are fully exempted from tax under section 10D. If the policy was issued on or after 1/4/2003, the exemption is allowable subject to the satisfaction of the following condition. What is the condition, ma? This is a condition. The annual premium paid by the policy holder shall not exceed the prescribed limits under section ATC. Right, sir? That means whatever the percentages mentioned there, 20%, 10%, 15%, these are the prescribed limits. So whatever the annual premium paid by the policy holder shall not exceed these limits. Suppose that if you have taken the that policy on or after 1/4/2012, so means the maximum deduction allowed to you is 10% of sum assured. Suppose that you have taken a policy of rupees 5 lakhs. So that means your annual premium shall not exceed 50,000 rupees. If you paid in any of the year during the policy term, suppose that the term of the policy is 10 years, let it be 8 years. The policy of the term is 8 years. Now, during that 8 years, 7 years, you paid the annual insurance premiums, say let it be some 30,000 rupees, right, sir? Annual insurance premium. But in 1 year, you happen to pay 60,000 rupees as annual insurance premium. So out of the total 8 years of term of the policy, 7 years you paid the insurance premium, which is well within the limits of prescribed limits, right? But in 1 year you have paid an insurance premium, which is more than 10% of that particular sum assured. Now, in that case, after the maturity of this policy, that is after 8 years is completed, let us assume that you have received a lump sum amount of 8 lakhs. Now, this entire 8 lakhs is taxable. You cannot claim exemption under section 1020. You cannot claim this exemption benefit because here you have not satisfied this condition. Are you following, sir? Every one of you. Look at here. Exemption under section 1010D is not allowable in the following cases, like keyman insurance policy. Keyman insurance policy proceeds are fully taxable. Next, annual premium paid greater than prescribed limits, this condition. And next, disabled dependent predeceases the assessee. If the disabled dependent died before the assessee dies, now the lump sum amount received by the assessee and it will be fully taxable in the hands of the assessee. Okay, now next. Then after that 80CCC, you have the provisions like 80CCC applicable only for individuals, not even HUFs, only for individuals. Nature of payment, contribution to annual plan of LIC or any other insurer for receiving the pension. Contribution must be made by the individual. Amount deposited subject to maximum limits, that is 1,50,000 rupees. But of course, there is an overall deduction 1,50,000, and I'll tell you later. Next, it should be paid out of taxable income only, sir. Clear? Next. Then after that, you have 80CCD, contribution to the notified pension scheme, NPS. Here you can see, sir, totally 3 categories of deductions you can claim. 1, with respect to the central government employees, 3, other employees, and 4, self-employed. 1, central government employees, 2, other employees, and 3, self-employed. Okay, now first look at the central government employees. If any central government employee making contribution to NPS, notified pension schemes, look at here. Employee contribution right? With respect to employee contribution only, you can claim deduction. Of course, employer contribution also you will get the deduction mark. But first look at the employee contribution. The maximum deduction allowable is 10% of salary. 10% of salary. But of course, this deduction is subject to overall ceiling limit under section 80cce. Okay, now in addition to this, under section 80cc 1b, you can claim an additional deduction of 50,000 rupees. And this 50,000 is over and above the ceiling limits under section 80cce. Right, sir? So 50,000 rupees you can claim deduction under section 80cc clause 1b. Right, sir? And this is in addition to the deduction allowed under section 80cc 1. And of course, this 50,000 is not forming part of overall ceiling limits. In addition to the overall ceiling limit, you can claim additionally 50,000 rupees. Okay, now this is with respect to employee contribution, central government employee contribution. Coming to the employer contribution, who is employer here? Central government. See, when you are an employee of the central government will become employer. Are you following or not? So here the maximum deduction allowed is 14% of salary. Okay, now. So this deduction is allowed under section 80cc 2, and this is also over and above the ceiling limits under section 80cce. Ma 80cce lo cover ayyedi only deduction under section 80c and 80cc and 80cc 1. Only these three sections covered under overall ceiling limit. 80C alone 1,50,000 you can claim. 80CCC alone 1,50,000 you can claim. 80CCD1 10% of salary or 20% of gross total income. This is applicable in the case of self-employed people. Okay, now. But overall deduction, the aggregate amount of deductions from all these three sections shall not exceed 1,50,000. And this was provided under section 80cce. Okay, ma, right? Next. Now coming to the other category employees. So employees contribution, the maximum deduction allowable is 10% of salary under section 80cc1. Since it is given deduction under section 80cc1 subject to overall ceiling limits, then additional deduction of 50,000 you can also claim, sir. And this is under section 1b, hence over and above the ceiling limits of 80cce. Clear, sir? Next, employer's contribution, the maximum deduction allowable is 10% of salary. Ma, you look at here, for employer's contribution, 14% of salary deduction here. Where ma? Central government employee case. In the case of the central government employee, with respect to employer's contribution, 14% of salary they can claim deduction. But with respect to other employees, only 10% of salary will be eligible for deduction. Okay, now coming to the self-employed people, the maximum deduction allowable is 20% of their gross total income. And since the deduction is allowing under section 80cc1 subject to overall ceiling limit. And of course, he can also claim additional deduction of rupees 50,000 under section 80cc 1b. And this is over and above the ceiling limits. Ma. Okay, now. So like this, totally under section 80cc 1b, we can claim the deduction like this. Every one of you. Okay, sir. So after that, I've started doing the problems, right, which are relating to this 80C series. Now we'll move on to the 80D series, ma. 80D series, deductions with respect to medical insurance premium, contribution to CGHS, Central Government Health Scheme, then preventive medical health checkups, and medical expenditure for very senior citizens. Medical expenditure for very senior citizens. Okay, ma. Now look at the deduction allowable here, right? So first of all, here totally two categories, ma. Deduction with respect to SSE, self-dependent children, and deduction with respect to the parents, right? And this is the total amount of deduction one can claim under section 80D. Okay, now neither of the SSE nor the spouse and not the parents are senior citizens. SSE, his spouse, and parents, none of them are senior citizens. So with respect to the SSE, spouse, and dependent children, 25,000 we can claim up to deduction. Ma, these are not flat amount, ma. These are maximum ceiling limits. Try to understand the difference. Flat amount means irrespective of the premium paid by you. that flat amount is allowed as deduction to you, right, sir? But this is a ceiling limit, not a flat amount. See, with respect to SSE, spouse, dependent children, look at my case. Sir, I've taken an health insurance policy with respect to myself, my wife, and two children. Right, I've taken totally 5 lakhs health coverage policy, right? And every year I'm paying an insurance premium of 14,000 rupees. 14,000 rupees every year I'm paying 14,000 premium, right, sir? So neither myself nor my spouse having the age of greater than 60 years. So for us, the maximum ceiling limit allowable is 25,000 rupees. But actually health insurance premium paid by me, how much? I paid 14,000 rupees. So the maximum deduction allowed under section ADD is 14,000 only. These are just ceiling limits, but subject to actual premium paid. These are not flat amounts. Okay, now suppose that instead of 14,000, I have paid a premium of 34,000 rupees. Now, can I claim the 34,000 as deduction? No. Subject to 25,000 rupees. Subject to the maximum ceiling limits. Are you following or not? So when it comes to ADD, the deduction will be allowable like this: actual health insurance premium paid or maximum ceiling limit, whichever is lower. Okay, now with respect to parents also, we can claim 25,000 rupees. So totally 50,000 rupees. Clear? Next. Now, SSC and spouse, not the senior citizens, but parents are senior citizens. Any one parent is senior citizen, that's enough. Need not be by both the parents. Even if one parent, either father or mother, is a senior citizen, you can claim a maximum ceiling limit of 50,000. For SSC, spouse and dependent children, 25,000. Since the parents are senior citizens, the ceiling limit increased to 50,000. Total put together 75,000. Okay, now next. SSC and spouse are senior citizens and parents also senior citizens. So 50,000 for SSC, spouse and children, 50,000 for parents, totally 1 lakh. Okay, now next. Coming to PMHC, preventive medical health checkup. With respect to SSC, spouse, dependent child, 5,000 is allowed. With respect to parents, 5,000 is allowed, but the aggregate amount of deductions in the nature of preventive medical health checkup with respect to SSC, spouse, dependent children, parents, all put together shall not exceed 50,000. 5,000 shall not exceed 5,000. Adenti sir, 5 plus 5, 10,000 kada? No. The maximum deduction allowable as deduction in the form of a preventive medical health checkup is 5,000 only. Okay, now, and this 5,000 is not an addition to these limits. This 5,000 is forming part of these limits. It is not a separate deduction. See, if you're falling on this category now, so this 5,000 is including of this 50,000. Sir, 50 plus 5, 55,000 deduction allowed. No. This 5,000 is forming part of this 50,000. No, your parents are senior citizens, so you're falling in this case. So this 5,000 is forming part of this 75,000. 75 plus 5, 80,000, not. Maximum deduction, 75,000. Clear now? Like that you have to see. Next, medical expenditure incurred for senior citizens. Right. So SSC, spouse, dependent child, 50,000 and parents 50,000. But the maximum deduction allowable is only 50,000. And this 50,000 also not a separate deduction. This is falling again on the overall ceiling limits. Clear now? Next, after that. So here you can see the discussion regarding the ADD, right? So it covers the payments like health insurance premium, central government health scheme, preventive health checkup, and medical treatment. Okay, sir, right? And the limits which we have already discussed here, preventive health checkup discussed, and mode of payment you can see here, sir. With respect to medical insurance premium, health scheme contribution, medical expenditure for very senior citizens, you can make that payment by any mode other than cash, right? And when it comes to preventive health checkup, you can make the payment including cash. Means you can incur this expenditure even in the form of a cash. Are you following, sir? Right? Sir, if I paid health insurance premium in cash, can I claim deduction under section ADD? Answer is no, you cannot. You cannot claim. Sir, I've paid preventive health checkup, preventive medical health checkup expenditure in cash. Can I claim it as deduction? Yes, you can claim. Absolutely no problem. Okay, now next. After that, ADDD. ADDD. So ADDD is with respect to the medical expenditure incurred, maintenance and medical treatment of handicapped dependent. Right, sir. So here the disability is with not respect to the assessima, the disability is with the dependent. Right, sir. If assessee himself having disability, then ATU comes into picture. If a dependent person having disability, ADDD comes into picture. Suppose that assessee's father suffering with leprosy, right, sir, or having handicapped the percentage more than 40%, right? So they can claim deduction under section 80DD. Assessee can claim deduction under section 80DD. Clear, ma? So this is applicable to the resident individuals, Indian or foreign citizen, and resident HUFs. The deduction allowable is flat amount of 75,000. Whenever you find the word flat, so irrespective of the actual expenditure incurred. Right, sir. Suppose that if you incurred an expenditure of 10,000 only, if it is a normal disability, you can claim up to 75,000 flat amount. If it is a severe disability, you can claim up to 1,25,000 flat amount. Okay, now, right? So you can see here, ma, who is a dependent? In the case of individual, spouse, children, parents, brothers and sisters, HUF, any member of the HUF are the dependents. What is a disability? Blindness, low vision, leprosy. Just now I've given you example. Hearing impairment, locomotor's disability, that is a disability of the bones, joints and muscles, and mental retardation. These are covered under the disabilities. Clear. What is a normal disability? A person suffering from not less than 40% of any disability as certified by the medical authority. So 40% to 79% normal disability. Severe disability means 80% to 100%. Okay, now, right? And yes, I've already discussed with respect to normal disability, the deduction allowable flat amount of 75,000, and in the case of the severe disability, a flat amount of 1,25,000. The same provision holds good even under section 80U. The only difference is under section 80U, the assessee is suffering with the disease. Okay, now next. After that, 80DDB, medical treatment for certain specified diseases, right? This is applicable to the individuals and HUFs, and the nature of expenditure must be medical treatment, right? Next. Specified diseases, we have a list here like neurological diseases, cancer, AIDS, chronic renal failure, hemophilia, and thalassemia. These are the some specified diseases under section 80DDB. Okay, now, and the deduction allowable is if the assessee is a senior citizen, expenditure incurred for a senior citizen, 1 lakh or amount actually paid, whichever is lower. Not very senior citizen, 1 lakh or amount paid actually whichever is lower, and normal cases 40,000 or amount actually paid whichever is lower. Okay, now next. Repayment of the loan taken for higher education, interest on educational loan, ADE, E for education. So interest on educational loan. Clear, sir? So that interest amount will be allowed as deduction over a period of totally 8 assessment years. And if in case that educational loan was paid within 8 years, suppose that within 5 years you have completely repaid educational loan, so you can get deduction of interest on educational loan up to 5 years. Okay, now next. ADEE was introduced for the purpose of providing the benefit of interest paid on housing loans. Deduction for interest on loan borrowed for acquisition of the self-occupied house property under section 80EE. Right, sir? And this is in addition to section 24, Amma. In addition to section 24. In section number 24, income from house property, 24 clause A, standard deduction, which is 30% of NAV always, and clause B, interest on loans. Do you remember? Especially with respect to the self-occupied properties, the maximum deduction allowable is 2 lakhs only. Suppose that if you paid an interest of more than 2 lakhs, then what? Right, sir. So that's why ADEE was introduced. You can check out here, sir. Right. So there are certain conditions to be satisfied for the purpose of claiming interest on housing loan as deduction here. Clear, sir. So the maximum deduction allowable here is 50,000 rupees. An individual, only individual summa, this will get this benefit, shall be allowed a deduction of 50,000 in section 80E on account of interest payable on a loan taken by him from any financial institutions for the purpose of acquisition of a residential house property. But the conditions to be satisfied, the loan must have been sanctioned by the bank or financial institution during the previous year 16-17, starting from 1/4/2016 ending with 31st March 2017, and the loan amount sanctioned with respect to the acquisition of the residential house property does not exceed 35 lakhs, and the value of the residential house property shall not exceed 50,000 rupees. Assessee does not own any other residential house property on the date of sanctioning of the loan. If all these conditions are satisfied now, under section 80EE, you can claim a maximum deduction of 50,000 rupees. Okay, now next 80EEA, deduction in respect of the interest payable on loan taken for the acquisition of the residential house property under section 80EEA. Sir, with respect to same, already we have a deduction under section 80EE. 80EE also, you can see the same tagline. But 80EE is an exhaustive section. It is an exhaustive section because this is applicable only for those persons who have taken the loan in between 16 to 17 during this previous year. Suppose that now I would like to take a housing loan during the previous year 20 to 23. Now, can I claim deduction under section 80E? No, I cannot, because this condition is not satisfying. Okay, now. So that's why department comes up with another section for giving this benefit, extending this benefit. So an individual who has taken a loan for the acquisition of their residential house property from any financial institution, then the interest payable such loan would qualify for deduction under this section. And the benefit of deduction under this section would be available from the assessment year 2021 and subsequent assessment years till the repayment of loan continues. Next. Conditions to be satisfied, stamp duty value shall not exceed 45 lakhs. Loan should be sanctioned by the financial institution between 1/4/2019 till 31st March 2012. So means 1920, 2021, 21-22. Within these three previous years, if you have taken any housing loan from a financial institution, you can claim deduction under section 80EEA. Okay, now next. The maximum deduction allowable 1,50,000 number. 1,50,000, and this 1,50,000 is a deduction allowed over and above the deduction available under section 24B. These are all in addition to 24, in addition to 24. Okay, now next. So that's about 80EEB. Next, sorry, 80EEA. Next one, 80EEB. Interest on loan borrowed for the acquisition of a self-occupied house property. 80EEB. How many sections? Already we have section 24 clause B. Then you said 80EE. Then after that you said 80EEA. Now we are saying 80EEB. In how many sections he can claim deduction, with respect to interest on housing loan? See, simple answer, sir. 24 clause B will continue anyhow. 80EE exhaustive section. The date was done. 80EEA also now exhaustive section, because if you want to claim deduction under section 80EEA, the loan must has been sanctioned from 1/4/2019 till 31st March 2022. Date over. Date is over. Now 13th of April 2022 today. The date is over. So now I can say even 80EEA also an exhaustive section. Clear. Now, as on today, if I taken a loan, housing loan for a residential house property, now I can claim deduction under section 24 clause B and then under section 80EEB. Okay, now so conditions, student, Sorry, sir. Sorry, small mistake. Here, the loan should be taken for the purchase of the house property, not for the purchase of the house property, ma, for the purchase of the electric vehicle. Okay, now just sorry, ma. Here the deduction is allowed with respect to the purchase of an electric vehicle. Right. I was given wrongly as self-occupied house property heading. Deduction or for interest on loan borrowed for the acquisition of electric vehicles. Sir. Right, sir. So the loan should be sanctioned during the period between 1/4/2019 to 31st March 2023, and loan should be sanctioned by a financial institution, and the assessee should be an individual. So this concept has been introduced with a view to encourage the usage of the electric vehicles, because of this, the vehicles which are now being run by the petrol and diesel, right? They are polluting the environment heavily. Right, even in Delhi we have seen the concept of odd even number system. One day only the odd number vehicles are to be right allowed into the roads, and the other day only the even number vehicles. The number plate, the last number will decide whether your vehicle is an odd number vehicle or even number vehicle. So in order to reduce the pollution in Delhi city, Delhi CM has taken that particular decision, and of course that be the same case in all the metropolitan cities. So in order to reduce the pollution, to protect the environment, and in order to encourage the electric vehicles usage, the department comes up with this provision. So if we are allowing a deduction, at least for claiming the deductions benefits, they will go for it. Yes or no? Nowadays, the majority of the people are paying LSU premiums only with a view to claim deduction under Section 80C. Nowadays, the people are opting for 5 years fixed deposits only with a view to get the deduction under Section 80C. Are you following, sir? Next, period of benefit, right? So the benefit of deduction allowed under this section available from assessment year 2021 and subsequent assessment years till the repayment of the loan continues. Maximum deduction, interest payable subject to a maximum of 1,50,000 rupees. Okay, now that's ADEEB. So with that, we have completed ADC series, ADD series, ADE series. Now time for the ADG series. Donations, ADG. Totally, we have 4 categories of donations, Amma. 4 category, right? Category 1 donations, category 2 donations, category 3 and category 4 donations. GQA, gross qualifying amount. Gross qualifying amount is nothing but the actual amount donated. Actual amount donated. Next, NQA, net qualifying amount. Net qualifying amount is nothing but 100% of GQA. But when it comes to category 3 and 4 donations, there is a restriction. The aggregate amount of NQA in category 3 and 4 shall not exceed 10% of adjusted total income. Okay, now what do you mean by it? I'll tell you, sir. Now coming to the amount of deduction, category 1, 100% of NQA allowed as deduction. Suppose that if you made category 1 donation 100 rupees, this is your gross qualifying amount. NQA 100% of GQA and again 100 rupees. Amount of deduction 100% of NQA and 100 rupees. So means whatever the donation you have made, that entire amount is eligible for deduction. If it is a category 1 donation. What is category 1 donation? You have a list, a very big list. Category 1, 100% of the deduction of amount donated without any qualifying limit. And you have a list. PM National Nil Fund, PM Scare Fund, right? Like this, you have a list of around 22. Among these, I'll give you some important ones like PM's, Prime Minister's National Relief Fund, Prime Minister's Care Fund, PM Cares Fund, and then National Defense Fund, Then you can have this Swachh Bharat Kosh and Clean Ganga Fund. These are majorly and repetitively asking in the main exam. Okay, now next category 2 donations. Only 50% of deduction of amount donated. Like I'll explain you with the help. Suppose that if we made a donation of some 500 rupees, so your gross qualifying amount 500, net qualifying amount 100% of GQA, and again you will get 500. Deduction 50% of NQA. What is your NQA? 500 into 50 percentage. So the deduction is allowed only 250 rupees. Though you have donated actually 500, the maximum deduction allowable is 250 rupees only. Okay, now so category 2, it covers Prime Minister's Drought Relief Fund, Jawaharlal Nehru Memorial Fund, Indira Gandhi Memorial Fund, and Rajiv Gandhi Foundation. Just try to remember that Gandhi's family. That will be your category 2. Category 3, 100% of the deduction is allowed, but subject to qualifying limit. Right? And what is covering here? Any contribution made by a company as donation to the Indian Olympic Association and government or local authority or approved association for family planning. So try to remember these words: Indian Olympic Association and family planning. Any donations you have made with respect to these two, that is a category 3 donation. Right. Next, category 4, 50% of the amount donated subject to qualifying limit. Again, you have a list: donations made to public or charitable trust institutions, donations made to the government or local authority to be used for any charitable purpose, and donations made to any authority set up for providing housing, accommodation, or tour planning, SC/ST backward classes, and renovation of the notified temple, mosque, church, or gurudwara. For these purposes, if you are giving any donations, then that will be a category 4 donation. Okay, next. Sorry, sir. Yeah, next one. So what is this adjusted total income? We have a format, sir. I've given or not. Yeah, is there? It's there in the material itself. Adjusted total income. Procedure for the computation of adjusted total income. Step number 1: compute the adjusted total income like this. So first take the gross total income. Gross total income, from which deduct all the chapter 6A reductions except 80G. Deduct all the short-term capital gains under section 111A, long-term capital gains under section 112 and 112A. And if any exempted incomes are there, deduct that also. So after making all these adjustments to gross total income, whatever you are going to get is a adjusted total income. Okay, now, right? Next. ATGG rent paid, you have a procedure like rent paid minus 10% of adjusted total income is the point number 1. 20% of adjusted total income, point number 2. Maximum deduction allowed is 5,000 per month, under 60,000. Whichever is lower, eligible for deduction, sir. And then after that, so ATGG, then ATGGC, not that important, GGB, GGC, JJA. From here, the income-based deductions are starting now. Income-based deductions, not at all important from examination point of view, sir. Right? Only one section is important here, that is 80JJAA, providing deductions with respect to the providing additional employment. So try to go through it once. Under income-based deductions, only read out 80JJAA, more than enough, sir. And 80 QQB, 80 RRB, these are all not necessary. Then 80 TDA, from here again, important section starts. 80 TDA, deductions with respect to the interest on savings bank deposits. Right, sir. This is applicable to the individuals and HUFs. Right? The maximum deduction allowed is 10,000 rupees. Okay, now. And 80 TDA applicable only for the normal citizens. If they are a senior citizen, they can claim deduction under section 80 TDB. 80 TDB. Okay, now switch on deduction in respect of interest on deposits. In the case of senior citizens, under section 80TDB. Clear, sir? So here not only savings bank accounts will cover, it also covers fixed deposits also. Interest income on savings bank deposits, fixed deposits, recurring deposits, all these are exempted. Sorry, deductible. See, I can tell you like this. Section 80 TTA, section 80 TTB. Point number 1. This is applicable for the normal citizens. This is applicable for only senior citizens. Number 2. Here only the interest on savings bank account will be eligible for deduction. Interest on savings bank account eligible for deduction. Here interest on savings bank account, fixed deposit account, and a recurring deposit account. Any interest eligible for deduction here. And under section 80 TTA, the maximum deduction allowable is rupees 10,000. But whereas under section 80 TDB, the maximum deduction allowable is rupees 50,000. So these are differences between 80 TDA and 80 TDB. Okay, now Chundama, 80 TDB applicable for the senior citizens, right, sir, whose gross total income including income by way of interest on deposits could be savings bank deposits, fixed deposits, and recurring deposits. Quantum of deduction, actual amount of interest or 50,000, whichever is lower. Okay, now, and then after that 80U, deduction in case of a person with disability. This section I've already told you. If assessee himself having a disease, 80U comes into picture. If dependent having the disease, disability, then 80 DD comes into the picture. Yes or no? Right. That's it, sir. So with that, we have completed chapter 6 deductions marathon also. Okay, sir. So next class, I'll go ahead with the return of income marathon, where we have some amendments in that chapter. Clear, sir? So till then, have a good day and good night. Stay home and stay safe. Bye-bye, sir. A very good morning, students. So welcome to the income tax marathon classes. In the last class, we have completed the discussion regarding chapter 6A deductions. That is deductions from gross total income. Yes or no, sir? Right. Now, let's time for the next chapter, that is return of income. Return of income. So what are we going to learn from this chapter, return of income? So generally, from the chapter return of income, we are going to discuss about who are the persons mandatorily required to file the return of income, to whom it is not mandatory, and what are the different types of returns like belated return, defective return, revised return. Yes or no? So different types of returns also we are going to learn, and after that we are going to discuss about the penalty for non-filing of the return of income or late filing of the return of income. And after that we are going to discuss about the persons who are eligible to verify the return of income. So all these topics we are going to learn from this chapter. Okay, ma. So look at here. First of all, what do you mean by the return of income? Return of income. We can also call it as income tax return. Income tax return or a return of income. It's very simple, sir. After the completion of the previous year, right, sir? So the present previous year, running previous year is 2020 to 23, the running previous year, because as on today, the date is 14th of April 2022. So the running previous year is 22 to 23, but for your examination purposes, the relevant previous year is previous year 21-22. After the completion of the previous year, that means in the assessment year, that is 2022-23, right? So whatever the incomes you have earned, during this particular previous year 2021-22, you have to disclose that income details in a prescribed format. All your income details and all your savings, right, and all your investment details. Then by taking into consideration all your incomes and your savings and your investments, assessee has to find out the total income. Now from the total income, he has to find out the income tax liability, and the tax liability he has to discharge. So filing of the return of income is nothing but disclosing our income details to the department in a prescribed format. And who is prescribing this format? CBDT, Central Board of Direct Taxes, time to time prescribes formats for the disclosure of the income details to the department. Like for salaried individuals, the prescribed document is ITR 1. Income tax return 1. The prescribed document is, right, sir? Income tax return. ITR stands for income tax return. For business associates who are opting for presumptive taxation provisions, ITR 4. Tax audit cases, ITR 3. If you're having salary income, house property income, along with that, you also have agricultural income, ITR 2. So like that, for every specified source of income, right, we have a separate prescribed format for disclosing our details to the department. Clear, sir? Every one of you, right? So filing of return of income is nothing but disclosure of the incomes. So I have the salary income, I have the interest income under that income from other sources. So this is my gross total income. I paid this much of LIC premium, I paid this much of health insurance premium, tuition fees paid, I have a housing loan, so for which I paid the principal repayments, I made this much amount of the donations. So this will be my taxable income, on which this will be the tax liability, and I have discharged my tax liability in the form of TDS and in the form of advance tax and in the form of self-assessment tax. So furnishing of all these details to the department in a prescribed format is what we call filing of return of income. Income tax is a self-assessment tax, ma. Income tax is a self-assessment tax. So the assessee have to calculate his tax liability on his own. Every one of you, right? So assessee has to calculate his total income and has to calculate his tax liability on his own. And after that, he has to furnish all these details in a prescribed format to the department. And that's what we call filing of return of income. Clear, sir? Next. So look at here. So return of income is the format in which the assessee furnishes the information to his as to his total income and tax payable. The format for the filing of returns by the different assessees is notified by the CBDT. So the particulars of income earned under different heads, gross total income, deductions, total income, tax payable by the assessee are generally required to be furnished in a return of income. In short, this is important point. In short, a return of income is declaration of income by the assessee in the prescribed format. That is what I have told you. Are you following, sir? Every one of you, right? And then after that, you have some hierarchy of income tax authorities. That's only given for your knowledge purposes. Then assessees who are required to file the return of income compulsorily, right? So to whom it is mandatory? So companies, partnership firms, including LLPs, whether having a profit or loss or nil income, filing of return of income is mandatory. Irrespective of your total income, sir. Irrespective of your total income. For companies, partnership firms, including LLPs, filing of return of income is compulsory. Are you following, sir? You just look at this example. First example, look at the first example. X Limited, a company, X Private Limited, a company having a total income of 1 lakh. So filing of return of income mandatory. Sir, 1 lakh, total income is just 1 lakh. So that means less than basic exemption limit. If the total income is less than basic exemption limit, filing of return of income is not mandatory. Who said ma? So first of all, what is the basic exemption limit applicable to a company? Tell me, sir. The basic exemption limit applicable to a company is nil, zero. Companies, partnership firms, LLPs, there is no basic exemption limit. Their incomes are taxable at a flat rate. So here X Private Limited having a total income of 1 lakh. So filing of return of income is mandatory. Next, second example, Y Private Limited having a business loss, not an income, it is a loss. Still, filing of return of income is compulsory. Here, he has to file a loss return. Y Limited has to file the loss return. If you remember, we also discussed about the same in the set off and carry forward of losses. For carry forwarding of current year losses to the future years, assessee must have filed the return of loss within the due date given under section 139(1). Yes or no? Right, sir. So even in the case of losses, you have to file the return. It's mandatory. Next. Then third example, ABC & Co, a partnership firm, total income nil, zero, nothing. But still the filing of return of income is mandatory. Here, the partnership firm has to file a nil return. Partnership firm has to file the nil return. By filing the nil return, the firm is disclosing its existence. Yes, we are alive. We are still in the business. Unfortunately, in the last year, due to the COVID pandemic, we were unable to make any business. So our taxable income is nil. Disclosing the same, you have to file the return. So thereby the department will get to know, okay, this partnership firm is still in existence. This partnership firm is still in existence. Are you following or not? Okay, now, so whether you're having an income or a loss or a nil income, a partnership firm, LLPs, companies compulsorily have to file the return of income. It's mandatory. Next. Second one. Individuals, HUFs, AOP, BOI, and other artificial judicial persons whose total income before giving effect to the provisions of Chapter 6A. What do you mean by it? Whose total income before giving effect to the provisions of Chapter 6A. So generally, the format goes like this, right? So we'll take income from salary, income from house property, PGBP, capital gains, income from other sources. This will give you the gross total income from which you will deduct Chapter 6A reductions, and thereby you will get the total income. So total income before giving effect to Chapter 6A reductions means nothing but gross total income. Nothing but gross total income. Are you following, sir? So what is the wordings? Look at the wordings. Total income, though he said total income, but immediately what he said, before giving effect to the provisions of Chapter 6A. So without giving deductions under Chapter 6A, whatever the income is there, what income is there, ma? Gross total income. Which income you are going to have? You are going to have the gross total income. So whose gross total income? You can write here, whose gross total income. Right. So before giving effect to the provisions of Chapter 6A are 54, 54B, 54D, 54EC, 54F, 54G, 54GB, 54G and 54GB. And exemptions amma. Exemptions under section 54. Capital gains lo untayi kadama. Exemptions avi. So individuals, HUFs, AOP, BOI, other artificial persons whose gross total income exceeds the basic exemption limit. So when your gross total income exceeding basic exemption limit, so greater than basic exemption limit, for you filing of the return of income is on, means compulsory. So look at here, ma. Example, look at this example, sir. Mr. X having income from salary 1 lakh and also having a long-term capital gains of 5 lakhs. But of course, he made reinvestments. He purchased a residential house property well within the time limit for the reinvestment. So he claimed the entire 5 lakhs as exemption under section 54. So what is the taxable long-term capital gains? 0. Apart from that, he is also having income from other sources 1 lakh. So income from salary 1 lakh, other sources 1 lakh. So gross total income 2 lakhs. Chapter 6 deductions 50,000. So total income 1,50,000. You can say it here, sir, as you said, the gross total income, sir, gross total income is just here 2 lakhs, which is less than basic exemption limit applicable to individuals, that is 2,50,000. So filing of return of income is not compulsory. But that's wrong. That's wrong. Before giving effect to chapter 6 reductions, ma, are you following? Here gross total income means before giving the exemptions under section 54 series. So you have to calculate like this. You have to calculate like this. So income from salary 1 lakh, long-term capital gains 5 lakhs, other sources 1 lakh. So gross total income 7 lakhs. So your gross total income 7 lakhs, which is greater than the basic exemption limit, that is 2.5 lakhs. So filing of return of income is mandatory. Are you following or not? Every one of you, right? Next. And after that, a person being a resident other than ordinary, not ordinarily resident, means resident and ordinarily resident. The residential status must be resident and ordinarily resident, right, sir? Who is not required to file the return of income? Who is not required to file the return of income? So that means as per the provisions of section 139(1), he is not required to file the return. His gross total income is less than basic exemption limit. But however, if he is a beneficial owner of any asset, including any financial interest in any entity located outside the India, or having signing authority in any account located outside the India. Suppose that I'm a resident and ordinarily resident. My gross total income is less than basic exemption limit. So as per the general provisions, I am not required to file the return of income. But however, if I have any asset located outside the India, or if I have any financial interest, suppose that I'm holding foreign company shares like Bank of America, Microsoft company shares I'm holding. So I'm having a financial interest in a particular entity, or I'm having a signing authority with respect to the bank account or any account located outside the India. So in that scenario, even though I am not required to file the return of income, still I have to file the return of income. As per the provisions of 139(1), I'm not required to, but since you are a beneficial owner of the asset located outside the India, you have a signing authority located outside the India, you should file. It's mandatory for you to file the return of income. Or he is a beneficiary for any asset located outside the India. You are a beneficiary, not a beneficial owner. Beneficial owner means I have a house property outside the India. I am the beneficial owner. Now my son having the rights over that property. He is having the right of enjoying the income over that property. So whatever the income I'm generating out of that house property, my son has every right to enjoy that income. Now my son will be called as a beneficiary, right? So whether you are a beneficial owner or whether you are a beneficiary, right, you have to file the return of income. Clear, sir? See, department here not asking you to pay the taxes. It is only asking you to file the return of income. Clear? Next. Obligation to file the return. This is the latest amendment by the Finance Act 2020, not by Finance Act 2021, for your kind information. Department has made some provisions. Those who are not required to file the return of income, any person other than a company or a firm who is not required to furnish the return under section 139(1) is required to file the income tax return in the prescribed form and manner on or before the due date if such person has deposited an amount or aggregate of the amounts exceeding 1 crore in one or more current accounts maintained with the banking company or a cooperative bank. So in the previous year, if you made any deposits, or aggregate amount of the deposits made by you exceeding 1 crore during the previous year, then filing of return of income is mandatory to you. Clear, sir? So the amount of deposit or aggregate amount of the deposits exceeding 1 crore. Next, second case, he incurred an expenditure of an amount or aggregate amount of amounts exceeding rupees 2 lakhs for himself or any other person for travel to a foreign country. So foreign tour expenses, if during the previous year, if you went to any foreign tour, and if the foreign tour expenses exceeding 2 lakhs, so now for you, filing up the return of income is mandatory. Next, the third one, if he has incurred any expenditure of an amount or aggregate an amount exceeding rupees 1 lakh towards the consumption of electricity, if the total amount of the electricity charges paid by you, exceeding rupees 1 lakh during the previous year, then for you the filing of return of income is mandatory. Very unfortunate situations. Let's see, nowadays, on an average, the electricity bill is touching around 2,000, 3,000 per month. During the summer season, 5,000, 6,000 per month. Yes or no? Suppose that if there is a joint family, a bigger family, right, residing in a like a 2-storied or 3-storied building. So obviously their electricity bill is 8,000, 9,000, 10,000 per month. Even if it is 9,000 per month, 9,000 into 12 months, 1,08,000. So electricity charges paid more than 1 lakh, filing of return of income is compulsory. Yes or no? Right? Next. After that, due date for the filing of return of income. The due dates are mentioned in the Finance Act 2000. In every Finance Act, the due dates will be mentioned, sir. Right? And the due dates are given under section 139, subsection 1. Okay, now. Tax audit cases, earlier the due date is 30th September, but now it is increased to 30th October. In the case of company SSCs, in the case of a person whose accounts are required to be audited, tax audit cases. For companies, always the due date is 31st October. And for tax audit SSCs, always the due date is 31st October. And a partner, earlier the wordings are working partner, only for working partner. But now any partner of a firm whose accounts are required to be audited. If partnership firm books of accounts are required to be tax audit, every partner in that partnership firm, right, sir, the due date will be 31st October for the filing of return of income. Anyhow, per partnership firm, it will be 31st October because their books of accounts are subject to tax audit. So when tax audit provisions applicable to the partnership firm, when the due date becomes 31st October, now for the partners of that partnership firm, also, the due date is 31st October. Okay, now, next. 30th November is applicable for those associates who are engaged into the specified domestic transactions or international transactions. Those who are subject to the file the transfer pricing report under section 92E. 92E. Okay, now. So for them, the due date is 30th November. So look at it here, sir. Yeah. Look at it in the textbook only. So those associates who are subject to file the transfer pricing report, and when it is become mandatory, sir, transfer pricing report becomes mandatory only when you engage into the international transactions or specified domestic transactions. Then filing of the transfer pricing report is mandatory. In that cases, the due date will be 30th November. Remaining in all the cases, 31st July is a due date for the filing of return of income. Clear, sir? Next. Fees for the default and furnishing of the return of income under section 234F. Right, sir. So 234F penalty I've mentioned here already. Late fees under section 234F. So if you file the return of income well within the due date for the filing of return, so the late fees is 0. If you filed in between, right, August to December, so that means up to December, In the case of individuals, it is August to December because the due date will be completed on 31st July. So from the August month till December month, if you file that return, then the late fees payable is 5,000 rupees. And in case if you file in between January to March of the assessment year, January to March, then the late fees payable is 10,000 rupees. Okay, now see, even if you not file the return within the due date, you are allowed to file the belated return. You can file belated return, but with penalty. If you file the belated return up to December, 31st December, the penalty is 5,000 rupees. If you file after December, that is in the month of Jan or Feb or March, then the late fees payable is 10,000 rupees. So after the March, even if you want to pay for 10 lakhs penalty, not allowed. Belated return maximum we can file only up to the end of the assessment year. That's it. Okay, now next. If the total income is less than or equal to 5 lakhs month, the late fees payable is just 1,000. Just 1,000, sir. Okay, now if your total income exceeding 5 lakhs, then only these 5,000, 10,000 limits applicable. If your total income not exceeding 5 lakhs, the late fees is only 1,000 rupees. Okay, now next. Now here comes the different types of returns. First one, loss return under section 139(3). I've already told you, even if you incur losses, you have to file the loss return. Then only that losses can be carried forward to the next years. Clear now? So if any person sustained losses, the following losses in any of the previous year, then such loss can be carried forward and set off only if the person furnishes a return of loss, and that is to well within the due date, on or before the due date specified in section 139(1). So if he is having any losses under the head PGBP, under the head like speculation business loss or specified business loss, capital losses, losses from the activity of owning and maintaining the resources. In order to carry forwarding these losses to the next year, you have to file the return of loss well within the due date. And of course, this loss return concept, 15 minutes. So in the case, the following losses: loss from house property and unabsorbed depreciation. For these two cases, a return of loss is not mandatory, sir. Irrespective of the fact whether you file the return of loss or not, you can carry forward these two losses successfully to the next year. Next. Any return filed under section 139(3) will be treated as a return filed under section 139(1). Return of loss is nothing but your return of income, sir. Next. If an assessee submits the loss return under section 142(1), such losses cannot be carried forward. See, generally 142(1) notice will be given to you only when if you have not filed the return well within the due date. Well within the due date. Suppose that, so for the previous year, the relevant previous year applicable to your examinations, previous year 2021-22. Suppose that assessee Mr. X, individual, now he has to file his return of income as per the provisions of section 139(1) on or before 31st July 2022. Yes or no? So suppose that he has not filed his return well within the due date. Then department immediately will issues a notice under section 142(1). A notice under section 142(1). So it will remind the assessee that your due date for the filing of return of income is completed. But don't worry, we are giving you an additional time period of 7 days or 10 days. Within the time limit mentioned in this notice, you can file your return. But of course, if you file any return which is in response to the notice of under section 142(1), that should be treated as a belated return, sir. Right? So you have not filed your returns well within the due date. You filed a belated return. So the losses, current year losses, cannot be carried forward. Cannot be carried forward. Current year losses. Are you following, sir? Next. And after that, you have a concept of belated return under section 139(4). So belated return, an SSE who has not furnished a return within the time allowed may furnish the return for any previous year at any time before the 3 months prior to the end of the relevant assessment year or before the completion of assessment. Okay, ma, right? So you have the time limit up to 31st of December 2022. Right. So for the previous year 2021-22, before the 3 months prior to the end of the relevant assessment year. Are you following, sir? Every one of you. Or before the completion of assessment, whichever is earlier. Whichever is earlier. Just a second, sir. Sorry, Ma, let's continue. Yeah, here you can see that late fees under section 234F. While we are discussing this, I've told you that this is at present, this is not applicable, sir, right? As the return belated return filing is only possible up to the 31st of December 2022. Right, sir. I've actually used the old notes. That's why this provision also not here, right? So this provision is not applicable now, not applicable, because now we don't have the option of filing the belated return between January to March of the assessment year. You can file only up to the 31st December of the assessment year. So the maximum late fees payable is 5,000 rupees. And if the total income is less than or equal to 5 lakhs, the late fees payable is 1,000 rupees. Okay, now, right? So we have the time limit for the filing of belated return before 3 months, clearly mentioned, before 3 months, right, prior to the end of the relevant assessment year. So that means for the relevant previous year 2021-22, the maximum time limit up to which you can file your belated return is 31st of December 2022 only. 31st of December 2022 only. Right, sir. So that's why in the notes also you can eliminate this part, right? This notes actually I've used for December 2021 attempt. That's why this part is also there for May 2022 attempt, right? So this third part is not there as the Jan to March provision has been removed. Clear. Now the belated return can be filed only up to 31st of December. Clear, sir. Next. After that, revised return. So what do you mean by the revised return? So once an SSE filed the return, and after filing of the return, he comes to know that there are some mistakes, there are some errors, omissions, right, sir? Now, in order to rectify that mistakes, in order to overcome that omissions, for the rectification of that errors, he can file a revised return, absolutely no problem. In the place of the original return, we can file a revised return. By revising the original return, he is filing a return. So that is why it is called as a revised return. Clear, sir? So an SSE having filed a return under section 139(1) or a belated return discovers an omission or mistakes in the return file, he could file a revised return at any time before the 3 months prior to the end of the relevant assessment year, that is up to 31st December, or completion of the assessment by the department, whichever is earlier. Right, sir? So that means before the 3 months prior to the end of the relevant assessment year, or before the completion of assessment by the department, whichever is earlier. That's the time limit for the filing of the revised return, sir. Same as belated return. Same as belated return. Even in the belated return also, we have studied the same time limit. We have seen the same time limit. Now, even in the revised return also, the time limit is same. Clear, sir? Right? Sir, even in the revised return, I filed a revised return. Even in that revised return also, I found some mistakes. Now, can I file a second revised return by rectifying the mistakes in first revised return? Yes, you can do so. You can do so, absolutely no problem. Can a revised return be revised? Absolutely yes. Absolutely yes. See, n number of times you can revise the return but that revision should be happen well within the time limit. Before the 3 months prior to the end of the assessment year or before the completion of assessment, whichever is earlier. Clear now? Next, can a belated return be revised? Yes. Even a belated return can also be revised. Next, can a lost return be revised? Yes, again, even lost returns can also be revised. Next, a return filed in response to notice under section 147 or 153A cannot be revised. 147, income escapement assessment. Income escapement assessment. 153A, search and seizure. So if you file any return in responses to the notice under section 147 or 153A, such returns cannot be revised. Okay, now after that, next concept, defective return under section 139 subsection 9. Defective returns means, sir, at the time of filing of the return of income, you have to enclose some statements, you have to furnish some important details, documents, like for company SSCs or for tax audit cases. While filing the tax audit return, he has to attach the tax audit report, which is issued by the tax auditor. For audited financial statements, profit and loss account, balance sheet, notes to accounts, computation of income, and the details of the proof of payment of taxes, proof of the payment of advance tax, proof of payment of the self-assessment tax. All these details have been attached, enclosed for your return of income. Suppose that you forgot to enclose them. Without enclosing the documents, without attaching some annexures, you have filed your return. Without filling up details in some columns, you have filed your return. Right, sir? Then first, the department will give you an opportunity for rectifying that mistakes. It will give you a notice, dear SSC, you forgot to attach your audited financial statements. So herewith, I'm giving you 15 days time limit. Within this 15 days, please attach the audited financial statements. Dear SSC, you forgot to attach the tax auditor's report, which is issued under form number 3CB 3CD. So within 15 days, the department will give you 15 days time limit, sir. Within that 15 days, you have to rectify that mistakes. If you come up with the rectification within the 15 days, your return will be treated as a valid return. Otherwise, your return will be treated as a defective return. Chundamma, the assessing officer may intimate the defect in the return to the assessee, and within 15 days or extended time limit, the assessee may be asked to rectify the defect. If not rectified, then it will be treated as invalid return. Belated rectification. You made rectification, sir, but not within the 15 days time limit. You have taken some 25 days. Then you have to provide the reasons for the belated rectification. If the assessing officer is satisfied with the reasons, then your return will be treated as a valid return. Okay, now. And after that, you will be having some returns of different persons like trust, political parties, associations. They are not that important, sir. And after that, you have the PAN number concept, right, sir? So for every SSC, filing of the return of income is mandatory. And at the time of filing of the return of income, quoting of the PAN number is mandatory. So in case if a minor not having the PAN number, then the minor has to quote the PAN number of his parents. Clear? Guardian. I can say guardian. Okay, now next. This actually, there is a latest amendment, sir. Date of intimation Aadhaar number to the prescribed authority extended from 30th September to 30th September, and it is further extended to 31st of March 2022. Right, sir? Even linking of the PAN number to the Aadhaar number, right? Linking the PAN to the Aadhaar, the due date also extended up to 31st March 2022. After which, failing which, you are subject to the pay the penalty of 1,000 rupees. Okay, now. And after that, transactions requiring the PAN number coding. This transactions only for your knowledge purpose. Just have a single reading. Minor to quote the PAN of the parent or guardian. I've already explained you. And quoting of the Aadhaar number. Aadhaar number is mandatory, sir. right? You have to quote the Aadhaar number while filing the return of income. If you fails to do so, your return will not be validated. Sir, in case if you don't have the Aadhaar number with you, you have not been applied for it, don't worry. Go to any other facilitation centers, apply for the Aadhaar card. They will give you an enrollment number, and that enrollment number you can quote. By quoting that enrollment number, you can file your return. And once you got the Aadhaar, then intimate the Aadhaar details to the department. Okay, now next. TRP concept, not that important. Yeah, this is important. Return to be signed by whom? Return to be verified by whom? See, at the time of filing of the return, the last step of the filing of the return is e-verification. Olden days, we used to take the printout of the acknowledgement copies, hard copy. We have to get it signed by the client, and then we have to send them to the Bangalore CPC, Central Processing Cell. Now, e-filing is mandatory. E-filing is mandatory. So the verification should also be done online only, e-verification. Right, sir? You have many options for e-verifications. Aadhaar based OTP, like then after that internet banking, you can go for the e-verification, or even you can walk to any nearest ATM centers. There also you can do the e-verification of your income tax return. By using the digital signatures also, you can e-verify your return. There are many ways, right, sir? When it comes to the individuals, who are the authorized person to e-verify his return? Individual himself, right, sir? See, when I am filing my return of income, I am the person to verify my return. Yes or no? In case if he is absent from India, still the individual himself can verify the return. See, even if you are absent from India, where you are going? You are going to the God. You are going to the space. Even in the space also, you have network. Online filing, kada. You can e-verify from anywhere in India. Anywhere, even outside the India. Okay, now. So in case if the individual person is unable to e-verify, don't worry. Any person duly authorized by him can e-verify the return. Right. In case if he is a mentally incapacitated person, the guardian can verify the return, or any other prescribed person, competent authority. For any other reason, if it is not possible to verify the return, then any person duly authorized by him on this in this behalf, holding a valid power of attorney, then that authorized person can file the return, can verify the return. Okay, now HUF, basically the Karta of the HUF has to verify the return of the income. In case if the Karta is absent from India, or he is mentally incapacitated, then any other adult member of the HUF, that adult member can be a male. This adult member can be a male, can be a female. Even a female adult member of the family can e-verify the return of the HUF. Okay, now coming to the companies. For companies, managing director is a person to verify the return. In case if there is no managing director in that company, there is no MD, or due to some unavoidable reasons he is unable to e-verify the return, then any director of the company, or we have a latest amendment, any other person as may be prescribed for this purpose. Suppose that if the company is under liquidation, so liquidator is a duly authorized person to e-verify the return of the company. Or if the company is went into insolvency, right, sir? So as per the provisions of the Insolvency Act, the company, the ROC or the department, the government will appoint some a prescribed officer for dealing with that insolvency case. That prescribed officer can e-verify the return of that company. Okay, now, right? So this is latest amendment. Any other person for this purpose, you can see here in the statutory guidelines. This is the latest statutory guidelines applicable for May 2022, right? Given by the ICI, sir. Here you can see any other person prescribed for the verification of the return of income in case of a company or LLP, right, sir? And here you can see in the case of a company, right, managing director thereof to verify the return of income, sir. In case if any unavoidable reasons or there is no managing director, then any director of the company or any person, this is the latest amendment prescribed for this purpose. And in the case of LLP, same provisions. Designated partner of the LLP has to verify the return. If there is no designated partner, then in that case, any partner of the LLP or any other person, of the LLP, prescribed officer can be verified the return, sir. Are you following, sir? Every one of you, right? Here, any other person means the ICI has given some clarification. These are the people are called as any other person, covered under any other person. You can see here, the CBDT has given a clarification specifying that any other person means, right, referred to in section 140 C and 140 CD, shall be the person appointed by the adjudicating authority, that is National Company Law Tribunal, right, and for discharging the duties of the functions of interim resolution professional or a resolution professional or a liquidator, right, sir? So these people are covered under any other person category, every one of you. Okay, next. So like this, you will be having a list, sir. So that's the latest amendment in relation to the partnership, LLP and companies, sir. Look at the LLP, sir. LLP. LLP. So designated partners are required to be e-verify the return of LLPs here. In case there is no designated partner or due to unavoidable reasons he is unable to e-verify the return of LLP, then any partner of the LLP or any other person as may be prescribed for this purpose. Clear, sir? That's the latest amendment from this chapter. And yes, with this we can complete it all the theory topics of this chapter, all the latest amendments also. And yet another latest amendment is that the last date for the intimating of Aadhaar number for the purposes of linking the Aadhaar with the PAN has been extended from 30th June 2021 to 31st March 2022. Okay, ma, right? So that's the latest amendment. Clear? So now with this, we have completed the marathon of return of income chapter. So in the next session, I'll come up with the TDS and TCS. TDS and TCS, yet another very important chapter. Till then, have a good day and good night. Stay home and stay safe. A very good morning, students. So welcome to the income tax marathon classes. In the last class, we have completed the discussion regarding the return of income chapter provisions. Okay, ma. Now let's move on to the yet another very important chapter from income tax, that is TCS and TDS. TDS and TCS, tax deduction at source and tax collection at source. Okay, ma. So generally, the department will collect the taxes from the assessees in the different forms, like in the form of advance tax during the previous year itself, in the form of TDS and TCS. These also during the previous year itself in the majority of the cases. And the third one, self-assessment of tax. Self-assessment tax paid by the assessee. So these are the different forms from which the department will collect the taxes. Right, sir? So in that, the very important part is TDS and TCS. Clear, sir? See here we have different sections, right, of ranging from section 192 and ends with section 194Q, a new section introduced by the Finance Act 2021. TDS and TCS chapter is a very important chapter. In every exam attempt, you are getting one question compulsory, ma. Since last 4-5 exam attempts, if you have taken, ma, right, you are getting one question compulsory from this chapter for 5 marks, a minimum of 5 marks, maximum 8 marks, because this chapter contains the amendments in every Finance Act. In every finance act, you can find the amendments from this chapter. And whenever there is an amendment, definitely the ICI will look into that particular chapter for giving a question, because ICI always tests whether the student is updating with the latest provisions or not. So ICI wants the updated knowledge students, not the outdated knowledge students. Are you following, sir? So you have to keep on updating yourself for writing the taxation paper. Clear? Now look at the basics of TDS and TCS. Who are the payer and who are the payee? Who is having the responsibilities towards TDS? Right. So look at this, a small example, a basic example. Let us see. Mr. X is the employer and Mr. Y is the employee. So Mr. Y is working in the company of Mr. X. X employer, Y employee. So X is paying 1 lakh per month salary to Mr. Y. 1 lakh per month salary. Right, sir? So now the X becomes payer. He is paying, right? So X paying the money to Mr. Y. X becomes the payer and Y becomes payee, recipient. Y becomes payee, or we can call recipient. Okay, ma. So payer means the person who paying the amount. Payee means the person who receiving the amount. Clear? Next. Now here, with respect to TDS, it is the responsibility of the payer. It is the responsibility of the payer. Payer responsible for deduction of the TDS and payer responsible for remittance the same to the department. So payer, he will be having two obligations here. He has to deduct the TDS and he has to remit the same to the income tax department. And fails to do so, he is subject to the disallowances under section 40 small a. 40 small a disallowances comes into picture. Regarding the 40 small a, we have already studied in the PGBP chapter. Yes or no? Right, sir. Okay. Next. So in case if Mr. X fails to do so, the entire expenditure would be disallowed under section 40 small a, and at the same time is also subject to the interest, penalty, late fees, and sometimes imprisonment also. So defaults with respect to the TDS, the employer is subject to all this. The payer is subject to all this. He has to pay the interest for the delay in deduction of TDS and as well as delay in remittance of TDS. He's also subject to the penalties, subject to the late fees, and also sometimes subject to the imprisonment. Clear? Since the payer responsible for deduction of TDS and remittance of the TDS, and he is subject to all this if he made any default in relation to the TDS. Clear, sir? So these are the basics regarding the TDS, right? So here you can see payer being the person who is deducting tax at source is responsible for interest, penalty, and prosecution in respect of the defaults committed. Clear? And after that, you have some range of sections. First one, like TDS on salaries, right, sir? So it is a responsibility of the employer who is paying the salary to the employees. He has to deduct the TDS at the average rate of income tax computed on the base of the rates in force. See, generally for all of the TDS sections, the rate of TDS will be mentioned like this. 192A, the rate of TDS 10%. 193, rate of TDS 10%. Like this in every TDS section, you can see, ma. 194A, the rate of TDS is 10%. In every TDS section, you will be find the rate of TDS. But whereas when it comes to section 192, the rate of TDS was not mentioned. Average rate of tax. All right. I've given an example here. Section 192 TDS and salaries. Mr. X is an employer, payer. X is an employee, payee. So total income, let it be some 10 lakhs rupees, right? And tax liability 1,17,000. So now you need to find out the average rate of tax. What is the formula? We have studied in the very first chapter. Average rate of tax. The total tax payable divided by the total income into 100. So the average rate of tax 11.7%. So salary per month 1 lakh. So TDS under section 192, 1 lakh into 11.7%. So 11,700 per month, the TDS is to be deducted. So find out the average rate of tax, apply the same on salary payable, then you'll get the TDS to be deducted from the salary under section 192. Clear now? Next. So do we have any payments or exempted incomes from the TDS? See, all the allowances, to the extent they are exempted, you have to ignore while calculating TDS, and also all the perquisites which are exempted shall be excluded. Okay now. And then see, here I'm going to discuss only the important sections as it is a marathon class. So 192 important, and then you can go for interest on securities. So try to remember the rate of TDS 10%. Now these provisions are not applicable because these provisions are given only for relief during COVID pandemic situation. COVID pandemic period. Only for the previous year 2020-21, you have only the 75% of original rate of TDS. Original rate of TDS lo 75% pay cheste chalama, and that provision is applicable only for the previous year 2020-21, not for all the previous years. Right, you can see here with effect from 14th of May 2020 to 31st March 2021. Right, sir. So during the COVID pandemic period, in order to reduce the burden of TDS, the government comes up with a notification of 75% of original rate of TDS, but that provision has been exhausted. Clear now? Next. After that, 194A, interest other than interest on securities. Here it covers interest on savings deposits, interest on recurring deposits, interest on fixed deposits, interest on deposits with post office. All this will be covered, ma. All this will be covered. Are you following, sir? Right. So generally in the normal SSEs, the threshold limit is 40,000 rupees. That means up to 40,000 rupees of interest, there is no need to deduct the TDS. But whereas in the case of the senior citizens, very senior citizens, the threshold limit increased to 5,000 rupees. Sorry, 50,000 rupees. The threshold limit increased to 50,000 rupees. Are you following, sir? And the rate of TDS 10%. And you have to ignore just the concessional rate of TDS. Just ignore. Just ignore. Are you following, sir? Every one of you. Right? Next. So, and these provisions are applicable to all the persons except individuals and HUFs whose turnover is less than or equal to 1 crore or 50 lakhs during the preceding financial year. That means whose books of accounts are not subject to tax audit. See, if their books of accounts are subject to tax audit, 194A applicable. If their books of accounts are not subject to tax audit, that individual, that HUF is not required to deduct any TDS under section 194A. Okay, now next. 194B, as you know, winnings from lotteries, betting, crossword puzzle, card games. So the rate of TDS 30%, and you have a threshold limit only 10,000 rupees. That means as long as your winnings are less than or equal to 10,000, no TDS will be applicable. No TDS will be applicable. When your winnings exceeding 10,000 rupees, flat 30% rate is applicable. 194BB, winnings from horse races, same provision, threshold limit 10,000, the rate of TDS 30%. And then after that, 194C, TDS on contract payments, TDS on contract payments. Clear, sir? And the threshold limit with respect to single sum 30,000 rupees, with respect to aggregate of sums created 1 lakh rupee. See, during the previous year, if you made a single amount to that contractor, you entered into a single contract, and after the completion of that contract, you are paying 30,000 or less, TDS is not attracted. No, sir. We have entered into series of contracts with him, more than one contract with him. We have made the payment more than one time during the previous year. Then you have to see the aggregate amount of the payments. If the aggregate amount of the payments exceeded 1 lakh, then TDS under section 194C applicable. Otherwise, TDS under section 194C not applicable. Clear, sir? Every one of you. Next. And 194C provisions applicable to all the SSCs. But when it comes to the individuals and HUFs, 194C provisions are applicable only when their books of accounts are subject to tax audit. Means their turnover should exceed 1 crore during the preceding financial year, or 50 lakhs in the case of the profession. In the case of the profession. Are you following, sir? And I would like to make an important point here. I guess during this marathon lectures, while I'm discussing the provisions of PGBP, right, and when it comes to the tax audit provisions, right? We have seen that when it comes to the business, the tax audit ceiling limit is 1 crore. If you opted for present to taxation, tax audit ceiling limit is 2 crores. And there is a new provision we have already studied, right? So in case if the total cash payments are less than or equal to 5% of the total payments, total cash receipts are less than or equal to 5% of the total cash receipts, right? If these conditions are satisfied, there is an enhanced threshold limit of 5 crores. Now that's been increased to 10 crores. Now the enhanced threshold limit is 10 crores. Those who satisfied their cash receipts and cash payments condition, right? In my marathon lectures, I might have considered only 5 crores, right? I beg your pardon. So make it to 10 crores. Make it to 10 crores. Now that revised the limit of 10 crores. Those associates who are satisfying the cash payments and cash receipts condition. Clear, sir? Next, come back. So for individuals and HUFs, right, AOP, BY, they are required to deduct the TDS only when they are subject to tax audit. Otherwise, not required to deduct the TDS under section 194C. Clear, sir? And the rate of TDS, just try to remember the original rates. Ignore the remaining thing. 1%, and here also 2%. If the contractor is happen to be individual or HUF, the payee is happen to be individual or HUF, the rate of TDS 1%. Other than individual or HUF, the rate of TDS is 2%. Clear, ma? Every one of you? Right. So look at the running notes here regarding 194C. Yeah, here it is, 194C. So we have some exceptions also regarding 194C, right? This last column discussed about the exceptions, right? The situations where TDS provisions are not applicable, right, sir? You can see here, any sum credited or paid to a contractor in a transport business who owns less than or equal to 10 vehicles at any time during the previous year, if the contractor furnishes the PAN to the person paying or crediting such sum. So for which I've given the running notes here. X Limited, the payer, and Navata Road Transports, payee. So from Navata Road Transports, X Limited received the services of transportation of the goods, GTA services. Navata Road Transports engaged in the business of GTA, Goods Transporting Agency. So we have received the services from Navata Road Transports in relation to the transportation of goods. Now we need to make the payment of consideration. Now while paying this consideration, are we required to deduct the TDS? First of all, look at how many number of vehicles owned by Navata Road Transports. Sir, Navata Road Transport owning less than or equal to 10 vehicles. Okay. Whether that payee furnished the PAN to the payer? Yes, sir. Then in that case, there is no need to deduct the TDS under section 194C. No need to deduct the TDS. So those persons who are engaged in the business of transport, and if they are owning less than or equal to 10 vehicles and furnish as the PAN, then no need to deduct the TDS. Next, look at here. Second example, second exception. Any sum creditor paid by an individual or HUF exclusively for personal purposes of such individual or HUF. Look at this example. Mr. X is a payer and Shakti Road Transporters, right? Again, we have received the GTA services, right? Transportation of the goods. And here we are receiving these services for our personal purposes. For our personal purposes. Sir, I got job in Chhattisgarh. Earlier, I used to be there in Hyderabad. Now from Hyderabad to Chhattisgarh, right, sir? For transporting my household goods, I've entered into a contract with Happy Packers and Movers. Happy Packers and Movers. And they have taken me around 70,000 from me for providing these services. For providing the services of packaging, right? Loading, unloading, and movement of the goods. For all these services, they have taken 70,000 from me for transporting all the household goods from Hyderabad to Chhattisgarh, Korba. So here I have also received the GTA services, but for my personal purposes. Now in this situation, do I need to deduct the TDS? Answer is no, not required to deduct the TDS. Okay now. And after that, we have some provisions, right? Some exceptions also. You can see here, ETV television channel, right? And it is receiving the services from Mallemala Entertainments. production house. Mallemala Entertainments is a production house. You're observing the programs like Jabardast, Extra Jabardast, right, sir? Cash. All these are like Mallemala Entertainments programs. Okay, now, right? Now here, Mallemala Entertainments designing a program, right? So here ETV giving the specifications, program specifications and requirements. So I want a program like this. So here the payer is giving specifications regarding a particular program according to the specifications and requirements of the television channel. This production house is programming or designing a program and giving back to the television channel. Now this is a contract. Now this contract is subject to TDS under section 194C. Now look at one more example. Ma TV, another television channel. Oak Entertainments. You can see the owner of this Oak Entertainments, Omkar. Yes or no? Oak Entertainments. So it's also a production house. You can see the programs like there are so many programs of Oak Entertainments, like some Super Jodi, some kind of programs are coming. No, all the reality shows of the Ma TV, majority of the reality shows of the Ma television channel is designed by the Omkar. Super Jodi, and then after that some kids programs designed by Oak Entertainments. Yes or no? So 1 second, there is a program. 1 second, right, sir? So all these programs is designed by the Oak Entertainments, right? These are all already designed programs. See here, Ma TV is not giving any requirements or specification in relation to a program. He already designed some programs, so ready-made programs. For purchasing these ready-made programs, it becomes a contract of sale, so 194C not applicable. See, look at the differences between the example number 4 and 5. In example number 4, the channel is giving the specifications, requirements. So I want the program like this. So according to the specifications and requirements, the production house is designing the program and giving back. So it's a contract, right, sir? But whereas in the example number 5, it's purely a purchasing of a program, a ready-made program, contract of sale. So 194C not applicable. Clear, ma'am? Next. 194D, TDS and insurance commission. Threshold limit, you can see 15,000 rupees, and the rate of TDS 5%. Okay, now. Then 194H, TDS and commission and brokerage. The threshold limit 15,000 and the rate of TDS 5%. 194I, important provision. 194I, TDS and rent. TDS and rent. And the threshold limit you can see here 2,40,000 rupees. 2,40,000 rupees. And this is applicable to all the persons except individuals and HUFs whose books of accounts are not subject to tax audit. If their books of accounts are subject to tax audit, TDS under section 194I is to be deductible. Otherwise, TDS under section 194I not to be deducted by that individual or HUFs. Okay, ma'am. And for plant and machinery and equipment, the rate of TDS 2%. Ignore the concessional rate of TDS that's been exhausted. And for land, building, furniture and fixtures, the rate of TDS is 10%. Okay, ma'am. Every one of you. Next. So look at this example, ma'am. ABC Limited is a tenant. He is a payer who paying the rent to the owner. Rent per month 30,000. That means 3,60,000 per annum. Exceeded the threshold limit of 2,40,000. So hence, Mr. ABC Limited is subject to the deduction of TDS under section 194I. And this is a building. No, the rate of TDS is 10%. So 30,000 into 10%, 3,000. So net rent payable to the owner 27,000. And whatever the TDS deducted 3,000, that should be remitted to the department. Okay, now next. Co-ownership concept here. When it comes to the co-owners, whatever the rent amount they are receiving, if the rent amount, right? See here, the rent amount is 6 lakhs, ma, which is greater than 2,40,000, which is greater than 2,40,000, right, sir? Greater than threshold limit. Are you following, sir? Every one of you. See here, can we deduct the TDS under section 194I? No. See, if the assessee is a single owner, yes. If the assessee is a single owner, yes. 6 lakhs is the rent amount which is more than the threshold limit of 2,40,000, that single owner has to deduct the TDS. Whereas it is a co-ownership concept. Every owner is receiving 2 lakhs income, rental income, 2 lakhs rental income. So which is less than threshold limit. Less than threshold limit. So 194I not applicable. Clear ma? So when it comes to the threshold limit of 194I and when it comes to the co-owners, you have to apply individually the threshold limit to individual co-owner. Clear ma? Next. After that, 194IA payment on transfer of certain immovable properties. So threshold limit is 50 lakhs, right? And the rate of TDS is 1%. Clear, sir? You can see here. 194IA, Mr. X is a seller, payee. He transferred a house property to Mr. Y, buyer, payer. Will also a payer because buyer is the person who has to pay the consideration to seller. So if the consideration amount is greater than 50 lakhs rupees, then TDS under section 194A applicable. Clear, sir? Every one of you. And TDS at the rate of 1%. Clear? Next. And then after that, 194IB, TDS on rent again. TDS on rent again. So already TDS on rent we have seen on 194I. What is this 194IB? 194IB is applicable to the individuals or HUFs whose books of accounts are not subject to tax audit. See, if subject to tax audit, 194I applicable. Not subject to tax audit, 194IB is applicable. 194IB is applicable. Every one of you following now, right? You can see here 194IB. Individuals HUFs, if the turnover of the business is greater than 1 crore or gross receipts from profession greater than 50 lakhs during the previous year. If answer is yes, TDS and rent 194I comes into picture. If the answer is no, so during the previous year, the individual's turnover is less than 1 crore. The individual's professional receipts less than 50 lakhs. TDS and rent comes into picture with the provisions of 194IB. 194IB TDS provisions applicable to such individual or HUF. Clear now? And what is the rate of TDS? Here the threshold limit is 50,000 for a month or a part of a month. So 50,000 per month, right? Or a part of a month means yearly 6 lakhs on it. Yearly 6 lakhs. But of course, here you should not apply the yearly threshold limit. You should apply monthly threshold limit. Monthly threshold limit. Okay, now the rate of TDS is 5%. Ignore this 3.75% as this is a concessional rate of TDS, but that is applicable only for 2021. 2021 already completed. Now we are in 21-22. The rate of TDS, original rate of TDS applicable 5%. Okay, now next. Generally, when should we deduct the TDS? There are two situations, Amma. Case 1, where the property is owned for 12 months. Now, in that scenario, the rate of TDS, the TDS to be deducted in the last month, sir. So from the April to February month, no need to deduct TDS under section 194I, right? But for all the 12 months of TDS, all the 12 months of TDS should be deducted in the last month. Clear now? You can see here example, 60,000 per month is the rent. So that means which is greater than threshold limit of 50,000 per month. Now here Mr. X is subject to deduct the TDS under section 194IB, but need not to be required to be deduct the TDS every month. All the TDS, all the 12 months TDS should be deducted from the last month rent. Look at this example. April to February, he has to pay 60,000 per month to the owner. Now in the month of March, rent amount is 6,000. The TDS amount 7,20,000 into 5%. 7,20,000 into 5%. So it comes to 36,000 rupees. So last month rent 60,000, from which 36,000 the rent should be deducted, sir. Rent should be deducted. So rent paid to the owner in the last month, it comes to be 24,000. Okay, now. So if the property is occupied for 12 months, it was let out for 12 months. First 11 months, no TDS should be deducted, but all the 12 months rent should be deducted from the last month rent. Okay, now you will get a doubt here. Sir, in case if the tenant vacated the property during the previous year, then Look at this example. The tenant vacated the property on 31st of December 2020. And 9 months. The property is under vacancy only for 9 months. Now in that scenario, what you have to do is first 8 months, that means from April to November, you can pay the rent to the owner without TDS. Full amount of rent you can pay. Now in the month of December, right, the 9th month, the last month, you have to deduct the TDS. Are you following, sir? Every one of you. Next, that is 194 IB. Next, then 194J, yet another very important section. Totally here, 5 payments will be covered, Amma. You can see here. I've given the notes. 194J. Payments covered here. Fees for professional services, fees for technical services, royalty, non-compete fees, and director sitting fees. All these 5 payments are covered under section 194J. And the threshold limits are first 4 items: fees for professional services, fees for technical services, royalty, non-compete fees. In these 4 cases, the threshold limit is 30,000 rupees per annum. These limits are per annum, not per month, per annum. Okay now. So, and next, and these threshold limits you should apply individually, individually. 30,000 for professional services, 30,000 for technical services, 30,000 for royalty, and 30,000 for non-compete fees. But whereas when it comes to the director sitting fees, there is no threshold limit. And even if you pay 10,000 director sitting fee, you have to deduct the TDS under section 194J. Even if you pay 1,000 rupees as director sitting fees, you need to deduct the TDS under section 194J. Are you following or not? Every one of you. Okay, now next. Sir, 194J provisions applicable to all the assessees, but when it comes to the individuals and HUFs, you have to look after whether the turnover exceeding 1 crore during the previous year, in the case of excuse me, in the case of a previous year business, and if the gross receipts exceeding 50 lakhs in the case of the profession during the preceding previous year. If the answer is yes, TDS under section 194J applicable. Are you following, sir? Every one of you. Fees for professional services, fees for technical services, TDS is to be deducted. Right, sir? And look at here, ma. Individuals and HUFs are not required to deduct the TDS and at source under section 194J on royalty, non-compete fees, and payment to director of a company. That is why I've covered here like this. If that individual's turnover exceeding the threshold limits means subject to tax audit, then 194J applicable to them, but they need to deduct the TDS only with respect to professional services and technical services. Royalty, non-compete fees, director's remuneration is not covered here when it comes to individuals and HUFs. Okay, now next. Sir, if that individuals and HUFs are not subject to tax audit during the preceding previous year, then 194J not applicable on all the 5 payments, but 194M comes into picture. 194M. Are you following now? Every one of you, right? So now look at here 194J, and the threshold limit I've already told you 30,000, except your director sitting fees, and the rate of TDS 2% when it comes to the business of call center and 10% with respect to other payees. So 194J, the rate of TDS is 10%. Okay, now next. After that, 194M. So payments to contractors, commissioner brokerage, fees for professional services. So for payment to contractors, 194C is already there. Commission and brokerage, 194H is already there. Fees for professional services, 194J is already there. Why again 194M? Mom, 194C, 194H, 194J applicable to all the assessees, but when it comes to individuals and HUFs, that respective sections are applicable only when their books of accounts are subject to tax audit during the preceding previous year. In case if their books of accounts are not subject to tax audit during the preceding financial year, then still payment to contractors are subject to TDS, commission brokerage subject to TDS, fees for professionals are subject to TDS, but not under the sections of 194C, H, and J, but under the sections of 194M. So 194M is applicable to those individuals or HUFs who are other than those who are required to deduct the TDS under section 194C, H or J. See, if 194C provisions are applicable to them, deduct the TDS under section 194C only. If not applicable to them, come to 194M and deduct as per the provisions of 194M. Okay now, but you can see here the higher threshold limit of 50 lakhs. 50 lakhs. Clear now. So look at here, ma. Individuals and HUFs whose turnover greater than 1 crore, right, with respect to business, and gross receipts greater than 50 lakhs with respect to profession during the preceding financial year. If the answer for that question is yes, individuals and HUFs are subject to deduct the TDS under section 194C, H and J. No, if the answer for that question is no, they have to deduct the TDS as per the provisions of 194M. So one should be very, very careful here. Okay, now next. And the rate of TDS 5%. Ignore this concessional rate. Now the original rate of TDS only applicable. Then 194N, TDS on cash withdrawals. TDS on cash withdrawals. Up to 1 crore of cash withdrawal, there is no TDS, ma. Right? Right. The aggregate amount of the withdrawals made during the previous year. If exceeding 1 crore, then he is subject to TDS, ma. Clear. The payer, banking company or any banking institution, cooperative society, payee could be any person. The rate of TDS is 2% of the sum exceeding 1 crore. Look at this provision, sir. 194N. Right. So this is applicable to the cash withdrawals, right, during the current previous year. Clear, sir. So 194N, we have a note point, note number 5. We will see that. Yeah. So TDS under section 194N would not be applied if the limit does not exceed 1 crore. That means you have not withdrawn more than 1 crore during the previous year. Clear, sir. And next. So these TDS provisions under section 194N not applicable if the payment is made to government or any banking company or a business correspondent. These are some exceptions. You just go through it. For all these people, the TDS under section 194N provisions are not applicable. Next. Next. If the recipient has not furnished the returns of income for all the 3 assessment years relevant to the 3 previous years for which the time limit for the filing of return of under section 139(1) has expired immediately during the previous year in which the payment of the sum is made, the TDS shall be deducted in the following manner. The amount of withdrawal is more than 20 lakhs but up to 1 crore. The rate of TDS is 2%. Amount of withdrawal is more than 1 crore, 5%. Okay, now, and I also given the example here. You just go through that example. In case of the individual, say the relevant previous year is 21-22. In respect of the assessment years 19-20, 20-21, 21-22 means the relevant previous year becomes 18-19, 19-20, 20-21. Right, sir? See, when your relevant previous year is 2021-22, the 3 preceding previous years becomes 2020-21, 2019-20, 2018-19. These are the 3 preceding previous years. Okay, now, in case if these 3 preceding previous years, he has not furnished his return of income within the time limit. Okay, now, and during the financial year 21-22, the bank has paid 50 lakhs in cash. Okay, now, right now, in this scenario, in the case of the HUF, the similar provisions prevails during the previous year 21-22, and the amount paid in cash to it by 120 lakhs. Okay, now in that cases, the modified threshold limits on TDS rates applicable. So the bank has to deduct the TDS. In the case of the individual, 50 lakhs cash paid kadama, up to 20 lakhs, no TDS provisions are applicable. In excess of 20 lakhs, how much is there? 30 lakhs. So into rate of TDS 2%, the banker has to deduct the TDS 60,000 rupees. When it comes to the HUFs, right? So in between 20 lakhs to 1 crore, the rate of TDS 2%. So 20 lakhs to 1 crore and the difference amount 80 lakhs into 2%. And in excess of 1 crore, the rate of TDS 5%. 20 lakhs into 5%. Okay, ma. So 2,60,000 here, the bank has to deduct the TDS under section 194N. Okay, now next. And after that, come back. $194 TDS on domestic company dividends. The rate of TDS applicable is 10% ma, and dividend paid or aggregate amount of dividends paid is up to 5,000. The threshold limit is 5,000. If the total amount of dividends paid exceeding 5,000 rupees, then the company has to deduct the TDS at the rate of 10%. At the rate of 10%. Okay, now that's also a new section. And 194K TDS on income in respect to units. Look at this example, sir. SBI mutual funds, the payer, right? And Mr. X invested into this particular unit of mutual funds. Whenever SBI paying the income on such mutual funds, and if the income exceeding 50,000 rupees, then TDS under section 194K applicable. Look at here, sir. Sorry, the threshold limit is 5,000 rupees, not 50,000. Threshold limit is 5,000 rupees, right? And the rate of TDS applicable 10%. This concessional rate you just ignore. The rate of TDS is 10%. Okay, now next. And after that, 194O, TDS on payments made by an e-commerce operator. Here the payer could be e-commerce operator, like whoever operating an e-commerce platform for the facilitating of the business, right? Like Amazon, Flipkart, Myntra, Jabang, and all the food service portals like Swiggy, Zomato, all the travel servicing portals like Make My Trip, Uber, Ola. These are all comes under e-commerce operators examples, right, sir? And the rate of TDS is applicable 1% of the gross amount. Just ignore this concessional rate. In case of the failure to furnish the PAN, the maximum rate of TDS is 5%. Okay, now next. No TDS if all the following conditions are satisfied, like the e-commerce participant is an individual or HUF. So this e-commerce operator facilities are being utilized by an individual or HUF, and the gross amount of such sale of goods or services are both during the previous year up to 5 lakhs. And the e-commerce participant has furnished his PAN or Aadhaar number to the e-commerce operator. Suppose that I am an individual person, sir. I'm an individual professional person. Suppose that I am registered with Just Dial. It is also an e-commerce portal, Just Dial, right, sir? And I'm registering in that Just Dial, right? I've taken some golden membership, and I'm providing the professional services. And the total amount of services provided by me through that e-commerce platform is less than 5 lakhs. And I furnished all my PAN details to the e-commerce operator. Now I'm an individual. The services provided by me less than 5 lakhs, and I provided PAN details to the e-commerce operator. All the three conditions are satisfied. Now in this situation, the e-commerce operator should not deduct any TDS under section 194O. Are you following or not? Okay, now so look at here. Amazon.in e-commerce operator, right? And local suppliers. And these local suppliers, by using these facilities of Amazon.in, they are supplying the goods. Yesterday, I ordered a watch, a smartwatch, right, sir? I ordered a smartwatch. And who is supplying that smartwatch? Whether Amazon is manufacturing that smartwatch and is supplying? No. The local supplier is there. That local after it receiving the order, that order will be given to the local supplier. That local supplier will deliver at the Amazon facility center. Then Amazon facility center will pack it and everything. Then that will be sent back to the customer. Yes or no? Right, sir. So here the e-commerce participants, the local suppliers, e-commerce operator, the payer. Here for rendering the services, it will take certain commission. It will take certain commission. Clear now, right? So here the rate of TDS how much, amma? 1% of the gross amount, not on commission, ma. Gross amount. In this example, right, that 1% TDS has to be applicable on the 10 lakhs rupees, every one of you. Okay, now look at this also example. Urban company, yet another e-commerce operator, where you can find all kinds of services, right? See, there is some electrical issues in your house. You can just open the Urban Company app. Now in that app, you can find the nearest all the repairers of the electricity items, right? You can find a repairer, right? And immediately you can place that particular contract of service. When you require an electrician, you just open an Urban Company, right? It will provide you all the electrician details near you. You can select one electrician, or you can just make a request. Then that Urban Company automatically will give you a time slot, right? And select the time slot. In that time slot, an electrician will come to your house and will look after all the electricity works. This kind of facility is there. You need a plumber. You just open an Urban Company app and provide that I need a plumber services regarding this particular in my house, and book a time slot. At that time slot, a plumber will come and will do all the works. Right, sir? That's the beauty of the Urban Company. Clear. Now, Mr. X is a professional chartered accountant. He is receiving, he is registered in that Urban Company app. He's registered in that Urban Company app. Now, through that app, he is providing the fees for professional services. Okay, now here totally 50,000 worth of services provided. Now, when Urban Company remitting the same to that Mr. X, on the gross amount, on the 50,000 rupees, the TDS is to be deducted, not at 0.75%. Now it is 1%. That means 500 rupees. Okay, now 0.75 is the concessional rate of TDS that is applicable only for 2021. Right, from 21-22 onwards, the original rate of TDS is applicable. Clear, everyone? Okay, now next. And next, 194P. This is a new section, latest amendment by Finance Act 2021. 194P. You can see here statutory guidelines. This is a material issued by the ICI statutory guidelines. In this, you can see section 194P. Are you following, sir? 194Q is yet another new section introduced by the Finance Act 2021. Now, first look at the 194P. So here the incomes covered pension along with the interest on bank. Clear, sir? Pension amount along with the interest on bank. And you can see here the threshold limit, the total income for the assessment year after giving effect to the deductions allowable under Chapter 6A and rebate allowable under Section 87A. Right. So here this 194P provisions is applicable only for those individuals, right? Right, they have used the word here specified senior citizens. Specified senior citizens. Rather, I can write here for your convenience. Section 194P. Incomes covered here. Number one, pension, and as well as interest income, like interest on savings bank account, interest on fixed deposits account, interest on recurring deposits account. These are the incomes covered under section 194P subject to TDS, and 194P provisions are applicable only for specified senior citizens. Specified senior citizens. Who are the specified senior citizens? Means the persons who are having the age of greater than or equal to 75 years and who is having the pension income, right, and as well as interest income, and these two are credited to the same bank account. Credited to the same bank account. Right, sir? These two incomes must be credited to the same bank account, sir. Clear one, right? So the payer could be the notified specified bank, and specified senior citizen. Payee must be specified senior citizen. Means an individual being a resident in India, right, who is of the age of 75 years or more at any time during the previous year, having the pension income and no other income except the exempt kadamma, except, make a change every one of you, except interest income received. Okay, now so he must be having only pension income and interest income. That's it. Clear. and interest income received or receivable from any account maintained by such individual in the same specified bank in which he is receiving the pension income and has furnished a declaration to the specified bank. See, first of all, here you can see the pension amount and interest amount should be credited to the same bank account. His age should be greater than or equal to 75 years and he should not be having any other income. Should not have any other income. Should not have any other income, right? And he should furnish a declaration to the bank. He should furnish a declaration to the bank regarding his pension income and as well as interest income. Clear? Now, in this scenario, the banker will find out the total income of such specified senior citizen. The banker will find out the tax liability of that specified senior citizen. And then banker has to deduct the TDS accordingly. Has to deduct the TDS accordingly. Now, in this scenario, sir, in this scenario, there is no requirement of filing of the written off income by such specified senior citizen. See, if all the above conditions are satisfied, means his age should be greater than or equal to 75 years. He is having only pension income and interest income, and the two incomes are crediting to the same bank account, and he is not having any other income apart from these two. He furnished a declaration to the bank with respect to the same, and the banker calculated the total income and tax liability of the senior citizen, and he has deducted the TDS. If all these conditions are satisfied, then there is no mandatory requirement of to that specified senior citizen for the filing of written off income. Not required to file any written off income, sir. Are you following or not? Next. Sir, what is a rate of TDS at the rates in force? The general rates applicable, the general slab rates applicable, the general flat rate is applicable. Of course, he's an individual, no? Obviously, slab rates are applicable to him. Right, sir? Right? So the general slab rates applicable. As per that particular slab rates, the TDS should be deducted, sir. Every one of you. Okay, now, next. That's 194P, right? And look at the amendment. What is amendment here we are having? Notification of specified bank and manner of computing the total income and deduction of the TDS under section 194P. Section 194P requires deduction of tax at source on the basis of the rates in force by a specified bank being a banking company as notified by the central government on the total income of the specified senior citizen for the relevant assessment year, computed after giving effect to all the chapter 6 reductions and a rebate. Clear? Accordingly, CBDT notified specified bank mean a banking company which is a scheduled bank. CBDT given a clarification. What do you mean by the notified specified bank? It is given a clarification that it means it is a banking company which is a scheduled bank and has been appointed as a agents of the RBI. Clear? Now, specified senior citizen is exempted from filing the written off income for the assessment year relevant to the previous year in which the tax has been deducted under section 194B. Clear? This point I've already told you. Now, specified senior citizen means an individual being a resident in India whose is age of the 75 years or more at any time and having only a pension income, and he should have no other income except interest income received or receivable from any account maintained by such individuals in the same specified bank. And he has furnished a declaration to the specified bank containing such particulars. Clear, everyone? Okay, now, next. Guidelines under section 194Q. A new section introduced by the Finance Act. You can see here, the Finance Act 2021 has inserted a new section under section 194Q, which is effective from the 1st July 2021. 1st July 2021. Okay, now. So 194 Q. Come here. Section 194Q, a new section. First point, it is a new section introduced by the Finance Act 2021. Second point, and this is came into effective from 1st July 2021, with effect from 1st July 2021, and when it is applicable. You can see here, right? This is a TDS on purchase of the goods. TDS on purchase of the goods, where the consideration paid for such a purchase of the goods is more than 50 lakhs in a previous year. You purchase the goods. Okay, now, right? Let's discuss with the example. Just give me a second. Right. Look at this example, sir. Or else let me take a new page for this. Look at here, my section 194Q. This is a new section introduced by the Finance Act 2021. And this came into effective from 1st July 2021. Okay, sir. Now, look at here example. Mr. X sold goods to Mr. Y. Sold goods worth rupees, say, let us say 80 lakhs rupees. So now Mr. X is a seller, Mr. Y is a buyer. Right, sir. And here look at the provisions. So if the amount of the consideration paid for such goods is more than 50 lakhs in a previous year, now the buyer is responsible for paying any sum to resident for purchase of the goods. The buyer means a buyer whose total sales or gross receipts or turnover from the business exceeds 10 crores during the financial year immediately preceding the financial year in which the purchase of the goods is carried out. So that means this is applicable only for those buyers whose total turnover or gross receipts exceeding 10 crores during the preceding financial year. Let me continue with my example. Sir, here buyer, the relevant previous year is 2021-22, means preceding financial year becomes 2020-21. Now you need to see during this previous year what is his turnover. If his turnover exceeding 10 crores during the preceding financial year, now for the current previous year 194Q provisions are applicable to such buyer. 194Q provisions are applicable to such buyer. Okay, now assuming that during the preceding financial year, that is 2020-21, his turnover is greater than 10 crores. His turnover is greater than 10 crores. Now Mr. Y has to deduct the TDS here. Right, sir. Now, while he is paying the amount to Mr. X, consideration amount, right? Now, here how much is paying? 80 lakhs. But we have a threshold limit. The threshold limit under section 194Q, 50 lakhs. Okay, now here the TDS provisions are applicable only for exceeding 50 lakhs. Right. So in this case, 80 lakhs amount, na, the TDS provisions are applicable only on 30 lakhs. Look at this. The rate of TDS is 0.1% of the sum exceeding 50 lakhs. Of the sum exceeding 50 lakhs. Are you following, sir? So, out of this 80 lakhs, get the 50 lakhs, the threshold limit, only 30 lakhs is a amount which is subject to TDS. 0.5%, sorry, 0.1%. 30 lakhs into 0.1%. Calculate cheyandamma ఎంత వస్తుంది? 3,000 rupees you will get, sir. So while remitting the 80 lakhs from this 3,000 should be deducted in the form of TDS. So only 79 lakhs 97,000 should be paid. this 3000 TDS should be deducted under section 194Q. Every one of you. Okay, now this is a base provision, sir. So for those buyers whose total turnover or gross receipts exceeding rupees 10 crores during the preceding financial year, for them in the current financial year, this 194Q provisions are applicable. Whenever they are making the payment of consideration in relation to the purchase of goods, if exceeding 50 lakhs, that excess portion of 50 lakhs, the TDS should be deducted at the rate of 0.1%. Okay, ma'am. Next. Sir, when the TDS should be deducted? At the time of credit of such sum to the account of the payee or at the time of payment, whichever is earlier. Right? So at the time of credit or payment, whichever is earlier. So at that time, the TDS should be deducted under section 194Q. Okay, now. And let us see, do we have any note points regarding this? Not given, but under statutory guidelines, you can see, sir, you have a lot of discussion here. So this came into effect from 1st July 2021. It applies to any buyer who is responsible for paying any sum to any resident seller. The seller must be resident for the purchase of any goods of the value or aggregate value exceeding 50 lakhs in any of the previous year. The buyer at the time of credit of such sum to the account of the seller or at the time of payment, whichever is earlier, is required to deduct the TDS an amount equal to 0.1% of such sum exceeding 50 lakhs. Clear? Now, what do you mean by the buyer here? Buyer means a person whose sales or gross receipts from the business carried on by him exceeding 10 crores during the financial year immediately preceding the financial year in which the goods are carried out. Clear? Clear, sir. Next. After that, next guidelines, applicability of the transactions carried on through the various exchanges, stock exchanges, various, like you can apply here stock exchanges, commodity exchanges, right, sir? See, whenever you're making a transaction in the stock exchanges, suppose that today I purchased the shares worth 60 lakhs. 60 lakhs. So during the preceding financial year, my turnover is more than 10 crores. Now, am I required to deduct the TDS under section 194Q on this transaction? Answer is no. Not applicable. Why? Do you know who is the seller? See, whenever you are purchasing the shares from exchanges, stock exchanges, can you identify the person from whom you are buying? Is it possible? No, absolutely not possible. See, when you're buying from a person directly, yes, okay, I'm purchasing from that person. I can easily say he is my seller. But when I'm purchasing through an exchange, stock exchange, you don't know from whom you are purchasing. The stock exchange is settling the transactions, yes or no? Right? So that's why there is 194Q provisions are not applicable in the case of the transactions carried out through the various stock exchanges. Chudandamma, there are practical difficulties in implementing the provisions of TDS under section 194Q in case of certain exchanges and clearing corporations. In these transactions, sometimes there is no one-to-one contract between the buyer and sellers. In order to remove such difficulties, it is provided that the provisions of 194Q shall not be applicable in relation to the transactions in securities and commodities which are traded to recognized stock exchanges, and transactions in electricity, renewable energy certificates and energy saving certificates traded through the registered power exchanges. Okay, now next, calculation of threshold for financial year 21-22. Right, sir. Now, sir, here look at some examples. Look at some examples. Example number one. Example number one. Sir, Mr. X is a buyer. During the previous year, 2020-21, his turnover is greater than 10 crores. That means during the current previous year, during the current previous year, that is 2021-22, for him 194Q provisions are applicable. 194Q provisions are applicable, right, sir? Now, from 1st April 2021 till 30th June 2021, right, sir? You can see during this time period whether 194Q in existence. No, because 194Q comes into the picture only from 1st July 2021 onwards. Its effectiveness is from 1st July 2021 onwards. So that means whatever the turnover, whatever the consideration you have paid for the purchase of goods during this time period, 194Q provisions not applicable. Even if the consideration paid amount is, even though the consideration paid amount is greater than 50 lakhs, because we all know that with effective from 1st July 2021 only 194Q provisions are comes into picture. Every one of you following now, all of you. Next, sir, now with effective from 1st July 2021 onwards, yes, from 1st July 2021 till 31st March 2022, till 31st March 2022, yes, 194Q provisions applicable. 194Q provisions applicable. Every one of you following now. Clear, sir? Next. Sir, now let me give you some examples. Turnover up to 30th June 2021. Turnover up to, or in between I can say turnover from 1st July 2021 to 31st March 2022. Okay, now, so turnover up to 2020, 30th June 2021, let us say some 20 lakhs, right? See, during the preceding financial year, that is 2020-21, his turnover greater than 10 crores. That's by default. You make an assumption his turnover is greater than 10 crores. Okay, ma'am, every one of you, right? And now turnover up to 30th June 2021 is 20 lakhs. Turnover from 1st July 2021 to 31st March 2022, let us say some 30 lakhs. Now, what is the TDS under section 194Q? What is the TDS under section 194Q? TDS under section 194Q. Answer, not applicable, because the amount of the consideration paid not exceeded 50 lakhs. Not exceeded 50 lakhs. 20 plus 30, 50 lakhs, not applicable, sir. Even if it is exactly equal to 50 lakhs, okay, no, not applicable. Next, turnover achieved, let us say 40 lakhs and up to 30th June 2021, right, sir? Leda, for your clarity, I can write like this: turnover from 1st April 2021 till 30th June 2021. Okay, 40 lakhs, and turnover from 1st July 2021 till 31st March 2022. Let us say some 30 lakhs again. 30 lakhs again. You can see here the total turnover during the previous year 70 lakhs, means exceeding 50 lakhs. Sorry, not turnover, amma, consideration paid. Consideration paid for the purchases. consideration paid for the purchase. The total consideration paid amount is 70 lakhs here, and more than 50 lakhs. TDS under section 194Q applicable on how much? On the entire amount of 70 lakhs? No. Here the TDS is equal to, in excess of 50 lakhs, how much amount is there? 20 lakhs into 0.1 percentage. 20 lakhs into 0.1 percentage. TDS is equal to 2000 rupees. Now you will get a doubt here. Sir, as you said, like in this example, whatever the consideration paid in between 1/4/2021 till 30th June 2021, right? 194Q provisions not applicable. Yes, not applicable. Not applicable. See here, am I deducting any TDS on this 40 lakhs? No, I'm not deducting, sir. I'm not deducting any TDS on this 40 lakhs. Whatever the turnover achieved during this period, not subject to TDS. I'm not deducting any TDS on this consideration paid. I am deducting TDS only in between these periods consideration paid. Clear? Sir, here for the purposes of calculation of the TDS, the consideration paid during this period not to be considered, but for the calculation of threshold limit of 50 lakhs, yes, it has to be considered. It has to be considered. So 40 plus 30, 70 lakhs. So the consideration paid exceeding 50 lakhs. So TDS provisions applicable. For the applicability of 194Q, for the calculation of threshold limit, the turnover achieved during this period should be considered. But for the calculation of TDS, only the turnover of this period should be considered. The consideration paid from 1st July 2021 should be considered. Are you following or not? I'll give you one more example, sir. So turnover during the previous year exceeding 10 crores, that is by default. Exceeding 10 crores. And consideration paid from 1/4/2021 till 30th June 2021. Let us say some 80 lakhs rupees. And consideration paid from 1st July 2021 till 31st March 2022, 50 lakhs rupees. Now, what is the TDS amount? Sir, 80 lakhs plus 50 lakhs, 130 lakhs. TDS provisions applicable here under section 194Q. And the TDS is 50 lakhs into 0.1 percentage, 5,000 rupees. 5,000 rupees. See here, on 130 lakhs, I'm not remitting TDS. I'm not deducting TDS. And even in excess of 50 lakhs, in excess of 50 lakhs, 80 lakhs on the total consideration paid by you is 30 lakhs. And we have a threshold limit of 50 lakhs. So in excess of 50 lakhs, 80 lakhs on the. So 80 lakhs into 0.1 percentage, 8,000 rupees. This is a wrong calculation. So when you're calculating TDS on 80 lakhs, that means you also including the consideration paid during this period. You should not do that. Right, sir? For calculating threshold limit only, for verification of the applicability of 194Q to the SSU only, the consideration paid during this period should be considered. For the calculation of TDS, only the turnover achieved, the consideration paid during this period should be considered. Okay, now, so you can see here on this 80 lakhs, the consideration paid during this period, I have not deducted any TDS. Only on this 50 lakhs, I have deducted TDS. Every one of you following now? Clear? These are some important points in relation to section 194Q. Next. So you can see here, 194Q has come into effect from 1st July 2021. Accordingly, as regards the manner of computation of threshold limits, computation of threshold limit 50 lakhs specified in this section, it is clarified that since the threshold limit of 50 lakhs is with respect to the previous year, for the full previous year, so calculation of sum for triggering TDS under section 194Q shall be computed from 1st April 2021. Hence, if a person being the buyer has already created or paid 50 lakhs or more up to 30th June 2021 to a seller, TDS under section 194Q shall apply on all creditor payment during the previous year on or after 1st April to the 1st July 2021 to such seller. As regards whether tax is required to be deducted in respect of advance paid before 1st July 2021 and some credited thereafter, it is clarified that since section 194Q mandates the buyer to deduct the TDS on credit of such amount account of the seller or on payment may offset sum, whichever is earlier, the provisions of this section shall not apply to any sum credited before 1st July 2021. With respect to the advances which you have received prior to the 1st July 2021, on such advances, there is no need to deduct the TDS under section 194Q. Okay, now, every one of you. Next. If either of the two events, what are the two events? Either time of credit or actual payment. Right? If either of the two events had happened before 1st July 2021, that transaction would not be subject to the TDS under section 194Q. Clear? Next. Adjustment for GST and purchase returns. Right, sir? As regards whether the adjustment is required to be made for GST or purchase returns for the purpose of TDS under section 194Q, it was clarified that no adjustment on account of GST is required to be made for the collection of tax under section 206C1H, since the collection is made with reference to the receipt of the amount of the sales consideration. Right, sir? See here only on the gross, the amount of which without TDS, the TDS should be applied. TCS provision should be applicable. Right now, GST amount need not be adjusted for the calculation of TCS and for the calculation of TDS. The situation is different so far as to the TDS concern. You can see here, wherever in terms of the agreement or contract between the payer and payee, the component of GST and services comprised an amount payable to a resident is indicated separately. The tax shall be deducted its source on the amount paid or payable without including such GST and services component. Sir, if GST component specifically mentioned separately, like example, sir, the consideration paid or payable, let us say some 60 lakhs, right? And IGST at the rate of 18%, 10 lakh 80,000. Total invoice value 70 lakh 80,000. So the total consideration you are paying to the seller 70 lakh 80,000. But here the TDS provisions are applicable only on the consideration payable. Only on 60 lakhs 194Q provisions applicable. On this GST portion, 194Q provisions are not applicable. Are you following, sir? Right? But this provision is applicable only when the GST portion mentioned in the invoice separately. Next. GST for these purposes shall include IGST, CGST, SGST, and everything. Okay, that's a common provision. Accordingly, with respect to TDS under section 194Q, it is clarified that when the tax deducted at the time of credit of the amount on account of the seller in terms of agreement or contract between the buyer and seller, the component of GST comprised in that amount payable to the seller is indicated separately. The tax shall be deducted on the amount created without including such GST. Okay, now next. However, if the tax is deducted on payment basis, right? Suppose that you have received an advance after 1st July 2021. After 1st July 2021, 194Q applicable on advances. See, if you received before that, 194Q not applicable. But if you received after that, 194Q provisions applicable. After 1st July 2021, 194Q provisions applicable. Now, in this case, look at here. The tax is deducted on payment basis because the payment is earlier than credit. Then the tax would be deducted on the whole amount, total amount, because as it is not possible to identify that the payment with GST component and the amount to be invoiced in future. You don't know, right? In the future, what will be the invoice amount? What will be the GST component? You don't know at the time of payment of advances, right, sir? In that case, the TDS should be deducted on the whole amount. Next, with respect to the purchase returns, it is clarified that the tax is required to be deducted at the time of payment or credit, whichever is earlier. Thus, before purchase return happens, the tax amount must have already been deducted under section 194Q on that purchases. Yes, at the time of original purchase, the tax must have already been deducted. After deducting the TDS only, you might have paid the consideration to the seller. Now, if that is the case, and against the this purchase return, the money is refunded by the seller. Yes, whenever you're returning certain goods, you will get the refund of consideration from the seller. Then this tax deducted may be adjusted against the next tax purchases against the same seller. Are you following, sir? Let us say you purchased goods worth some 70 lakhs, on which the TDS is deducted under section 194Q at the rate of 0.1%, which comes to 7,000 rupees. Later on, out of the 70,000, 10 lakhs worth of goods you have returned, and this 10 lakhs you have received as a refund from the seller. Now, what about the TDS with respect to this 10 lakhs, sir? 194Q TDS at the rate of 1%, which comes to 1,000 rupees. See, after the purchase returns, the total consideration paid becomes 60 lakhs, on which the TDS is supposed to be deducted 6,000 only, but you have already deducted 7,000. So excess deduction of 1,000, this should be adjusted against to the next purchase. If you purchase the goods from the same seller in the future, that future purchases, against to that future purchases, this 1,000 will be adjusted, ma'am. This 1,000 will be adjusted. Are you following or not? Every one of you. Next. That's the provision was mentioned, sir. It may be adjusted against the next purchase against the same seller. No adjustment is required if the purchase return is replaced by the goods. Means you have returned certain goods, but with respect to the same, you have received new goods, right? You have not been refunded the amount, you have get a new goods. In that case, no adjustment is required, sir. Okay, now, next, whether non-resident can be buyer under section 194Q, right? Sir, here 194Q provisions are applicable, right? So even to the non-resident buyer, you can see here, whether the provisions of 194, sorry, not applicable, not applicable. You can see here, 194Q would apply to a buyer being a non-resident. Whether the provisions of 194Q would apply to a buyer being a non-resident. It is clarified that the provisions of 194Q shall not apply to a non-resident who purchase of the goods from the seller resident in India, right? Is not effectively connected with the permanent establishment of such non-resident in India. Clear, sir? For this purpose, permanent establishment means shall mean to include a fixed place of business through which the business of enterprise wholly or partly carries on. See, if that non-resident having a permanent establishment in India and the seller having some connection to that personal permanent establishment, yes, 194Q applicable. But if that non-resident not having any permanent establishment in India or having permanent establishment, but the seller not having connection with that permanent establishment, then that 194Q provision is not applicable to such non-residents. Next. Whether the tax is to be deducted when the seller is a person whose income is exempted. Answer is not applicable, sir. Chudandamma. It is clarified that the provisions of 194Q would not apply on purchase of goods from a person being a seller who is a person exempt from tax. Clear, sir. Next. With respect to section 206C1H, it is clarified that the provisions thereof would not apply to the sale of a goods to a person being a buyer who is a person exempt from income tax. Clear, sir. Next. But here, these exemption provisions, these exceptional provisions are applicable to that seller, that buyer, only when their income is fully exempted. You can see the above clarifications would not apply only if a part of the income is exempted. If their full income is exempted, no 194Q, no 206C1H applicable. But if there only a part of the income is exempted, but 194Q, 206CH full applicable. Next. Whether the tax is to be deducted on advance payment. See here, it is clarified that since the provisions apply on payment or credit, whichever is earlier, the provisions of section 194Q shall apply. Applicable. But if the advance amount is received before the 1st July 2021, not applicable. After 1st July 2021, applicable. Next. Whether the provisions of section 194Q shall apply to a buyer in the year of incorporation. Answer is not applicable, sir. Suppose that, example, you can see here, during the previous year 2021-22 itself, he commenced his business operations. Right, sir? Now, for these provisions of 194Q, whether for the previous year 21-22, whether 194Q provisions are applicable, and the answer is no, because the preceding previous year the preceding previous year means 2020-21. Now, during this preceding previous year, what is his turnover? His turnover is nil, zero, because in the year 2021, he was not carried out any business. And during this preceding previous year, his turnover not exceeded 10 crores. Hence, 194Q provisions not applicable. So for the year of incorporation of the business, 194Q provisions are not applicable. Chundama. So 194Q shall apply to a buyer in the year of incorporation. Whether it is applicable or not, it is clarified. A buyer is required to have a total sales turnover from a business carried on by him exceeding 10 crores during the financial year immediately preceding financial year. Since this condition would not be satisfied in the year of incorporation, the provisions of section 194Q not applicable. Next, whether the provisions of 194Q shall apply to a buyer if the turnover from the business is rupees 10 crores or less. Answer is no, sir, not applicable. Right? See, a buyer should be having the total turnover of gross receipts exceeding 10 crores. Are you following, sir? Then only 194Q provisions are applicable. Right? If the total turnover gross receipts is not exceeding 10 crores or less, it is clarified that for the purpose of section 194Q, a buyer is required to have a total sales turnover gross receipts in the period exceeding 10 crores during the financial year immediately preceding. Hence, the sales at turnover in the calendar does not exceed. Not exceeding 10 crores, not applicable. Exceeding 10 crores, applicable. Okay, now. Next. Cross applications of 194O, 206C, 1H, and 194Q. Right, sir. Now, here, sir, in between 206C, 1H, and 194Q, like, sir, you can see for a same situation, whether 206C, 1H, and 194Q provisions applicable. Right, means, look at here, sir. Suppose that Mr. X is a buyer, Mr. Y is a seller. So Mr. X purchased the goods worth some 80 lakhs. Now X is required to deduct the TDS under section 194Q at the rate of 0.1%. Now Y is required to deduct the TCS. X is required to deduct the TDS. For him, TDS provisions applicable. Now for seller, TCS provisions applicable under section 206C1H. Right, sir. Now for the same situation, TDS provisions and TCS provisions are applicable. So whenever there is a situation existing, 194Q provisions prevails. So the buyer is subject to deduct the TDS under section 194Q. Seller is not required to deduct the TCS. Seller is not required to deduct the TCS under section 206C1H. Are you following, sir? Every one of you. You can see here. Just a second, sir. Look at here, look at here. So whenever there is both a transaction is covered under section 194O and 194Q, right, sir? In that scenario, 194O prevails, right, sir? Right. If the tax has been deducted by the e-commerce operator on a transaction under section 194O, the transaction shall not be subject to 194Q. You can see if a transaction is both within the purview of 194O and 194Q, the tax shall be required to deduct under section 194O and not under section 194Q. Now apply the same logic here. In case if a transaction covers both 194O and 206C1H TCS, in this scenario, sir, it is clarified the primary responsibility is on the e-commerce operator to deduct the TDS under section 194O. In that scenario, 206C provisions not applicable. Clear? Next, sir, in case if a transaction falls both within the purview of 194Q and 206C1H. Now, in that scenario, the tax is required to be deducted under section 194Q. The transaction shall be come out of the purview of the section 206C1H. Okay, right? So whenever the two sections are applicable, 194Q prevails. Clear? Next, but of course, if the TCS is required to be deducted by other sections other than 206C1H, right, sir? Other sections of 206C, then 194Q not prevails. The other sections of 206C prevails. Are you following, sir? Like, I'll show you here. TCS provisions. Yeah, here too, TCS provisions. You can see tax collection at source under section 206C, right? And here you can find the different sections, 206C 1G, 206C 1H. Clear? So if the TCS is happened to be deducted under these sections, TCS is happened to be deducted under section 206C, right? 1A, 1B, 1C, 1D, or 206 1G, right? In that scenario, you know, the 194Q provisions not applicable, sir. See, 194Q provisions and 206C1H provisions. If a conflict arises between these two, 194Q prevails. The buyer has to deduct the TDS under section 194Q. Every one of you following now. Next, other than 206C provisions are applicable now, then that other than 206C provisions prevails, 194Q not prevails. Right? Next. That's it, sir. These are the statutory guidelines from this TDS and TCS chapter. So with this, we have covered all the provisions, important provisions from this chapter, sir. Right? So with that, I'm concluding this income tax marathon classes, right? So we have covered all the 5 heads of income marathon classes. Then we have covered setup and carry forward of losses, chapter 6A deductions, return of income, and TDS and TCS provisions. And I have covered 9 chapters marathon classes. And all these 9 chapters are very important for doing problems on total income chapter. Right? So problems on total income, you don't have any theory, only problems you'll have. And but doing all the problems, whatever the content you required, I've covered in marathon classes. So technically speaking, 10 chapters marathon classes are covered, ma. Every one of you, right? Out of 17 chapters. Clear? And out of the 17 chapters, 17 chapters is a miscellaneous concepts. Miscellaneous concepts. And residential status I've covered into the 2 parts. Residential status part 1, part 2. Like, technically speaking, only 15 chapters, out of which 10 chapters I've covered, and almost 70% of the portion covered in marathon syllabus. Clear now? Every one of you. Okay, right? Including the amendments covered. So I wish you very all the best for May 2022 examinations. I've already given GST marathon classes and now income tax marathon classes, right? So the entire taxation subject marathon completed now. Almost we have taken around approximately 24 hours. 24 hours. Clear? So I would like to see you again in CF final. Hope you will all comes up with a good marks and ranks in CA inter examination. I wish you very all the best. So see you in the next session. Till then, have a good day and good night. Stay home and stay safe.